Benjamin Graham was living in the south of France, retired, with his lady friend, and translating Greek and Latin classics. That was a favorite avocation. The prescript of security analysis, the forbidding black Bible of security analysts, is from Horace. Many shall be restored that are now fallen, and many shall fall that are now in honor. I hadn't known him, but I had written some sentences about him in the money game. Graham, I had written, was the dean of our profession, if security analysis can be said to be a profession. The reason that Graham is the undisputed dean is that before him there was no profession, and after him they began to call it that. Graham liked being called the dean. He corrected, in Greek, a sentence in my book that no one had checked, and one or two other references. He said he had something in mind to discuss when he came to New York. Shortly thereafter, he did appear in New York, to see a publisher about his translation of Aeschylus, and to see his grandchildren. I asked him what he thought of the market. Hoc etiam transivit, he said. This too shall pass. Graham said he wanted me to work on the next edition of The Intelligent Investor, the popular version of his textbook. There are only two people I would ask to do this, he said. You are one, and Warren Buffett is the other. Who's Warren Buffett? I asked. A natural question. In 1970, Warren Buffett wasn't known outside of Omaha, Nebraska, or Ben Graham's circle of friends. Today, Warren is so well known that when newspapers mention him, they sometimes need no phrase in apposition to identify him. Or if they do, they simply say, the investor. There are full-length biographies on the shelves. He is indeed the investor, one of the best in history. Investing has made him the second richest person in the country, behind his bridge buddy Bill Gates. Even in 1970, Warren had an outstanding investment record, and with an unfashionable technique. He had started an investment partnership in 1956 with $105,000 from friends and relatives. When he terminated the partnership in 1969, it had $105 million and had compounded at 31%. Warren's performance fee meant he was worth about $25 million. He ended the partnership because he said he couldn't understand the stock market anymore. I was not the right author to work on the next edition of The Intelligent Investor. I was an acolyte of Sam Stedman, not the mutual funds or the bridge conventions, by way of Phil Fisher. Stedman's investment philosophy, loosely called growth, said you should find a couple of rapidly growing companies whose growth rates were secure. The companies would have a competitive advantage because of their patent protection or impregnable market positions. They would have 3 years of earning visibility, and you would buy them at less than their growth rates, because their prices would seem high compared to the average stock and they paid no dividends. The machine that addicted us to growth investing was the Xerox 914. It was the first machine to copy plain paper, and I can remember writing that someday people would use the word Xerox as a verb. That seemed radical at the time. Xerox was a 10-bagger, and once you have a 10-bagger, everything else seems tame. The Xerox crowd even got to play the game again, with Rank Xerox in the United Kingdom and Fuji Xerox in Japan. We all went to Dunhill on 57th Street and had suits tailored where the 4 buttons on the sleeves had real buttonholes. We did not think much about Ben Graham. Charming as he was, he had written, in 1949, that he could not buy IBM because its price precluded the margin of safety which we consider essential to a true investment. At Graham's urging, I had several conversations with Warren, and then I flew to Omaha to meet him, even though I still didn't think I was right for the job. We had a steak dinner. We had a bacon, eggs, and potatoes breakfast. We got along famously. Warren was, and is, cheerful and funny. He has a gift of metaphor that is irresistible, and, as everybody now knows, he is very smart. Warren didn't look like the Xerox crowd. While he wore a suit and a tie, his wrists emerged from the sleeves, revealing an indifference to tailoring. Today, as our senior financial statesman, he is dressed impeccably, but without, I suspect, intense interest in the process. To a member of the Xerox crowd then, he looked like he had fallen off the turnip truck. I went to Warren's house on Farnham Street, which he had bought for $31,500 in 1958. It was a rambling, comfortable house. He had added a racquetball court to it. How, I wanted to know, could he operate from Omaha? In New York, the portfolio managers were all trading stories at breakfast, lunch, and dinner. Omaha gives me perspective, Warren said. He showed me a write-up from a Wall Street firm that said, securities must be studied on a minute-by-minute program. Wow, Warren said. This sort of stuff makes me feel guilty when I go out for a Pepsi. I couldn't interest Warren in the truffle hunt for the next Xerox. Our growth crowd was sniffing everywhere, talking to vendors, customers, competitors, the Phil Vischer geometry. Not that Warren didn't do research his own way. For example, Warren noticed that the bonds of the Indiana Turnpike were selling in the 70s, while the nearly identical bonds of the Illinois Turnpike sold in the 90s. The casual word among the bond crowd was that the maintenance allowance wasn't high enough behind the Indiana bonds. Warren got into his car and drove the length of the Indiana Turnpike. Then he went to Indianapolis and turned the pages of the maintenance reports of the Highway Department. He thought the Indiana Turnpike didn't need that much work, and bought the bonds. They closed the gap with the bonds of the Illinois Turnpike. Not exactly the next Xerox. Warren showed me the principles he had written out on a lined, yellow legal pad and framed. A. Our investments will be chosen on the basis of value, not popularity. B. Our investments will attempt to reduce the risk of permanent capital loss, not short-term quotation loss, to a minimum. C. My wife, children, and I will have virtually our entire net worth in the partnership. Warren had ended his partnership, so I couldn't have bought into it anyway. The partnership had bought shares in an old New England textile company, Berkshire Hathaway, and that stock was traded in the pink sheets. I looked up Berkshire. It seemed to be a failing New England textile company. Berkshire is hardly going to be as profitable as Xerox in a hyper-tense market, Warren wrote to his investors, but it is a very comfortable thing to own. We will not go into a business where technology, which is way over my head, is crucial to the decision. Berkshire's attraction was that it had $18 in net working capital, and Buffett's investors had paid $13. I didn't buy Berkshire Hathaway. At the end of my stay, I said I didn't want to work on Ben Graham's book. Warren said he didn't either. We wrote a note to Ben saying his book didn't really need any improvements. The little story about Ben and Warren went into this book. The original publisher, Random House, gave a party for the book. Warren came to the party and had a good time. We have the pictures. My hair is embarrassingly long, and Warren's haircut looks, well, mid-America. We kept in touch. Who's Warren Buffett? The people at the Washington Post Company asked when Warren bought a steak. They ordered 50 copies of Supermoney. I tried the Washington Post idea on my Wall Street friends. They couldn't see it. Big city newspapers are dead, they said. The trucks can't get through the streets. Labor problems are terrible. People get their news from television. And anyway, it wasn't the next Xerox. In 1976, Rupert Murdoch's News Corp launched an unfriendly takeover of the New York Magazine Company. I had been one of its founders, with 5-cent stock. We had spent 8 years building a unique property. We not only had New York Magazine, but also the Village Voice, and a California magazine called New West. Now Murdoch had bought 50.1% of the stock. I called up Warren and whined. You want it back? He asked. I got very attentive. He sent me News Corp's annual report. It was full of British or Australian accounting terminology. I didn't get it. News Corp has a market cap of only $50 million, Warren said. For $27 million, you could have 2 big newspapers in Australia, 73 weekly newspapers in Britain, 2 television stations, 20% of Ansett Airlines, and you'd have your magazine back. How do we do it? I asked. What is this we, Kimosabe? Warren said, using a term from our radio days with the Lone Ranger. You want your magazine back? I'm telling you how to do it. But Murdoch controls News Corp, I said. You didn't read carefully, Warren said. Look at footnote 14. Clarendon has 40%. The rest is Australian institutions. Clarendon is Murdoch and his 4 sisters. I figure it would take 1 sister and the float and a year in Australia, and guess which one of us is going to spend the year in Australia? I didn't go, and we didn't get the property back, either. I should have bought News Corp. Murdoch sold our magazines for many times what he had paid in the raid. When we launched the weekly Adam Smith television show, we took it to Omaha right away. It was the first TV Warren had done, and for a long time, the only TV. It didn't take much to get Warren to use his baseball metaphors. When I look at the managers who run my companies, I feel like Miller Huggins looking at his lineup of the 1927 Yankees. Those were the Yankees, of course, with Babe Ruth and Lou Gehrig. Or this one. In the stock market, it's as if you are the batter and the market is the pitcher. The market has to keep pitching, but in this game there are no called strikes. The market can throw you 100 different pitches every day, but you don't have to swing until you get a fat pitch. So you might not swing for 6 months. You might not swing for 2 years. That's the beauty of Berkshire not being on Wall Street. Nobody's at the fence behind me calling out, "Swing, you bum!" Warren continued this theme in subsequent television interviews with me. You have said they could close the New York Stock Exchange for 2 years, and I wouldn't care. But you are considered an investment guru. So how do you reconcile this? Whether the New York Stock Exchange is open or not has nothing to do with whether the Washington Post is getting more valuable. The New York Stock Exchange is closed on weekends, and I don't break out in hives. When I look at a company, the last thing I look at is the price. You don't ask what your house is worth 3 times a day, do you? Every stock is a business. You have to ask, what is its value as a business? Warren once sent me the collected annual reports of National Mutual Life Assurance, when Lord Keynes was the chairman of that company in Britain. This guy knows how to write a chairman's report, Warren scribbled. Warren's own chairman's letters for Berkshire Hathaway became even more famous than those of Keynes. They were teaching instruments. They carefully spelled out not only the businesses, but also the accounting procedures, and a very plain vanilla evaluation of the scene. The annual meeting of Berkshire in Omaha draws more than 10,000 people, and Buffett and his vice chairman, Charlie Munger, answer questions for hours. Questions on all sorts of subjects. It is a unique seminar with attendance hitting new records every year, no matter whether Berkshire has had a really good year or not. When you leave Omaha after this Woodstock of capitalism, you feel more lighthearted. During the dot-com bubble, Buffett kept his cool. He said that if he were teaching an investment course, he would ask, "How do you value a dot-com?" If the student answered anything at all, Buffett said, he would get an F. Warren has never wavered either from the warm and folksy persona or from his sound, shirt-sleeves wisdom. He is a powerful intellect, but he is also biendan sapo, comfortable in his skin, which mobilizes him and helps to keep him from second-guessing his perceptions. Corporate and institutional icons have fallen, and others are under suspicion. Growth companies that once were accorded reverence are now said to smooth their earnings. A prominent accounting firm whose name was an imprimatur has lost its credibility. Many have fallen that had been in honor, as Horace wrote. But Buffett is still Buffett, still in the same house on Farnham, still in the same office in Coit Plaza as when I first went to discuss the Ben Graham project. Warren was counted on by the government to right the wrongs at Solomon. He takes to print in the op-ed pages of the Washington Post on important issues. Recently, his chairman's letter found him in high moral dudgeon. Charlie and I, he wrote, referring to his vice chairman, Charles Munger, are disgusted by the situation, so common in the last few years, in which shareholders have suffered billions in losses, while the CEOs, promoters, and other higher-ups who fathered these disasters have walked away with extraordinary wealth. To their shame, these business leaders view shareholders as patsies, not partners. Warren Buffett was entitled to be in high moral dudgeon in the age of Enron and WorldCom and Adelphi. His comments met a receptive audience. The same moral dudgeon exists in this book. The financial world has always invited the sleight-of-hand artist. Money is choreographed in numbers, and numbers are so easy to push around. Richard Whitney, president of the New York Stock Exchange at the time of the Great Crash, was photographed on the steps of Sing Sing, the prison that was to become his home. He was the Martha Stewart of his day, but society today is more forgiving. Richard Whitney did not emerge to host a radio show or star in a movie. This book, originally published in 1972, also has a distinguished character in high moral dudgeon, David Babson, founder of the firm that bears his name. He was the avenging angel described in the chapter An Unsuccessful Group Therapy Session for 1,500 Investment Professionals, starring the avenging angel. I moderated that historic session, when the crusty New Englander said to the representatives of big banks and mutual funds still familiar today, "Some of you should leave this business." He then read a list of stocks that had gone from lofty levels to 1, some even to 0, and catalogued his own Cotton Mather list of sins. The conglomerate shell game, accountants who certified earnings that weren't there, CEOs and CFOs who treated the pension fund as a cookie jar, mutual fund managers who manufactured paper performance, and so on. Virtually nothing on his list is out of date, decades later. What fun David Babson could have had with the hedge funds. I'm sorry he is no longer with us. Supermoney is the successor to The Money Game. Both books use some of the techniques of what was then called New Journalism. The first-person narrator, the dramatization of points with the actions of various characters. The great Winfield, for example, appears handsomely in The Money Game, coming to work in jeans and cowboy boots, chasing stocks that went from 5 to 50. In Supermoney, his accounts have gone down 90% in the credit contraction and stock implosion of the early 1970s. But he was not perturbed. He still owned the side of the mountain in Aspen he had bought with his winnings, and he was studying art history at Columbia. He had bought some regulated utilities. The great Winfield in utilities? I asked. Things change, my boy, things change. We have to recognize them when they do, he said. The figure called Seymour the head, sockless and tieless in this book, made the New York Times even in 2005. He was a figure in class action lawsuits, and there was some problem about whether, as the aggrieved investor, he was kicking back to the law firms that bought the suits. Things change, said the great Winfield, but sometimes the more they change, the more they seem the same. For example, as this edition of Supermoney appears, we are engaged in an expensive and unpopular war. We are running big budget deficits, and the country is feeling divided and ill-tempered. Plus ça change, the scenario could be back in the early 1970s. Vietnam and its deficits, and the feeling that something unpleasant lurked around the next corner. In the financial world, the structural changes are about to occur, just as they did at the time of the original edition. Those changes in the 1970s took out 3/4 of the firms on Wall Street. We don't know what will happen in this decade, but we can sense the tremors. Beneath the anecdotal approach and the names of some of the characters, there are serious themes in these books. For example, The Money Game suggested that people viewed financial matters as rational because the game was measured in numbers. And numbers are finite and definitive. But said The Money Game, the truth was elsewhere. Any intelligent observer could see that behavior, psychology, had a lot to do with the outcome. Further, people did not behave as economists postulated. always assuming that people maximized their actions for rational gain. The money game, it said right off, is about image and reality and identity and anxiety and money. Some of the aphorisms in it were the stock doesn't know you own it, prices have no memory, and yesterday has nothing to do with tomorrow. The founder of Fidelity, Mr. Johnson, tested the thesis. A crowd of men behaves like a single woman, and a psychiatrist postulated that some people actually want to lose. Mr. Johnson also said, somewhat prophetically, the dominant note of our time is unreality. This idea was startling enough that when the Wall Street Journal ran a front-page story about the book, its headline was, "New Book That Views Market as Irrational is a Hit on Wall Street." Several decades later, Amos Tversky and Daniel Kahneman did their pioneering work in what has now become the fashionable field of behavioral economics. And what did they find? That people can behave irrationally. They don't maximize their odds, they fear loss. Tversky and Kahneman were psychologists, not economists. Their work in psychology had breathtaking ingenuity. They constructed games, puzzles, and situations that revealed how people actually behave, as opposed to the postulations of classical economics. They called this prospect theory, and published it in an Econometrica, the economic journal, rather than Psychological Review, because Econometrica had published notable papers in decision-making. Had the paper been published in a psychology journal, it might never have had the impact it did. My colleagues and I pored over Tversky and Kahneman looking for some edge in the market, and their follower Richard Thaler, without, I should say, particular financial results. Kahneman received the Nobel Prize in Economics in 2002. Tversky had died a few years before. Supermoney also attempts to take on some serious ideas. It expands from a visit to a new greenfield General Motors plant to a discussion of whether the Protestant ethic, that engine of productivity, has been evaporating. Supermoney itself is a term I coined to describe the difference between the green bills in your wallet and the real wealth in the country, which is earnings or profits, capitalized, when they are run through markets, that is, stocks. You might work very hard on your algorithms in your job at Google, but your weekly paycheck will be dwarfed by your Google options, which have the opinion of the marketplace applied to multiples of the stock. Cash your paycheck at Google, and you have money. Cash your options, and you have supermoney. So we have a wide gap in this country, indeed, all over the world, between those who have no currency, those who have currency, and those who have supercurrency. And supermoney also mulls about how we account for the unquantifiable in our economic system. A 500-year-old sequoia redwood, chopped down, appears as a plus in the accounts of the gross domestic product. There is no minus for the lack of a redwood. And even large quantities of supermoney don't guarantee a community in harmony. This book asks, will General Motors believe in harmony? Will General Electric believe in beauty and truth? The phrasing of the questions is done in an offhand, angular journalistic tone, but the underlying questions bear some discussion and could still be asked today. I would like to acknowledge the help of Craig Drill and Warren E. Buffett in the preface to this new edition. Chapter 1. Metaphysical Doubts. Very short. Not even a decade ago, everybody believed. Events did seem under control. Inflation would creep, not gallop. The new economics would fine-tune the economy. Productivity would increase. Wars would be fought, but not by us. We were the mediators. Understanding but tough. Problems would be articulated, and that articulation was half the solution. We would begin upon the solutions. Kennedy rhetoric. Let us begin. Let the word go forth. Let us never negotiate from fear, nor fear to negotiate. Let anybody call upon us, confident, ambitious, optimistic, even naive, the very best of the American tradition. Hail, Columbia, happy land. Then, one thing and another. The John Philip Sousa music faded a bit. Could rational men make events behave rationally? Maybe they couldn't. Nobody then asked for a definition of rational. Maybe the falcons could not hear the falconers. They were still wheeling around up there. Would they listen? Chapter 2. Liquidity. Mr. Oddlot Robert is asked how he feels. We have a capital market that is a great national asset, like the wheat fields of Kansas and the Grand Canyon. Some of the Yankee monopoly in technology and management techniques has been broken, gone to Wolfsburg and Milan and Toyota City. But Tokyo and Amsterdam and Frankfurt and Buenos Aires do not have that great, deep capital market, ready to handle the world's investable funds. So everybody still has to come to New York. And when they come, they bring money, not only for what they buy, but also for commissions, tips, and shoe shines. Everybody came because the great capital market was so liquid and honest and continuous. Today's price related to yesterday's price, and you could buy and sell in almost any size. But there were some nagging doubts. We had a market slide, the biggest since 1929, and some crises. Market slides frightened the public, and 1969 through 1970 was no exception. What would the public do? I think it was Gertrude Stein's cousin, according to Miss Stein, who said that money is always there, but the pockets change. It is not in the same pockets after a change, and that is all there is to say about money. Well, maybe. From all accounts, we are now in a marvelous economy, moving forward to normal being July 4th, 1955, during the Eisenhower Regency. Peace, prosperity, and harmony. Did the public get a little frightened there for a year or two? They are coming back. The brokers all sit like hunters in a blind, with the first honks already coming over the horizon. Did the big bear leave some scars? Welcome to the club. Justice Holmes said that a man has to be part of the actions and passions of the times. Only 2 years ago, you could fire off a cannon in a downtown restaurant like Oscar's and not hit anybody, because the price of beef Wellington had been moving up with the prime rate, and many citizens in the financial community had switched to tuna on white toast. Now the corks are popping again. Wonderful, the cyclicality of life. What happened to the money community has some relevance to the larger drifts of our society, for that community is in charge of much of the liquid wealth of the country. The money community's health affects our savings and investments, the assets of university endowments and foundations, the cost of government, and whether the pension money will be there when the employees are ready to retire. In turn, some of the changing attitudes about work and play and people and the uses of the present are going to affect the money community and what it shepherds. A while back, there were some metaphysical doubts and some specific doubts. The metaphysical doubts were perhaps common to the country as a whole, and concerned the assumption that rational men could make events behave rationally. Maybe the falcons could not hear the falconers. The jury has to be counted as still out on whether the falcons are within earshot. On the bread and butter level, the specific doubts concerned liquidity, which can mean a number of things, but in this context meant the ability of buyers to buy and sellers to sell. We have that capital market that brings in the people from everywhere. Liquidity seemed to be disappearing. The public was beginning to cash in its mutual funds, and the minus signs were getting fatter on line 30 of the Federal Reserve's computer printout labeled Flow of Funds, the sector statements of saving and investment, households, personal trusts, and non-profit organizations. William McChesney Martin, Jr. was upset. Mr. Martin, a former president of the New York Stock Exchange and a former chairman of the Board of Governors of the Federal Reserve, is to the money business what de Gaulle was to France, which is to say, he was there when times were bad and he was the only man everybody could agree on when they got bad again. "I'm very concerned about the liquidity of the stock market," Mr. Martin said, "and I've talked to corporation heads who are worried to death about it." When asked why individuals were leaving, Mr. Martin said he thought the lack of integrity in the marketplace was the reason. And when asked where the individuals were putting their money, Mr. Martin said some of those he talked to were putting the money into lotteries. But there is no line on the Fed's flow of funds for lotteries. Institutions, mutual funds, insurance companies, pension funds, and so on, were coming to dominate the marketplace, and that was thought to be troubling for liquidity. Edgar Bunce runs the $3.5 billion of Prudential's stock portfolio, and the Wall Street Journal quoted him thus: "If everybody buys at the same time, who will we sell to?" There were those who were prepared to write off the 31 million shareholders as far as liquidity was concerned. Liquidity means not only the smoothness of the market, but the depth of the market. This point of view maintained that you heard only of panic-stricken institutions suddenly dumping thousands of shares, creating 10 and 20-point air pockets in stocks. You never heard of the quiet, orderly, day-by-day functions that went on without comment. Anyway, it was said, the public dealt mostly through half a dozen brokerage firms, and a buy or sell recommendation from one of those could move a whole battalion of individuals with the same net effect as an institution. In order to get a better perspective on what had gone on, I had lunch with my friend Odd Lot Robert. A little micro look at the macro scene. As the learned economist would say, an odd lotter, you will recall, is one who buys or sells less than 100 shares. There are theories around that the way to make money is to do the opposite of what the odd lotters do, and there are services that keep track of this. I asked Robert how he had done in the past couple of years. "Not very well," he said, "but better than my friends. Of course, you have to remember that we are not exactly little old ladies. We do not just buy telephone and sit with it. A good thing, too, because telephone has gone from 70 to 40, and over the last 6 years you could have lost damn near half your money in good old Ma Bell and not even have had any fun. But my friends and I, frankly, were prepared to speculate." I asked Robert how his friends had done. "Terrible," he said. "At least the market hasn't changed my life. But take my dentist's wife. During the early 60s, she got very interested in the market. She studied very hard, she worked the thing like mad, and I must say she hit it like a fixed slot machine. I mean, she must have made a couple $100,000. I think she even got out pretty well in 68, but she couldn't stay away." "She gave it back?" "She gave most of it back. She went into a deep depression, and now she's in group therapy. The other members of the group say she thinks she was the stocks, and when they melted away, so did she, like the Wicked Witch of the West in The Wizard of Oz. Or was it the North? The one who just faded out from under her hat. Then I have another friend who also made a lot of money. He was in his early 50s and he was going to retire. He hated his job and he was going to leave it. Finally, and then he lost a hell of a lot of money and he's still at the job and he's out of the market." "But it didn't change your life?" "No. I never made that much in the first place. I don't mind telling you. I've taken some very healthy losses. My Brian Lloyd went from 6 to 1. You're still active, though?" "I'm not as active as I used to be. There was one period when I almost didn't do anything at all. This friend of my sister's had an account with the firm, and the firm got in a lot of trouble, and she couldn't get her stocks back. And there was stuff in the paper every day about brokers going busted, so I got scared. Firms closing every day, so I asked for the papers." "What papers?" "You know, the papers, the ones the stocks are printed on. The stock certificates." "Right, of course. I didn't want to tell my broker why I was asking, that I was afraid he might go broke, or that maybe he didn't have the stocks at all, or that he was really screwed up somewhere. So I said I was making a will. I said my lawyer wanted me to have my stocks so I could make a will. My broker bought the story completely. It took a while, but he sent me the stocks. And then, well, first I put them in the drawer of this table in the living room where we keep the bills we haven't paid yet. Then somebody spilled coffee on the table and some of it dribbled into the drawer. I'm not quite sure how. None of the coffee actually got onto the stocks, it just got onto the bills, but I had to move them. I mean, a stock with coffee on it is still probably legal, but what if I wanted to sell it? And some stores won't take a torn $5 bill. And what if I sold a stock and the buyer said, "Hey, wait a minute, this one has coffee on it." So I moved the stocks to my dresser drawer. In your bedroom? Yeah, under my socks. But every time I got a pair of socks out, I would see some of those turkeys. It would make my stomach turn sour. Also, if I sold one, I had to take it out of the dresser drawer and mail it back, and that was a drag. And then if I bought something, they had to mail me the new one. And it was always late, and I was wondering if they screwed up somewhere. Finally, I got tired of all the mailing, and I didn't hear so much about the problems anymore, so I mailed the stocks back to the broker. I told him the will was all made and the lawyer was through, and he bought that story completely. You didn't sell when the market went down? No, my stuff went down too fast, and then I didn't want to take the loss. Actually, when the market was going down, I wanted to sell short. I wanted to be going in the same direction as the market for once. But my broker wouldn't let me. And then when things were really going down, I had a funny feeling. I wanted everything to collapse. I mean really collapse. So you could buy at the bottom, like 1932? Well, yes, if I had any money, but that wasn't my main thought. When things were really going down, I figured if the market really collapsed, that would be the end of our government, and we'd have socialism or something. I thought, what the hell, let's have socialism. You still feel that way? No, I hollered at my broker a lot and got it out of my system. The most depressing thing of all is when they don't list your stocks in the paper anymore. I really like looking up my stocks in the paper, and when they're not there, it really hurts. I look at the odd lot figures too. The odd lotters were selling all the way down. That's one of the reasons I didn't sell. I didn't want to be an odd lotter. I wanted to pursue the question of liquidity, so I told Robert there was controversy over the specialists on the floor, and over contentions that the liquidity, the orderly market, was disappearing. The structure of the market was changing, and maybe stocks were more volatile. Robert could buy a stock at 20 and find it at 16 20 minutes later because an institutional seller has appeared. He wasn't greatly disturbed. 20 to 16, a few points more or less. What the hell, it might work the other way too. Maybe I'd buy it at 20 and that big mother would move it to 24. You can't quibble over a few points. I want a stock to have a move I can really see. Then I said there was controversy about accounting procedures and about what earnings really are. Some maintain that the small investor couldn't hope to sort those things out. Could he? I pay attention to the earnings, but I pay more attention to the mathematics of the whole thing. The mathematics? Yeah, like when my broker says, I think this one has 10 points in it, then I watch to see if it makes the 10 points. Hell, all I want is a break. If I have a stock that's 30 and it goes to 40 and then it goes to 9, I had my chance. I could have sold it at 40. It's my own fault. But I do need a break like that. Say, 10 points. You had a stock like that? My high-grade foods went from 30 to 80 and then to 9. But we hung on, and it finally made it back to 30, and I got out with a $200 profit. Still another controversy, I said, continuing to probe, was the institutional investor and the information they seemed to get before the small investor. Oh hell, everybody knows that, and the funds have computers and research and all that. I think the strategy for the small investor is to jump aboard once he sees that the big boys are moving the market. My broker knows some of them, so we get some inside information once in a while. I got some myself. It was a stock related to those gambling casinos in the Bahamas. The stock was down from 20 to 8 because it was thought there might be some trouble with the Bahamas government. Then I heard from some guys I was working with that a report was coming out that would be very good for the casinos, so I bought some. What happened? The stock went to 7 and now it's 4. It's very cheap on earnings. You ought to buy some. I asked Robert how he felt in general now. When the market was going down, I asked my broker why it was going down. He said Nixon. The market has no confidence in Nixon. Then it went up again, and I asked him if it had confidence in Nixon now. He said it wasn't Nixon, it was the funds buying and foreigners. I don't see how it can have been Nixon on the way down and not on the way up. But my broker is brighter than most of them, so he must know. If Robert had done so badly, why did he think his broker was better than most? For one thing, he's still in business. That's no joke. I got into a cab at LaGuardia a couple of months ago, and I got to talking to the cab driver. And this cab driver had been a broker with one of the houses that went busted. I asked him if he still followed the market, and he said not so much anymore. Look, I know some things aren't fair. Take the commissions. I was watching a stock called Data Lease Financial. It used to sell at 29, so when it got to 2, I figured, how low can it go? And I bought 200 shares. They charged me a $21 commission for the 200, a $400 order, and I guess another $21 to sell. That's more than 10% in commissions. What the hell? The track is only 17%, and that at least goes to the government. The track is gambling, sort of socially disapproved, and the market is getting up near the track, except for the big boys. The big boys don't pay any commissions at all. But what am I going to do? Write my congressman? It's the only wheel in town. Listen, I have friends who had accounts. They're small investors just like me, and they can't even get a broker. Nobody wants them. You're lucky to have a broker these days. First, your broker has to survive. Then he has to keep you. They keep trying to shove you into some mutual fund where you wouldn't be able to watch the stocks. I have a good relationship with my broker, so I don't think he would drop me. But when I holler, I don't holler too much, even about a 10% commission. My wife wants me to get out of the market. She says the market makes her feel insecure, and she wants to buy a piece of land or put another room on the house or something, if we have any money left. Are you going to do that? I suppose it makes more sense. My house has gone up more than any of my stocks, and so have the taxes on it, I might add. But I can't give it up now. I might be quitting just at the bottom, and if I couldn't look my stocks up in the paper, I'd really miss it. Part of my life that I enjoy would be gone. Are Odd Lot Robert and his cousins in or out of the market? With all the quantification going on of security prices, volume and movements, and all the computer memories chock full, still no one knows whether the public is in or out of the market, or even more important, how their individual portfolios have done. We have the most elaborate machinery possible for tracking prices, but that is like bending over the buffalo tracks and saying, yes, many buffalo go this way. Very good if there are a lot of buffalo all going in the same direction. The investment company Institute can tell us whether, on balance, mutual funds are being bought or sold. The Federal Reserve can tell us whether there are minus signs on lines 30 and 31 of its flow of funds computer printout, mutual funds and other corp shares, and even where some of the money might be going, perhaps bonds, line 27, savings accounts at commercial banks, line 22, or savings and loans, line 23. For your very own flow of funds printout, a little more up to date, you can ask the same people I do, the Board of Governors of the Federal Reserve System of the United States, Constitution Ave and 20th Street Northwest, Washington, D.C., 20551. Pollster Albert Sinlinger says the number of individual accounts has dropped 10%. Yet at the same time, margin debits can quadruple and volume can increase, which traditionally mean the public is increasing its participation. I used to think that somewhere there was somebody who knew where the public was and what its behavior meant, and that if I tried long enough and hard enough we could find that corner of the library or the agency or the computer room. But knowledge is still spotty. Further, virtually no one has paid much attention to people. The assumption is that price behavior and volume behavior equal people behavior. The money game attempted to sketch some of the irrational forms of people behavior, and to suggest that emotions had as much influence as buffalo tracks. I once commissioned a psychologist to write a paper on anxiety as a market force, and until I got together with Dave Campbell, a psychologist from the University of Minnesota, nobody had even made an elementary sketch of professional money managers as people. As in the old maps of Africa, the outlines are all there, but the interiors are all blank. The rivers are marked, but there are big gaps where we might as well have pictures of elephants and the word unexplored. Be all that as it may, the New York Stock Exchange says there are 31 million shareholders and that there will be 40 million in 1975 and 50 million in 1980, plus all those indirect shareholders in pension funds, insurance policies, and mutual funds. They must be looking for something. Maybe they realize that the green stuff in their wallets is not the real money. Chapter 3. Supermoney, Where It Is. The Supercurrency. There is a certain amount of mileage politicians discover periodically in griping about our tax system. It is discovered that last year 300 people had incomes of $200,000 and paid no taxes. And let's get the bastards. Or the Atlantic Richfield Company, a major oil producer, paid no taxes on $454 million. Jean-Paul Getty has an income of $300,000 a day and pays no taxes, and so on. Then there is some thrashing around and some pulling at the drawstrings of the loopholes. You have only to turn to the classifieds in the Wall Street Journal and read the bold letters "tax shelter" to realize that a large group of our citizens minimize their taxes. Sheltering income does not produce supercurrency. Supercurrency being a term I made up to describe the real money of the country. Supercurrency is capitalized income, not sheltered income, and in a moment this chapter will explain it. Instinctively, people know that they are not going to get rich working for a salary. Part of the reason they drift toward the securities markets is that they know that is where the supercurrency lives. But since much of the publicity is about reducing taxes on income, let us get that out of the way first. People send the congressman to the U.S. Congress, and Congress writes the tax laws. When the Congress wants to encourage something, it writes a favorable tax law. Cynics and Mr. Dooley could say that Congress responds to lobbies because it wants to encourage its own re-election. Congress wants to encourage the search for energy, so it writes the oil laws the way it does. As a social objective, Congress wants everybody to own his own home, so it triple subsidizes personal housing, which incidentally makes a house one of the best investments you can make. Do not write and say that you made your investment and then they raised the taxes and then the roof fell down and then the freeway came through. Congress subsidizes personal housing by creating agencies to provide mortgages, by making the interest on those mortgages and the taxes on the property deductible, and by deferring the taxes when the house is sold if another one is bought within a year. If I were making up a list of readings for a sociology course about American life, I would put the United States Master Tax Guide at the top of the list. That marvelous book will show you that Congress values things. The people may be born, get married, and die, but the things live on. For a work to be of superior worth in the eyes of the Master Tax Guide, it must be a thing. If you write a poem, whatever you sell it for will always be income, taxed at the highest earned rate. That is because you created the poem. The tax law very specifically, and anti-intellectually, says that creations, particularly copyrightable ones, are always income. If you sell me your poem for $10, it then becomes a property, a thing. When I resell it for $1,000, I pay a capital gains rate because exchanges of things are more socially desirable than the creation of them. The anomaly develops because the privileges granted to one group can be bought by another at a premium. If, for example, you write a poem or sing a song or discover a cure for the common cold in your basement lab, and you are successful, your wise tax counselor might tell you to go drill an oil well. But if you drill a successful oil well, no one is going to tell you to go write a poem or sing a song. If one man sits alone in a room with some paper and an idea, and the ideas become words on paper, and then actors act them or singers sing them, straight income, call the driller. If one man sits in a room with some paper and an idea, and the ideas become diagrams, and the diagrams are machined into metal, you have made a thing. You can capitalize it, borrow on it, build a company with pensions, stock options, floating yachts, a little private jet, and a capital gain at the end. The dentist who has a good year and adds up his potential tax bill may decide to drill oil, not teeth, or to go into real estate, or to try some other venture. Wall Street is gearing up more and more to the selling of these packages. It can make more on them than from the commissions on stocks. The tax shelter will take the income tax from dentistry, run it through an approved thing, and produce an eventual capital gain tax at rates lower than the dentist's earned income rate. Though if the dentist would calculate the discounted present value of the deferral, he would see that unless he is very lucky, the fees he pays to the brokers and lawyers and accountants and drillers and ranchers will probably make up the difference in the rates. I have done this myself sometimes, just to defer income from one year to another and have more time to think about it, because part of my family is in the cattle business. To defer income, you call my brother-in-law Bill and buy a lot of feed. All the feed is deductible. Then you borrow on the feed to buy the steers. The interest is deductible, and while the steers chomp away at the feed, getting fatter, you cross January 1 and into another year, when the sold steers return as income. There is, of course, a problem in addition to the income returning. The grain is real and the steers are real, and they do not always get fat on schedule, and the prices at which they are sold go up and down. I may have gotten too close to the business. In a borrowed cowboy hat, I was once sitting on a rail fence with Bill when a steer with a very ugly red eye walked by. "That's one of yours," Bill said. If there were turkey vultures circling high in the Arizona sky, Bill would say, "Must be some of yours over there." And if the vet was heading for a particular pen with a foot-long needle, I knew whose steers those were. One year, obviously a long time ago, I watched steer prices go from 19 cents a pound to 27 cents a pound, and I thought we were in Fat City, but the profit for the year came in at $57.32. "Some of yours died," Bill said. I do have to say that Bill is very fair and dispenses justice with a tempered hand. The next year prices went down, and my loss was only $57.32, for which I was grateful. "The other fellas died," Bill said. "See, it all evens out." Everybody knows that for rich people, tax-paying is a game of hare and hounds. The revenuers against high-priced accountants, in which you never have to settle for 100% of the assessment anyway. But rich people are not those who have deferred their taxes, though rich people may do that because they have smart lawyers. Your income is still your income even if the taxes are a bit lower. The real money comes from supercurrency. The most pure forms of supercurrency are the great companies with broad markets selling at high multiples of earnings. Granddad and Uncle Harry had a partnership. They took the money home. Uncle Harry turned it into a company, and it was then worth whatever a private buyer might pay for it. But Uncle Harry sold it to Eli Lilly or IBM or Xerox or Coca-Cola, and now Uncle Harry's side of the family is rich and peels off the supercurrency, shares of IBM or Coca-Cola, whenever it wants a new boat. There are some profound social implications here, because it is not lost on the smaller proprietors of American business that the way to cash in is to turn the family business into supercurrency, whether by selling to the public or to IBM, or hopefully first to one and then to the other. For in addition to those impulses to concentration that come from economies of scale and the aggregation of capital, there are the impulses of the owners to cash in their business for a superior currency. Further, the supplier on the supercurrency increases the distance between wage earners and capital owners. The tax reforms we hear about concern the various subsidies of some taxpayers by other taxpayers. In a recent study, the Brookings Institution said that these subsidies, or benefits, or loopholes, come to $77 billion annually. So, presumably, the elimination of the privileges for the subsidized taxpayers would drop the rates for all the others. But supercurrency is beyond tax reform. It is, as any currency is, the fiber of the society. Only on the periphery, where there are stock options and other devices to let the latecomers in, is there some talk of how to get in. To reform supercurrency would be to change the whole notion of wealth in America, to change trusts and multiple trusts, and estates and inheritance laws, and the nature of the corporate animal itself. So supercurrency will be around for a while. It used to be, in the imperfectly developed securities markets of days of yore, that if the company had some assets, you could sell stock to the public. The common stock then had some claim on these assets, after the bonds and the preferred. But that style has changed, and the love of assets has been left far behind. It now is the income stream and the market's readiness to capitalize it that matters. Uncle Harry's company will go public, and in fact, its goal is not just to take care of Uncle Harry and Aunt Edna and that worthless hippie cousin Eugene, but to make it to the public marketplace. The company will merge, borrow, and doll itself up to that end objective. If the company is marginal, there are years when it may have to wait, but the commissions are fat on underwriting original issues, and generally there is always a hungry underwriter. Let us make up a capricious example. There are 2 Park Avenue doctors swabbing children's throats. They are doing a land office business. Together they make $100,000 a year. They could make even more, but taxes are high. They like to ski and they do not like children. With their $100,000, they pay taxes and grocery bills, and maybe put something in the savings bank. They form Pediatricians, Inc., meet the hungry underwriter, and sell the stock to the public at 30 times earnings. Their after-tax net is $50,000, so their stock is worth $1,500,000. Now, when they want to pay grocery bills, they peel off some of the $1,500,000, as much as the market can stand. They have moved into the supercurrency class. If their auditors had made a statement of their net worth before, it would have consisted of stethoscopes, fluoroscopes, and a jar of lollipops. Now their net worth is $1,500,000, partly in cash, which they sold to the public, and the rest in their stock. Their old net worth, the sum of stethoscopes, fluoroscopes, and lollipops, came, let us say, to $10,000. Their new net worth is $1,500,000. The difference of $1,490,000 is new money to the economy, just as if the Fed had printed it, and should be included in all the calculations of the money supply. You have to have a good market to sell Pediatricians, Inc., but perhaps the example is not so capricious. Advertising agencies consisting of 3 hot talents, 2 typewriters, 4 crayons, a telephone, and a line on some zippy accounts have made it into the supercurrency class, thereby turning the $60,000 made by the participants into a multiple thereof. In 1972, we had a good example of supercurrency. The Levitz brothers, Ralph, Gary, Leon, and Philip, of Pottstown, Pennsylvania, were furniture retailers whose company netted $60,000 or so a year. Then the company noticed that sales were terrific when they ran the year-end clearance sale from the warehouse. Furniture right in the carton, cash on the barrelhead, 20% off. The idea was very successful. They added more warehouses, and the company went public, in fact, super public. At one point, it was selling for 17 times its book value, 100 times its earnings, and Ralph, Gary, Leon, and Philip had banked $33 million public money for their stock, and they still held $300 million worth. History will tell, of course, whether selling furniture from warehouses is really worth 100 times earnings, but the $33 million is safely in the bank. Paul Newman is going public, along with Shirley MacLaine and Sidney Poitier. That is not the end of the line by any means. I have an ambivalent attitude toward this. On the one hand, there is no question that hungry underwriters have sold lots of junk to the public. Should they be policed in some way? We get then to the other hand. In almost no other country do small enterprises have such easy access to capital, and easy access to the public markets is part of this, a great national asset. Caveat emptor, the odds are better than at the track. Small enterprises provide ferment, keep the establishment on its toes, and sometimes even grow into great enterprises. Does Mrs. Rudkin bake good bread at her home in Fairfield, Connecticut? She does indeed. But after her business expands into a bakery called Pepperidge Farm, the Rudkins want to trade it in for the real money. Supercurrency brings more than cash almost every time. So they trade the bakery for $28 million of Campbell's soup. Very good supercurrency. With the broad stock exchange listing of Campbell's soup, they can peel off some, turn it into cash, diversify, and start behaving like rich people. In fact, you can go through the supercurrency history exercise right in the kitchen. You can see the food families trading right up there on the label, because usually the family name was well enough known that the supercurrency company kept its own identity to a quiet little line somewhere. Is there some Hellmann's mayonnaise? Obviously, there once were some Hellmann's in the mayonnaise business. That is not a name an ad agency would think up. The supercurrency ultimately turned up as CPS, formerly Corn Products, via Best Foods. Dannon is not a family name, but Isaac Carasso, a Spanish businessman, named his product after his son Daniel, hence Danone, later anglicized to Dannon. At some point, Dannon was traded in for Beatrice Foods, billion-dollar dairy supercurrency. Is there some Breakstone cottage cheese? The supercurrency is Kraft. Finally, all of the following were good businesses on their own, and they all have something in common. Avis Rent-A-Car, Canon Electric, Federal Electric, Sheraton Hotels, Howard W. Sams, a publisher, Continental Baking, Grinnell Corporation, Pipes and Pipe Fittings, Hartford Fire Insurance Company, a major insurer, Rayonier, Pennsylvania Glass Sand, Southern Wood Preserving Company, and Levitt & Sons, the famous builders of Levittowns. What do all of these thriving enterprises have in common? Their owners all traded up for the same supercurrency, ITT, formerly International Telephone and Telegraph, which has been the prime example of how a supercurrency company uses its premium currency to buy what it stalks. The capricious examples have a lot of goodwill in the supercurrency. For goodwill, some skeptics sometimes read air, but all capitalized earnings count as supercurrency, especially the legitimate and broadly traded ones. The people in the big house on the hill have supercurrency because Granddad bought the tabulator company that turned into IBM, and IBM is regal supercurrency. Make no mistake about it, this is real money. The psychiatrists and social scientists have other definitions, but economists start with a basic definition. Money is M1, all the coins and currency in circulation outside the banks, plus demand deposits, i.e. checking accounts, in the banks. To this, most economists add M2, which includes savings accounts and time deposits in banks. This can be spent almost as easily as M1. Everyone does not cash in his savings account on the same day, but all you have to do is transfer your savings account to your checking account to get M2 to M1, and that's pretty easy. Some economists add short-term government bills to this, since they are also practically cash. To this I suggest we add M3, supercurrency. Supercurrency is the before and after of a stock going public, in at book and out at market. That act of going public creates additional currency, just as switching a savings account to a checking account moves M2 to M1. To get M3 to M1, you buy at book, sell at market, peel off some stock, move it to your checking account, and presto, M1, you are rich. A while ago, there was a debate among economists on what really moved the economy. And the monetarists said, being monetarists, that it was the money supply which was most important. But in calculating the money supply, few economists paid much attention to supercurrency. Yet, there it was. All I wanted for my own efforts was a little footnote, just to the left of Say's law and the Hicks-Hansen synthesis, called Smith's increment. A former member of the Council of Economic Advisors asked, "Are you willing to do some serious work on this?" That shut me up. I knew that meant writing up supercurrency in Boolean algebra, in Kyklos, or maybe econometrica, presenting a paper full of sigmas and deltas and little numbers lying on their sides, writing the social implications of supercurrency, for the public interest, or maybe even the New York Review, and finally souping it all up for the New York Times Magazine. Unfortunately, even with my new electronic calculator, I am lousy at multiple regressions, stochastic series, and such. It might be more respectable to write up supercurrency in algebra, but I have to do it in English. So, in English. Everything in Smith's increment is supercurrency, but only that supercurrency which has just changed from stethoscopes and lollipops to a multiple of net counts as Smith's increment. At some point, all supercurrency went through that process, but we count it only the first time it happens. So we have a somewhat skewed income pattern in the society. There are people below or outside the level of M1. They have problems earning any money at all, because they are badly educated or not motivated, or they can't get to where they have to go. They have no money to speak of, whether currency, coins, or checking accounts, and many of them are on welfare. Then we have the vast majority of people, earners of M1. They go to work, their employers pay them, they spend the money at the grocery store, mail checks to the druggist, pay their taxes, stash a little into M2, and struggle on. And finally we have the supercurrency holders, the serene owners of the M3. The poor innocents among us do not realize the impact of a superior currency around. They still think the green stuff in their wallets is money. We can all huff and puff and work overtime, but there is no way we can catch up because there is nothing to capitalize our earnings. And supercurrency compounds beautifully given a bit of time. The Rockefellers may be smart, but the gap between our smartness and theirs is not equal to the difference between our currency and theirs, by several light years. A friend of mine bought himself a 28-acre palazzo in Greenwich, and fixed it up handsomely before the bear market. He said he could always get $1 million for it. I asked him who would have $1 million to spend on a house in spare times, and he said, there will always be somebody whose company has gone public and gotten listed who can peel off some of the stuff and spread it around. There will be more of those guys than there will be houses with 28 acres in Greenwich. Corporations sell stock to retire debt, to build new plants, or what have you. That is not supercurrency, because on the books of the company the money received turns into the new plant. But when the selling stockholders dispense of their equity, they move into the supercurrency class at capital gains rates. There are other ways of compounding wealth, usually involving borrowing on the asset, the real property or the oil in the ground, and buying some more. But the most easily accessible form is supercurrency, obtained as close to the source as possible. That is your number, M3, and if riches gleam in your eye, at least you know where they are. While there are other forms of wealth, supercurrency is the superior currency of the country. Because if they make a profit, even the oil deals and the real estate deals and the farm deals and the equipment leasing deals will be brought to market and sold at a multiple of their earnings so that their participants can get the real stuff, traded paper. Obviously, the laws and mechanisms of the country are built around the protection not just of currency, but also of supercurrency. It would not be the same society, whichever way you like it, without the structure and mechanisms that support the currencies, both super and regular. Yet a very short time ago, the structure and mechanism went through some perilous times. What happened in 1970 helps to explain why so many investors have recent scars. The shaking of the structure was a much nearer thing than anyone realizes. That is, anyone except those who were in at the countdown. And there are some lessons to be learned. It is not easy to have a story about something that did not quite happen, and it is particularly not easy to have that story revolve around abstractions, concepts that may be unfamiliar, and statistics. To avoid footnotes, the statistics have been chucked into the back of the book. Most of the numbers are from the Board of Governors of the Federal Reserve, or the Federal Reserve Banks of New York and St. Louis, whose help is hereby acknowledged, or from equally public sources. It is more important for a general reader to get the feel of what happened than to walk through the mechanics. So if it gets a bit abstract, just keep going. Given what happened, there was no way for the market to stay up, though a repetition of these events is not likely, at least for a while. There is nothing to say that they could not happen again. The first of the two moments when the structure swayed perilously is the weekend the United States almost ran out of money. That is more metaphoric than precise, but it does serve to introduce the first of the great near misses. Most investors turn only to the stock market page, but the stock market does not exist all by itself. There are also bond markets, commercial paper markets, commodity markets, a banking system, and so on. None of these is self-contained. Money does flow and the markets are interdependent. Any disaster or near disaster brings a search for villains, who fleeced the lambs, and so on. In the crunch, the villains were very widely dispersed. In fact, the crisis point came from a rather broad sweep of history. Chapter 4. The Day the Music Almost Died. The Banks. June 1970. In a crunch, the country runs very dry of money. It is hard to understand that a country can run out of money because, after all, countries by definition can print money. But they can also be overtaken by events, after which the printing power does not alleviate the pain. Everybody could tell that June weekend in 1970 that a crunch was on. It was difficult for small borrowers to breathe and their ribs hurt. If you wanted to buy a $40,000 house, 5 years previous you might have put up $6,000 in cash and paid 5.5% for 25 years. Now, in the late spring of 1970, the savings and loan wanted $15,000 down and 8.5% if it would make the loan at all, and some did not. Some smaller businesses were even worse off. They had been, let us say, used to taking out a bank loan for taxes, and then repaying that loan over a year. Now they were told the loan would be cut down or out, and if they went to other banks, the other banks said they weren't taking any new clients. That meant the small borrower was out on the street, hustling for money wherever he could find it. Interest rates were at their highest levels in 100 years. The prime lending rate at banks had been as high as 8.5%, and some said there was no reason it could not go to 10 or 12 or 15%. If the prime rate is at 15%, that is such a new ballgame that the Dow Jones averages could fairly surely be predicted to sell at 0.02. There are bankers around who say there was no crisis in 1970. You could always get money if you wanted it. You might have to pay 20% interest for it, that's all. Or maybe take it in block dinars. Even the use of the word crisis is controversial. It always is, but the Federal Reserve Bank of New York used it in a retrospective. As that June weekend begins to fade, the crisis seems less acute. By the time of the annual report of the Fed's Board of Governors, the language applied to the events was serious uncertainties. The liquidity crisis of that time didn't have much to do with the inability of buyers and sellers of stock to find each other and touch fingertips. Liquidity in this case meant usable funds, borrowable funds for American business. A decade ago, nobody could imagine that money in the United States was finite. It was like all the rest of our natural resources. There was plenty for everybody. You could get what you needed, and you certainly didn't have to worry about running out. The discovery that the supply of money was limited seems to have had a profound social effect as well, for, as with middle age, it does mean that you may be able to think of what you would like to do, but that does not mean you get to do it. There were two popular off-the-top-of-the-head rationales for the crunch, and both of them were true. One was that nobody had bothered to finance the Vietnam War. There were no major increased taxes to pay for Vietnam, for reasons well spelled out by political commentators. It was not supposed to last that long, and increased taxes would endanger the Great Society program. The second reason was inflation psychology, which meant that you had better buy it today because tomorrow it, whatever it might be, would cost more. Right after the summer the money almost ran out, I had a long talk with the treasurer of the telephone company in one of our major industrial states. The telephone company has excellent credit, and even in a crunch it can borrow. This particular treasurer, and his appropriate committee, committed his company to pay more than 9% for 20 years. If he had waited through the crisis, it might have cost his company only 8% or even less, 1% on many millions of dollars can buy a lot of telephones. I wanted to know if he felt dumb, though I didn't put the question quite so boldly. He said he didn't, and he had worked out a nice rationale. He had had a leeway of only 6 or 8 months, he said, in which to borrow the money. The rates were 8%, so I decided to wait a bit, he said. Then they went to 8.5. That is historically very high, so I wanted to wait until the rate came back to 8. Then the rates were 9, more than 9, and there was talk that they might go to 10 or 12. We needed the money, and I had run out of time. So I had to do it. I pressed him a bit. Listen, he said, we borrow money all the time, and if the rates stay down, I'll borrow some more, and then the average won't look so bad. Anyway, I'm retiring in 4 years. It still sounded dumb to me. But then I have never had to borrow money for the telephone company, and quarterbacking is easier from the grandstand, especially after the game is over. Even presidents know that. Once again, the story of what happened can be seen from the tables of the Federal Reserve, this one called Funds Raised, Non-Financial Sectors. Vietnam and inflation were indeed the causes of the crunch, but from the Fed's figures we can see that the stage was well set, for the demand for credit had increased by more than twice the savings that could supply it. In the early 60s, the demands for money were more or less consistent with the growth of personal and corporate savings. But by 1964, the demands for credit by business and by state and local governments had begun to increase. After a period of fairly slow economic growth, business began to spend for new capacity and new technology. By 1965, corporations had more than doubled their 1960 borrowing, from $14 billion to $29.6 billion. State and local governments increased their borrowing 40%, and in consumer credit and mortgage, individuals and households increased their borrowing 72%. All this was against an increase in the gross national product of 36% and in personal savings of 40%. Against that 40%, the total of credit demands by all borrowers moved up 90%, so that even before the escalation in the Vietnam War, much of the flexibility in the credit system had been lost. The demand for funds was already pushing the available supply. Then between 1965 and 1968, the federal government increased its expenditures by $60 billion, about half of it related to defense, without raising the taxes to cover this burst of spending. In 1966, the Federal Reserve made one stab at an anti-inflationary policy by restricting the money supply. Then its fingertips burned by the brief crunch of that year. During the 2 years following, it let loose a $24 billion addition to the money supply. In mid-1968, Congress passed a 10% income tax surcharge, which was supposed to take the steam out of the economy that had been supplied by all that new money. By that time, the momentum of inflation had really taken hold. Much of the borrowing was short-term, because the borrower didn't want to commit himself to a lifetime of high interest rates. It was a dumb corporate treasurer who had not borrowed at 4.5% back in 1964. Besides, borrowing was a way to boost the earnings per share of the stock, and that was what the stock market wanted, increasing earnings per share. So off to the market they went, better late than never. And individuals did not cut back on spending as much as all the econometric models suggested they would, because they had no choice. Their spending was more for the essentials of life than for the so-called discretionary items. The cost of those essentials increased faster than personal income. If you wanted a house, the mortgage cost that much more, if indeed you could get a mortgage, and if you needed a doctor or a hospital, that cost a lot more. The state and local governments had to meet increases in teachers' salaries and paving contracts and so on. American business, impressed with the ugliness of cash as an asset, increased its borrowing to $47.9 billion in 1969, almost 3.5 times the 1960 total. The banks had about loaned out the amounts they were permitted to by the Fed. They went to Europe and borrowed euro dollars, dollars that had been generated abroad or taken abroad, and then re-loaned them here. The Federal Reserve figured inflation could be cut back if borrowing could be cut back, and it began to restrict the borrowing of its associate banks. It even moved to cut off the borrowing of eurodollars. But the lead time of the corporations did not permit them to turn around so quickly. The money was committed to be spent, so the corporations in aggregate borrowed up full at the banks, edged out of the long-term debt market, and began to sign IOUs, short-term commercial paper. Some say the Federal Reserve indirectly encouraged the growth of this paper by forbidding banks to pay the going interest rate on large time deposits. Some say the banks steered their clients into paper because they couldn't accommodate them. Certainly the dealers in that paper sold their product aggressively. Commercial paper is just that, an IOU. It says that Sears, Roebuck, or Chrysler, or what have you, promises to pay you, in 30 or 60 or 90 days, the face amount. Most commercial paper does not have a maturity of more than 90 days, and much of it matures in under 30 days. The buyers of commercial paper are big buyers. The smallest customary denomination is $25,000, and some pieces run $1 million. Some pension funds and banks buy commercial paper. But most often the buyers are corporate treasurers who want to put money to work for just a few days at a higher rate than treasury bills and similar instruments will yield. A company treasurer or a country bank buying commercial paper expects to get its money back in a few days plus interest. If the U.S. Treasury will pay him 7% for those days, he may get 8.5% from commercial paper. Obviously, he believes the commercial paper is a good risk, or he could not take a chance with all that money for only a few days' worth of extra interest. Traditionally, a company is supposed to have bank credit equal to its outstanding commercial paper. After the debacle, or near debacle, questions were asked and lawsuits filed. How come the credit behind the paper hadn't been thoroughly analyzed? The answer will not be found here. The question is part of the feeling of the time. But obviously, the buyers once thought all the paper was good. They were wrong about a small part of it. Then for a time, they thought no paper was good. With the banks tight and their ability to sell bonds limited, American corporations sold IOUs, commercial paper. From 1966 to 1970, the amount of outstanding commercial paper more than quadrupled, from $9 billion to nearly $40 billion. For the 12 months up to the June crunch weekend, it had doubled. The lack of liquidity in the economy had its roots half a decade back. Much of the borrowing done by business had been under at least some assumptions that sales would be good, but they were disappointing. The flow of cash in corporations was 10 to 30% below expectations, and that in itself built up the necessity to borrow. By June of 1970, the sixth largest enterprise in the United States and the largest railroad in the country, the Penn Central, was busted enough to be very slow to pay the conductors on its trains. It was having trouble renewing or rolling over its maturing commercial paper, and it had $200 million outstanding. For weeks, the Penn Central's bankers had worked night and day on an emergency loan to be guaranteed by the U.S. government. The administration lobbied in Congress for the loan. On Friday, June 19th, the bankers were so confident that they gathered in the Northwest Conference Room on the 10th floor of the Federal Reserve Bank of New York to sign the papers as soon as word came from Washington that the government guarantee would be in effect. But the word did not come. Congressional disapproval had been hardening. The $200 million loan, said Wright Patman, chairman of the House Banking Committee, would be only the beginning of the welfare program for this giant corporation. It would risk hundreds of millions of the taxpayers' money in a highly questionable scheme. Later, Patman told Congress that the administration had asked the Federal Reserve Bank of New York to check out the loan. The bank replied that the loan would provide no significant relief to the company, that it could not recommend approval of the proposed loan on the basis of factors normally considered in appraising credit risks, and that it did not see how the taxpayers would ever get their money back. But the administration, said Patman, did not bother to give Congress that report when it was lobbying. All this is in the congressional record. Shortly before 5 p.m., a government official, the intended guarantor of the loan, told the assembled bankers in New York that there would be no approval. The bankers, who had been working on the project so intensely, said the notes of a later Federal Reserve meeting were shell-shocked but not resentful. They left our building and went to the uptown office of the First National City Bank, where they tried to figure out how they could protect themselves. In Philadelphia, the Penn Central's lawyers began to draw up the bankruptcy papers. They would rather, they reasoned, march in orderly under a white flag than have some creditor put them into bankruptcy. The Penn Central's chairman, Paul Gorman, and 3 of his directors went to Washington to see Patman on Saturday. Patman had not changed his mind. The directors went back to Philadelphia. The Penn Central's board met again in Philadelphia on Sunday and threw in the towel. One of the lawyers drove to the suburban home of U.S. District Judge C. William Kraft, Jr. with the papers. Sunday is always a good day to go busted. Once the Penn Central had handed over the papers, it did not have to pay its debts except under reorganization. Most important for this story, it would not pay the holders of its IOUs, its commercial paper. They could paper their bathrooms with all $200 million. The corporate treasurers who had thought they would put money out at a better rate than Treasury bills would get back neither interest nor principal, at least not without lengthy lawsuits. They would lose all the money they had put up. The Walt Disney Corporation lost $1.5 million that way, American Express $4.8 million, Homestake Mining $1 million, and so on. The paper holders eventually sued everybody in sight, and some settled for a fractional reimbursement from the dealers. There were some other very large American corporations also in a state of gasping illiquidity. It is not polite to name names, but you could start with Lockheed, Chrysler, TWA, Pan American, and LTV. In particular, 2 finance companies, Chrysler Financial and Commercial Credit, had commercial paper out far in excess of their approved credit at banks. The worriers began to see the following script. The holders of the Penn Central's commercial paper would be busy papering the bathroom and calling their lawyers. Like Mark Twain's cat, who sat on a hot stove and then would not sit on any kind of stove, hot or cold, investors would not exactly be reaching for more commercial paper. The commercial paper from other companies had short maturity. Some would come up Monday, some Tuesday, and so on. There was $40 billion of commercial paper outstanding, and if nobody was to sit on that particular stove again, where would $40 billion come from as the notes matured? Day by day? Not from the stock market. The stock market was flat on its back, and anyway, it takes time to register to sell stock. Not from the bond market. The bond market was in disarray, and the bond dealers were still working off inventories from weeks previous. Not from the banks. The banks were all loaned out. I was on a summer weekend in Cape Cod, says the economist of a major New York bank. I went to town to get the paper, and I just stood there reading it in the grocery store. I could see the U.S. banking system might have to pick up an extra $15 billion, and it just didn't have it to give. I remember thinking to myself, this could be another Credit Anstalt. The Credit Anstalt was the Austrian bank that failed in 1931 and turned out to be the first domino to fall. It triggered a whole series of bank failures and helped to bring on the worldwide depression. Wasn't that a bit extreme? I asked the senior economist. The 6th biggest enterprise in the United States goes broke, he said, but it's a railroad. There are special provisions for railroads, left from the 1930s. They keep operating. But you let half a dozen major U.S. companies default on their short-term debts, their creditors throw them into the courts. Their suppliers and contractors are afraid they won't get paid, and they rush for the courts. And meanwhile, everybody tightens up and cuts operations and starts laying off people. You could have a real panic that would snowball, a panic that would feed on itself. It's happened in this country before. But I said in this day and age that wasn't likely. You've never lived through a panic, he said. But there is a lender of last resort. That is why we have a Federal Reserve System. Congress, by the Constitution, can create money, and Congress gave that money printing function to the Federal Reserve in 1913 when that agency was created. The Fed reports to Congress once a year. It is an independent agency. Its 7 governors are appointed by the President for terms of 14 years apiece. This is not the place for the college freshman economics course explanation for the mechanics of the working of the Fed. Suffice it to say it can turn money on and off. By the way, it turns the faucet. The Fed hopes to speed up the economy when it slows down, and slow down the economy when it gets overheated. It used to believe that if the cost of money went up, buyers would drop away. At this point, however, the Fed was working more with monetary aggregates, which one Fed official described as roller skating on 3 wheels. It will work, but you need new body movements. There is a philosophy that the way to cure inflation is to get everybody to stop reaching out. You want them to curl up in a fetal position and stop breathing for a while. That cures enthusiasm. Then things cool off. The Fed had had the money valve largely off, because inflation was certainly roaring. The Fed itself had been criticized for cutting off money too abruptly in 1966, for increasing it too fast in 1967 and early 1968. Fed meetings are not public, but the 2 possible positions were fairly clear. The first position said thus: only we can print money. Once we print it, we can't control how it is used. Printing money has to be part of an overall plan, involving foreign balances, taxes, and so on. Our official policy is one of restraint, and if we depart from it, not only are we not able to control where the money goes, but the news of a sudden change might have a reverse effect and scare everybody to death. The second possible position for a Fed governor was to worry about Monday morning, and to treat the weekend as something special in history. The issuers of commercial paper would not be able to sell anymore. They would go to their banks. The banks would say, sorry. The issuers would be brought into the courts by the people to whom they owed money. The issuers would start to lay off people and cut back operations. Everybody could stake out a corner for an apple stand, if the corner wasn't already occupied by a fried chicken stand. The notes of a Fed official to a Fed meeting later that summer uses this language. Inability of the issuers to pay their paper at maturity would have dire consequences for the issuers, the commercial paper market, other financial markets, and the banking system. Dire consequences is a phrase not used lightly. The Monday Morning Worriers won. Alfred Hayes, the president of the Federal Reserve Bank of New York, was in London. Acting for him was a 63-year-old former Wall Street lawyer, William Treiber, now the executive vice president of the New York Fed. Treiber is a pleasant, white-haired type, given to conservative 3-piece suits, just as you would expect from a Columbia College, Columbia Law, Sullivan and Cromwell, executive vice president of Federal Reserve Bank. Treiber left the massive Federal Reserve Building, modeled after the Strozzi Palace in Florence. At the same time, the shell-shocked bankers went up to the First National City's offices. Treiber drove to this weekend home, a 200-year-old farmhouse in East Winchester, Connecticut. He called the First National City Bank at 10:30 p.m., he reported later. The bankers were all still there and still in a state of shock. Treiber got on the phone. Over the weekend, that was all he did. He moved a card table with a phone on it into the dining room of his farmhouse. He talked to Arthur Burns, chairman of the Board of Governors and captain of the Monday Morning Worriers. He called the head of every major bank in New York at home, or the next in command if the chief executive couldn't be found. David Rockefeller of the Chase Manhattan was on his boat, off Bar Harbor, Maine. Treiber couldn't leave his card table, except briefly, because the farmhouse only had one line, and frequently he had to leave word. His daughter took a picture of Daddy's weekend office. In the dry language in which these things are reported, it was said the bankers were told that the use of the discount window would be appropriate, which does not mean everyone got a cut rate. Sunday night, Treiber flew to Washington. The Fed's Board of Governors met Monday at 9 a.m. By Monday night, phone calls had gone out through the 12 Federal Reserve banks to every bank in the system, not just to big city banks, but to small-town banks all over the country. The Fed's index finger was beginning to bleed from all the dialing. The message was the same. If anybody comes into your bank and wants a loan, give it to 'em. Then if you're all loaned out, come to us and we'll see that you have the money. I began to speculate. What would have happened if teenagers tied up the home phones? Or if the Fed's own Paul Revere were unable to get through? The Penn Central's lawyers are driving through suburban Philadelphia looking for the judge's house, nervously thumbing the paper, and the line is busy. I could see the following scene. After all, school was out. "Hello, Mr. Jones, please." "This is Timmy." "Hello, Timmy. Can I speak to your father?" "No." "Please, Timmy, it's important." "No." "Why can't I speak to your father?" "He's not here." "Where is he?" "He's outside practicing his golf swing." "Could you go get him?" "No." "Why can't you go get him?" "I'm not allowed to leave the kitchen until I finish my lunch." "This time it's all right. I'll fix it for you, I promise." "I have to finish my lunch." "How long will it take to finish your lunch?" "I don't know. I don't like carrots, but I have to eat them." "Could you call him from where you are?" "No." "Is anybody else home?" "Yes." "Who? Let me talk to them." "Arthur can't talk." "Who can't talk?" "Why can't they talk?" "He's a dog." "Timmy, listen closely. I want you to put the carrots in Arthur's dish and then go get your father." "They'll find out. Arthur doesn't eat carrots." "Just do it. Listen, Timmy, would you like a new football helmet? Would you like an autographed picture of Arthur Burns in uniform?" "Yes." "Good boy. Just do what I say." After an appropriate interval, the banker makes it to the phone. "Hello?" "Rodney, this is the Federal Reserve calling. I'm sure you know why." "Ah, I think my kid got the message garbled. He said you said to put the carrots in the dog's dish." The Fed official says, sorry to call him at home, but that if anybody wanders into his bank, dispense money. Rodney thanks him and reminds him, don't forget the autographed picture of Arthur Burns. On Monday, June 22nd, Arthur Burns, the Fed's pipe-smoking chairman, pressed not only for the additional reserves, but to do away with the regulation queue, which would permit the banks to take in large short-term time deposits. The Fed had taken those large time deposits away from the banks as an anti-inflation move. Now it decided to worry about inflation some other time, and gave them back. After an all-day debate, Burns won his point. From that point on, events followed the script. The Penn Central went broke, but no one else did. $6 billion fell away from the commercial paper market as buyers recoiled in horror. The companies that were going to sell the commercial paper and were unable to do so went to their banks and begged for money. The banks went to the Fed loaned them the money, and the banks reloaned the money to the would-be insurers of IOUs. In one July week alone, the banks lined up for $1,700,000,000 at the Fed window. More than $2 billion in bank money went to companies whose commercial paper was coming due. Not only that, with regulation Q wafted away, the banks took in $10 billion. $10 billion in time deposits, just in case anybody needed more money. Some of the bankers who had stayed awake that summer, fretting that if anybody added up the losses in their bond portfolios they might think the bank was busted, were stunned to find that they were having a very good year. The Fed was pleased. Not only had there not been a crisis, but the money had been recycled. It had been there as debts before, and it was still there. Now, however, it was owed to banks, not to individual borrowers. And with the banks, the borrowers could have some breathing room to sit down and work repayments out in an orderly way. And there was no great inflationary addition to the supply of money. Gradually, there began to be faint cheers for the Fed's actions from all of the 17 people who understood them. A New York banker said the Fed had done a classic job. Business Week said a wrong move by the Fed could have allowed Penn Central's financial distress to infect the nation's financial system, touching off a chain reaction of corporate failures. As the crunch abated, the bankers and the Fed performed the equivalent of the pro football touchdown ritual. Lots of fanny patting, jumping up and down, and hugging the ball carrier. I can see it all in a ghostly, silent instant replay, except that the stadium is empty. It is empty because nobody knows it happened, not only Mr. and Mrs. America, who think that the Fed is the FBI, but all the readers of those papers that carry financial pages. It is all too abstract and too hard to explain. 105-yard razzle-dazzle touchdown in absolute stony silence. William Triber's September 10th report to New York Fed directors contains some sense of satisfaction. The commercial paper market was in a near-crisis situation, he said. The banks stepped into the breach promptly to provide credit, aided, of course, by the expressed desire of the Federal Reserve to assist the banks in avoiding a crisis. The commercial paper market is now calm. Triber had to add a final sentence. It was an interesting, he said, at times a highly exciting experience. I have to figure the crisis of June 19th through the 23rd, 1970, as a very near miss, because the normal language of banks, and especially of the Fed, is dry, abstract, full of passive tenses and unemotional. Things are not supposed to be interesting in the banking business, and when they become highly exciting for the participants, I begin to hold my breath. When it was over, the Fed returned to its nice, dry language. Here is some of its description of the events transpired from the Monthly Review, August 1970, of the Federal Reserve Bank of New York. Never mind the phrases that are strange. Keep going and get the feel. Fears of a general liquidity crisis rose to a peak late in the second quarter after the Penn Central Company filed a petition for reorganization on Sunday, June 21st. These worries were exaggerated. Nevertheless, concern during the second quarter over the possible widening of liquidity problems aggravated the uneasy atmosphere in the money and bond markets. These pressures were most evident in the commercial paper market, where participants became apprehensive that some borrowers would be unable to refinance a large volume of existing debt, some of which was of very short maturity. The Federal Reserve System acted to facilitate refinancing of these debts by the banking system by suspending Regulation Q ceilings on large short-term time deposits and by using the discount window and open market operations to guard against liquidity pressures. These actions had a salutary effect on most financial markets. Tensions subsided, and everybody lived happily ever after. Just that easy. Yet something bothered me. It was in the phrase, the lender of last resort. Why was everybody cheering the Fed? Did not some people say that the Fed's stop-go policies had helped cause the crunch? Was it not their job to do just what they did? I asked the Fed. It seems to me, I said, that the Fed did just what it should. That is why we have a Fed, so we do not have the panics that we had in 1873 and 1893 and 1907, with banks failing and markets collapsing and everybody out of work. It's like having a fire. You call the fire department. The Fed officer leapt at the metaphor. I guess Fed officers are so used to saying the discount window might be appropriate, that a metaphor has seductive charm for them. Exactly, said the Fed officer, exactly, the fire department. This never happened before, and it worked. The engines and the hoses and the water pressure and the foam, it works, it all works. In time, as nobody else went busted, some confidence crept back into the commercial paper market. The demand for funds abated. The banks reduced their prime rate to 8%, then to 7.5%, then to 7%, and they built up their own liquidity. What could have been a crisis was over. And why is this drama relevant to understanding what went wrong in the stock market? Any investor has a choice. He can buy a stock or he can buy a bond. If bonds are yielding 2%, he may well figure he can do better in the stock market. If bonds are yielding 10%, he may just settle for that. If you are running a pension fund and all you need to supply the pensions is a return of 4.5%, and you can buy a telephone bond at 9%, you buy the telephone bond and play golf until you retire, for your job is over. When there isn't enough credit, people will bid up the price of money, and telephone bonds will sell at 9%. Then the money that could go into stocks will go into bonds instead, or stockholders, professional and individual, will sell their stocks and buy bonds. And that means that everybody who bought an 8% telephone bond at 100 finds it marked down to 97, when there is a new telephone bond at 100 that yields 9%. When there is a 9% telephone bond, everybody that owns an old bond, even a week old, has a loss. That is a description of an uneasy bond market and why it is bad for the stock market. If you add to that a real crunch, with the possibility of major companies not paying their bills and their payrolls, nobody will buy stocks. Maybe some other time, maybe they will be cheaper later, Maybe we will get a chance to buy Chrysler at the 1933 prices, if there still is a Chrysler. If you add to that just a few rumors of a bank holiday, well, it does something to the atmosphere. A bank holiday is a misnomer. Everybody else gets the holiday. The bankers have to stay till midnight figuring out which companies to save and how to keep the bank going. By historical standards, American business is still not enormously liquid. But the summer of the crunch created a great thirst. The first order of business was to get a cushion back into the balance sheet. According to Tilford Gaines, senior economist of the manufacturers Hanover, business needed more than $50 billion, over and beyond any needs for new money, just to get back to the relative stability of the early 1960s. Within a year, that was down to $35 billion, and it is still going. Secondary borrowers have a much harder time than the big boys, but once more there is money for everybody. The prime rate for bank lending has come down 3 percentage points, which doesn't sound dramatic enough, so they say 300 basis points, which is dizzying. In the days since the Great Crunch, there have been other threats to peace, serenity, and the stock market, notably in the balance of payments crisis and the devaluation of the dollar. Government intervention in the economy increased in the forms of various controls and phases. While it would be possible to tell some near-miss stories of these events, they occurred after the market had passed its points of greatest vulnerability, both in terms of prices and of structure. All the banks have been reminded of the name, address, and telephone number of the lender of last resort, and all the bankers' children know that if the phone rings on Sunday, and it is a man from the Fed sounding breathless, it is perfectly okay to go outside and get Daddy without finishing your lunch. Chapter 5. The Day the Music Almost Died. The Brokers, September 1970. If there was a lesson learned from the crunch, it was that illiquidity snuffs out a stock market. People who need money bid the price up, and then bond yields go up, and then other people take their money out of the market and buy bonds, and the market goes down. Nice and simple. So you have to look one page past where your stocks are listed to the bond page. If well-rated bonds are yielding 7.5%, that is an amber light. If they are at 8 or 8.5%, you can start to get nervous. By the time they get to 9%, it is probably too late. There were people, respectable people, who thought the bear market was going to last for 5 years or 10 years or maybe forever. That was how long it was going to take to get liquidity restored. Corporations needed $50 billion, and states and cities and the federal government, well, they would never be through with the money demands at all. But once the cycle was cracked, the treasurers, both public and corporate, who once had hurried to market because next week the rate would be higher, held off. Now if they simply waited a month or two, they were rewarded with lower rates, and that brought back the more normal supply and demand flow. But the liquidity crunch was not the only near miss in the Big Bear. Wall Street itself almost collapsed from its own mismanagement. We need not go into too much detail, because this story has been told elsewhere, and there are few lessons to be learned by individuals not involved in the business. But it is possible to write a near miss, equally hair-raising script about the last day of American capitalism, and focus it on good old Wall Street, which itself had been so used to judging the rest of corporate life. The middle 60s were a euphoric period for the broker types. It should be said right away that some people kept their houses in order and did not get their names into the paper. And both of them are still happy. 120 firms went out of business. The center of this drama is a piece of paper, the stock certificate. In the old days, under the buttonwood tree, one knickerbocker would hand over the coins and the other would hold forth the piece of paper. That was in a time when all the trading was over by morning coffee time. A century and a half later, the mechanism was still the same. The people who got into trouble were the so-called retail brokerage houses. They dealt with the public, and the public was in the market. The name of the game was production, which meant writing tickets. To do that, you opened a new branch office, hired some new salesmen, bored housewives, failed accountants, drop-out aluminum pan salesmen, and told them to call everybody they knew with the hot new stock ideas. The ex-aluminum pan salesman's Aunt Mary and his lodge brothers opened accounts. The production went up, and the tickets went up. That was where the trouble started. For Wall Street, by and large, was like a beautiful fan-tailed Detroit Belchfire 8 with leather seats, remote control windows, color TV in the back seat, and under the hood, 6 perspiring squirrels running on a treadmill. The branch offices were equipped with beautiful quote machines, that great promotional device, the tape, now probably in orange symbols electronically flashing on a black background, and a Dow Jones ticker so demure it went clack, muffle, muffle, clack, instead of takada, takada. When the lodge brother bought a stock, the transaction would be recorded in the back room by a gentleman wearing gym shoes and a jacket indicating the freshman basketball team of Cardinal Hayes High School, who would lick his pencil as he recorded the trade. With such personnel, it was not uncommon to have mistakes. The securities, if they could be found, would be delivered to the brokerage firm by another gentleman in a Salvation Army overcoat, a 9-day growth of beard, and a certain air of Muscatel, California, 1973. Sometimes he would get where he was going, and sometimes he would not. Sometimes his parcel would get there with him, and sometimes it would not. Business was very good. You could walk into a teller's cage and walk out with securities. They were lying on the floor, on the tables, all over the place. Did not bad people then take the securities away and never bring them back? Yes, they did. In 1971, they took $500 million worth. Sometimes good people did too. It was commonly assumed that the mob was responsible for all the missing securities. It was very easy to put in your very own man. You could dress him in a Salvation Army overcoat if you wanted to get the securities that way, and you could dress him in acne and a Cardinal Hayes leather sweater if you wanted them that way. If you wanted to move him up one step in sophistication, you put a man in the clerical department as the bank transfer agent, or in some other record-keeping capacity, and then nobody could figure out the records. One step up from that, you took the securities to a country bank in Limburger, Ohio, put them up as collateral, took out a loan, and then simply left them there forever. Why not? Not your stocks. One operator, known as the paper hanger, told Congress just how to do it. I was having a drink one evening with the governor of the stock exchange who had worked very long and hard hours on the problems. The mafia couldn't possibly have stolen that much money, he said. Good people had to steal too. The temptation was too great. The FBI, the other Fed, apprehended some bad people and located some missing securities. To wit, some 3,400 shares of IBM belonging to a well-known brokerage firm. Plucky public servants that they are, they called up the firm and told them to be happy. Their IBM was found. We're not missing any IBM, they were told. Months later, when the records were a bit more straight, the firm sheepishly asked the FBI if it could have the IBM back. The FBI said yes. It is not recorded what else they said. Not all the securities, of course, were stolen. Many were not there in the first place. They were clerical errors. In fact, most of the discrepancies probably belong in the bookkeeping category. Firms lost physical control of the pieces of paper. But if you think I'm kidding, I recommend to you 2 splendid documents. One is the review of SEC records of the demise of selected broker-dealers, the report of the Securities Subcommittee of the House Committee on Interstate and Foreign Commerce. The other is the study of unsafe and unsound practices, done by the Securities and Exchange Commission in conjunction with Section 11H of the Securities Investor Protection Act of 1970. I particularly recommend the transmittal letter of the Chairman of the Securities and Exchange Commission to the President of the Senate and the Speaker of the House, dated December 28, 1971. Here is one pithy summary. This statute was enacted against a backdrop of the most prolonged and severe crisis in the securities industry in 40 years. Widespread failures of broker-dealer firms and concern for the funds of their customers had followed a prolonged period of easy business. Rising brokerage income and rising security prices had produced a general euphoria. In this mood, expansion of sales effort and overhead had not been properly supported by more capital and stronger back-office effort. A veritable explosion in trading volume clogged an inadequate machinery for the control and delivery of securities. Failures to deliver securities and to make payment ricocheted through the industry, and firms lost control of their records and of the securities in their possession or charged to them. Operation conditions deteriorated so severely that securities markets were required to cease trading one day each week at one point, and later to limit daily trading hours. The chairman of the SEC had a very strong sentence to conclude that paragraph. Those conditions, he wrote, should not be allowed to recur. Why was the record-keeping so fouled up? Among other reasons, there is a simple sociological one. In times of prosperity, stockbroking is a prestige profession. You get to talk on the phone, sound important, know what's going on, and play with expensive electronic gadgets. Underwriting companies is even more prestigious. Being a partner of a firm is best of all. You get to order a splendid new office with books by the yard and a special shower off the men's room, or, if it is an older firm, an appropriate antique roll-top desk. From there you talk to the giants of capitalism. It is not very prestigious to keep records, match up certificates, or in general do the dreary housekeeping known as back office. So nobody wanted to be the partner in charge of dishwashing, and in many cases, nobody was. Once the troubles started, all the business school type partners knew exactly what to do. They tell you that at business school. If you have a problem, you call in an outside consultant, Arthur D. Little or McKinsey or Booz, Allen, Hamilton, or one of the computer software people. The consultant says it is lucky you called. Your communication techniques are obsolete. Your record keeping is archaic. How can you expect to conduct a 20th century business with 18th century record keeping? What you need is an IBM 36020 computer system at $5,000 a month and some staff to go with it. You are relieved. You have made the right executive decision. At business school, they told you would have to use a computer. That is, when your firm goes busted, the computer follows up. I refer you to SEC Chairman Casey's points 8 and 9 in the transmittal letter referred to above. 8. New and expensive technologies were hastily brought to bear on the paperwork problem without adequate preparation, analysis of cost, or mastery of technical requirements. 9. Records were put on computers without maintaining the old records for safety until the computer operation proved itself. Of course you threw the old records away. The computer people told you everything was fine now, didn't they? A sociologist came downtown and found that the computer people wouldn't talk to the securities people. The securities people wore wide ties, and the computer people wore narrow ties. The securities people lived in Manhattan or commuted from the suburbs, and the computer people lived in Brooklyn and took the subway. If Jonathan Swift had written a story about a war between the people who thought you should tap the little end of the egg first and those who thought the big end should be first, everybody would think it was a fable by some crackpot who had a strange attitude toward Irish children anyway. At the peak of the troubles, fails to deliver totaled $4 billion. Nobody could find $4 billion worth of stocks. The New York Stock Exchange has certain requirements. A firm is supposed to have a certain amount of capital in relation to its obligations. Never mind that the obligations were getting out of hand. There was trouble on the capital end too. If you had put capital into Wall Street firm, you could take it out sometimes in 90 days, sometimes in a year. Few other businesses have such an ease of exit. Some of the capitalists took their capital out, and the remaining capital, well, that was frequently in the stock market, and many of those stocks were melting away in market value. Back to the near miss. As firms began to fall grossly behind in their capital requirements, they would be suspended from dealings by the New York Stock Exchange, except for very big firms. There was indeed a prejudice in favor of size. Said Robert Hack, president of the exchange, "We simply can't afford to have a major firm fail." Much later, the stock exchange gave 3 justifications for its prejudice in choosing to try to save the major firms, while letting lesser firms fail. The great number of customer accounts, they said, would not have allowed an orderly liquidation. Suspension of the firms would have lost them their technical clerical staffs at a time of intense competition for such people. And the announcement of a suspension of a major firm might cause a run on all brokers, even ones in good shape, by worried customers. The stock exchange had established a trust fund early in the 60s, at the time of the salad oil scandal which put Ira Haupt and Company out of business. Those funds were to provide an orderly liquidation for a failed firm so that the customers would not lose their money and maybe spread the word that you could lose all your money without even making a mistake in the market. That leads to the calling up of congressmen. As the major firms began to teeter, the exchange would authorize its members to increase the trust fund. The amounts increased from $10 million in 1965 with an additional $15 million in standby credit, to a maximum of $55 million in 1970, to $75 million in January 1971, and finally to $110 million, with $30 million set aside in a customer assistance program for Merrill Lynch's obligations in its Goodbody rescue. At each increase, some of the surviving members would ask, "Why don't we just let the bastards go down the tube?" And Felix Rohatyn, a soft-spoken governor of the exchange, a merger specialist from Lazard Freres, who had bought a number of companies for ITT, would say, "That is not an acceptable risk." At 8:30 a.m. on September 11, 1970, Hayden Stone was out of business. It had followed the classic pattern: increased production, disorganized record-keeping facilities, its capital impaired by being invested in falling securities, and a large number of fails. At one time, it had been said that Hayden Stone was so disorganized that you could peel the wallpaper off the wall, deliver it to Hayden, and get paid. Rohatyn and Bernard Lasker, chairman of the governors of the stock exchange, had applied all their merger-making talents to finding a firm that would take over the lagging giant. The problem was a group of Hayden Stone's note-holders, who were reluctant to go along with the marriage arranged by shotgun and persuasion with Cogan, Berland, Wheel, and Levitt. If the Hayden merger didn't go through, said an exchange governor, that could have been the ball game. The end of the ball game might have had the following script: the opening bell rings. Hayden Stone is declared in liquidation. A minimum of $25 million from the trust fund would have been needed to pay the overhead and clear up the records while the firm's affairs were straightened out. The firm's overhead had been running at $5 million a month. Even reduced to $2.5 million, the costs of liquidating it would more likely have been $40 million to $70 million over 18 months, perhaps as high as $100 million. Hayden Stone's 90,000 customers would have been frozen in place, unable to buy or sell for many months. The cash and securities owed by Hayden Stone to other firms would have forced those firms under. Perhaps another 50 firms could have gone out of business. As those firms sold securities to raise cash, the Dow Jones average need not have stopped at 630, or indeed anywhere short of 400 or so, and broader market averages would have suffered equally. But worse, the confidence of millions of investors, already impaired by the bear market, would be dealt a final blow by the sight of Hayden's immobilized and screaming customers. They would all race to their brokers and demand their cash and their securities. Wall Street had for years used its customers' cash, and many of the securities were very likely nowhere to be found. There would be a classic run, not on the bank, but on the brokers. And beyond that loomed a specter, so frightening nobody wanted to think about it. There was $50 billion out there in mutual funds. A mutual fund can be redeemed in one day. You simply bring the papers in and say, "Sidney, I want the money." The mutual funds had had a cushion. Every year their salesmen sold more fund shares than fund holders redeemed. So they had to sell stocks only as a market strategy. If they thought the market was going down, they might want 10% in cash. If they thought it was going up, they might want to be fully invested. Statistics show, parenthetically, that is what they did when they thought those thoughts, but the market generally went the other way, rather perversely. They did not sell stocks to give cash back to worried redeemers. What if the holders of mutual funds got scared and started to cash in? Already 50 brokers were going out of business. Hundreds of thousands of accounts were tied up. A run on the brokers was going on. Brokers were selling stocks to beef up their capital accounts, and now, what if the mutual funds were forced into sales to raise cash to pay off nervous redeemers of their shares? To whom would they sell their stocks? I thought about that a lot, said my friend who was the exchange governor. We would have had to close the exchange. Close the New York Stock Exchange, I said. What happens then? I don't know, because it's never happened like that, he said. But certainly you would have the government step in, and when the exchange finally reopened, things would be very, very different. Maybe like the Yugoslavia Stock Exchange, I suggested. Maybe, he said. At 8:30 a.m. on September 11th, 1970, the script was 90 minutes away from the bomb in the suitcase. To get Hayden Stone merged safely away took the approval of 108 note holders of the company. Not only did the Hayden Stone officials scramble to get the signatures, so did Robert Hack, the president of the New York Stock Exchange, and the ubiquitous and worrying governors, Messrs. Rohatyn and Lasker. By Friday, September 4, when the deal was supposed to have been set, all but a few of the note holders had said they would go along. The merger was supposed to be delivered to the Exchange's Board of Governors on Thursday, September 10th, but one of the note holders still had not signed. By the Exchange's own rules, Hayden Stone should have been suspended some time before. Now the Board of Governors voted a reprieve of a few hours. The holdout was an Oklahoma City businessman named Jack Golson, who had put $1.5 million into the firm only the previous March, believing, he said, that the firm's statements were up to date and that the New York Stock Exchange would not have allowed him to invest in a firm that was about to go busted. Golson said he'd rather go into liquidation. Maybe the tax consequences were better, and anyway, he was tired of being pushed around. Having been given a few hours' reprieve, the Cogan-Berlin people, who were to take over the merged firm, raced for the Teterboro airport, chartered a Learjet, flew to Oklahoma City, and sat up all night with Golson. At dawn, Golson was still shaking his head. At 8 a.m., Rohatyn and Bunny Lasker got on the phone in a conference call. They hit me with a whole trainload of social responsibility, Golson said. The government, said others, was aware of the situation. Golson capitulated. At 9:55 a.m., 5 minutes before the liquidation would have been announced, the Dow Jones ticker flashed the news of the merger. But the duties of Rohatyn, Lasker, and the other worriers were far from over. Two other great firms were taking on water fast. Francis I. DuPont, with 275,000 accounts, the third largest brokerage house in the United States, and Goodbody and Company, 225,000 accounts, also one of the largest in the country. It did not take an adding machine to figure that if they both went down, the Exchange's trust fund would be out of money and then some, and the whole run-on-the-bank script would be back in operation. Both of these accounts have been rendered elsewhere in the press. You could make a book out of all those adventures alone, or better yet, a successor to Mission Impossible, with a cliffhanger each week ending at the last commercial. It was not easy to get people to take over Wall Street firms that were losing millions of dollars a month. Remember the alternate uses of money. You could get 9.35% a year, every year, in that good old telephone bond, and never worry about another thing. But in a takeover, you had to put up more than money. You had to have the expertise to take over and, if necessary, shut down branch offices. You had to take over and straighten out the tangled records and finances. In short, you had to take over and run a large and failing business. Who needed that? Obviously, only a major financial institution could do it. There had been pressure from mutual funds and insurance companies to join the exchange, but that pressure had been resisted by the existing members, the brokers, for fear it would hurt their own businesses. So the exchange had no institutional members. Only 2 or 3 brokers could take over someone as big as Goodbody. It was decided that Merrill Lynch, by far the biggest broker, should have the new acquisition. Merrill drove a hard-nosed bargain. The exchange community was to put up $30 million against losses incurred in straightening Goodbody out, and absolutely no other firm should fail or the deal was off. That left DuPont, and the DuPonts of Wilmington, Delaware, were in no mood to help. The candidate on the white horse was clear. It was a Texas billionaire called Ross Perot. Perot was not at all the traditional loud, cigar-chomping, super right-wing cartoon Texas oilman. His money was all in shares of Electronic Data Systems, or EDS, a computer software company. Perot was so straight and H. Elgar-like that even stricken Wall Streeters could not believe it. As a boy, he had gotten up at 3:30 a.m. and ridden 20 miles on horseback to deliver the Texarkana Gazette to poor neighborhoods that no one else wanted to service. He was an honors graduate of the Naval Academy. His billion came from the high price at which EDS shares sold, but he said often that the day he became an Eagle Scout was more significant than the day he became a billionaire, and he gave several million to the Boy and Girl Scouts. He had joined IBM as a salesman and had met his yearly quota by the third week in January. He started EDS with $1,000 and was turned down 80 times before he made his first sale. Perot is 5'6", has a crew cut and wears straight ties. His nightlife is playing basketball with his wife and 5 children, or taking everybody out for a hamburger. Perot first came into the news because of his efforts to take Christmas packages to prisoners in North Vietnam. His chartered planes had gotten as far as Laos. The Nixon administration knew both Wall Street and Perot. Attorney General John Mitchell was a partner in a law firm specializing in municipal bonds. Richard Nixon himself had been a senior partner of that firm. Peter Flanagan, a special assistant to the president, had been a partner in Eastman Dillon. Mitchell had managed the 1968 campaign, to which Perot had been a contributor. Furthermore, Perot certainly knew Francis I. DuPont and Company. Even if he did not know Wall Street, EDS had been hired to do the computer work for the firm, and in fact the firm accounted for 15% of EDS's revenues. John Mitchell was very helpful in getting Perot involved, said an exchange governor. That whole story need not be recounted here. The cynics said that if EDS revenues were $50 million and 15% of that came from the DuPont contract, then it should have been worth $100 million to keep that business alive. And anyway, maybe Perot wanted EDS to take over all the computer work for the stock exchange and a lot of other firms. The believers say Perot wanted to save Wall Street and the system that had been so nice to him. One friend of mine who knows him well says that Perot is half Boy Scout and half horse trader, totally sincere at both and very good at both. Perot took over DuPont. First he put in $10 million, then he put in another $30 million. So far, he has had to put up about $50 million, but the place is still in business. Taking over Hayden Stone had involved teams of people. Taking over Goodbody had enlisted the biggest firm in Wall Street. The final role, and it is so extremely rare that this falls to one man, had fallen to a single individual who said that if Wall Street had been impaired, even temporarily, the consequences would have been dire, not only for industries but for the cities, counties, and school systems of the country. It would be easy, said the current chairman of the Securities and Exchange Commission, to point out errors, omissions, and failures in the last 5 years. Firms and self-regulatory authorities were thrashing about, wrote Mr. Casey in his transmittal letter to Congress, in all directions fighting to avoid catastrophe. Time and time again they had to select the lesser evil. Decisions had to be made in a rapidly changing situation. Maybe Congress could understand if it read War and Peace, said Mr. Casey, in what surely must be the only time the SEC has ever reported to Congress by quoting Tolstoy. There was Kutuzov facing Napoleon before Moscow. And, said Casey, said Tolstoy, the commander-in-chief is always in the midst of a series of shifting events, and so he never can at any moment consider the whole import of an event that is occurring. Moment by moment the event is imperceptibly shaping itself, and at every moment of this continuous, uninterrupted shaping of events, the commander-in-chief is in the midst of the most complex play of intrigues, worries, contingencies, authorities, projects, counsels, threats, and deceptions, and is continually obliged to reply to innumerable questions addressed to him, which constantly conflict with one another. An order to retreat must be given to the adjutant at once, that instant, and the order to retreat carries us past the turn to the Kaluga road. And after the adjutant comes the commissary general asking where the stores are to be taken, and the chief of the hospitals asks where the wounded are to go, and a courier from Petersburg brings a letter from the sovereign which does not admit of the possibility of abandoning Moscow, and the commander-in-chief's rival, the man who is undermining him, and there are always not merely one but several such, presents a new project diametrically opposed to that of turning to the Kaluga road. Everybody knows what happened. Kutuzov survived. Wall Street survived. No other major firms went out of business. Congress, mindful of the 1,500 letters a month the SEC was getting, and of its own mail, passed the Securities Investor Protection Act of 1970, which created an agency that could borrow up to $1 billion from the U.S. Treasury, if necessary, to protect customers against losses if it became necessary to liquidate the firm in which their securities and cash balances were held. That took the pressure off the industry and off the New York Stock Exchange, and restored some public confidence. Securities in the failed-to-deliver class dropped from $4.1 billion at the end of 1968 to $1 billion at the end of 1971. The narrow tie computer people were given new prestige, more money, and some partnerships, or the equivalents in corporate form. The piece of paper, the stock certificate, is still at the center of the transaction, and delivery is still made by gentlemen in Salvation Army overcoats. That is still troubling, but the mechanism of transaction, it is safe to say, has everyone's attention. And, said the chairman of the SEC, looking down the road a little, not the Kaluga road, a metaphoric road, the time will come when the execution of a trade will be electronically conveyed to a point where securities are transferred by electronic record with paper printout, and payment is made by similar electronic means. The future of the New York Stock Exchange is not totally clear. But what is clear is that it will not be moving to Dubrovnik. The structure of the securities industry is going to be quite different, but that concerns the people in it more than the multitude of investors. The involvement of Congress in passing the Securities Investor Protection Act means a continuing involvement of Congress. The government rarely leaves any endeavor where it has created an additional staff. So, bad things happen that need not and should not have happened. But catastrophic things did not happen, at least not catastrophic enough to send the whole business to Dubrovnik. The individual investor, it seems fairly safe to say, slept unaware of the liquidity crunch, and read in the papers about the problems of brokerage firms. All he knew was that his stocks were going down. But what of they, the big boys, the professionals? They with the research and the computers and the experience, was the hand steady at the helm? The gaze steely and cool? There are answers to these questions, because this is an industry that keeps score daily, unlike almost any other in the world. But statistics provide rather bloodless answers. Let us go back, just for a sense of atmosphere, to see how far we have come. For it was not so long ago that you could have panic in the street, and that is a buying panic as well as a selling panic. Chapter 6. Nostalgia Time. The Great Buying Panic. Just one term ago, the president, then incumbent, said he did not choose to run. The response of the marketplace was unmitigated enthusiasm. The previous volume records had occurred in the great selling convulsions of 1929 and 1962. The I do not choose to run speech triggered off a buying panic, and now there were new volume records. With all the brouhaha about Vietnam and the cities recently, a Wall Street panic seems like very small potatoes, almost irrelevant beside the cosmic problems. But panic there was, and very interesting to a handful of students of mass psychology. The panic is interesting because it is a reverse panic, therefore requiring a new line in the dictionary. The old line in the Random House Dictionary reads, Panic. Finance. A sudden widespread fear concerning financial affairs leading to credit contraction and widespread sale of securities at depressed prices in an effort to acquire cash. That is the dictionary definition. All the rest about panics you can ask Granddad about. The roar on the floor increases. The phone lines jam. The volume of all the shares traded breaks new records. Now you can see that we did indeed have a panic. Sudden widespread fear and credit contraction. The difference in 1968 was that this time cash was sold at depressed prices to acquire stocks. The panic was so great that all the old 1929 volume records have gone out the window. The new 1968 records belong to the Great Buying Panic. It was, in general, a much happier panic, since it was only some of the professional money managers who bore the brunt of the malaise. Everybody else got to feel smart. The boardroom watchers felt smart because the stocks they forgot to sell were going up. And downtown the brokers felt like absolute geniuses because they all met their 1975 profit projections 8 years ahead of time. And any industry that far ahead of its projections must be populated by geniuses indeed. The president did not choose to run, and peace is bullish. Are the causal relationships that simple? I happened to be having breakfast on April 1, the morning the panic began, with poor Grenville. This epithet is at least partly ironic. Poor Grenville runs a swinging fund, and with his tall, blonde, establishment looks, poor Grenville is a Hickey Freeman model or an ad for the racket club. Not poor. One of poor Grenville's great-grandmothers had a duck farm, and part of the duck farm is still kicking around in the family. There aren't very many live ducks on it anymore, since the duck farm ran roughly from Madison Avenue east, bounded by, say, 59th Street and 80th Street. But then you never know how much the descendants get their fingers on, what with estate taxes and trusts and all. Poor Grenville was suddenly called poor because he had just gotten nicely into cash. $25 million of it. In 1966, when the market turned around and ran away. If you are a true performance fund manager, you should be 100% invested when the market is moving up. Now here it was only March of 1968, and poor Grenville had just gotten himself back into cash. $42 million this time, and the president had just said he isn't going to run, and peace is in the air. Poor Grenville was very fidgety at breakfast because last year he had had to come up fast on the outside to stay in the performance fund derby at all. Win, place, and show in the derby means the salesman can sell that record into hundreds of millions. I think it's a whole new ball game, poor Grenville said that morning. I have to lose all my cash right away. So I stuck around after breakfast just to see how poor Grenville would spend $42 million. I asked poor Grenville why he had sold so much in the preceding weeks. I wasn't that unhappy with some of the stocks, poor Grenville said. But I didn't like the international monetary situation. I thought Washington had lost control. I thought it would take high interest rates to get the balance of payments back in line. And Johnson? Who could believe Johnson? Confidence is an important factor. And now the international monetary situation is okay, and you believe Johnson, I said? All from that one sentence last night, I do not choose to run. I don't believe anything he says, poor Grenville said. It's probably some trick. The international money situation is still followed up. So what? It's still a new ball game. It doesn't matter what's true. What matters is what everybody else thinks. Every fund you and I know is about to come piling in. Let's get on the phone. So we got on the phone. Poor Grenville put in an order for 20,000 burros at 170. That's $3.4 million. Burros had been in poor Grenville's notebook to buy at 150, but this was a new ball game. Poor Grenville also tried for a block of Mohawk data at 140, and bid for a block of control data. These were the stocks that helped poor Grenville come up fast on the outside last year. The market opened, and while we were waiting for the first $20 million to go to work, we gossiped on the phone with some other managers around the country. "Oh, we might nibble a little this morning," said one West Coast Dennison coolie. He was so cool he had been in his office since 5 a.m. practicing his buying. "Actually, we bought a lot last week." "I can see the history of this whole event shaping up," I told poor Grenville. "If the market goes up this week, it's last week all the smart fellows will have bought." "Nibble? Hell," poor Grenville said. "I hear he is loaded with cash. I bet he's in there bidding for my burros." Poor Grenville called the broker he had picked for the burros. He was told burros hadn't opened yet, nor had controlled data, nor had Mohawk. Heavy buyers on the floor, no sellers. Temporarily, the great auction market had come to a halt. Poor Grenville began to nibble at a fingernail. He called the broker back again and raised the bid to 172. "That's an awful big order for the floor on a day like today," the broker said. "Have you tried the blockhouses?" Blockhouses are Wall Street firms who arrange large trades, blocks, like poor Grenville's 30,000 shares. We called 2 blockhouses, One of them thought he could get a nice block of 30,000 burros for Grenville at 200. Robbers, thieves, said Grenville. That's $1 million more than Friday. You think $1 million grows on trees? The first figures on the market came in. The volume was setting new records. The market was up $17. Look at them all piling in, the greedy bastards, poor Grenville said. The Burroughs broker called back. Burroughs was trading at 184. It had opened on a large gap, which is to say it did not go up a neat point or two at a time, but simply started a whole 15 points or so higher than it had last closed. Idiots, poor Grenville said. Do they think peace comes overnight? Don't they know the Korean War went on for 2 years after the talks started? Okay, I'll take it at 184. The broker said he would call back, and in a few minutes he did. How much did I get at 184? Poor Grenville wanted to know. You didn't get any, the broker said. Burroughs is 189. Madness, poor Grenville said. See if you can't get it at 188. Poor Grenville had researched Burroughs, had worried over when the computer operation would become profitable, had even tried out one of the new electric accounting machines. He had carefully considered what he wanted to pay for it. Now, in 2 hours, he had raised his bid on the Burroughs from 150 to 170 to 172 to 184 to 188, and he still didn't have any. He called the broker back. How much Burroughs do I have now? He asked. You don't have any, the broker said. Burroughs is 191. It was lunchtime. We sent for sandwiches. The volume was setting records every minute. The lights on the phones flashed every 30 seconds. Poor Grenville's Mohawk and control data were way over his bids, too. My God, poor Grenville said. It's 12:30 and I still have $42 million in cash. It was true. Poor Grenville had been chasing his favorites, but they had outrun him. He had yet to buy a share. This market has come too far too fast, poor Grenville said. We'll pick some things up on the reaction. There's bound to be some profit-taking. There was a reaction, about 1:30. It lasted about 3 minutes. Poor Grenville missed it because he was eating his bacon, lettuce, and tomato. And anyway, a 3-minute sinking spell doesn't do you much good when you have $42 million to spend. Now poor Grenville was beginning to clutch. Every fund in the country is going to be up 3% today, he said. They're going to be up 8% for the week. Within 2 weeks they'll be up 15%, and I'll still have this lousy damn $42 million. Poor Grenville wrote $42 million on a notepad and stared at it, hating it. I've got it, he said. Let's buy what the hedge funds are short. Hedge funds, as you may know, try both sides of the market. They increase their leverage by selling some stocks short while they buy others. In a big upswing, obviously, they would have to buy back what they had sold. It took us about 5 phone calls to find out where there were some blocks short. Now we could make them suffer a bit by buying those stocks we knew they would have to be buying. We called up one hedge fund just to chat. The hedge fund was paranoid. It pulled up its drawbridge and poured boiling oil over the ramparts. It had troubles of its own. The volume was still setting new records. A friend of mine is buying a sheep farm, poor Grenville sighed. That would be a much more peaceful and productive way to make a living. With your timing, I said, you would sell all the sheep just as everybody was about to go long, lamb chops. We have to buy something, poor Grenville said. I can't just sit here and cash. I'm going to look stupid. They'll throw me out of the Performance Fund Union. Get on the phone and collect some stories. We'll buy stories. It doesn't take long to collect stories. A story goes, I hear XYZ is going to earn $4, but the street doesn't realize it yet. Never mind why. Tomorrow, there will be no more stocks for sale. So we bought and we bought and we bought. The phones rang and the hold buttons were pushed and there was general tumult. At the end of the day, I was helping poor Grenville go through some of the tickets in the snowstorm on the floor. There were tickets for stocks poor Grenville had never thought of. The only ones missing were the ones he had been chasing, his friendly high flyers, Burroughs, Control Data, and Mohawk. What the hell's this, he said. Union Carbide? An old granddaddy company? Are you out of your mind? 100,000 shares of Union Carbide? 100,000 shares of Union Carbide is a nice block, about $4 million. I didn't buy any Union Carbide, I said. I put that guy on the hold button. I thought you talked to him. There were 4 phones ringing. I never bought any carbide, poor Grenville said. I would never buy a tired old mother like carbide. Well, I didn't buy it either, I said. We stared at each other, and then at a smudged, penciled slip. It followed us home, poor Grenville said. What the hell? Just go out and get it some warm milk and a blanket. The next day, a New York Times reporter called poor Grenville to check on the block. Poor Grenville learns fast, and he was ready. Our fund, he said, did not follow the mass panic into such high flyers as Burroughs and Control Data. In these times of turmoil, we are seeking value. Union Carbide, for example, whose additions to net plant make it attractive. We believe, after exhaustive research, that the chemicals are ready to turn. Next thing you know, Newsweek was about to quote poor Grenville on value in these troubled times. 4 more funds bought carbide. Grenville, the statesman. The headlines make causal relationships. Market spurred by peace hopes. Market rises on booming economy. But the real impulse behind the buying panic was not in the headlines. It was in a statistic. On March 22nd, 8 days before the beginning of the Great Buying Panic, the mutual funds had Grenvilled themselves into $3.4 billion in cash just because things looked so gloomy. That's $1 billion more than normal, and the $3.4 billion didn't count all the pension funds and colleges and foundations that were beginning to play the aggressive performance game. The object of the aggressive performance game is to be first, to have the stocks that go up the most, to buy stocks at the bottom. You have to sell them first, so you have the cash when you want to buy. Naturally, not everybody gets to be first back in, and when you have dramatic moves in war and politics, the swings can be of panic proportions either way. Only the triggers are missing. Performance is a new word among the funds, but a taste for quick gains is not new. In 1935, our Lord Keynes wrote, "The social object of skilled investment should be to defeat the dark forces of time and ignorance which envelop our future. The actual private object of the most skilled investment today is to beat the gun, as the Americans so well express it, to outwit the crowd, to pass the bad, or depreciating half-crown to the other fellow. This battle of wits to anticipate the basis of conventional valuation a few months hence does not even require gulls amongst the public to feed the maws of the professional. It can be played by the professionals amongst themselves. Nor is it necessary that anyone should keep his simple faith in the conventional basis of valuation having any genuine long-term validity, for it is, so to speak, a game of snap, of old maid, of musical chairs, a pastime in which he is victor who says snap neither too soon nor too late, who passes the old maid to his neighbor before the game is over, who secures a chair for himself when the music stops. The game can be played with zest and enjoyment, though all the players know that it is the old maid which is circulating, or that when the music stops, some of the players will find themselves unseated. Sometimes I wonder whether those paragraphs from the general theory of employment, interest, and money will ever lose their validity. The games were, and are, indeed played with zest and enjoyment. The swings get shorter and more violent. It is not news but atmosphere, climate, and psychology that set this up. Some market Copernicus might say that the news does not change. It is our perception of it that moves. Chapter 7. An unsuccessful group therapy session for 1,500 investment professionals. Starring The Avenging Angel. The swings did get bigger, and the living was easy for 7 or 8 months after President Johnson's speech. Brokerage firms that dealt with the general public opened new branch offices and scoured the countryside for salesmen. All kinds of stocks went from 5 to 50. Flocks of them had the word computer in the title, or had names that suggested data processing. Still others franchised some sort of fast food, hamburgers, or chicken. There were chains of nursing homes, for we had suddenly discovered geriatrics is a boomed industry. Sideburned young men in melodandry shirts were running 5,000 into $500,000 by talking to other sideburn young men. Age was a great handicap. No one over 30 could understand the market, and everyone knew it would come to an end. A mass circulation magazine asked me to explain to its readers what was going on. I had this Fellini scene. We are all at a wonderful ball where the champagne sparkles in every glass, and soft laughter falls upon the summer air. We know by the rules that at some moment the Black Horseman will come shattering through the great terrace doors, wreaking vengeance and scattering the survivors. Those who leave early are saved, but the ball is so splendid no one wants to leave while there is still time, so that everyone keeps asking, "What time is it? What time is it?" But none of the clocks have any hands. The Black Horseman did come, of course, and most of the guests were still at the ball. In the same article I suggested that the market did not make any sense to anybody with a sense of history. The way to participate, therefore, was to hire a kid. A kid would buy these stocks going up tenfold, where anyone else would be scared to death, and a kid could be rented for $1.50 an hour plus room and board, and would mow the lawns on weekends. The satire was ineffective, to say the least, and the price was far too low. Just after the 1968 buying panic, I made my annual visit to the investment course at the Harvard Business School. While there, I asked the class how many were going to Wall Street. There was a forest of hands. Usually numbers of them wanted to go to Procter & Gamble or General Motors. But the action was no longer that way. None of them, however, had in mind working for $1.50 plus weekend lawn mowing. They thought maybe $20,000 a year to start would be fair. The more venturesome wanted to run a hedge fund and get 20% of the action. After all, they had been running paper portfolios in class all year, and they had done extremely well all term. And they had analyzed complicated prospectuses, and some of them had been in the market on their own for 2 or 3 years. By the third section of the class, I got a bit testy, and it was clear that the curmudgeon was out of his time and a thorough has-been. Some of the students did work with hedge funds. That must have lasted about a year, and some got quite handsome starting salaries. That doesn't happen so much anymore. But then the institutions were in an expansive and hiring mood. At the institutions, the mutual funds, investment counselors, and endowment funds, a new generation had taken over. The old generation had concentrated on the preservation of capital, and inflation had taken its toll. McGeorge Bundy at the Ford Foundation, the biggest of all the foundations, delivered himself of a memorable blast. We recognize the risks of unconventional investing, but the true test of performance in the handling of money is the record of achievement, not the opinion of the respectable. We have the preliminary impression that over the long run caution has cost our colleges and universities much more than imprudence or excessive risk-taking. The Ford Foundation gives out a lot of money to colleges and universities, and the Bundy statement was read religiously. It was true that respectability rather than performance had been the goal of most endowments, but now the implications were clear. Nobody had better get caught with caution. So the colleges and universities sold some of their bonds and increased their positions in the equity markets. They told their investment counselors to hunt for small growth companies, like the ones that had brought the University of Rochester from nowhere to the 5th richest in the land in the previous 10 years. The mutual funds were out on their own derby because the salesman could sell only the previous year's record. The bank trust departments were a bit frustrated because the trust laws did bid them be prudent, but the definition of prudence had loosened up, and some of them started special equity funds to seek out performance. So it was not merely greedy individuals who fueled the boomlet, picking up tips on the train or at the barber shop or what have you. You can't have a market fever anymore without some institutional help. Just to take one example, National Student Marketing was bought by Bankers Trust and Morgan Guaranty. The General Electric Pension Fund, the Northern Trust Company, the endowment funds of the University of Chicago, Harvard and Cornell, and the Continental Illinois Bank. That is by no means a complete list. The original symbol of go-go performance, Jerry Sy, held 122,000 shares in his Manhattan fund. The stock was recommended by the old-line firms of Kidder, Peabody and Eastman, Dillon, as well as by Roberts, Scott & Company, W.C. Langley & Company, Lowy & Company, and others. W. Cortez Randall, the 34-year-old mastermind who put National Student Marketing together, had a net worth in his own stock of $50 million, a 6-passenger Learjet, a 55-foot yacht that slept 12, an apartment at the Waldorf, 3 cars, a snowmobile, and the rapt attention of both security analysts and deal makers. In the story market, Randall had a concept that eager analysts could chew on. National Student Marketing signed up students on the campuses to take market surveys, hand out samples, and put up posters. This was to be the franchise to tap into the youth market, 40 million Americans between 14 and 25, who had $45 billion a year to spend. With Wall Street underwriters and dealmen leading the scouting, National Student Marketing acquired 23 companies in fiscal 1968 and 1969, including a travel agency, a youth-oriented insurance company, a maker of college rings, and a collegiate beer mug manufacturer, using its own stock selling at 150 times earnings, true supercurrency. Even at that price, brokers were recommending it as an attractive long-term speculation. Dynamic changes have occurred in society, at least in part due to the growing force and influence of the current sophisticated campus groups. Student economic power overlooked by marketing experts. National Student Marketing is a pioneer in closing the generation gap between the corporate client with a product or service for sale and the youth market with its purchasing power. Preaching his company's gospel around the country, Cortez Randall reported net earnings of $3.2 million with higher to come. Barron's skeptical columnist Alan Abelson did his usual perceptive job. National Student Marketing's fiscal 1969 profits included 3 companies with which deals had been made, but which actually hadn't been part of the operation during that year, and 5 companies that hadn't even agreed to merge yet. Abelson subtracted the new companies from the operating results, a simple enough operation, and came up with a loss of $600,000 instead of a profit of $3.2 million. The stock kept right on going. At corporate headquarters there was a whole middle management, some 60 to 70 strong, flush with the power of a new idea, and apparently with rather lavish expense accounts. Only out there on the broad green lawns of the academy, not all the campus representatives were putting up their posters as they promised. Some of them out there must have gone to the basketball game or taken up dealing in grass. Not an approved NSM line. The whole operation became expensive to maintain. Some of the on-campus stuff flopped totally, and a direct mail campaign was a disaster. Instead of glorious profits, the company was into $1.5 million loss for the first quarter alone of fiscal 1970. National Student Marketing went from 36 to 1.5. I did not check to see what the Morgan Bank did with its stock, nor the Northern Trust, the Continental Illinois, the Bankers Trust, the Manhattan Fund, and the University of Chicago, Harvard, and Cornell. No longer could the last 3 be accused by McGeorge Bundy and the Ford Foundation of excessive caution. Not to single out those 3, virtually every investing institution had something like that. The University of Vermont and Syracuse University had 4 Seasons nursing homes, which made it from 91 to busted in a remarkably short time. The market value of the equity portion of Oberlin's endowment dropped 25% in 1970. Temple University moved its equity portion of the portfolio from 35 to 85% in 1967 and 68. And when asked how that had fared, the investment advisor at the Girard Trust in Philadelphia said, "Horribly." Euphoric at the ball, few of the professionals really left early, and though it was not their money they had lost, they did not feel good. They are competitive fellows, most of them, and they like to do a good job. So I thought that at one of the industry meetings we could dwell on what went wrong. One of my functions within the investment community, and one which I enjoy, has been to be a moderator at seminars and conventions. There is one in particular, an annual meeting that attracts the largest number of bank trust officers and mutual fund managers. We assemble the investment types with the best records, and they tell what insights led them to their triumphs, what stocks they have just bought and therefore would like the audience to buy, and what they see ahead. Of course, it is not always genius that earns an investment type a slot on this panel. He may have taken undue risks. He may be down 90% in the next year. He may have done the equivalent of flipping heads 51 times in a row. No matter, the figures are in, and up to the dais he comes. I have never found one who is inarticulate, and in fact most are willing to comment on the investment significance of foreign policy, economic policy, sociological changes, and other subjects usually reserved for Eric Severeid. It has become a minor tradition that I needle the panelists gently, reminding them perhaps of a sour stock they had confided to me some other time, rather like the slave in the Roman chariot assigned to whisper into the garlanded conqueror's ear that glory is fleeting. I thought it would be a nice psychological purge after the worst year of the Big Bear if some of the previous winners would get up and confess their sins. Every one of the professionals in the audience, after all, harbored some dark secret. His own block of national student marketing, which he had dropped behind the paper towel bin in the men's room, hoping no one would notice. There they were, these professionals, walking around harboring these unconfessed misdeeds. Who could tell the damage being done to the collective unconscious of the investment community? So I think I had in mind a group therapy session for 1,500 investment professionals. Previous winners would get up, face the audience, and say that not only had they bought national student marketing, they still owned it, in case anybody would like to buy it, and furthermore, they had put it into their children's accounts. In Alcoholics Anonymous, you are supposed to be on the road to cure if you can face your peers and say, "My name is John Jones, and I am an alcoholic." Not only would my session benefit the confessors, but the audience would identify and go through something of the same process. Some of them might feel the spirit and rise from their chairs, crying, "I bought 4 Seasons nursing homes." The audience would respond with the business school equivalent of "Glory!" Everybody would leave feeling cleansed and free. For a while it worked. 2 of the previous winners talked with good temper about what they had done and would not do again. They would no longer have such a limited view of history. The limited view of history said that you don't sell good stocks in a decline because they'll come right back. They would no longer go into illiquid situations, no matter how great the promise. They would no longer fall in love with stocks for giving the first lapse, and then the second lapse, and so on all the way down. "We didn't pay attention," said one speaker, which was to say everybody had paid attention to 10 or 15 stocks, but not to Vietnam and Cambodia and the Federal Reserve and Washington and the world at large. Another speaker was going to laugh if somebody said, "There is only a limited supply of stock," and still another speaker was going to disregard his clients, or potential clients, especially the ones who, when you were bearish, would say, "Call me when you're more optimistic." Snug in its chairs, the audience was warm and responsive. It was all going along well. Then I tapped David Babson. I should have known better what was coming. Babson is a crusty, amiable New Englander who heads the 6th biggest investment counseling firm in the country. He was then just turning 60. For a couple of years he had been preaching and scolding. The stock market, he had said, was becoming a national crap game. If the sinning didn't stop, he had told other groups, if the whole gigantic parimutuel operation didn't stop, there would be government intervention. Babson had told me once that when he brought good grades home from Harvard to the family farm in Gloucester, Massachusetts, his father was down in a vegetable garden. The Babsons are 1630 New Englanders, but Yankees, not Brahmins. In addition to running the farm, Babson's father was the local veterinarian. Babson walked the length of the field and told his father the news. "That's good," said his father, "but you've been home 10 minutes, and you still don't have your overalls on." Babson had not always been scolding. In fact, his weekly letters proved him to be a cheery optimist and a bull on America in the late 40s, a time in which the surrounding opinion was quite gloomy. He had started the weekly letter because, when he began his counseling service in 1940, there was no line outside the door. In Babson's view, the most prized virtues were hard work and common sense, not smartness or cleverness, but common sense, and these virtues would triumph in the long run. Babson read off a list of 11 villains, which I will come back to in a moment. I picked him up on a statement. Was this terrible market due to the professionals? Of course, he said. Nobody else. The professionals, people who ought to know how to manage investments, got sucked into speculation. "What do you think we ought to do about this?" I asked. Babson looked over his glasses at the audience. "Some of you should leave this business," he said. There was nervous laughter. I asked him if he had anybody in mind. "Some of them have offices near here," he said. I said I didn't know anybody with an office near here. "Some of them are sitting quite close," he said. When a prospect for a new account asks how much growth he can expect, and we tell him 10%, and he says somebody else has promised him 20% a year, we ask him which Fred promised him that. By sheer coincidence, there were some very well-known aggressive portfolio managers named Fred. We had one, by another coincidence, sitting with us. Later, each of the Freds was to express resentment at having been lumped in with the other Freds. "Too many Freds?" I heard Babson mutter, and then he said, "Should a manager who put Parvin Dorman into a client's account be allowed to advise anyone again?" Parvin Dorman had gone from 142 to 14. "I have a list here," Babson said. He pulled it out and began to read. "Four Seasons Nursing Homes," he said. "The high was 91 and the low is bankrupt. Anybody that went to bed with Four Seasons?" "David," I said gently into the microphone. The audience was beginning to rustle. You can tell something has happened to the good feelings when the water pitchers start to clink nervously against the water glasses in a rising cacophony. "Commonwealth United," he said. "The high was 25 and the current price is 1. Susquehanna, the high was 80 and the current price is 7. Unexcelled, the high was 68 and the current price is 4. All great institutional favorites." "Don't read the list," I said. The audience was beginning to scrape its chairs. My massive group therapy session had taken a sour turn. Nobody was going to confess if they were being accused. "Computers?" Babson said. "Management assistants 46 to 2? Levin Townsend 68 to 3? David," I said, "Liasco data processing 57 to 9? Data processing and financial general 92 to 8? David," I said, "you have passed the pain threshold of the audience." He stopped. The audience was absolutely silent. Well, I remember thinking, maybe catharsis was the wrong idea anyway. Maybe sinners in the hands of an angry God is more appropriate. "Thank you, Jonathan Edwards," I said. Babson did not get a standing ovation. We had questions from the audience. There was one rather plaintive one for Babson which showed that my original idea had at least taken hold. "Isn't there just one mistake of yours that you could point to?" the questioner asked Babson. That got the applause. Babson said he could find a few if he dug hard, but no serious ones. Babson's own fund had taken 7 years to double when others were doing that in months, but it had held its ground while the others melted away. "My host asked me what my strategy is," he said. "It is the same this year as for any year, to try to use our common sense. I asked all my other winners whether the game was coming back. They all said that sooner or later it was, except Babson. No greater period of skullduggery in American financial history exists than 1967 to 1969, he said. It has burned this generation like 1929 did another one. And it will be a long, long time before it happens again. The day I went to work in 1932, Babson said later, steel mills were running at 8% of capacity. I remember days when the trading was so slow people played ball on the floor of the exchange. The ticker didn't move at all, and then Armour crossed at $4 a share. After the war, I pushed growth stocks when today's performance managers were in their playpens. The Census Bureau predicted the U.S. population would be 165 million in 1990. I was a radical then, and maybe I'm a curmudgeon now. Times change. The economy changes, but another group has to grow up out of the playpens, and the scars have to heal before you do it all again. I said that was pretty optimistic. Maybe so, but common sense will go a long way to help. Here's Babson's list of villains. 1. The conglomerate movement, with all its fancy rhetoric about synergism and leverage. 2. Accountants who played footsie with stock-promoting managements by certifying earnings that weren't earnings at all. 3. Modern corporate treasurers who looked upon their company pension funds as newfound profit centers and pressured their investment advisors into speculating with them. 4. Investment advisors who massacred clients' portfolios because they were trying to make good on the overpromises that they had made to attract the business. 5. The new breed of investment managers who bought and churned the worst collection of new issues and other junk in history, and the underwriters who made fortunes bringing them out. 6. Elements of the financial press which promoted into new investment geniuses a group of neophytes who didn't even have the first requisite for managing other people's money, namely a sense of responsibility. 7. The securities salesmen who peddled the items with the best stories or the biggest markups, even though such issues were totally unsuited to the customer's needs. 8. the sanctimonious partners of major investment houses who wrung their hands over all these shameless happenings while they deployed an army of untrained salesmen to forage among even less trained investors. 9. Mutual fund managers who tried to become millionaires overnight by using every gimmick imaginable to manufacture their own paper performance. 10. Portfolio managers who collected bonanza incentives of the heads I win, tails you lose kind, which made them fortunes in the bull market, but turned the portfolios they managed into disasters in the bear market. 11. Security analysts who forgot about their professional ethics to become storytellers, and let their institutions be taken in by a whole parade of confidence men. This was the list of horrors that people in our field did to set the stage for the greatest bloodbath in 40 years, Babson said. The doctor in Pocatello, Idaho, did not by himself think up the idea of buying liquidonics and Minnie Pearl. And the man on Main Street didn't decide on his own hook to buy a new El Dorado mutual fund which has since flushed half its assets down the drain. Well, that is a handsome list of villains. I have the feeling that in Babson's part of New England the stocks they put you into for not having common sense are the wooden ones down on the village green that are very uncomfortable for the hands and feet. In retrospect, there is nothing wrong with Babson's list except that the villains do overlap, and the excesses are seen as totally within the industry. There were, as we have seen, some macro villains that also helped to set the stage. There was the unpaid for Vietnam War with the concomitant inflation, and those responsible for that. And there was the antiquated structure of the securities industry, and those responsible for that. 4 of Babson's 11 villains were investment managers guilty of one sin or another, and 3 were people in other roles in the securities industry proper, partners, analysts, salesmen, who ignored their professional responsibilities. I brought Babson's list in here to show that there was a lot of finger-pointing within the industry, and that if you have a secret hurt, so did a lot of the professional managers. If you bought an El Dorado mutual fund, you may have hurt right along with those managers. Which brings up a pertinent point. Suppose that all this business about the Federal Reserve and the market and the swings makes you too nervous. Suppose you want to leave it all to the pros. You go to your bank and let them manage the money. Or you buy a mutual fund. How would you have done? For after all, it should be pointed out that many funds were not El Dorado funds, and that the vast majority of American securities by market capitalization were not promotions but mature American companies. They may not have produced gains for their investors, but that may be due to other reasons having more to do with their own basic natures and the broader market forces. A simplistic answer has to precede the statistical one. If you bought a mutual fund that went up, you did well. There were such funds. If you bought one that went down, you did badly. There were such funds too. And there were banks that made money for people, and banks that lost money for people, and investment counselors that did the same. This point is brought up for a very obvious reason. You have to do something with the money, and just because you invest it does not mean you have to be the median or the average. Somebody has to be first and somebody has to be last, and one hopes to be closer to the former than the latter. Now to the sources. They are familiar to those in the industry that care about such things, and they include the obvious. The Institutional Investor Study Report of the Securities and Exchange Commission, especially Volume 2, the Comptroller's staff reports from the Office of the Comptroller of the Currency, bank trusts, investments and performance, and the work done by several academic institutions, notably the Wharton School of Finance at the University of Pennsylvania. From the latter came the best-known statistical job, sponsored by the 20th Century Fund. It is published as Mutual Funds and Other Institutional Investors by Irwin Friend, Marshall Bloom, and Jean Crockett. In addition, there are a number of academic papers, usually heavy in mathematics and statistics, published in such professional journals as the American Economic Review, the Papers of the American Statistical Association, and so on. And you can take your own samples from the Lipper computer runs of funds, since those have been done, and the Weisenberger statistics from the mechanical age. For various reasons, I have had to go through much of this material as it came out, and I have talked, though not extensively, to the authors. This battery of citations is a defensive measure, for, as you might have guessed, the news is not so good, and some very well-paid manager might just come up to me in the shuttle line at the airport and swing if we say that managed funds with well-paid managers do about the same as a totally random portfolio. For that is what the statistics say, and we are back with our old friends from the freshman course, the random walkers. Here is a key sentence from the Wharton study led by Erwin Friend. Virtually all the published government and academic studies have indicated that the investment performance of mutual funds in the aggregate is not very different from that of the stock market as a whole. The Wharton study compared the mutual funds with random portfolios in New York Stock Exchange stocks. Mutual funds as a whole in 1960 through 68 seemed to perform worse than equally distributed random investments in New York Stock Exchange stock, but except for low-risk portfolios, did better than proportionally distributed random investments. It isn't necessary to go into the comparisons with the funds here. Whether the random portfolios were weighted or unweighted, the Wharton people tried both, and the so-called beta coefficients, or degrees of volatility, in the portfolios. For some of the period of the Wharton study, the higher risk funds, those so asperically charged by Babson, helped the overall performance of the fund industry. Because the Wharton study ended in September 1969, before those funds took their biggest bath, and a horseback guess would be that by factoring that in now, you would once again come out about even. These statistics do not count the sales commission of the fund, if it has one. So if you pay that, you have to start that much further behind. In other words, a random portfolio is just as good as the average mutual fund. Chicago's Harris Trust tried another way, comparing the funds with the Dow Jones average and the Standard & Poor's 500 stock average for the 25 years ending in 1970. For half of that time, the median common stock fund came in last, behind the averages. There is no evidence, says Professor Friend, that any groups of funds can beat the averages. Of course, you cannot buy a statistically random portfolio, even though your portfolio may have a very random look about it. And you cannot really buy the Dow Jones average or the Standard & Poor. If you are going to buy a fund, or the equivalent slice in a bank-managed common trust, you have to buy that, and you hope that your fund or your bank is at the top of the list, helping the team against the randoms and not at the bottom. There is at least one other important point in the Wharton study from the potential fund investor's point of view. Adjusted for risk, the performance correlation in funds between one time period and another is zero. Professor Friend's words, expressed also in the study, there may be no consistency in the performance of the same fund in successive periods. In other words, a fund that performed well in 1966 and 1967 may not perform well in 1969 and 1970. This is important because many new investors came to buy funds for the first time, or were sold them within the last 5 or 6 years. The funds that took in the most money the fastest from investors were those that had the hottest records for a short period of time previously. The investors who in 1967 and 1968 bought funds that had shown big increases in the year or two previous did unusually badly, worse than they had any statistical right to expect. Jerry Sei's Manhattan Fund, up 39% in 1967, went down 6.9% in 1968, 10.15% in 1969, and 36.8% in 1970. The Gibraltar Growth Fund, ranked third in 1968, ranked 481st in 1971. It threw in the towel and was taken over by the Dreyfus Organization. Insurance Investors Fund, ranked fourth in 1968, ranked 317th in 1971. The Mates Fund, ranked first on some lists in a disputed finish in 1968. Ranked 512th out of 526 funds in 1971. Statistics by Arthur Lipper Corporation. The conclusions seem obvious. If you want to buy a fund, buy it. Do not be sold it. There are magazines and publications, Forbes among them, which rank mutual funds over a period of years in all kinds of markets. You do need more than a year or two to judge a record. There are funds and fund management organizations that have performed well for their investors over many years, consistently, in good markets and bad. And there are independent investment counselors who have done even better. It does take some investigation, however, a small enough price to pay. As a group, the professionals did not have a very good time through what happened. Some of them even suffered personally, which is to say that they checked out. Chapter 8. Cautionary Tales. Remember these, O brother, in your new hours of triumph. Usually it is the customers who suffer more. That is the point of the very old story about the visitor being taken around the waterfront and having the yachts pointed out. That is Morgan's yacht, that is Gold's yacht, and so on. And the customer says, but where are the customers' yachts? The brokers make as much money selling for customers as buying for customers, the reasoning goes, so it doesn't matter. That was not always the case this time. The customers could get busted right to zero, but some of the brokers managed to make it well below zero. The two incidents I felt most personally among the casualty list did not involve brokers. I just don't know many brokers. Of the brokers' misfortunes in a moment. One summer night I had a drink with a gentleman who was on his way back to Texas, from which place he had sprung with a reputation for open-handed daring. For a brief period he was well known, and he had been in one of our seminars a happy new millionaire. Now the hedge fund he was running seemed to have evaporated, and rather than hang around New York, he decided he had better get his toes back in the good old Texas dirt and see if he could find himself again. We talked about some of the things that had gone on, and he looked at his watch. He said he'd better be off to the bus terminal. The bus terminal? I have nothing against buses, but that is a long bus trip, and I offered to lend him $41.05, the difference between the air coach fare and the bus fare. He turned it down. I don't know when I could pay it back, he said. Anyway, it's a good way to see the country. Shortly afterward, I got a call from another gentleman I had met once but did not know. Could he speak to me confidentially? He could. Had I heard what happened to his firm? I gathered it was busted. It was, he said, and so was he. And he was selling his wine cellar. He knew I was interested in wines, so naturally he thought of me. A wine collection can be just as valuable an asset as a stamp collection or a spoon collection or what have you. Somebody who has paid attention to his wines not only has vintages that have appreciated, but has those that can't be found anywhere on the open market. They have all been bought and many of them have been drunk, so they are unobtainable at any price. I listened intently, pencil in hand. I expected him to say he had, say, 3 cases of that, a prize case of something else. I have 4 bottles of Latage 1962, he said. 4 cases of Latage, I repeated. Very good. What do you want for those? Not 4 cases, he said. 4 bottles. I want $30 a bottle. Well worth it. Go on, I said. I have 3 bottles of Chambertin Clos de Bez, 1964. I began to get very depressed. Tell me the cases, I said. I don't actually have cases, he said. Of course, I could put 12 bottles in the same box and make up a mixed case. He read me the rest of the list. All excellent wines, obviously picked with great care over several years, but they were individual bottles. Listen, I said, that's a very nice collection, but even pricing it generously, your whole cellar is only worth about $600. Make it $650 and it's yours, he said. You just can't be that broke, I said. In Texas, a man can only be busted down to his house and his horse. There must be something in some statute in this part of the country that says a man can only be busted down to his last 20 bottles. I owe the money, he said. Do you want it or not? I may have other buyers. If I was ever busted down to my last $650, I said, and they came for my wines, the day before I would go down in the cellar and pull the corks and have a festival they would talk about for 50 years. In fact, I proposed just that. I would bring a large brie, some splendid French bread, and a corkscrew, and we would invite a convivial group, charge admission at the door, and do justice to the last remaining assets. That idea didn't sell. A buyer came along who bid up $730, I believe, and the wine collector watched his bottles depart one by one. What do you do all day? I asked this of Dan, who had run both institutional accounts and an in-house fund at a leading institutional brokerage house. Dan's background was impeccable. Princeton and the Harvard Business School. He had been at the firm about 7 years, and as of the Big Bear, was in his late 30s. His portfolios had been volatile, to say the least. Some of them had performed quite spectacularly earlier in the decade, but he had paid the price for the volatility in more recent markets. His personal account showed the streak of a true gambler. Stocks were rarely leveraged enough. That is, the profits didn't move fast enough unless he borrowed and bought more. Usually he was into calls and sometimes into commodities. While he was a partner or stockholder in the firm, it was decided mutually, he said, that they should part company. It was very pleasant at first, he said. The only time I'd ever had off from working was vacations, time to benefit the kids, and so on. Now I picked them up at school every day and helped with the marketing. I decided that with Wall Street in a convulsion and contraction, this was no time to go looking for another job. I read the New York Times every day. I read it. I used to spend 10 minutes with the papers. I found I could spend 3 hours with the Times alone. I didn't tell very many people I'd left. I didn't think that would help. Then it was summer and I went to the park with the kids every day. Summer is vacation time and people don't know whether your vacation is in June, July, or August. So they just assumed I was on vacation. I went to 1 or 2 job interviews, but it was plain that going to work at that moment would not be advantageous. I never knew whether I would have gotten those jobs, but I think I would have had a good chance. But they wanted me to relocate, one to Hartford, one to Toronto. I wasn't ready to do that. Furthermore, I began to ask myself what I wanted to do for the rest of my life. Maybe I'd had enough of the financial world. Maybe I'd go into government. Fall was a bit rougher. The kids went back to school, and obviously I couldn't go sit in the park anymore. I went on a couple more interviews that didn't promise much. I asked Dan what he was living on at the time. He said he gradually sold off some of his stocks, and he had sold the stock of the firm in which he had worked. He made a few turns in the market. I asked Dan's wife how she liked having him around all the time. At first I liked it a lot, she said, and even on balance I liked it. If your husband has been working long hours in an absorbing job with some travel, it's nice to have him around for lunch and to help with the marketing and to get to know his children. But he did get discouraged from time to time, and then I really had to be careful with him. He could have real flashes of depression and anger. Don't ever cross him on the New York Times, by the way. He knows everything in that paper. Eventually, which is to say about 16 months after he and his job had parted company, Dan became a financial consultant to a governmental agency. He had decided not to go back to Wall Street. That whole place, he said, is just devoted to making a lot of money, and I wanted to make more than anybody, really, to pile it up. You don't need all that much. What was all that about anyway? It was, as I said, some of the brokers who managed to make it well below zero. The only way their customers could have gone more broke than that would have been to borrow more than was legally available. The principle was very simple. A gentleman would go to work for a firm and, his eye on the golden apple, strive for years to become a partner. He would work late, take out-of-towners to the hockey games, land accounts, put a syndicate together, or whatever one had to do to become a partner in his particular area. Then one day the partners would come to him and say, "Rodney, you've made it. You can have fresh orange juice on a silver tray at 11 every morning." There would be some legal mechanics. If the firm was worth $10 million, and they had decided to make Rodney a 1% partner, then he would be expected to put up $100,000. He could then start earning a very handsome share of the partnership. Of course, if he didn't have the $100,000, the partnership would lend it to him. Sort of a fringe benefit. In the recent unpleasantness, firms that got into serious trouble often asked their partners to put up more money, or various other lenders were called in, and their money would have to be repaid before the partners had a partnership. If the whole effort failed, the firm might be merged away on very unfavorable terms, such as $1.50 per desk, 75 cents per chair, and zip for the partners. The trouble is that a $100,000 loan would still be listed as personal liability for Rodney. In the old days, he would have gone to debtor's prison or to Australia. One unlucky gentleman to whom I was introduced had worked for years at a distinguished firm, but his efforts were not rewarded with that golden apple of partnership. and he got another offer, this time a partnership at Goodbody and Company. Goodbody quite happily loaned him the partnership money, and for a year or two he reaped the handsome rewards that Wall Street partners reap. Then, as we have seen, Goodbody got deeper and deeper into trouble, and finally, with numerous midwives and witch doctors attending, Goodbody got merged into Merrill Lynch at $1.50 per desk. And let us say quickly that everybody breathed very hard on Merrill to do it, since Goodbody was so large there was practically no one else that could swallow them. Our gentleman found himself without a job. He did get another one, but along with him went that loan he had signed. "My life is very simple," he said. "I am 54 years old. I have 3 children in school and college. I have a job, no assets, and I owe $545,000. The way this works can be illustrated with the story of a man we shall call Phil. Phil was in research, and at 45 he was making $75,000 a year at one of the leading retail brokerage firms. Phil did well, and they offered him a partnership. To buy the partnership, Phil put up $6,000. Phil did not come from a moneyed family, and the firm loaned him $30,000. The firm at that time had a capital account of $4 million. The only problem was that the liabilities of the firm seemed to increase geometrically. The figures showed that the partnership was deeper and deeper in the red, and so was Phil. "I had an East Side apartment and 3 kids in school, boarding school," Phil said. In February or March of 1970, the senior controller showed me the real figures, which even the senior partners weren't up on. In fact, as the firm started to go, we began to get monthly financial statements that broke down the loss per partner and said at the bottom, "Please remit," or something like that. Phil tried to get out of his contract. You couldn't get a lawyer on Wall Street in those days, he said. They were all afraid of retribution. I finally got a kid I knew on the Harvard Law Review. Not even a lawyer, but there was nothing I could do. I owed the firm $350,000. It was just too ridiculous to think about. I mean, I thought about it. I still think about it. I couldn't pay them $1,000, much less $350,000. The firm went busted. It was reorganized, let us say. And Phil found himself on the sidewalk for the first time in his life. You go through various psychological things when you've been laid off. You begin to doubt your ability. All sorts of things. Even at that, I was luckier than some. There was one partner who had inherited his money. He had put up all the money as a subordinated lender to the firm, and he had made a handsome return out of it, playing golf with the president. He lived in a big house, owned chauffeured limousines, had never thought about money a day in his life. His wife is 62 years old, and she just went to work. How can a man like that start wearing Tom McCann shoes? I job hunted for a while. My bank account was down to $80. My wife divorced me. She was going to do that anyway. And I started on marrying my second wife. Then I broke my hip moving furniture for her. It was really pretty depressing. It's not that your friends desert you, it's that they don't know what to do with you. When you're back, they call, but while you're out, they don't call. And you don't call them because you don't want to put them in an awkward position. There was one job I really wanted, and when I was turned down, it really toppled me. I think the guy who interviewed me was really interested. Then he asked the opinion of a senior man, and the senior man said, "Nah, he's a has-been." Or maybe he said, "shop-worn." Even now, when I hear the expression has-been or shop-worn, I cringe. Phil got a job with another firm. I would think somewhere in the $15,000 to $20,000 range. He still has his $350,000 debt, but he doesn't think about it quite so much anymore. "I'll tell you one thing," he said. "It's like having to pay a percentage of your income as alimony. It cuts down on your ambitions." The great Winfield is on the casualty list, even though he retired with a considerable fortune. Winfield went to Wall Street in cowboy boots and jeans, had his own firm, and made a reputation as a tape trader. Which is to say, he watched stock symbols dancing across the screen, bought those that danced well, sold those that did not dance well, and so on. He also sometimes promoted companies of dubious virtue. And once he got me involved in a cocoa scheme that I reported on some years ago. I thought Winfield should be on the casualty list because without his firm and his audience he no longer had quite the same aura, and because I sent him an account which went down 90%, a notable score even for those years. Winfield had gone all the way up in Lisco, But his accounts also went from 67 to 11 in that stock, and then he found a company in Brooklyn that rebuilt old air conditioners. Somehow it got rechristened Atmospheric and Pollution Controls. Did it not, after all, cleanse the atmosphere and control pollution room-wise? But the stock went from 26 to 6. Many years ago, Winfield had bought a ranch in Aspen, Colorado, because he liked to ski and he liked the West. And now the ranch's borders were sprinkled with condominia. Just his luck. He had a hot hand in good years, but it was gone. And according to him, so was the business. It was a great business for a while, but it's over. Over. The government, the SEC, they've ruined it. There won't even be any more characters like me. In his heyday, the great Winfield was noted for his bubbly confidence. This is a stock, he would say, that is going from 10 to 200. Solitron Devices had done just that. The new one would be backed with the same conviction. In the great Winfield's philosophy, what one should do in the market was to find a kid with a hot hand, one who really needed to win, and let him find the stocks that would go up 10 times in a year. That was what he liked, 10 times in a year. I saw the great Winfield once after he had left his firm. He was now, at 47, a graduate student in art history at Columbia. He had a Pan-American stewardess. He was always partial to Pan-American. I picked up the list on his desk. Columbia Gas, Virginia Electric Power, Texas Utilities, Southern California Edison, Southern Company, American Electric Power, South Carolina Electric and Gas. "What the hell is this?" I said. "Utilities?" "That's my portfolio," he said. "The great Winfield in utilities?" "That portfolio is going to double in only 20 years, maybe 15. Riskless, a sure thing. You used to have stock that doubled in a week. Things change, my boy, things change. We have to recognize them when they do." On a trip, I stopped by the office of Irwin the professor, the master architect of computer-based technical analysis. Irwin's professing included computer applications, management sciences, and some advanced mathematics, but he spent more time with his own companies than he did with his students. Irwin's companies have names in their titles like computer, decision, application, technology, and so on, and he works in a new office building about 3 blocks from the university. Irwin's computers monitored stocks, the price, the volume, the percentage move. Then they determined the stock's behavior pattern. Once the computer knew the stock's behavior pattern, it knew when to buy and sell. The ultimate in technical analysis and charting. Irwin's computer had certain anthropomorphic qualities. When we first put the computer on the air, he said, we asked it what it wanted to buy, and we couldn't wait to see what it reached for. It said, treasury bills, cash. We couldn't get it to buy anything, so we checked out the program again, and while we were checking it out, the market went down. Then we asked it again. The computer insisted on staying in cash. We begged it to buy something. There must be one stock somewhere that's a buy, we said. You see, even computer people are victims of these old atavistic instincts from the pre-computer days. The computer just folded its arms. It wouldn't buy anything. Then, just when we were worried that it never would buy anything, right at the bottom it stepped in and started buying. The market started going up, and the computer kept on buying. Then one day it came and asked us for margin. It wanted to keep buying, so we gave it some margin. After the market went up some more, it sold out a bit and came back to being fully invested. A brokerage firm had signed up Irwin's computer and was selling the service to customers. On my trip, I asked Irwin how the computer portfolio had done. Irwin said it had gone down 30% in the bear market and that the broker had canceled the service. Another casualty. I asked what had gone wrong with the computer. Nothing, Irwin said. Nothing was wrong with the computer. It was the people we had tending it. They kept interfering. They made interim judgments. They couldn't leave the program alone. It's people that are the problem. The computer couldn't have lost 30% by itself. The computer was fine. I asked Irwin what he was up to now. He said the computer program was being refined. He was tinkering with it all the time. Meanwhile, his other computer programs for industry were doing all right. Of course, Wall Street was not too flush, so Irwin didn't know when another brokerage firm would spring for wiring up his computer. But we're running it on our own, he said, and the computer is doing very, very well. It is outperforming the market. And our system is getting better every day. It is almost people-proof. It really wasn't the computer's fault, those losses. The computer will be back, you'll see. You can't turn back the tides of history. Seymour, the head, has to go on the casualty list for losing $10 million. But he says that does not make him unhappy. That is because Seymour is following the way, and money is only a chimera anyway. I met Seymour in the mountains of Mexico. He was the talk of Cuernavaca, or at least of the endowed Americans of Cuernavaca. They were sure he was a fraud, or a con man, or at least some superior kind of nut. He said he had been a respectable Los Angeles lawyer, but that he had quit that, he claimed. They said to have bought and sold $300 million worth of stock the previous year. He claimed to have made $15 million and to be the biggest individual trader on the New York Stock Exchange, all the while operating long distance from Mexico and the Bahamas and Nepal, where he owned a monastery. If Seymour likes you, said the friends, you get the ultimate gift. Seymour has 100 llamas from his monastery say prayers for you for 1 hour. So they trotted me along to meet Seymour, to unmask the impostor, to expose the fraud, because how could this character with the wild gleam, his hair down to his shoulder blades, wearing a jumpsuit and no socks, how could this character be anything he said? A hippie speculator? An acid head arbitrager? It was all true, of course, a little hard to take because of the manic gleam and the long, stringy hair and the sandals. But there I was, the Berenson of the mountains, and Seymour was real, formerly a respectable Los Angeles lawyer with a respectable wife and child, who discovered arbitrage, mind-blowing chemicals, and a new lifestyle all at the same time. Goodbye, law practice. Goodbye, wife and child. Goodbye, socks and ties. If Seymour went to a directors' meeting in New York, for Seymour was on several boards, a secretary would pull out some socks kept specifically for him. Seymour would put them on for the directors' meeting and take them off afterward, returning them to the drawer. That was the extent of his compromise. He was not going to live a materialistic life. He was going to feel beautiful and do good things and help people, meanwhile playing the arbitrage game to finance it all. David, the bondman at TPO Inc., and the traders at Bear Stearns learned to answer the phone any time of day or night, and if it was a character sounding slightly stoned calling from Nepal, take the order. So Seymour borrowed $100 million, all from banks, married the most beautiful and serene Chinese girl you have ever seen, and sought inner peace. We went to lunch at Seymour's rented mansion in Mexico and had a wonderful chocolate cake for lunch, a cake to help peace and understanding and bring love, and with Seymour giggling wildly, like a Renaissance prince watching his palace visitors get tipsy. The guests ate the chocolate cake, and we got back from the Tuesday lunch Wednesday night. Sara Lee should have that recipe. It does something to your sense of time. Seymour said the experience was beautiful, and we had such a good time that he had his 100 llamas in Nepal say 2 hours of prayers for me, which had no noticeable effect on my portfolios. There is supposed to be minimal risk in arbitrage because you are buying and selling the same thing, only at different times or different places. If Company A and Company B are going to merge, and B sells slightly higher, you could buy A and sell B, all with borrowed money to make the effort worthwhile. The only risk is that it doesn't come off quite right, and that is what happened to Seymour in a very big arbitrage. Seymour dropped about $10 million, but his lifestyle did not change one whit. He never wrote checks or paid bills anyway. His brokers did that for him. Seymour said he had been too rich anyway, and stayed quite cheerful. He had put the initial money up for a vaginal douche called Cupid's Quiver. There are vaginal douches and vaginal douches. Apparently this one was the first with flavors: strawberry, raspberry, champagne, and so on. The chic ladies' magazines took the ads for it. McKesson and Robbins took over the franchise, and Seymour was above water again. Seymour said that the same group had made an unsuccessful attempt in trying to market a flavored jelly for homosexuals. I never knew whether to believe him, but in his new incarnation Seymour didn't believe in lying. He still sponsors an ashram in Arizona, and the monks must still be praying for him in Nepal because I saw him once in the south of France, wearing a pair of dirty white pants and carrying a hairbrush and some Tibetan art the monks had shipped him. He said he had just gotten off a plane, and that was all his luggage, the hairbrush and the Tibetan art, because he wanted to be a free spirit. He never made plans and would never commit himself for more than 24 hours, because he wanted to live in the moment, in the now, and go where he wanted when he wanted. We went to look at a villa for rent that used to belong to Mrs. Hines, the ketchup one. Then he made 2 very long-distance telephone calls and disappeared again. We heard later that he had gone to Montreal to borrow some money, $10 million or so, to buy some bonds. As usual, carrying his hairbrush and nothing so soiling as currency, Seymour borrowed the money, then realized he could not even get back to the airport. So he asked the banker for an additional $100 for cab fare. Then we heard he was trying to start an astrology fund, with none of the usual stuff about this mutual fund specializes in growth situations. The managers would all be picked and would operate by the signs under which they were born. 6 months later I got a call early in the morning from Seymour. He had an arbitrage scheme so complicated it would result in a perpetual tax loss. But when your Curaçao Corporation received a loan from your Bahamian Corporation, you wrote off the loan from your Panamanian Corporation and got the money back. I said I couldn't follow it. Seymour said that was all right. He would call some other time. Right now he was going to Ecuador to look at some pre-Columbian art, and he did. There is a final character on the casualty list, and that is me. A man has to be part of the actions and passions of his time, right? The path he chooses does not matter. Having done that stuff about the Black Horseman, I was not about to buy for myself any fried chicken stands, chains of nursing homes, fancy conglomerates, the so-called gambling industry, or national student marketing. I saw it all coming. Yes, sir. And I bought the safest stock anybody could buy. I bought a Swiss bank. Chapter 9. How my Swiss bank blew $40 million and went broke. In early September of that bad year, 1970, I was riding into New York on one of the Penn Central's surviving trains when a story in the Wall Street Journal caused some hot flashes and palpitations. Nothing alarming. In 1970 it was impossible to read the Wall Street Journal without having hot flashes and palpitations. This story was not even on the front page, and I am sure was passed over by many of the newspaper's readers. United California Bank, read the headline, says Swiss unit incurred losses that may hit $30 million. Swiss unit? United California Bank? That was my bank. I don't mean it was my bank in the sense that the Bank of New York is my bank because I have a checking account there, or that people have a friend at the Chase Manhattan because that is where they owed the payments. I mean it was my bank because I owned it. There was no public stock in this bank. It was the biggest, solidest, and safest investment I had ever made. A lockup, as they say. And only months after I bought this hunk of the bank, my judgment seemed to be confirmed. The majority interest was bought by the great United California Bank of Los Angeles, one of the 15 largest in the United States, second largest bank on the West Coast. Itself, the flagship bank of Western Bank Corporation, the largest bank holding company in the world. Big Brother. Clifford Tweeder, senior vice chairman of United California and president of its parent, Western Bank Corporation, last night declined to explain how the loss occurred. He said he hoped to be able to provide more data once an audit at the Swiss bank is completed. That would be within the next few days, he added. We think we should speak in general terms at this time, Mr. Tweeder said. The troubled institution, United California Bank in Basel, is 58% controlled by United California Bank. The other 42% is held by a variety of investors, mostly individuals, Mr. Tweeder said. It was a good year when I bought into my Swiss bank. I had a popular book on all the bestseller lists. Now you take the average American male who has a fat year or a windfall, and there are a lot of ways to spend the money in tune with Fantasyland. He could buy a beautiful sloop, not to mention yawl, ketch and cutter, and cruise around the world. He could get fitted for a Purdy in London or a Wesley Richards 375 and go shoot an elephant in Kenya while they are thinning out the herds. He could buy a pro football team, or at least part of one, and buy and sell 280-pound tackles, and have a modest little speech prepared when the television cameras roll into the locker room amidst the victory whoops, the champagne, and the wet towels. Not me. I had to buy a Swiss bank. Overexposure to early Eric Ambler, I guess. When if you really wanted to know what was going on, you certainly didn't watch the newspaper headlines because they didn't tell you anything. You watched the rise of the dinar and the fall of the drachma, and those barely perceptible flutters told you that Peter Lorre and Sidney Greenstreet were in a compartment on the Orient Express on their way to Istanbul. They were looking for Demetrius, and you remember the trail led right back to Switzerland. Good old Switzerland, where the master spy was in his chateau playing a Bach fugue on his magnificent organ. So it wasn't all safety and solidity that attracted me, though what could be safer than a Swiss bank? It was a hedge against the troubles of the dollar, and a friendly place to call upon in Europe, and the prospects of a lot of fun, and maybe even a very good investment to boot. The United California Bank of Los Angeles didn't buy into the bank because of Eric Ambler. American business was expanding in Europe. There was big merchant banking to be done. American banks were expanding in Europe, opening branches, chartering banks. Dollars had piled up overseas, and there was a big business in euro dollars. American banks sought to start banks in Europe, but that was hard and took time. If they could buy one, that would put them right in the middle of the action. We junior partners were delighted when the United California Bank took over. Obviously, our bank was to be part of the big expansion in Europe. We were in for a great ride. When I got to my office that September day, the story came out. I dialed 061-359450, the number of the bank's office in Basel. I remembered that I was worried but not stricken. No one likes to see his biggest investment have a bad year. But with the great United California Bank as a senior partner, could anything really go seriously wrong? It was like owning a great ship in partnership with Cunard. The Titanic is unsinkable. If you hear that it has had a little brush with an iceberg, you are annoyed that maybe some paint has been scraped off and now the damn thing is going to need a new paint job when it gets to New York. After only a few moments, 061-359450 answered, but the bank's office seemed to be in some confusion. I asked for Paul Erdman, the 38-year-old American president of the bank. Previous calls had gone right through, the voices across the Atlantic sounding clearer than a local call. Both Paul Erdman and his secretary seemed not to be there. There was some chattering in German on the other end. Finally, a male voice said, "Mr. Erdman is not here. He is not with the bank anymore." "Since when? I wanted to know." "Since yesterday," the voice said. I asked where I could reach Erdman, and the voice said to try him at his home in Basel, which I did. Erdman sounded cheerful as usual. "I've resigned," he said, "but I'm staying on as a consultant. There's a bit of a mess, maybe you heard." I told him I had just read about it, and what exactly was the problem. "There's a shortfall in the trading account of $30 million. $30 million? Unlike American banks, Swiss banks act also as brokers and can trade for their own accounts. The assets of our bank were reported to be $69 million at the end of 1969, but of course there were liabilities against those assets. The capital of the bank was less than $9 million. A loss of $30 million would have busted not only our bank, but two more the same size, except for our giant parent." I brought this up. "UCB will keep the bank open," Erdman said. "They have to. Their reputation would be damaged if they closed it." "Where is the $30 million? I wanted to know." "It's lost," Erdman said. "We lost it trading. A commodities trader lost it." "Listen," I said, "I have seen guys lose $1 million, $2 million even. But there is just no way to lose $30 million. No way." "Well, it's lost," Erdman said. "The UCB will make it up. You're going to suffer some dilution, but the bank will go on." "How come you resigned?" I asked. "The buck has to stop somewhere, and I was in charge," he said. At that point I began to feel some sympathy for Erdman. For me the bank was an investment. For him it was a personal creation, something he had spent years building up. I said, "This must be tough." "I'm all right," he said. "I'll be at the bank tomorrow helping to clean up the mess." But he wasn't. Shortly thereafter the Basel police picked Erdman up, as they did all the directors of the bank who were in Switzerland. The two directors they did not pick up were the chairman of the board, Frank King, who was also the chairman of the United California Bank in Los Angeles, and in fact of the Western Bank Corporation, and Victor Rose, a vice president of the Los Angeles Bank. Both of them were in Los Angeles. It seemed somehow very Swiss to put the board of a bank in jail. I never heard of it happening here. Erdman was to spend 10 months in the Basel prison, much of it in solitary confinement. Habeas corpus is an Anglo-Saxon institution. In Switzerland they can keep you in jail as long as they see fit, for investigation. The Swiss say it's very efficient. I called Erdman's house a few days later and talked to Erdman's attractive blonde wife, Helly. "It's like a nightmare," Helly said. No one will speak to me. They won't let me talk to Paul. I'm afraid the house is being watched. It's like a bad criminal show on TV. How could they simply hold someone without a charge? This is not the United States, Helly said. There is a long phrase. Verdacht der Ungetron Geschossverung. I don't know how to translate it. Helly was a native-born Basiler, but she spoke good English. I think she said it means suspicion of crimes against a bank. I couldn't think of anything like that in English. There isn't, she said. In Switzerland, this is very serious, more serious than murder. That, incidentally, is true. Long jail sentences do not meet the Swiss standard of justice. There is a gentleman at this moment in the Basel jail who caved in his wife's skull with a blunt instrument. She was a nagging wife, he said, and she liked to boss him around. One day he had had all he could stand, and he dispatched her. Then he went downtown and mailed a letter. Murder 1, 5 years, with a year and a half off for good behavior. In Switzerland, almost everybody gets off for good behavior, because almost everybody is well behaved. On September 16, 1970, at 2 p.m., the United California Bank in Basel AG closed its doors and posted a notice on its premises at St. Jakobstrasse 7. According to the papers, the losses were closer to $40 million than $30 million. Representatives of the United California Bank in Los Angeles presented a plan to the Swiss banking authorities in Bern. They would, they said, make good to the depositors and creditors. In a report to its own stockholders, the California Bank explained that a great international bank has deposits from other great international banks, and if it were to Welsh, it couldn't continue in business. The loss, it said, would be treated as an ordinary and necessary business expense, and it applied to internal revenue for a tax saving of half the loss. Furthermore, insurance might cover $10 million. On the New York Stock Exchange, Western Bank Corporation went down 2.5 points, and then back up 2 points. In 1969, Western Bank had had a net profit after taxes of a bit more than $60 million, so a $10 million or even a $20 million loss, while quite an inconvenience, was not a serious impediment to doing business. Western Bank Corporation was a publicly traded company. The United California Bank in Basel was held privately by the Los Angeles Bank and a few of us faithful junior partners. No one called the junior partners, at least no one called me, and I certainly left my phone number in enough places. There seemed to be nowhere to get information. I called an investment officer I knew professionally at the UCB in Los Angeles. He clucked sympathetically, said he didn't know anything that hadn't been in the papers, and suggested that the best use for my stock certificates was as wallpaper. "Write it off," he said. "Off what?" I said. Finally, I began to play a little game. I would call the office of Frank King, the chairman of the United California Bank, and explain carefully why I was calling, what it was in reference to, and that it was a call from the junior partner to the senior partner. Frank King's office would say they would take the message and he would call back. Then he wouldn't call back. We tried this 31 times and then gave up. I had to conclude that nobody wanted to talk to me. We were, after all, in the same boat, and we did have something to talk about. But when there is trouble, bankers get very tongue-tied, and this incident was a real conversation stopper, bank-wise. My calls were over several weeks. Paul Erdman's salary stopped instantly, and since his only real possession was the bank stock, Helly got a job as a secretary. Teams of auditors moved onto the premises of St. Jakobstrasse 7, but no one had any clear idea of how $40 million could disappear from a modern banking institution, especially a Swiss bank. Paul Erdman was in a small single cell, with a toilet, a fold-up bed, and a table. My bank was busted. Paul Erdman had come to my office one summer day in 1968. He was lean, tall, and bespectacled. I forget now who sent him. We were seeking to expand our knowledge of European banks, and Paul Erdman was to tell us about the Swiss, who are not eager to tell about themselves. We went to lunch, and Erdman began to tell me not so much about the rest of the Swiss banking establishment. He would introduce me to someone who could do an even better job than he could, but about his own small bank in Basel. I liked Paul. Furthermore, I have an interest, or a weakness, for and in small companies that have big ideas. You would never consider running General Electric to be fun. It might be something else, but not fun. But you take a couple of guys with a sheet of yellow paper and an idea, and the idea is right, and they have an itch to make something happen, to build something that grows. That's quite exciting. If it works, it's exhilarating and, though the word is inadequate, fun, almost as much fun as anything else you can think of. The odds against success are quite long. The idea does have to be right, and the money, enough money, has to be there. And then more money has to be available. And then you have to have the counter strategy ready when the existing establishment feels the sting and starts to growl. And most important, you have to have the right combination of people, and they must all bring out each other's positive qualities to the optimum. This is hardest of all because people are the most valuable resource of any quickly growing operation. And the fellow who first started musing on the sheet of yellow paper is likely to have a very big ego, along with his imagination, and a corresponding lack of sensitivity to the people the company needs. I suppose I have been involved in about a dozen of these amateur venture capital situations, and the record is no worse than anybody else's. It used to be, when the venture business was easier, that in the morning you expected to find a couple of your colts stiff, their feet in the air, but that one or two would turn out to be great winners, 10 or 15 for one, and that would more than make up for the losers. In the early 60s, I was in a company that made radar antenna so successfully it went broke. It doubled its sales every year, and the Navy loved the antennae, but they sold for less than they cost, somehow, and the company ran out of money. It barely managed to sell its stock to the public before it went broke. Then there was the electronic grading machine that was going to be used in every school in America. A lot of them were sold before they found all the bugs in the machine. And the company that made the typewriter that talked back to 3-year-olds when they pressed a key. There was one outfit that was designed to relieve office overtime. No need to hire expensive temporaries for, say, peak insurance work. You just dictated into the attachment on your phone, and dial dictation would have it for you the next morning. The company hit some foul weather, and at night the president used to call me in California, where I lived at the time, to talk to me. Finally I asked him why he was calling me. I wasn't a very big stockholder and I wasn't a director. Nobody else will talk to me, he said. There were a couple that worked. Controlled Data bought the laser company, and the company that made the radiation equipment for atomic tests not only made it to the public offering starting gate, but was given a very nice ride in the 1967 enthusiasm. So, no great fortunes, but a lot of interesting entertainment, and my basic conviction was still unshaken. You don't get rich owning General Motors because General Motors has already grown up. What you should do with General Motors is inherit it. What you look for, at least before technology became a bad word, was the next Xerox. A lot of people have gone down swinging trying for that one. Typewriters that talked back to 3-year-olds, attachments for telephones. I had never thought about a Swiss bank. I took Paul to lunch at the restaurant of the American Stock Exchange, and he had told me how he had started his bank. Swiss banks, he said, the most common concept is the secrecy, numbered accounts, tax evasion. South American dictators, all that. But Swiss banks are universal banks. They operate everywhere, and they are used to processing information from all over the world. But did you ever do business with a Swiss bank? Cold, formal, snooty, extremely cautious, very conservative, eh? I could see the age of the multinational corporation arriving. Polaroid and IBM building plants in Europe. Swiss drug companies expanding in the United States. The services offered by Swiss banks weren't up to those offered by American banks. I thought, what about an American bank in Switzerland, eh? A bank that would have American management techniques and American aggressiveness. But that was operating in Switzerland under Swiss laws, with Swiss universality, with maybe some of the dynamic qualities of a top-flight British merchant bank, eh? Paul was an American, but enough of Basel had rubbed off on him so that he frequently ended his statements with a basilar interrogative. Ja? Certainly, if anyone was going to start an American bank in Switzerland, Paul was uniquely qualified, except that, with hindsight, maybe his knowledge of bank operating procedures was a bit sketchy. The Wall Street Journal was to describe him later as a personnel man's dream. He was born in Stratford, Ontario, where his father, an American Lutheran minister, had been called to a parish. Paul's father is now a vice president and administrator of the Lutheran Church in Canada, responsible for such activities as Lutheran hospitals and Lutheran insurance. Paul was sent at 14 to a Lutheran gymnasium, boarding school in Fort Wayne, Indiana, and then to Concordia College in St. Louis, where he met Helly, a native Basler. After he graduated from Concordia in 1953, Paul enrolled at the School of Foreign Affairs of Georgetown University, thinking he might be interested in the Foreign Service. He worked part-time as an editorial assistant at the Washington Post and graduated with an M.A. in 1955. Still not sure of a vocation, but wanting to study abroad for a while, Paul and Helly returned to her native Basel, where Paul enrolled at the University of Basel. One of his professors there later remembered him as a brilliant student. He received his second M.A. and then a Ph.D. in 1958, and his dissertation on Swiss-American economic relations was published in 1959. His academic credentials got him a job with the European coal and steel community. In collaboration with a German economist, a friend of his, Paul produced another book, this one in German, called Die Europäische Wirtschaftsgemeinschaft und die Drittländer, a study on the European Economic Community. Now his visibility was such that the Stanford Research Institute of Palo Alto scooped him up as a European representative. For 3 years he commuted from Basel to the Stanford Research Office in Zurich, but he told me I wasn't there much. I was all over Europe consulting on business problems. We did a study for Alfa Romeo on their trucks, another for a Dutch steel mill that wanted to know whether and how to build a large diameter pipe, and so on. Stanford Research moved him back to Palo Alto, but consulting began to Paul. He wanted to do more. Through Neil Jacoby, dean of the UCLA Business School and a director of Stanford Research, he met Charles Salique, a San Diego businessman who had formed an investment company called Electronics International, Inc. Salique sent him back to Basel to monitor European companies, and then bought the idea of a brand new American-Swiss bank. "What do we call the bank?" Salique asked. And after some toying with words such as Swiss, Universal, and American, Paul suggested they call it the Salique Bank. "Why not?" Paul said. It was his money. Salique and his family put up $600,000, and the bank began in 2 rooms. No one could accuse the Salique Bank of being formal or snooty. Paul himself hustled customers all over Europe, and at one time the bank claimed to be Basel's second biggest Swissair customer, even though Basel is headquarters for several of the world's great drug companies. The Salique Bank not only took deposits and made loans, short-term collateralized loans in this case, but like most Swiss banks, it dealt in portfolio management, commodities, and foreign exchange. Its resources grew apace, from 13.7 million Swiss francs, $3.5 million, at the end of 1966, to 37.8 million Swiss francs, $9.8 million, at the end of 1967, to 142.5 million Swiss francs, $37 million, in mid-1968. Paul's particular interest was in currency speculation. In many ways, this is the headiest speculative game of all, for it involves anticipating the moves of central banks, watching the trade balances of countries, and assessing both gossip and political intelligence. Basel itself is an arena for such talk, because the Bank for International Settlements, the clearinghouse for nations, sits in an old converted mansion opposite the railroad station. The headiness of the speculation comes from the large sums and high debt involved, because one side of the transaction has a floor. For example, let us say, as it was in 1967, that the Bank of England is committed to buy and sell pounds at roughly $2.80. That is where the value of the pound was arbitrarily pegged. But Britain has a trade deficit. No one wants to hold pounds. There are more sellers to the Bank of England than buyers. You decide that the pound is weakening. Sooner or later it must be marked down to a level where international trade will once again support it, and where once again it will reflect the realities of that trading. So you sell, for future delivery, $1 million worth of pounds. You have already sold them, so to deliver them you will have to buy them back at a future date. You have sold them at $2.80. You know that you can buy them from the Bank of England close to that price. You need put up only $50,000 or so. Your only expense is the commission on buying and selling, and the interest charges on your obligation. You hope, of course, to buy the pounds back cheaper, marked down. But ripeness is all. those interest charges can begin to mount. Analysts of World War II like to point out the influence of kendo, the Japanese bamboo stave fencing, on Japanese military strategy. A lot of parrying, watching for the perfect moment, and then victory in one devastating, lightning stroke, thus Pearl Harbor. Paul's mentality was something like that. Not for him a slow, quiet, dust-covered compounding in some vault. In the fall of 1967, Paul was watching the sterling situation closely. A number of customers of the Salik Bank sold pounds for future delivery at $2.80, when Britain devalued the pound to $2.40. The customers bought their pounds in at $2.40 and delivered them, cleaning up. One client made $80,000 over the weekend. The coup, the shattering kendo stroke, had worked. Paul's reputation on currency matters rose, and he enjoyed the role of the currency critic. He wrote papers on gold and the dollar, signed by Dr. Paul Erdman, President, the Salik Bank, Basel. Not only is there something heady about currency speculation, but there is an element of the ultimate judge when one in effect says to a whole country, "Get your inflation in check and your trade balances up, or down goes your currency." That is the role not only of the Bank for International Settlements opposite the railroad station in Basel, but the currency speculator. Paul also wrote for the International Harry Schultz letter, a breezy investment advisory letter from London with Winchell-like tones. High-low ratio is negative, but market not ready for a real ka-chunk. Money trading in Germany hectic. Frustration with biz expectations causing a rise in nationalism. While the Winchell gossip might have been about starlets and entertainers, Schultz's concerns trade deficits, currencies weakening, and cryptic bulletins on world markets. Austria, sell into strength. Holland, buy. Italy, avoid. Japan, hold. Reread HSL 254. Schultz had been a California newspaper publisher and is the author of several investment books, including one on Switzerland and Swiss banks. Schultz's readers, called HLSM, for Harry L. Schultzman, are a loyal group. Take an HLSM home to dinner, who buy HLS ceramic cufflinks and spend several $100s for a ticket to the seminars in London and Denmark. Schultz likes to compare the United States to ancient Rome and its decadence. In fact, he signs his letters Slavius. Debasing of the currency is a favorite Schultz leitmotif. He considers it not the symptom, but the cause of national decline. A people can only sink lower without a dependable store of value. Currency debauchery is the sole source of U.S. decline and decadence, just as it has been in every society of recorded history. Schultz's letter was a boost for Paul. It ran his short articles detailed in one-liners some of Paul's travels and thoughts, and even identified some customers for the bank. It was one of Schultz's tenets that in the face of the weakening dollar, investors should not hold cash in U.S. savings or bank accounts. Instead, they could profit from the revaluation of the harder currencies, the Dutch guilder, the Japanese yen, the German mark, and Belgian and Swiss francs. Accounts in a Swiss bank could, of course, be invested in any of those currencies. And in fact, an account could be left in a Swiss bank in a time deposit and denominated in Swiss francs. Because of the corruption of the dollar, the faithful also saw exchange controls coming. Soon you would not be able to take dollars out of the country. After all, the English had once roamed the world, and now they were restricted at the borders to a few measly pounds and could scarcely travel abroad. The same could happen to Americans. The faithful, by getting their money out ahead of the lowering boom, could assure their future mobility. They would still be able to travel, to buy a house in France or a ski lodge in Switzerland. Their foresight would be rewarded. Denuded of the rhetoric, the faithful were, of course, right. The dollar has been devalued, some say not for the last time. Specific taxes have been laid on to discourage American investment abroad, and the first limitations on transferring capital abroad have been imposed. Your bank keeps a record of each transfer into another currency of more than $5,000, and in fact you are supposed to report any such transfer to the IRS. Brand new law. Presumably, the IRS can thumb through all the microfilm any afternoon it feels like looking for fleeing capital. Schultz ran a short list of Swiss banks in his letter, with the Salik Bank conspicuously on the list. After one Harry Schultz seminar in London, an excursion to Switzerland was formed, with Paul and his fellow Salik Bank employees entertaining the excursioners in Basel. Paul said he did not always agree with Schultz's apocalyptic notes, and he disparaged some of the Schultz faithful as right-wing Texas kooks who eat that stuff up, but he was glad to have them as clients. For a small bank in Switzerland's second city, the bank had an unusual number of Texas clients, and reportedly some of the clients became shareholders. When Paul came to see me, he was not seeking another shareholder, he was seeking a friend for the bank. He did this naturally, as an active promoter, a selling president. He sought friends everywhere and found them. Economists, business school deans, currency experts, commodity dealers, all found him interesting and agreeable. He even cultivated the press, unlike, I am sure, any other bank president in Switzerland. Other Swiss bankers went to lengths to avoid the press. Paul courted friends for the bank everywhere. If he were asked to write an article on currency for a magazine, he was glad to do that. If, as we did, someone requested more information on Swiss banking, he would set us up with people who could help us. But he could sense my enthusiasm. A dynamic young bank that had increased its resources by a factor of 15 in less than 3 years. That was exciting to me. Coincidentally, the bank had grown so fast that it needed more capital, and it was just in the process of raising it. Paul himself had written the prospectus, and while the prospectus, representing a Swiss corporation, naturally did not need to be registered with the SEC in Washington, it was just like a prospectus for the SEC, because we want to do everything right. We may come to the U.S. someday, and a New York law firm is going over it completely. It occurs to me, Paul said, that you would be a very good shareholder for us to have. I said I was very interested. We shook hands, mutually impressed, and Paul went back to Basel that evening. The prospectus arrived a month or so later. From the beginning, 1965, said the prospectus, the Salik Bank was conceived as a bridge between conservative Swiss banking, characterized by extreme caution, stability, and a unique expertise concerning financial matters on a worldwide basis, and modern corporate and financial management techniques, usually identified with the United States. The bank had, the prospectus reported, recruited talent in the fields of portfolio management, foreign exchange, and commodities, and a Swiss financial newspaper had reported that the bank was the fastest growing banking institution in Switzerland. The bank, the prospectus reported, acted as a broker and dealer in foreign exchange, metals, and commodities. This field of activity, said the prospectus, is usually reserved to the large commercial banks, since the private banks of Switzerland seldom have sufficient expertise in this rather esoteric area of international finance. The Salik Bank has sought, it added, to move beyond the usual areas of money management offered by many of the more traditional private banks in Switzerland, and to provide total money management by building its capabilities related to type of investments other than the usual stocks and bonds. Little did I know, but those paragraphs contained the potential for disaster. But like the hidden figures in the child's puzzle, how many animals can you find? My eye could not see anything but good. The bank was also to open a subsidiary in Brussels. Then within 3 to 5 years there would be an international bank holding company, which could make other acquisitions, on a larger scale, in other areas of Europe, as well as perhaps the Far East and even Australia. The Far East and even Australia. The sun would never set on the Salik Bank. I asked some of my pals on Wall Street for their counsel. I said I had a chance to buy a rapidly growing Swiss bank at a quarter over book value. Would they do something like that? How much can you get me, they said, to a man, and they offered to take any leftover. Of course, they were basically gunslingers attracted to such situations. They didn't get any of the stock, but that didn't help them. The nursing home and peripheral computer companies they bought did just as badly. My enthusiasm grew. I decided to go to Basel. When you land at the airport in Basel, you notice one thing right away. You're not in Switzerland. You're in France. Everybody wants to own land in Switzerland because of its stability, and that puts a premium on land. So the Basel airport is over the border in Alsace, a part of France, halfway to the town of Mulhouse, and when you come out of the airport the freeway or turnpike has a big fence on each side, a nice sanitized corridor into Switzerland. uncontaminated by France. You would have to say that as a European city, Basel is undistinguished but likable. Green trams seem to run everywhere. You can sit by the Rhine watching the barges and sip pleasant Swiss wines, or even pleasanter German ones. And there are some nice parks and squares. For a city whose main industry is a series of drug and chemical complexes, it seems remarkably clean. At first, when you walk the streets, you can't quite define what's missing, and then you realize it's the garbage bags spilling over on the sidewalks that you see so consistently in New York and London. And where is the litter? Where are the wrappers underfoot, the cigarette butts, the old newspapers? I never could figure out whether everybody peel strips their butts and throws the tiny shreds into a container, the way they bring you up at Fort Dix, or whether the Turks and Spaniards and Italians who clean Basel just do a good job. Paul picked me up at the airport, and we had lunch with the gentleman who was to fill us in on the background of Swiss banking, the subject that had brought Paul and me together. And after lunch we went to St. Jacobstrasse, one of the main thoroughfares of Basel. There it was at number 7, all glass and metal and shiny, 4 stories of it, my Swiss bank. Paul had worked with the architect, designing the circular staircase that connected 2 floors. Otherwise it looked like, well, what can you say? It looked like a bank, like an American bank, all open and bright and shiny, with tellers and people in shirt sleeves and calculators, which is to say that it did not look like a private Swiss bank, with its corridors and guards and its general air of reticence. We sat in Paul's office, with its impressive desk and conference area, the right dimensions for a proper bank president, and I met a variety of people. Now I can only remember one of them, and that is perhaps because I met him a number of times later. Louis Thole, a pleasant, blond Dutchman in his 30s, scion of an Amsterdam banking family, who was going to handle the bank's portfolio management activities. "The Deutsche Mark looks a bit stronger," said one of our staff. "Let's buy another 1,000,000 Deutsche Marks," Paul said. Louis Thole wanted to know if I had looked at Japanese convertibles. I hadn't. "The Hitachis are coming next week," Louis said. "They are beautiful. They are quite sexy." "Silver," Paul said. "Silver is going to go through the roof." I knew the silver story. "I'm doing a report on silver," Paul said. "The U.S. Treasury will run out of silver at some point, and then, whoom! We have a man in Beirut who is very good on silver. And gold, well, the world was not going to stand for long for all these jerry-rigged paper currencies, depreciating every day as their governments printed more paper." Then another pleasant gentleman came in, whom I will call Alfred because I can't remember his name. Alfred had with him the forms to open an account. I said I was going to become a stockholder, not a depositor. Alfred said most of the stockholders were also depositors, and didn't I know all the advantages of a Swiss bank account? I don't know what made me hesitate. Swiss bank accounts seemed appropriate for Las Vegas gamblers, South American dictators, mafiosi, and people with cash incomes, some doctors, say, or with incomes abroad who weren't about to tell the government their foreign earnings because they considered taxes a personal injustice. I didn't see myself as the holder of a numbered account. Where would I keep the number? Tattooed on my heel? And what would I put in the account anyway? "I don't need an account," I said. "I already have a checking account in the United States." Alfred looked a little weary. Obviously, that was not the right thing to say. I began to think the other visitors to the bank must have arrived with cardboard suitcases full of currency. "Look," I said, "I'm very excited by the bank as an investment, but I pay my taxes." Alfred looked absolutely blank at that. I was still apologetic. "My income," I said, "is totally visible, and they take the taxes right out. And anyway, if you don't want to pay your taxes right away in the United States, you put your money into tax shelters, and then you don't pay them, at least that year. All legal and approved by the government." I had Alfred's interest. "See, the United States Congress writes the tax laws," I said. "Then special interest groups lobby for privileges." I told Alfred about my cattle. Alfred liked the Western flavor of the tax postponement, but it did not deter him. "You do not have to have a numbered account," Alfred said. "You can have an account as public as you like. I am happy you like to pay your taxes. In Switzerland, we feel that what happens between a gentleman and the tax agents of his own country is his own business. In Switzerland, we cooperate fully with other countries in pursuing criminals, but by Swiss law tax evasion in another country is not a crime. But let me ask you, are you married? I was married. Happily married? Happily married. Now, said Alfred, you are happily married. You have insurance on your house. You naturally believe you will always be happily married, but you know that statistics do not bear this out, especially in America. And we know what happens in American divorces. They are famous. The woman keeps the house. She continues to live the same life. Lawyers in the courts take the husband's income and permit him to live on $70 a week, in poverty. You are happily married now, but no man knows the future. 5, 10, 20 years away. You are an American. You like to pay taxes. If you do not want to pay taxes, you feed cows. You think you will always be happily married? But do you not owe yourself a little insurance? What are you saying? I asked. With an account here, you need do nothing illegal. You can pay your taxes, you can buy stocks on any exchange in the world, you can buy and sell commodities anywhere in the world, and no one need know about it. And someday, when your wife's lawyers are trying to take away the money you have worked for 20 years to build up, you will have a private reserve. Alfred must have met Americans before. Like a master insurance salesman, he closed in. Even the happiest of husbands would have paused for a moment. Nothing illegal, Alfred said. There is nothing illegal in trying to strike a more equitable bargain with your wife's lawyers. That has nothing to do with you and your government. Now that the matter was not between me and the government, but between me and my wife's lawyers, those sons of bitches who were going to make me live on $70 a week, I began to loosen up. I could see them, the ferret-faced wretches, Bardell and Pickwick, crackling at their roll-top desks, rubbing their bony hands together as they dispatched me to some roach-infested garret with winos lying in the hallway and junkies shooting up under a 10-watt bulb. Why? What did I do? It's not illegal not to tell my wife's lawyers, I said, forgetting for the moment that my wife had no lawyers nor any need of them. You don't owe your wife's lawyers anything, do you? Alfred said. They are going to try to prove you a criminal. That is the nature of American divorce justice. One party must be a criminal, an adversary proceeding, a criminal in fiction, mind you, mental cruelty, lack of attention, what have you, things that would make a European laugh. When an American wife behaves in a manner that would cause her to be shot if she were married to a European, the American stands still like a patient lamb to be fleeced. I've seen some tough cases, I said. A friend of mine just went through it. They left him one shirt and one cufflink. Another thing, Alfred said. Your dollar is declining. Your Vietnam War is bleeding it. Your government mishandled its finances. That is going to cost you dearly as a citizen. I've been saying that for 3 years, I said. Good, Alfred said. Now you pay your taxes, so you are already paying for your government's political sins. But why should you pay for its fiscal sins when you yourself warned against them? Your account here will be in Swiss francs, so when the dollar falls apart, you will still have some currency with some value. Terrific, I said. Sign here, Alfred said, holding the pen out for me. Wait a minute, I said. I don't need a number, just a name. The number is for us, Alfred said. Not secret. Your own account in America has a number. All bank accounts have numbers. Computers can't work with Roman numerals. Okay, I said. Alfred held the pen out. I signed the form. No secret number, I said firmly. As you wish, Alfred said. I had a Swiss bank account. I put $200 in it. No alarm clock, I said. No toaster. No bonuses for signing up. Do I get pretty checks? A winter scene? Alfred did not seem to know about the American banking tradition of giving away $2 appliances for new accounts, and he indicated as long as the account was that size, I would probably not need checks. The bank charges for the various bookkeeping transactions of deposits and checks were higher than in the United States. Paul came back into the room. You have a new depositor, I said, but no number. Good, Paul said. Now that I'm part of the family, I said, tell me, do we have any South American dictators as depositors? Oh, for heaven's sake, Paul said. I bet we must have one mafioso. What's a Swiss bank without at least one mafia account? For heaven's sake, Paul said, we want to go public with this bank. We walked out through the bank, and Paul pointed out various of the officers. One was working in a small room with a desk calculator. Paul said he was from a wealthy family. He himself was a multimillionaire. Then why, I asked, was he working in a bank? First of all, Paul said, in Switzerland everyone works. We have no playboys. If you are going to be a playboy, you have to go to the south of France or to London or New York, or wherever they have that environment. St. Moritz is for foreigners. And second, in Switzerland, you never know how much money anyone has. There are families in Basel whose net worth must be $1 billion, but you never know. If you ever get to anyone's house and through the front door, sometimes you see it on the walls. Picasso's, Renoirs, and so on. And when they take a vacation, they take a good vacation, a safari in Africa, a visit to South America, and so on. But you must leave Basel to spend the money. The houses are solid and square, not ostentatious. In Switzerland, it is not only the money you have that is important, it is the money you get. On the way to his house, Paul drove up to the cathedral, and we stood in back of it, overlooking the Rhine. We walked around among the gabled houses of old Basel, some of them built in the 14th and 15th centuries. Basel's skills came from the Catholic persecutions, Paul said. The Protestants who fled here had two skills. One was that, not being Catholics. They could lend money and change currencies, and that grew into banking. The other skill was in dyeing textiles. During the 19th century, the skill of mixing dyes grew naturally into chemicals, and during the 20th century there was a natural transition from chemicals into drugs, and that is how Basel became one of the great chemical drug complexes of the world. Paul lived in a pleasant American suburban-style house, with a cathedral ceiling and books in 3 languages overflowing the shelves. The house was located in a solid residential section of Basel. The Erdmanns did not live elaborately. They had an Alsatian girl who helped with the 2 daughters. "It's nice to have somebody for dinner," Helly Erdmann said. "In America you do that all the time. In Switzerland you just don't do that. Visits inside the house are inside the family. You go out to dinner only to see your own relatives. Once a year," Paul said, "maybe you will go to someone's house, another banker, let's say. Then it is very stiff, very formal. Dinner jackets. You send flowers to the hostess ahead of time. The conversation is very stiff, too," Helly said. "There are no backyard barbecues in Basel that I know of," Paul said. "Switzerland is built on privacy." We talked about the plans for the bank. There would be a branch in Zurich and then another in Geneva, and a subsidiary bank in Brussels. Eventually the bank would sell its stock to the public in Europe and spread its activities far beyond Switzerland. "Paul is involved in every detail," Helly said. "I can't tell you. He even debated with the architect over where that stairway should go in the bank." The next morning we went back to the bank, and I went over various reports on European issues and European currencies. I also used my new bank to make an investment. The Bank for International Settlements is the international clearinghouse for the central banks of governments. It is through this bank that government currency swaps are engineered. And also through this bank, a government that is going too deeply into deficit in its international accounts is told to shape up. The stock of the bank is held by the member governments, the United States, Germany, France, Japan, Italy, and so on. Every once in a while there seems to be a few stray shares floating around, and so there was this day. For something like $1,100 I bought 1 share. Then the stockholders were the United States, Germany, France, Britain, Japan, Italy, and Adam Smith. I think I had in mind going to a meeting of the stockholders, or having some conversations with them, but I never got around to it. Paul had a present for me. It was a diseased cocoa pod. Someone had brought it to him, and there had been a section on cocoa in my book which Paul liked. We took pictures of each other holding the cocoa pod in front of the Bank for International Settlements. In the light of what was to happen, it was the ultimate in irony. I got on the train for Zurich. Swiss trains were supposed to run with the precision of watches. The train was to leave at 11:59, and I had just had my Swiss watch set. Starting at 11:57, I watched the sweep of the second hand. The train left 10 seconds early. In Zurich I had appointments with several major banks, sometimes peripherally. I would drop the name of my new bank into the conversation just to test the reaction. There wasn't much of one. Those that had heard of it didn't know much about it. One banker who had thought the bank was very aggressive, which in Switzerland is not a term of praise. In Zurich, the visceral feeling I had about Switzerland and money began to be confirmed. Now I do realize that a week spent in banks does not provide a very broad background for generalizing about a country. You could spend a week on the ski slopes and come away with a different feeling, or a week in the chocolate factories, or some time with watchmakers or with the Cuckoo Clock Guild. Nonetheless, there is something about Switzerland and money that makes it Ultima Thule, the country that provides one definitive end to the spectrum. After all, why Swiss banks? Most Western industrialized countries have well-developed banking systems, and a number of countries, Lebanon, the Bahamas, and Uruguay, have imitated the Swiss system of secrecy. Lebanon even used the Swiss banking code as a model. Still, for its size and per capita income, Switzerland leads the world in this profession. Why? It is the Swissness of the Swiss, and it might be interesting to take a moment to see how they got that way. Even though my new bank was not very typically Swiss, it gave me a feeling of confidence against fiscal dangers unknown, a home away from home. By rights, Switzerland ought to be one of the world's losers. The popular image of Switzerland is mountains, and the popular image comes pretty close to being right. Only 7% of Switzerland can be farmed, and the country can't feed itself. Unlike much of Europe, it has no coal, oil, gas, iron ore, or other industrial amenities, and no access to the sea. It had, of course, William Tell, a symbol of pragmatism, technical competence, and an unwillingness to be pushed around. Being mountainous, Switzerland had no large estates, no large convenient political divisions. Each valley community had to survive by itself. That led to a certain amount of hard-headedness. It isn't a Swiss proverb that says if you have an ugly face, learn to sing, but it might as well be. In the late Middle Ages, the small Swiss towns found themselves astride a German Mediterranean trade route, handling sugar, salt, and spices, discounting the gold from Venice and the silver from the Rhineland. According to one author, T.R. Fehrenbach, the Swiss burghers also had little use for medieval Christianity. For the Swiss businessmen already honored hard work, individual effort, and money, and medieval Christianity denigrated all of these things. Gott regiert in Himmel uns Gott auf Erde, when a Zurich proverb. Für Gott tanzt sogar du Teufel. God rules in heaven and money on earth. Even the devil dances for gold. John Calvin and Ulrich Zwingli changed the course of Switzerland. Gold was the sober gift of God, and work was holy. Calvinism's ideal was a society which seeks wealth with the sober gravity of men who are conscious at once of disciplining their own characters by patient labor, and of devoting themselves to a service acceptable to God. This is from Tawny's Religion and the Rise of Capitalism. So is what follows. Calvinism is perhaps the first systematic body of religious teaching which can be said to recognize and applaud the economic virtues. No longer was the world of economic motives alien to the life of the spirit. Here is Zwingli, quoted by Weichsman, quoted by Richard Tawney. Labor is a thing so good and godlike, that makes the body hale and strong and cures the sickness produced by idleness. In the things of this life, the laborer is most like to God. Thus banking became one of the Protestant fine arts, according to Fehrenbach. Zwinglianism did not reconcile Christ and Mammon. Zwingli and his rational spiritual descendants never saw any conflict. The Swiss did not learn to love money. The Swiss respects money, a very different thing. Respecting it, a Swiss pursues, handles, and husbands money as an end in itself, which is utterly different from German materialism with its emphasis on things, or American status-seeking with its drive for power or prestige, respecting money. The Swiss made its handling not a miserly trait, but more a priestly calling. He erected ritual rooms and bare confessionals, guarded one and gave the other secrecy. For 400 years, the Swiss stuck close to the proverb, money rules on earth. No political passions, no religious crusades. When the Swiss went to fight a war, it was somebody else's war. Something like 2 million Swiss soldiers left Switzerland to fight all over Europe, but always for money. The Swiss mercenary became a factor in the military history of the world. Hard-headedness, pragmatism, and a distrust of new ideas. If the Swiss had had General Motors, they would have erected a statue to Charlie Wilson for saying that what was good for General Motors was good for the country. Feudalism and Catholic Christianity weren't good for business. Nor was despotism, anarchy, nationalism, a strong central government, socialism, Marxism, and even female suffrage. All of those winds have swept over the mountains without effect. Only recently did the ladies get the vote. But Switzerland is still a male chauvinist pig country. If community property is involved, any husband can request information on his wife from a bank. But no wife, for any reason, can get such information on her husband without his consent. Non-Swiss seem to have been affected most by two factors in the Swiss banking code. One is the Swiss attitude toward taxation. In the Zwinglian Protestant society, honesty was not only the best policy, but work and the reward of work were holy. There was no strong central government, only a confederation of states. So by any world standard, national taxes are not particularly high. Therefore, you get what you pay for, and you pay your taxes. Taxes are a part of duty, and duty is a part of life. In the 1300s, the Austrian Habsburgs had made life tough for William Tell, and sent the nasty agent Gessler, still booed in schools. Swiss society is structured to leave the individual Swiss alone. No Swiss government has ever made the evasion of taxes a crime. Americans shook off the stamp tax and the tea tax imposed by the crown and went on, independently, to taxes of their own. The Swiss, having gotten rid of the Habsburgs, saw no need to complicate life further. That lesson was learned. Most governments in the world today cooperate with each other in apprehending criminals, but only if they agree on the crime, or on what is a crime. A crime in Soviet Russia or in Mao's China might not be a crime in the United States. A tax matter in Switzerland is an administrative detail between the state, that is, the canton, and the citizen, not a crime. But if you rob a bank and send the money to a Swiss bank, the Swiss government is delighted to cooperate, take the lid off the bank account, check the serial numbers, and help send you to jail. Everybody agrees that bank robbery is a crime. In the early 60s, there was a scandal concerning a Texas promoter called Billy Sol Estes and a lot of missing assets. Some people thought that maybe some of the assets had worked their way into Swiss banks. But the U.S. government has slapped a tax lien on Billy Sol's assets, making the affair a tax matter. So as far as the Swiss were concerned, that was the end of it. The other factor in the Swiss banking code that has endeared Swiss banks to foreigners is secrecy. But secrecy is nothing new to banks. In fact, the lack of secrecy is something relatively new, a part of contemporary nationalism. Roman banking law, Germanic civil law, and the laws of the northern Italian states, where banking flourished during the late Middle Ages, all contain secrecy provisions. Europeans are still a little startled by the way an American department store, or worse, the American government, can call up your bank and find out your fiscal habits. Until the 1930s, a Swiss bank account was properly secret, but it was up to the Swiss banker to preserve the secrecy. As Germans, particularly German Jews, began to send their money out of Germany under Hitler, Gestapo agents tried to follow the money. Some of them simply bribed or cajoled the employees of Swiss banks, but others came up with a more ingenious device. They tried depositing money in Swiss banks in the names of various wealthy Germans. The Swiss bank that accepted the Gestapo agent's ruse as a courier and accepted the deposit confirmed the fact that there was a bank account, and the unlucky German was whisked to a concentration camp, from which he asked the Swiss bank to send his money back to Germany, and then was tortured and executed. Much of the money that left Germany was never recovered and is still in the Swiss banks, and by now it belongs to the banks themselves, since under Swiss law, if no one has claimed the deposit after 20 years, it is cheats to the bank. The Swiss government was annoyed enough by the Gestapo's tactics to ratify the Banking Code of 1934, which made bank secrecy a part of the penal law. It took the moral burden off the banker by making it a crime to reveal any banking secrets, and it reassured foreigners that foreign deposits were protected by Swiss law. The final appeal of the Swiss bank is not in the Swiss Banking Code, but in the Swiss banker. From his neutral perch, he has seen the world on the horizon go to war for 700 years. Castles are sacked in war, chieftains are scattered far, kings are deposed, governments fall, currencies become worthless, families break apart, wives leave husbands, husbands leave wives, children turn on their parents, mobs swirl in the streets, all like one of the Bruegels in the Swiss museums. If governments were not corrupt, if paper currencies did not depreciate, if taxes were fair, if there were no wars, if humanity were not so fallible, if the world were like Switzerland, then there would be no need of Switzerland. But the world is like that, and if Switzerland did not exist, to paraphrase Voltaire, it would have to be invented. The money in the bank is there in solid Swiss francs backed by gold. Never mind the people who brought it there. It is the money that is immortal, to be tended like a delicate flower by God's own anointed gardeners. Even that simile is not quite accurate, for it is more important that the money be preserved than that it grow. Thus, the honored calling, to preserve the incremental lump, the evidence that somewhere, sometime, someone pleased God with some work that was rewarded. Husbanding the lump, that stewardship is an elite enough calling. And incidentally, very profitable. Can anything profitable be all bad? I have had some time to think about the policing effects of the Protestant ethic since my Swiss adventure. Clearly, something was lacking in the competence of Swiss accountants, or in the Swiss banking system. Somewhere, some Swiss had not made the handling of money a proper priestly calling. Would I rather be policed by the Fed in Washington, or by the ethics of the good Swiss bankers? The trouble is, even in Switzerland, nobody really lives in fear of God, Calvin, or Zwingli anymore. Most of the habits continue in good shape, but the Protestant ethic leaks. In the month following my first visit to the bank, Paul and Louis Thole came to New York. Paul was eager to get the bank established in underwritings, that is, to be one of the groups selling securities to the public, a function usually done by brokerage houses in the United States. Paul also wanted the bank to get more deeply into money management, running portfolios for clients. Those were the heady days of offshore funds, led by Bernie Cornfield's IOS. The funds were headquartered in tax havens, such as Curacao and the Bahamas. These are countries equal to the United States, Britain, and West Germany in legal status, but their laws governing taxes, investment policies, and the ability to borrow on the funds were and are more relaxed than those of more developed countries. Paul and I talked about a hedge fund to be operated by the bank, as an additional service to its clients. We tried the hedge fund for a brief period on a pilot basis, that is, with a very small amount of money, but with the pretense on paper that it was really full size. We washed around in some of the popular stocks of the tail end of the bull market, but it was plain to see that there was something nervous in the market. It simply did not behave with any degree of health. We discontinued the experiment after a few months with a small loss. In the spring of 1969, I got a jubilant letter from Paul. Now the stationery was different. It bore the bold words, United California Bank in Basel, in the same typeface used by the United California Bank in Los Angeles. It also had a familiar monogram, UCB, familiar to me because I had once lived in California, and the UCB had a very catchy UCB commercial all over the television channels. Now we can proceed with a number of projects, Paul wrote. You will see by our new stationery that we have changed our name and made a great step forward. The United California Bank has bought a majority interest in the bank. UCB itself is the flagship bank of Western Bank Corporation, one of the biggest bank holding companies in the world. Frank King, the chairman of both the UCB and Western Bank Corporation, has become our chairman, and I am vice chairman. We have a number of very exciting plans. But for the next year I was not in very close touch. We ran a seminar on American investments at the Savoy in London, attended by a number of European institutions, major banks, mutual funds and insurance companies from Britain, Switzerland, France, the Netherlands, Belgium, Germany, and Italy. Paul and Louis came as invited guests, but I did not have much chance to speak to them. In the spring of 1970, our Basel Bank offered additional shares to its shareholders. I called Paul. He said things were going well, that the expansion was continuing, but that 1969 had been a disappointing year due to losses in the securities markets. That was not surprising. 1969 was not a good year anywhere. But now we had a new and additional important shareholder, the Vesta Insurance Company of Bergen, Norway, and through them, perhaps 20 Scandinavian banks. Scandinavia was to be a new and fertile field, and our Scandinavian shareholders would send us a lot of reciprocal business. Bear market gloom was upon Wall Street, and brokerage houses tottered. There wasn't much time to think about Basel or the United California Bank, but presumably things were going well. That was all I knew. The Basel Bank was indeed one of the fastest growing financial institutions in Switzerland. In the United States, such an image would have been welcomed. In Switzerland, it was considered not sound and a bit pushy. For one thing, it was not easy to find qualified, competent people. Hiring away from another bank is something not readily done in Switzerland. To manage the bank's portfolios, Paul recruited Alfred Kaltenbach, an affable, nattily dressed Swiss with uncharacteristic long sideburns. But the prize catch was Bernard Kummerly, an intense, nearsighted, rather olive-skinned foreign exchange specialist. Kummerly was a native of Rheinfeld, a small Swiss town near Basel noted for its spa and medieval old section. Kummerly's father was the banker in town. Kummerly had been educated in the local schools and in a private Catholic school, and then had worked for the Credit Suisse, one of Switzerland's big three banks. Paul found him at the Bank Hoffmann, a smaller private bank, where Kummerly was the head of the department that traded currencies. Kummerly was very ambitious. His reputation was that of a walking computer, a man who could transact millions in foreign exchange in his head, the essence of cool. Kummerly is described as emotionless, which can scarcely be true for someone with that kind of fire in his belly. But that was the description extent. Kummerly could effect $10 million trades without the flicker of an eyelash. 3 or 4 young traders came with Kummerly from the Bank Hoffmann, one of them Victor Zamuli. The Lee or Lay suffix in a Swiss name is a diminutive. Swiss German abounds in diminutives. When Paul's trading department got going, Kummerly and Zamuli became known to the currency and commodity traders in Europe's financial centers as the Lee Boys or Lee Boys. Paul had assembled a staff of young executives, almost all of them in their 30s, but not without some cost. The big 3 banks of Switzerland sent Paul a rather stiff, formal, 4-page letter. It was not done to go raiding for employees, said the big 3, and Paul was to stop it. Kummerly arrived in mid-1968 and took a characteristic plunge into silver futures. The bank and some of its customers had already been into silver, and Paul had put out a letter in May suggesting that silver was a sale. But if his executives and his customers wanted to speculate, well, the customer was always right. The rationale for the silver play was that the U.S. Treasury had stopped selling silver. Industrial uses of silver were growing. Therefore, with the U.S. Treasury no longer selling and industrial uses growing, silver had to go up, right? There was only one problem with that reasoning, and that was that the story was too old. Speculators had already anticipated all the events. I myself had called out the dollar bills that came to me when breaking a 10 or a 20, and saved the ones that said silver certificate on them. And in fact I had taken 19 of them to the U.S. Treasury and traded them for a baggie full of silver. At this point there were no more dollar bills that were silver certificates, and the price of silver had in fact gone from 91 cents an ounce to $1.29. The price at the time that the Treasury had stopped selling, all the way to $2.50, the point at which the Basel geniuses discovered it. But so had all the people who had patiently bought silver for years, awaiting just such a rise. Certainly the last 30% of the rise had been sheer speculation. By the end of 1968, the speculators had begun to cash in, and silver was down to about $1.80. In a commodity trade, the cash the investor puts up can be as low as 10%. So a drop of 25 cents an ounce on $2.50 silver would wipe out the account. Long before that, there would be margin calls. By June of 1969, silver had dropped further to less than $1.60, but the bank had recouped some of the losses by quick trades on both sides. For its own account, the bank made back its losses, but its customers who had been in silver were needless to say quite unhappy, and some of them complained to Paul. Since May 1968, Paul had disassociated himself from the silver trades. He believed, he said, in giving his staff full rein, in leaving them complete autonomy. Paul felt badly about some of the accounts with silver losses. Those guys, he said of his staff, put some people in who had no right to be in. Not exactly widows and orphans, but practically. That was wrong, especially after his form letter predicting just such a decline. So the bank did an extraordinary thing. It canceled some of the silver trades, taking the losses onto its own books. We looked over the list, Paul said, and we figured if it was a sophisticated guy, he was big enough to take his own lumps. But some of the accounts weren't, and we took the losses ourselves. The losses on the silver accounts were more than 2 million Swiss francs. If it had become known that my Swiss bank was guaranteeing its clients against loss, it soon would have become the most popular financial institution in the world. Yet the bank was to do this twice more. Once it was in an over-the-counter stock called Leasing Consultants, Inc., a Long Island computer leasing company which financed aircraft and computer equipment. There was a plethora of such companies in the late 1960s. They based their existence on a bank loan for, say, an IBM 360 or a jet plane, something that could be readily leased. Then they sold the management of the company to the public. By the time Alfred Kaltenbach had found this company, it was already late in the game. Liasco, Data Processing, Financial General, and Levin Townsend were on their way to Mr. Babson's booby list. An analyst in Oslo, Norway, told our sideburned and nattily-dressed Kaltenbach about leasing consultants, proving that distance from Rosslyn, Long Island, lends enchantment. For the bank's account, Kaltenbach bought letter stock, which was restricted and which the bank could not sell for a number of years, at prices around $12 and $13 a share. Not only did the bank buy leasing consultants for its own account, it circulated a report on its own stationery recommending its purchase. 19 of the bank's clients bought the stock through the bank. Unfortunately, leasing consultants went the way of many such companies. Its income had been overstated, and early in 1970 it admitted it. The stock dropped to 7. By August, the company had filed for bankruptcy, and the stock was 37 cents bid. Again, the bank was distressed at the losses of its clients. This time the major loss was in the bank's own account, in fact. The loss was to total $2 million. But the 19 clients got their money back. In the Wall Street Journal, Ray Vicker reported that one startled customer had said, "This was the first time anybody ever reimbursed me for a bum trade." Meanwhile, Coomerly had found a new field for his talents, cocoa futures. But by the time Coomerly was really rolling, our bank was part of the great United California Bank. In 1968, Paul had been on a trip to the West Coast, and had looked up his friends from the Stanford Research Institute. Over drinks one night, Paul met Edward Carter, the chairman and chief executive of Broadway Hale, one of the nation's major department store chains. Carter, who was on the board of both the United California Bank and its parent, Western Bank Corporation, later called Cliff Tweeder, the vice chairman, who set up a meeting for 9 the following morning. Tweeder was joined by the senior vice president for international affairs of the bank, Victor Rose, then 65. Within 10 minutes, according to Paul, Rose had said, "Can't we buy that bank?" In October, shortly after my own visit to Basel, Paul had met Frank King, the chairman of the United California Bank, in the London Hilton. King, then 71, had started as the assistant cashier of the First National Bank of Sparta, Illinois. He had been president of the United California Bank for 24 years. "We want to buy your bank," King said. King had 3 prerequisites. First, that the United California Bank in Los Angeles have absolute control. Second, that Charles Salique and his family retain no further interest. And third, that the management team stay on. In January, King came to Basel to look over the bank. There seemed to be no question of his fascination with Paul Erdman. In March of 1969, there was a handshake agreement between King and Salique, and the lawyers went to work. The deal was complete in May. The Basel Bank was valued at $12 million. What the UCB sought, among other things, was the Basel Bank's toehold in Switzerland and Europe, and even more important, its dynamic young executives. "We bought the bank to get Paul Erdman," said a UCB official at the time, and according to Ray Vicker of the Wall Street Journal, King regarded Paul almost as a son. The United California Bank put 2 men on the board of its new acquisition. Frank King became the chairman of the board, and Victor Rose became a director. The California Bank was quite proud of its acquisition. It changed the name almost immediately to the United California Bank in Basel. In its glossy annual report for 1969, it discussed the acquisition of the Basel Bank as high among its achievements for the year, and listed it as a subsidiary. Paul had thought the affiliation with a powerful bank would bring in new business, but apparently it did not. Paul was to report directly to Frank King, and in their discussions they went over a potential international program. In particular, now that he had Scandinavian stockholders, Paul had planned his end run around the dominant banks of Scandinavia. There were no American banks in Scandinavia. Now, with his new Scandinavian connections, he could meet middle-sized businessmen in those countries and recruit their accounts before they moved from their country banks to the major banks of the Scandinavian capitals. At the time the California Bank took over, it had sent in its own auditors, who reported how the bank had taken over the customers' losses on silver, and also that there was a substantial exposure on margin accounts. But this did not get in the way of the merger. In fact, according to Paul, there was little communication with the parent bank. Occasionally, Paul said, a visiting fireman from Los Angeles would come through. He would ask where the good restaurants were, and whether we would get him a reservation at the 2- and 3-star places over the border in France. There was no general plan, and no external budget. And only slowly did the Basel Bank come on stream into the California Bank's reporting system. Meanwhile, Bernard Coomerly was on his way to buying half the cocoa in the world. Even to this day, I find the incident which brought down the bank totally and personally incredible. I had received the write-up on leasing consultants, and in fact had asked Louis Thole where they had come up with such a turkey at such a late date. But no one ever told me our bank was going into cocoa. What was to follow was as bizarre an example of nature imitating art as could ever be found. For after all, I had been into cocoa a bit myself. That was back when the great Winfield discovered cocoa trading. Occasionally, in those more leisured days, I would sit with him lazily watching stocks move, like 2 sheriffs in a rowboat watching the catfish in the Tennessee River. There was a lull in the market, and everybody was fatigued from some slide or other. And somehow the great Winfield had figured that the world was about to run out of cocoa. And my boy, I remember him saying, "When the world is just about out of something, the price goes up. The cocoa exchange is unregulated. A 3-cent rise in cocoa doubles your money. It's going to be wild. Come along for the party." The cash you had to put up for a cocoa contract was small. Why was the world about to run out of cocoa? Well, the African states that produce cocoa were having political troubles, and there was supposed to be an outbreak of black pod, a dreaded cocoa disease. The farmers had been leaving the farms and hadn't sprayed the plants, so I bought some cocoa contracts and began to root for everything that would bring about a worldwide shortage of cocoa. Was there an unconfirmed report of black pod in the far interior of Ghana? We cheered. Was Nigeria breaking up into civil war? That was good for cocoa prices. Maybe they wouldn't get the cocoa to market. Cocoa was selling for 25 cents a pound, and all we needed was the farmers leaving the farms, riots, chaos, no spray for the cocoa, and some torrential rains to encourage the black pod, and cocoa would be at 60 cents, and we would all be rich. We even sent Fat Marvin from Brooklyn, 5'6", 245, to West Africa to find out what was going on. Marvin knew pieces of paper in the commodities markets. In fact, he had just recently gone busted trading the same. I had gone to Abercrombie with Marvin while he outfitted himself in a safari suit and tried on an elephant gun, because you never knew what you would need in Africa. We waited breathlessly for word from Marvin about our speculation, and got telegrams like, "Raining off and on, Marvin," and "Britisher in hotel here says same number of cocoa trees as last year, and capsid fly under control." We did not know a capsid fly from a horsefly, but anything that ate cocoa trees was all to the good. Eventually they brought in a nice medium cocoa crop, same as most always, in spite of civil war, chaos, riots, no spray for the cocoa trees, and the dreaded black pod. Marvin returned, having had one adventure where he was dunked naked into warm oil by some of the locals. Cocoa prices did not go up, and we lost our stake. I wrote that story, and it was not only in the money game, it was also in De Grosse Spiel ums Geld, more or less the same thing in German. And in fact, Paul and I had taken those pictures with the cocoa pot in front of the bank for international settlements. The problem, or one of them, with our cocoa venture, was information and its interpretation. There were some serious players in the game, Hershey, Nestle, and M&M, and they brought real cocoa and knew a capsid fly from a black pod. And I have to assume they knew more than we did, because they are still in business. So I wrote that the next time the feeling came over one that there was money to be made in commodities, one should go to a nice beach and lie down until the feeling went away. But Bernard Kummerly hadn't read that cautionary tale. When I was trying to find how my bank could have evaporated into the soft summer air so quickly, a vice president of the United California Bank in Los Angeles said, "You know this is all just like your own story about cocoa." It was, and in spades. Unfortunately, I do not have all the pieces, because they take their time about trials in Switzerland, and Kummerly was still in the Basel jail, and the authorities there showed absolutely no interest in letting me swap yarns with him. For Kummerly followed the trail of Fat Marvin, at a distance of a couple of years, even though the admonitory and avuncular lessons were already in print. Paul had not changed his policy of letting his staff have free rein, even after the stubbed toes in silver. Everybody makes mistakes, he said. Our bank had already dabbled in cocoa for the accounts of some of its customers. A few contracts, nothing more, Paul said. And in the noble tradition of our bank, when the market went against the clients, the bank of course took over the losses. Small stuff, only $100,000 or so, Paul said. I thought we only had a few contracts. All that, according to Paul, had been audited by the United California Bank's own auditors when the Los Angeles Bank bought the majority interest. The bank, of course, was eager to have a coup. It had a reputation for brilliance and aggressiveness, and Paul's own style was the kendo stroke. The mistakes in silver and the securities market needed to be made up. Somebody must have told Kummerly the world was about to run out of cocoa. With Fat Marvin's trail scarcely cold, Kummerly took off for Ghana to become an expert. Later I asked Paul what Kummerly had done in Ghana. "Damned if I know," he said. "Drank a lot of beer?" I think he got to know some of the fellows who were experts, commercial attachés, people in the cocoa trade, and so on. In mid-July of 1969, there was some sort of interdepartmental intrigue going on in the commodity department of our bank. Kummerly was on vacation, and the other one of the Lee boys, Victor Zummerly, came to Paul to report that Kummerly had been speculating. According to Paul, Zummerly discovered 3,000 cocoa contracts, all betting on chaos, riots, no spray, and black pod. What did they do? We traded them out. Heretofore there had been no limits on the commodity traders. Now Paul told the young Swiss accountant on his staff, Helmut Brutzky, to set controls. Apparently Brutzky never got started, and even Paul, out on the frontiers wooing the Scandinavians, began to realize that better operational controls were needed. He hired such an officer from a Swiss unit of National Cash Register, but he didn't work out, and by the time another such officer was brought in, this one from the Volksbank, the books had been doctored. When Kummerly returned from vacation in August 1969, he promptly fired Zummerle. Zummerle, he said, had been speculating without authorization. What follows is perforce a bit hazy, and it may safely be said that probably no one knows exactly what happened. Since the bank closed its doors, teams of auditors have been sorting out the Byzantine mess, and to compound the usual Swiss secrecy, a trial is impending, and much of the information belongs to the prosecuting attorney, who is tight-lipped even for a Swiss and a prosecuting attorney. Somewhere along the line, the United California Bank in Basel bought 17,000 cocoa contracts. 17,000 cocoa contracts, with a face value of $153 million. That is quite a chunk for a bank with a net worth of $8 million or $9 million. The contracts were sold by major commodity brokers, Merrill Lynch, Hayden Stone, and Loamcrest of London. Normally, brokers would not extend a total of $153 million in credit to an institution with $8 million in assets. But our stationery did say that we were the United California Bank in Basel, and the United California Bank itself had assets of more than $5 billion. Our bank's exquisite timing extended to cocoa. It managed to buy at the highs something like 48 cents a pound, and the market promptly began to erode. By June of 1970, it was close to 30 cents a pound, and on 10% margin, the bank had lost 3 or 4 times its stake, maybe more, and was desperately insolvent, except for whatever its California parent cared to put up. Only nobody knew it, since by now the books were really doctored. The balance sheet was undeniably falsified, said Max Studer, an auditor from the Swiss Society for Bank Inspection. But the chicanery had begun before. The bank had not exactly taken all its loss on the leasing consultant's fiasco. That was just too big a loss, Paul said. No one writes off 5 million Swiss francs in 1 quarter. That was too big a hunk. You spread it over a longer accounting period. It would have looked very bad. What Kaltenbach did was to get a letter from the Norwegian firm that had first recommended the stock, promising to buy it at its $25 cost, even though by then the stock was down some 40%. In return, the bank promised to make good the Norwegian firm's purchase so that they would lose no money on it. In other words, the two institutions would trade worthless pieces of paper. The Norwegian guarantee is meaningless, Paul told the California Bank. As long as it keeps the auditors happy, said L.A. Apparently that was all right with the California Bank. The auditors were a company called Gesellschaft für Bankenrevision. The auditing firm itself was owned by 2 of Switzerland's big 3, the Swiss Bank Corporation and the Credit Suisse. Not only were the auditors happy, but they approved and certified a balance sheet that was already short by about 20 million Swiss francs. Kummerly and crew rather desperately tried to straddle cocoa as it fell. Some auditors, that is, tried to minimize losses by contracts covering short-term fluctuations with different delivery months. But even the straddles misfired. On the rare occasions there was a cocoa profit. That went on to the books. When there was a loss, the confirmations went into Kummerly's desk drawer. Later, in fact, the day after Paul got out on bail, I asked him how, in an age of computers and organized record-keeping, all this had been possible. One mistake, he said, was that the commodity department ran from under the same roof as the foreign exchange trading and the money desk, where interbank deposits were made and accepted in a multiplicity of currencies. The big 3 banks controlled the foreign exchange market, Paul said. We were very aggressive. We had built up until we were 5th in Switzerland, and we were turning over 5 billion Swiss francs a day in exchange. The bank's own positions in currencies, forward and spot, added up to more than $2 billion. When you have that much out, nobody cares much about a few $1,000,000. The brokers who sold the UCB cocoa contracts were paid out of the foreign exchange department. The California Bank had spot-checked its bumptious subsidiary and suggested that maybe a position of $2 billion in foreign exchange was a bit much for a bank that size. It suggested that perhaps only $1 billion in foreign exchange be held. Paul and I sat there on an apartment terrace in Basel discussing this just as if we were management consultants, analyzing the process. Say, I said, you remember the thing I wrote about cocoa? Sure, Paul said, that was good. You remember you gave me a diseased cocoa pod as a present when I first came to Basel? Sure. You remember what it said at the end of the story? That there are serious pros in cocoa, Hershey and Nestle and like that? When you are tempted to speculate in cocoa, lie down until the feeling goes away. Paul shrugged. These fellows said they knew what they were doing. How about Kummerly? Did he read that story? No, it wasn't out as Das große Spiel Umsgeld yet. And Kummerly didn't read English. For the first time I lost my temper. He bought the cocoa in English, didn't he? I said. There was an awkward silence, and the cordiality dropped away. He bought the cocoa in English. Paul shrugged again. I'm sure he never read the story. We went back to discussing the decline and fall. How could it happen, I asked, in a modern 20th century Swiss bank that so much money could disappear unchecked simply by putting the losses into a desk drawer? After all, this was not a robbery, not an embezzlement, and as far as was known, no money actually went in anyone's pocket. We should not have combined the commodity money market and foreign exchange departments, Paul said again. That made it too easy to cover by simply listing a time deposit from another bank. and if a department gives an order, the confirmation should go somewhere else, to be double-checked. Every position in the balance sheet should be verified, and it wasn't. Shouldn't the outside auditor come in and check, at least once or twice a year? They should, but Swiss auditing firms only care that the numbers you give them match up, not that there is anything behind the numbers. There's one more thing. What's that? The chief executive of a bank should know the operations side of a bank. All the procedures, the accounting processes, and so on. I thought I had people covering that, but I didn't, and I certainly didn't do the job myself. I wanted to know what Coomerly's motivations were. I could see how anyone could bite on the cocoa story. I had myself. After all, in any given year, the world can run out of cocoa, although it has never happened yet. But from there to putting the losses into a desk drawer, and thence to busting a bank, is quite a step. I think at first he wanted to impress his own traders. He had a big ego, a reputation for being very smart. When the losses were $1 million or $2 million, he just couldn't admit it. He was like a man at a roulette table, doubling up and doubling up again, waiting for the final double up that would break him even. Finally, I don't know. Maybe he saw the handwriting on the wall and decided as long as he was going to get nabbed at some point, he would put something away for the day he got out of jail. I don't know. To do that, he would have had to have confederates somewhere else, someone working in one of the commodity houses. One day in the summer of 1970, Paul was preparing to go on vacation. At that point, he had condoned the jiggle of leasing consultants and knew that there was speculation going on in commodities, but the depth of the trouble lay ahead. He stopped by the office of the bank's chief accountant, who said he had a question. It was a small piece of pink paper with a debit of 25 million Swiss francs. The accountant said it must be a mistake. Paul hadn't a clue. I knew something was wrong, Paul said. I knew I should stay and sort it out, but the family hadn't had a vacation in a long time. One of the items on Paul's desk was a partial translation of the annual report, done internally. Foreign exchange, foreign currency, and margin positions for commodities had been lumped together in one big number. There was that mysterious pink slip for 25 million Swiss francs, apparently a realized cocoa trade. Paul deleted the reference to margin in the report, even though it had already circulated in German and had been approved by the Swiss Banking Commission. Why wave a red flag if you don't have to, Paul said. We needed time to clear things up. The family took off for Marbella, Spain, but Paul did not enjoy his vacation. I didn't sleep very well, he said. I had a tummy ache. Paul decided that the vacation just wasn't going to work, with unanswered questions floating around. Why had that accountant given him a chit for 25 million Swiss francs and then asked what it was? What else was wrong? Something wasn't right, and I wasn't facing it, Paul said, a bit belatedly. Back to Basel went the family, and behind Coomerly's back, Paul started a low-key investigation. There were, it seemed, huge losses in the commodity department. So according to Paul, he called Coomerly in, and something like the following dialogue took place. Paul, what's going on? Coomerly, losses, losses. Paul, I know losses, but how much? Coomerly, I don't know. Paul, why not? Coomerly, I lost control. I just lost control. Paul, how much are the losses? 5 million? Coomerly, more than that. I lost control. Paul, 10 million? 15 million? Coomerly, more than that, I think. Paul, 20 million? Coomerly, somewhere around there, I think. And Coomerly kept muttering, losses, losses, and we lost control. At 20 million, not only was the bank gone, but so were 1.5 more banks the same size. Paul decided that he had better carry the message to Los Angeles personally, and he caught the daily Swissair early bird from Basel to Paris, and then an Air France flight over the pole to Southern California. Paul and Helly checked into the Century Plaza in Los Angeles. Neil Moore, a senior vice president of the UCB, met them. Don't give me the details, Moore said. Just tell me the loss, down to the penny. On Sunday, August 30, Frank King led the group of UCB officials who met with Paul in a conference room at the Beverly Hilton. The president of the bank, according to Paul, was philosophical. Win some, lose some, he said. The one concern everyone seemed to have was to keep the affair secret to avoid a run on the bank. How many people know about this? Paul was asked. Can we keep it all a secret? The bank's chief auditor was worried about the extent of the loss. We could handle $5 million, he said, but $20 million? $20 million could mean trouble even for Frank King. 2 days later, Paul and Helly and Neil Moore and an attorney for the bank flew back to Basel. Nobody said much across the Atlantic, Helly recalls. Outside auditors went to work on the bank's books. The losses seemed to be closer to $30 million than to $20 million. In Los Angeles, Paul had tendered his resignation, but he was to remain as an executive and consultant to straighten the mess. The idea was that the bank would remain open, still the United California Bank's Swiss unit. The parent would work out a scheme to protect depositors and creditors. On September 6, there was a board meeting of the United California Bank in Basel, but Paul did not stay long. He was asked to leave the room and told that he was fired. I went home and had a scotch. The UCB officials went to the Swiss Bank Commission in Bern and presented their plan to reimburse the depositors and creditors. The Swiss Bank Commission naturally was worried about the reputation of Swiss banks. The word around Basel was that once that was protected, they were glad to see an American-owned bank get a black eye. Now it would be easier to keep the foreigners out of Switzerland. The details of what went on between the UCB officials and the Swiss Bank Commission are not known. Again, there were rumors that the Commission told the UCB that if it would make good and get out of Switzerland, it would be kept out of the trial to follow as much as possible. On September 10th, the bank suspended operations, and on September 16th at 2 p.m., it posted notices on its doors saying it was bankrupt. The United California Bank in Basel AG was by no means the first Swiss bank to go broke. In the Depression of the 1930s, 3 of the top 7 Swiss banks folded, just as banks everywhere did. Swiss banks were overinvested in Germany and suffered from the German inflation of the 1920s and the rise of the Nazis, and then from the impact of World War II on their German investments. In more recent years, the German bank had folded because of bad loans, and the Asian Bank and Arbitrex on speculation, and the Seligman Bank had bought a huge tract of land south of Rome without clearing the building permits, and expired suffocated by illiquidity. So busted banks were not new to Switzerland, but my bank goes in the almanac. That is the biggest Swiss bust ever. Paul was about to come down to breakfast on Wednesday, September 9th. He was wearing loafers without socks, and was in his shirt sleeves when 2 Basel policemen appeared at the door. They said he was wanted for questioning. Paul expected this. He would be there, he thought, 2 or 3 days. The Basel police also picked up the Lee boys, Kummerly and Zummerli, as well as Helmut Bruschke, the accountant Beat Schweitzer, Louis Thull, and Alfred Kaltenbach. Paul was shown to a cell with a toilet and fold-up bed and a table. The schedule went like this: lights on at 6:30 a.m., and a broom handed through the door. At 7 a.m., a mug of cocoa and some bread. The mug reached for at 7:30. Occasionally a half hour in the exercise yard was offered. Then lunch through the door at 11. Lunch was not so bad, Paul said. Dinner, soup and black bread, came through the door at 5, and the lights went out at 9:30 p.m. At 8 a.m. every morning, the warden came by and asked through the door if everything was all right. The Basel prison itself is a grim 17th century building, downtown with small windows high above the floors. Even though no charges had been brought against him, Paul was not allowed to see a lawyer. He was permitted to write 2 letters a week, and allowed 1 visit of about 15 minutes per week from his wife. The expected questioning did not materialize for weeks. Then there would be a key turning in the door, and a guard would escort him to another building for interrogation. I asked if the guard was armed. He was armed with a dog, Paul answered, but that was all. Paul faced the investigating magistrate across the table. What happened? Asked the investigating magistrate. For Helly, life was, if anything, even more difficult. She was, first of all, without means, since the family's assets were all in the bank. She got a job as a secretary with a pharmaceutical firm, and moved the girls and her Alsatian help, who volunteered to stay without pay, to a small apartment. I was scared, Helly said, because no one in Basel would talk to me. I thought the house was watched. People were afraid to call me on the telephone. It was like a bad criminal show on TV. Later, some of Helly's Basel friends were to say that it served her right for marrying an American, and that an American so aggressive had to have unsound practices and was therefore getting what he deserved. Some of the Basilers suggested this was a good time for a divorce. Basel, Helly said, is not a pleasant place for a woman alone with children, especially one whose husband is in trouble. When Helly was not working, she was trying to get Paul released on bail and talking to lawyers, but it looked as though, if bail ever were to be set, it would be 1,000,000 Swiss francs, or about $250,000. That would be far beyond anything she could raise. The general feeling was that Helly's husband had committed a crime so unspeakable it could barely be discussed. Murder, at least, was comprehensible. But Paul was still not charged. In Switzerland, a citizen may be held on suspicion for 3 weeks, with the 3-week periods continuously renewed if the authorities feel they need additional investigation. Paul was to spend 10 months in the Basel prison, most of it in solitary, all without bail and without being charged. When his lawyer inquired, he was told that the charge would probably be Verdacht der Unguntrun Geschäftsführung, which turned out not to be crimes against the bank, but suspicion of untrue management, to which Urkundenfälschung, falsification of documents, was added. Later I asked a Swiss lawyer about the process. This is not an Anglo-Saxon country, he said. We do not have the doctrine of habeas corpus, nor the underlying idea of innocent until proved guilty. The job of the investigating magistrate is to determine as far as possible the truth, and if you hold a citizen in jail and permit him to talk to no one, only the investigating magistrate, that is quite efficient. What I asked, if the citizen were innocent. If he is innocent, then he receives justice, the Swiss lawyer said. He is paid his former salary for his jail time. If his salary is $60,000 a year, then he is paid that, and of course, if he is guilty, the time he serves counts, and for good behavior it counts half again, and the sentences are not as long as in the United States. At first I was glad it was over, Paul said, and I really thought I would be there only a week or 2. I was guilty of negligence, no doubt about that. But that doesn't mean I should spend years in solitary, eh? After a few weeks I could see if I just sat in the cell I would become a vegetable. So I established a strict discipline. After sweeping my cell, I did half an hour of calisthenics. Then I asked for a typewriter. I decided that as long as I was in jail and in solitary, I would write a novel. Paul, of course, was not an ordinary prisoner. He was an uncharged bank president, and the Basel prison was no Attica. Spartan it might be, but it was also Swiss. In Switzerland you get what you pay for. Paul paid for subscriptions to the Wall Street Journal, the Financial Times of London, The Economist, and the Neue Zürcher Zeitung, the leading Swiss newspaper. He also paid for the rental of a television set. Within a short time, he said, I was as well informed as I have ever been in my life. Except for the uncertainty, I enjoyed the rest. It was not only a 17th century jail, it was a 17th century prison life, like Captain Macheath in the Beggar's Opera, who could send out to the best restaurants for his meals and even for Polly. You could send out for meals only on occasion, Paul said, if you pay for them. In Switzerland, you can have what you pay for. Meanwhile, back at the ranch in New York, I did what any aggrieved citizen would do. I called a lawyer. Several, in fact. It should, I figured, be interesting. After all, this was not just a sour investment, a stock that went down. This was a crime. The management of the bank was all in jail. For crimes there is some sort of justice. The reaction of the great Wall Street law firms was very interesting. Enough to inspire a certain amount of cynicism, if you are inclined to be cynical about lawyers. They acknowledged there was a case, but scuttled away like rabbits through the brush because of their own banking connections. I was as popular with the Wall Street lawyers as a Black Panther. One friend said, listen, don't think we don't take unpopular cases. Why? We represent ex-Nazis out of Spandau. Rich ex-Nazis, I grant you. We represent Greek ship owners who are so far beyond any national laws they think a law is an insult. But you're talking about an action against a bank. We represent a major New York City bank. This is a major West Coast bank. They do a lot of business together. Our New York City bank pays a lot of the bills, and they wouldn't like us in this. Sorry, baby, but go away. I called Abe. I should have done that first, anyway. Abraham Pomerantz is 69, portly, and has a nice white mane. He is also the name that scares banks most, not to mention mutual funds and other financial institutions, because Abe is the Ralph Nader of the investment business. There are differences, of course. Ralph Nader lives in a boarding house and operates from a payphone down the hall. Abe lives in a penthouse and operates from the senior partner's corner suite of a prosperous midtown law firm. Ralph Nader burns with righteous zeal. Abe thinks there are many defects in the society which can be corrected through legal action, and he gets enormously well paid for the corrections when they worked. One day in the early 1930s, when Abe was a struggling young lawyer, the widow of his high school gym teacher came to see him. The widow, Galen's husband, had left her 20 shares of the National City Bank. Once they had been worth $400 a share, and now they were worth only $20 a share. I remember telling her there was no law against losing money, Abe said, and the widow Galen went away. Then the Senate Committee on Banking and Currency, identified usually by its counsel, Ferdinand Pequot, began to investigate the skullduggery that had gone on in some of the nation's boardrooms, the excessive compensation, the dealing in corporate assets, and so on. Charles Mitchell and some of the directors of the National City Bank seemed to be high on the list, in a famous case adequately chronicled elsewhere. Abe filed suit on behalf of the widow Galen against National City Bank, and hence its stockholders, in a derivative action, so called because the stockholders derive their rights from the shares in the corporation they own. The stockholder who brings the suit brings it on behalf not only of himself but of his class, that is, his fellow stockholders. The courts awarded the widow Galen $1.8 million, of which Abe and the lawyers and accountants who worked on the case took $472,500. Abe became a champion of the minority stockholder. The Chase Bank was next. That was $2.5 million for a Mrs. Gertrude bookbinder. Abe went on to test the way mutual funds used the commissions derived from buying and selling their portfolios to pay for the selling of their funds. Excessive sales loads for mutual funds, using the commissions to buy research, and so on. In the courts, he questioned the way banks used the commissions from their trust departments to gain deposits for themselves. Eventually, he even got to the drug companies on the price fixing for tetracycline, which resulted in a judgment against the drug companies of $152 million. Since it was impossible to pay back the individual consumers of the drugs, that amount was spread out among the health departments of the 50 states. Most of Abe's efforts, though, were in the securities and investment fields, and the structure of that industry was hardly the same for having known Abe. So I called Abe. Normally, and at this stage of his career, Abe does not take phone calls from private citizens, however grievously wounded. But in our peregrinations through the securities business, our paths had crossed. Abe had already read about it in the papers. He told me to come right up. "Makes me feel young again," Abe said. I had made up a list of questions. If a big bank bought a little bank, and hence had the power to hire and fire people, and in fact the right to name the whole board, weren't they responsible for proper procedures? They did have that power. They had, in fact, fired the president in 10 minutes one Sunday without even telling us junior partners. So wasn't the big bank guilty of ungetrun Geschäftsführung, even if they weren't guilty of Urkundenfälschung? And the outside auditors certified all the Urkundenfälschung and the ungetrun Geschäftsführung. Price Waterhouse and Pete Marwick had gotten into a lot of trouble for less. Weren't the auditors liable too? And the board? Naturally, the board. But when I went to see Abe, he was in a sober mood. He had read through some research, and he looked up from the papers. If this had happened in this country, he said, this would be worth $100 million as a class action. But it happened in Switzerland, and everything in Switzerland is a secret. We don't even know who the stockholders are. Switzerland is a very backward country. They have never heard of a class action. So the answer to all your questions is yes. Yes, the board is clearly liable, but the management of the bank is in jail and clearly busted, except for the 2 Californians from the parent. And yes, if it were here, the auditors would be culpable. And yes, if it were here, the controlling bank would have a liability. But it wasn't here, so I can't take the case. But I like you and you like me, and out of all the people that the UCB doesn't want to have overhanging the cleanup of this, the 2 of us have to be at the top of the list. I have a reputation as an ogre in this field, and so I will write them on my ogre stationery and will offer them your stock at cost. Maybe they'd like to buy out a partner just to clean things up. Their name was all over the prospectus after all. But the United California Bank didn't seem eager to buy any more stock. We got a stiff letter from O'Melveny and Myers, the lawyers for the United California Bank. The entity to which we referred, they said, was a Swiss bank. Funny it had the same name, but clearly, how could they be involved? I was afraid of that, Abe said. You see, that's the trouble. This whole damn thing is in Switzerland. The Swiss won't even tell you the telephone number. You'll have to sue in Switzerland, and the trouble with that is there is no bank left in Switzerland, so there's nothing left to sue. And the United California Bank itself is in Los Angeles. Is there no justice? I asked. That's a metaphysical question, Abe said. I don't know if there is or isn't justice, but I do know one thing. There's no class action in that damn backward country over there. You know, I had a client once who put me into a sure thing in commodities. What happened? Seemed to be the proper inquiry. I lost my shirt, Abe said. I've never made a penny on an investment. It's good I've been lucky in the law. While I was pondering the fickleness of justice and its limitations at natural boundaries, Paul was typing away in his cell. After a while, the stringent regulations relaxed a bit. Paul was allowed to go to the prison library, but he found it disorganized. He got permission to use some of the other prisoners in reorganizing and cataloging the library. Furthermore, he said, there are people of other nationalities in the Basel jail. Yugoslavs, Spaniards, Englishmen. There's nothing for them to read. Paul wrote to the ambassadors of 13 countries and asked them to donate old books to the Basel prison. Some of them did. When the reorganization of the library was complete, the warden of the prison gave a dinner for the library task force. He and his wife served it themselves, and we had a very acceptable wine, Paul said. One by one, the bank's management was released from prison on bail. Louis Thole had a nervous breakdown, was released and went to Belgium. In the early summer of 1971, Paul was released on bail of 500,000 Swiss francs, raised from Harry Schultz, Helly's family and some friends. Paul went to England to work for the Harry Schultz letter. All the prisoners were out on bail except Kummerly. And the word was that Kummerly, pending of course his guilt or innocence at trial, would be in custody a long time. Paul had had one confrontation with Kummerly before the investigating magistrate. Kummerly said that everyone knew the books were doctored, and that he got his orders from Los Angeles. He might as well have said from Joan of Arc or Jesus, Paul said. There was some speculation around Basel as to whether Kummerly had really gone off the deep end in jail, or whether this was a foxy act so that he would be allowed to serve his time in a mental institution rather than in prison. There was also some talk about Frau Kummerly, who was bombing around town in a flashy Mercedes. There is a phrase in Schweizerdeutsch which translates as green widow. A green widow is one who obviously knows where some of the green is for, which her husband is serving time. The investigating authorities sent questionnaires to all the commodity brokers who dealt with the UCB Basel and cocoa. All were returned except the one from Lomcrest in London. I went over the prospectus once more, masochist that I am. There it was, the bridge between conservative Swiss banking and modern corporate and financial techniques, usually identified with the United States. The present situation, then, it said, is that the bank is a subsidiary of United California Bank of Los Angeles, a bank with total assets of $5.2 billion at the end of 1969. United California Bank is, in turn, affiliated with Western Bank Corporation, the world's largest bank holding company, embracing 23 full-service commercial banks located in 11 western states of the United States. United California Bank itself is the full owner of an international bank in New York City, and has branches, representatives, or affiliates in England, Belgium, Switzerland, Spain, Lebanon, Japan, Mexico, and Greece. It has direct correspondent relations with important banks throughout the world. The music began to rise again. The sun would never set on our fast-growing Swiss bank. I was trying to abstract some lesson from the experience, but I knew that if tomorrow someone brought me the fastest-growing financial institution in Switzerland, with that kind of affiliation, and with a dynamic young management, I would probably do it all over again. There was one thing that bugged me above all others. When I called you, I asked Paul, and asked you how the bank was doing at the time the bank was raising more capital, you knew that all was not well, and you didn't say a word. We were opening new branches in Zurich and Geneva, Paul said. We were going to have banks in Brussels and Luxembourg. We had a little problem with the balance sheet, but who would have thought we couldn't work things out? I asked Paul what he was going to do next. I don't think I'll be the president of a bank, he said. I didn't think so either. I'm going to finish my book, he said. I read the first 60 pages of Paul's novel. Belatedly, maybe I did learn something. It was set in the near future. The world was involved in a financial crisis. Treasury officials from various countries were flying from capital to capital. Among the characters were a Russian from the Narodny Bank, a titled Englishman from the Bank of England, a bluff American, a safe cracker named Sammy, the Basel police, and a stiff, austere Swiss banker who was about to pull off an audacious and entirely legal currency coup, which would result in a profit to his bank of $1 billion. $1 billion, the greatest kendo stroke of all time. Chapter 10. Somebody must have done something right. The lessons of the master. What we had hoped to do in the soberer days of our Swiss bank was to create some supercurrency in Europe. Before the bizarre events, we had hoped the plan would go this way. Our bank would prosper and grow. Then it would offer some of its shares to European investors, and also to Americans if they would pay their government's penalty tax. Then the shares would be traded, probably in London and Brussels and Zurich, and we would have a supercurrency. We could buy other banks and other services with supercurrency instead of cash, and any time one of the stockholders wanted a chalet or a new cuckoo clock, he would peel off a few shares of our supercurrency. It would be Swiss supercurrency, too, and as the dollar had troubles, that would make a Swiss supercurrency sell at an even bigger premium. Some of the creators of supercurrency came to grief, and so did many of the traders in it, but not all by any means. The casualty list was typical, but not universal. There were those who kept their counsel and their cool. There is only one dean of our profession, if security analysis can be said to be a profession. The reason that Benjamin Graham is undisputed dean is that before him there was no profession, and after him they began to call it that. He came to Wall Street in 1914. 20 years later he published the first edition of Security Analysis, the first and reigning textbook in the field. Big, black, and forbidding, it has gone through 4 editions. Generations, plural now, of analysts have grown up with Graham and Dodd, as it is called, Dodd being David Dodd, the Columbia professor who was and is co-author of the book. Graham himself taught at Columbia on and off for 18 years, and also at UCLA. When Graham arrived on the scene, a security analyst was a statistician, an ink-stained wretch wearing a green eyeshade and sitting on a 3-legged stool, who gave figures to the partner in charge of running that day's pool. Now there are examinations and learned analyst societies, and the appellation CFA, or Certified Financial Analyst. That makes Graham dean, but it would not necessarily make him respected in the downtown canyons, since professors of finance rarely move stocks, and respect is today's buck after all. But Graham was also an active investor. He put in about 20-odd years at it, as the head of his own investment company, Graham Newman, which was considered a very smart outfit 1 generation ago, and he retired a very comfortable multimillionaire. Graham is now 78, and travels to his houses in Mallorca, in the south of France, and in La Jolla. That makes him respected, in addition to making him dean. One day I got a letter from the good dean, who was at his house in the south of France. It is a nice letter, and so characteristic of the dean that you might as well read it all. It tells you a lot in a brief moment. La Champousse, 42, Avenue des Marseilles, 42, Aix-en-Provence, September 6, 1968. Mr. Adam Smith, care of Random House, New York City. Dear Adam Smith, this is an appreciative note about the money game from the chap you call the Dean of all Security Analysts. I read your book with a great deal of enjoyment and with admiration for your many-faceted culture. Also, it gave me a lot of information on what has been happening in Wall Street since I left it some years ago. I think I understand pretty well everything in the book that's in non-mathematical English. However, your Greek on page 25 gave me a bit of trouble. The second part is evidently a version of the well-known Quem Deus volt perdere, prius dementat. But your text has octave instead of octave. Does the preceding part mean, when a beam falls every man gathers wood? If so, your dovag must be changed to docog. And where does the quotation come from? Thanks in advance for your reply, and sincere congratulations on your book. Benjamin Graham. P.S. Also, shouldn't it be MMA, recamier instead of de stal, page 221, and Hinselmenschen for mention, page 270. That's for your next printing. You know something right away. Nobody messes with the dean as far as the classics are concerned. Too many Wall Streeters. Horace is the guy who works in the cage in the back room tallying the margin accounts. Benjamin Graham has always been a classicist. The prescript to security analysis is a marvelously apt quotation from Horace's Ars Poetica. Multa renescentur, quem se sidera, candentque, que nunc sunt un honere vocabulae. Many shall be restored that now are fallen, and many shall fall that now are in honor. It is nice to hear good words from the dean, even with the ruler taps on the wrist. We did have to have a special printer for the great quotation, and any good proofreader would have realized the octave should have been octave. Hinselmenschen should certainly have a C. You can't catch them all. I did, however, mean Madame de Stael, not Madame Recamier. After some further correspondence, the good dean came to town, and we had breakfast at the Plaza. Graham is a short, dapper man with a vague resemblance to Edward G. Robinson. He was in town, he said, to see a publisher about the new translation of Aeschylus he had just completed, and then he was going to see some of his grandchildren. When we met, the market was sliding, and the performance-nicks were in their final throes. I asked him what he thought of what was going on. "Oh, I don't keep up any more," he said. "I only own one stock, and the rest is all municipal bonds. But these periods have come before. As it was written once, hoc etiam transibit. This too will pass. What was the one stock? That's just leftover, government employees' life insurance. We owned the whole company at one point. I don't even keep up with that. I've reached the stage where I'm just giving things away, not trying to make more." We talked about events since the last edition of Security Analysis. Benjamin Graham had an idea he wanted to talk to me about. A new edition of The Intelligent Investor was forthcoming, that book being more or less a distillation of the textbook, Security Analysis, only for the layman. Graham wanted me to work on it, more or less by long-distance correspondence with him. I could send the relevant chapters to Aix-en-Provence, or Majorca, or La Jolla, and he would send them back again. "There are really only two people I would want to work on this," Graham said. "You're one, and the other is Warren Buffett." "Who's Warren Buffett?" I asked. That, as it turns out, was a rather extraordinary question at the time. Extraordinary because I knew most of the highly visible professional money managers of the time. They spoke at seminars, delineated their theories, dressed up and trotted out their favorite industries and their favorite stocks. I didn't know Warren Buffett. He was not in the chain letter for Four Seasons or Viatron, or even for Control Data or Polaroid. That, of course, would have made him atypical, but not remarkable. What was remarkable was that Buffett was easily the outstanding money manager of the generation. And what was more remarkable was that he did it with the philosophy of another generation. While the gunslingers of the 60s were promoting each other over drinks at Oscars, then going back to their offices so they could watch the tape, Buffett was compiling the best records in the industry from Omaha, Nebraska. No quote machines, no ticker, no Oscars, no chewed fingernails, no tranquilizers, no galusil, no backgammon after the close, no really big spectacular winners, no technological companies, no conglomerates, no concepts. Just pure Benjamin Graham, applied with absolute consistency, quiet, simple stocks, easy to understand, with a lot of time left over for the kids, for handball, for listening to the tall corn grow. Buffett, it's true, did not manage a public fund, so he was not subject to the pressures of salesmen wanting to sell the fund. While he made his record with the philosophy of another generation, some of his big winners were also well within the growth stock philosophy. He did not have a committee to deal with, and he did not have a boss. He kept himself out of the public eye, though for most of his career the public eye would not have been on him anyway. If he bought so much of a company that he controlled it, he was willing to step into the business. All of these factors freed him from more typical restraints. His partnership began in 1956 with $105,000, largely supplied by uncles, aunts, and other assorted relatives. It ended in 1969 with $105 million and a compounded growth rate of 31%. $10,000 invested in the partnership in 1957 would have grown to $260,000. Over that time, the partnership did not have a single losing year, and it gained in the years of severe market declines, 1962 and 1966 among them. The partners in the Buffett partnership received a letter annually telling them the goals of the partnership, and the same consistency ran through the 10 or so letters. The money managers of the 60s habitually took a record of 1 or 2 hot years, gave it to the salesmen, and let them bring in the people. Buffett's record ran for 13 years and wasn't merchandised in any way. In fact, as the partners began to see the success, they wanted their own relatives in, and Warren couldn't accommodate them because this was a private partnership of limited members. Warren Buffett was a far more logical choice than I was to work on Graham's new edition, and indeed, he did do some work on it, though he and Benjamin Graham, pupil and master, did not agree on everything, and Warren is acknowledged but doesn't share the authorship. Shortly after I met Graham, Warren came to town and we had lunch, and this was followed by other similar meetings and a rather desultory correspondence until finally I went to the west bank of the Missouri with my various marked-up Graham texts. There, in the heartland, Warren and I went over the lessons of the master to see what was still relevant, like two scholars over the scripture. Having compiled his record, and having made both himself and his partners quite comfortable, Warren did another unusual thing. He quit. They hung up the jersey and retired the number. He was then 39. He said that it was getting harder and harder to have good ideas, and of course his own drive had been somewhat dimmed by his own success, since he had then $25 million or so to his own name, and there are other stages of life. Of the scholars and the scripture in a moment. Warren's own story serves as such a cute counterpoint to what was going on at exactly the same time elsewhere in the financial world that it is worth telling on its own. I find a certain nostalgia in this triumph of Middle America. It seems almost to have taken place in another country than the one which experienced the Vietnam War, a changing morality, student riots, and a burgeoning military-industrial bureaucracy. Warren was born in Omaha, the 7th generation of Buffett in that city since the first Nebraskan Buffett opened a grocery store in 1869. Warren's father was a stockholder, but his main interest was in politics. In Omaha in the 1930s, stockbroking cannot have been an overwhelmingly fascinating occupation, though it must have exposed Warren to the atmosphere early on. Warren remembers chalking the board on his father's office as a boy. Howard Buffett ran for Congress 5 times, serving 4 terms as a Republican from Omaha, and Warren moved to Washington at 12. He was already interested in the market the way some lads used to be in baseball averages. And he was interested in business. He had, of course, the prerequisite for all business success stories, a paper route. He delivered the Washington Post, which enabled him 25 years later to tell Katharine Graham, the owner, that he had once worked for her. Together with a friend, he also had a business delivering and servicing pinball machines in barber shops. That was good for $50 a week. The paper route was good for $175 a month. And Warren saw no reason to go to college. It interfered with business. His father prevailed, and he went to the University of Pennsylvania's Wharton School of Business and Finance for 2 years. He wasn't exactly turned on by it. It didn't seem like I was learning a lot. After 2 years, he transferred to the University of Nebraska, and by taking an accelerated course, was out in another year. At Nebraska, Warren had still another business. He sold golf balls. Once he showed me his ledgers, his net worth carefully calculated, all on lined paper and cramped round handwriting. His first stock purchase, 3 shares of Cities Service Preferred, and the golf ball business. The ledger itself looks like what Horatio Alger might have donated to the Baker Library at the Harvard Business School. The net worth starts very, very modestly. The initial capital, after all, is merely the proceeds from the paper route, the pinball machine servicing, and the selling of golf balls. Warren was also into the market, although his older sister had to sign the appropriate papers, since he was not yet 21. I went the whole gamut, he says. I collected charts, and I read all the technical stuff. I listened to tips, and then I picked up Graham's security analysis. That was like seeing the light. Warren went off to Columbia University Business School to study under the master, and when he graduated he worked for Graham Newman for 2 years, commuting from White Plains. He had married Susie, an attractive blonde girl from Omaha, when he was 21. Graham Newman was further training in the same principles, but Warren did not like the pace of New York or the commuting. In 1956 he returned to Omaha and started his partnership. All his partners were relatives or friends. The partners were to get a return of the first 6% of the profits, and the profits in excess of that were to be split, with 1/4 to the general partner, who comprised the entire operation. For the first 6 years the office was an upstairs bedroom in the rambling house Warren had bought for $30,000. Located in a relatively unfashionable section of Omaha. This was the fashionable part of Omaha maybe 40 years ago, Warren said, when we drove out to the house. Now everything's moved on much further west. I think most of my neighbors make $10,000 to $15,000 a year. You can be anywhere in 5 minutes from here. The house is on a pleasant, midwestern, tree-shaded street. It looks like the same section of Kansas City or Indianapolis or Des Moines. You would need only a jalopy and some high school youngsters, and that street, and those trees, and those houses to have a 1947 Saturday Evening Post cover. Warren's house is a rambling affair, more rambling because the Buffetts added on another room when they wanted to, and an indoor paddleball and handball court. The house is full of books and the walls of posters. War is unhealthy for children and other living things. It is the obvious gathering place for neighborhood children. The Buffetts have 2 children in Central High School. One of them is named after Benjamin Graham, where Warren's father and grandfather went, and one at the University of Nebraska. Susie works energetically for Planned Parenthood and for the Panel of Americans. Among all the books is a shelf on Bertrand Russell. Warren can quote Bertrand Russell almost as well as he can quote Ben Graham. Obviously, as the Buffett partnership grew, so did Warren's contacts on Wall Street. And some of those contacts must have asked him why Omaha, for his answers show the question has occurred to everybody. I can be anywhere in 3 hours, Warren says. New York or Los Angeles. Maybe a little longer since they took the nonstop off. I get all the excitement I want in those visits. I probably have more friends in New York and California than here, but this is a good place to bring up children and a good place to live. You can think here. You can think better about the market. You don't hear so many stories, and you can just sit and look at the stock on the desk in front of you. You can think about a lot of things. What did Ben tell you? Warren asked before dinner one night, as I stirred my scotch and he stirred his Pepsi-Cola. He told me medius tutimus ibis, I said, which he explained as what Phoebus Apollo told Phaeton about chariot driving, and the bum didn't listen. You go safest in the middle course. That's Ben all right, Warren said. Gee, Ben really knows languages. Ben really liked learning things. The one thing he didn't care much about was money. I don't think Ben ever knew how much money he had. To win, the first thing you have to do is not lose. That is my own distillation of one of Graham's first principles. It sounds absolutely simplistic. Of course you shouldn't lose if you want to win. There is more to it than that. This is a rational statement in a rational world, even though Keynes once said there was nothing more disastrous than a rational investment policy in an irrational world. And it excludes all the people who really do want to lose, because their parents told them they were losers, or for whatever psychological fulfillment they might get. Graham does not do much to feed the fantasies of those who would say, turn 5,000 into $250,000. He starts with the supposition that your money is at risk. The first thing you must do is not lose your money, even before you think about making more with it. The joys of compounding are there if you keep your stake growing. But all you need have is 1 year in which you give back half, and your program, at the same growth rate, must stretch out years and years longer. And he is not sanguine about your ability to judge the market or even to judge individual stocks. Everyone knows that most people who trade in the market lose money at it in the end. The people who persist in trying it are either unintelligent or willing to lose money for the fun of the game, or gifted with some uncommon and incommunicable talent. In any case, they are not investors. A great deal of brain power goes into this field, and undoubtedly some people can make money by being good stock market analysts. But it is absurd to think that the general public can ever make money out of market forecasts. For who will buy when the general public, at a given signal, rushes to sell out at a profit? Too many clever and experienced people are engaged simultaneously in trying to outwit one another in the market. The result, we believe, is that all their skill and efforts tend to be self-neutralizing, or to cancel out, so that each experience and highly informed conclusion ends up being no more dependable than the toss of a coin. Graham had little faith that even stock market analysts themselves could, as a group, prove consistent winners. We once likened the activities of the host of stock market analysts to a tournament of bridge experts. Everyone is very brilliant indeed, but scarcely anyone is so superior to the rest as to be certain of winning a prize. An added quirk in Wall Street is that the prominent market analysts freely communicate and exchange their views almost from day to day. The result is somewhat as if all the participants in a bridge tournament, while each hand was being played out, gathered around and argued about the proper strategy. Modern stock market movements, in fine, are the result of a concentration of tremendous skill in a limited area, where profits can be made by smart people only at the expense of other people who are almost equally smart. The metaphor is very much like Keynes's market metaphor of musical chairs. You can see why I was the wrong choice to work on the next edition of Graham. In Graham's view, the stock market is what the game theory economists would call a zero-sum two-person game. That is, one person wins what the other one loses, as in a gin rummy game, or one team wins over another team, as in a bridge game. But my own apprenticeship was geared to the recognition of small, rapidly growing companies. The company was worth $20 million when it was small and $600 million after it grew up. Someone else did not have to lose in order for you to win. Of course, over a long period of time and with enough participants, there is a zero-sum game simply because there is a buyer for every seller. This concept, it should be added, is relative to the market. If the whole market moves up, then the losers have lost only relative to the winners. They still may have more than they started with. Conversely, if the market moves down, even the winners may have less than they started with. Mathematicians everywhere are undoubtedly working on the final and complete equation for the whole thing. Well, all right, not to lose is a very good ambition. It will be hard for optimistic young tigers to bother with, or even people looking for increments to their life from the market, other than the ones they might rationally expect. How not to lose? There is one important proviso, Graham wrote. The shares must be purchased at reasonable market levels, that is, levels that are reasonable in the light of fairly well-defined standards, derived from past experience. Nothing wrong with that. Some of Graham's critics say that properly applied, this would have kept him out of most of the market from 1949 to 1969, because the market levels never looked reasonable in terms of the way they had looked from 1929 to 1949. IBM, for example, was never right to Graham. $1 of 1949 earnings on IBM was valued 3.4 times as liberally as $1 earned by Atchison, and 4 times as $1 earned by Atlantic Refining. The price itself of IBM precludes the margin of safety which we consider essential to a true investment. IBM, said Graham, was a speculation. It might turn out all right, but that was a speculation. To Graham, a stock had intrinsic value. In the dark ages of the 30s, it was not so hard to find intrinsic value. Some companies were selling for less than the cash they had in the bank, and many for less than their true book value, or for their cash and net assets. You could buy a stock for $10, and that share of stock would have behind it $10 in cash. Ideally, you would buy a stock for no more than 2/3 of its intrinsic value. That way you would have a margin of safety. A stock selling at 2/3 of its intrinsic value would have to be counted as depressed. It might not rise immediately from that discount from intrinsic value, but sooner or later it would have to. One might wonder why, if the market undervalues the issue at the time he purchases, it should not continue indefinitely to do so. and perhaps even increase the measure of undervaluation. There is no theoretical reason why these unpalatable results could not occur. The comfort and encouragement to the intelligent investor are to be found in practical experience. In the long run, securities tend to sell close to a price level not disproportionate to their indicated value. This statement is indefinite as to time. In some cases, the day of vindication has actually been deferred for many years. You can see why Benjamin Graham never sold Like Anyone Can Make a Million, or How I Made $2 Million, and so on. Telling a game player that he might make some money in 2 years is like betting him on how tall the corn will grow and then letting him sit on a camp chair in the cornfield watching it. And in the long run, Keynes said, we are all dead. Benjamin Graham would never buy a growth stock, or what has been recognized as a growth stock, because growth stocks seem to be betting on a future market judgment and the continuation of those growing earnings. The growth stock would not turn out to be one after all, and one has only to look at the growth stocks of the 50s, chemicals and aluminums, to realize that growth in many, probably most, companies is not a permanent stage, but a dramatic burst in early adolescence. But of course, in other instances, growth was quite real. Not only would Benjamin Graham have steered clear of IBM in 1949, he would have avoided it at any time, and IBM has been the source of many fortunes. The same could be said of Xerox, Polaroid, and innumerable other growth companies. They simply do not look like the value is there. It is certainly not there in assets, related to market value. It may be there in patent protection or reputation, but how do you measure that? Money has been lost in growth companies which stopped growing, and at market peaks, it has been possible to pay too much for even the true growth companies. The growth companies rarely have the cash in the bank, and the more true the growth, the more they have deprived both their own current profits and current balance sheets to the benefit of some future payoff. And as the companies get more technical, the assessments become more difficult. Sperry Rand preceded IBM into computers, and American Photocopy preceded Xerox into copying, and it was possible to lose handsomely in either case. All you can say is that there are multiple theologies. Another of Graham's tests was the value to the private owner. Would a private purchaser pay the same price as the market? In depressions, or market bottoms, a private purchaser could find great bargains that way. The rest of the time he would not pay cash in debt. There would be too much of a premium assigned by the market to future earnings, or goodwill, or a future buyer even more eager. The private owner would have to have supercurrency of his own, or not pay. In any case, the investor was to ignore the market, the current price quotation. He need pay attention to it and act upon it only to the extent that it suits his book, and no more. Thus the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. Price fluctuations have only one significant meaning for the true investor. They provide him with an opportunity to buy wisely when prices fall sharply and to sell wisely when they advance a great deal. At other times he will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies. Dividend returns? Dirty words to an aggressive investor in the 50s, and certainly to a swinger in the 60s. Happiness when stocks decline. And ignore the market? Not watch the tape? Not trade stories? Not press the buttons on the quote machine? Benjamin Graham was studied with respect by generations of analysts, but not with affection. What was one to do all day if the market was to be ignored? That would not get you rich. How could anybody ignore IBM? How smart could somebody be if he had missed IBM? Not because he didn't know about it, but because he had considered it, measured it, and turned it down. Graham was well aware that he was himself selling at a discount from intrinsic value. Through a number of editions of Security Analysis, the final sentence to the summary of the valuation of common stocks warned that our judgment on these matters is not necessarily shared by the majority of experienced investors or practicing security analysts. But the judgment was shared by one bright student. Warren sat in his bedroom office reading through the manuals, the statistical manuals of Moody's and Standard & Poor's. There are all the statistics, the balance sheets, the debt, and the contingent reserves, and slumbering on the forest floor, if you could but recognize them, were the truffles. I always knew I was going to be rich, Warren said. I don't think I ever doubted it for a minute. There was Western Insurance earning $16 a share and selling at $16 a share. There was national insurance selling at 1 time's earnings. How could it miss? Warren wrote to his partners every year, and what he wrote was in line with the teachings of Benjamin Graham. I cannot promise results to partners, he wrote, every year. What I can and do promise is that A. Our investments will be chosen on the basis of value, not popularity. B. Our patterns of operation will attempt to reduce the risk of permanent capital loss, not short-term quotational loss, to a minimum. And C. My wife, children, and I will have virtually our entire net worth in one partnership. The foundations of the operation were almost straight from Graham. Never count on making a good sale. Have the purchase price be so attractive that even a mediocre sale gives good results. There is this about Graham. If you have bought at less than true value, if you have a comfortable margin of safety, you are going to sleep better. Then, as the stock starts to work its way up from the discount from its intrinsic value to that value, you will have a gain. And when gains compound, you do very nicely. Warren's letters to his partners usually carried a small table to show how compound interest, the growth of money from the increment, can grow. Here is a compound interest rate table showing the gains from $100,000 compounded at various rates. Now you can do better than 4% at a savings bank, and a 16% gain, 2 points on a 10-point stock, and pay the taxes, does not seem unusual as a goal. But look what happens toward the right-hand corner. It is hard to believe that the professional managers running hundreds of millions in the late 60s ever looked at such a table, or they would not have been able to declare confidently that they expected to do 20% a year. 80 times the original stake is better than any professional I know has done with other people's money in the last 30 years. The point is that a 16% compound can be a pretty exciting figure. Over a long enough period of time, the effect of compounding can be a bit ridiculous, and you can play any historical game you want. The Manhattan Indians sold their island to Peter Minute in 1626 for $24. Who got the better deal? Well, at $20 a square foot, Peter Minute's island is now worth $12.4 billion. Could the Indians have gotten 7%? They now would have more than $225 billion, and they would be 20 times better off. Or take Francis I, the French Francis I, who is reported to have paid 4,000 écus for a painting called Mona Lisa. Local scholars translate that écu rate out at about $20,000. Had Francis been able to find, in 1540, a 6% after-tax investment, his estate would be more than $1 trillion, a quadrillion 3,000 times the U.S. national debt. Try that on your art dealer the next time he says art is a hedge against inflation. You do have to have a very long life in order to enjoy the greatest benefits of the compound table. Warren wrote them up for his partners to illustrate the enormous benefits produced by relatively small gains in the annual earnings rate. Every percentage point of investment return above average has real meaning. Warren had a relative, not a finite goal from the beginning of the partnership. It was to beat the Dow Jones averages by 10 percentage points a year. If the market was up 20%, the partnership should be up 30%. If the market was down 30%, the partnership should be down only 20%. Because of the investment approach, it would be easier to beat the Dow in a down market than in an up market, which was the reverse of the very aggressive so-called swinging managers. The record demonstrates that, in the 5 years that the Dow was down, the partners were up, and the Dow was comfortably beaten by 10 percentage points, except for 2 years in which that average was up rather sharply. All through the 60s, Warren stayed away from the stocks that dominated the financial headlines and provided the excitement in the boardrooms. The partners bought an old textile company called Berkshire Hathaway, because its net working capital was $19 a share and their cost was about $14. They ended up owning most of the company, and Warren put new management in. While Berkshire is hardly going to be as profitable as Xerox, Fairchild Camera, or National Video in a hypertensed market, it is a very comfortable sort of thing to own. We will not go into the businesses where technology, which is way over my head, is crucial to the decision. In some of the partnership's investments, the partnership did end up controlling the company. A second category was workouts, that is, situations in which a merger or reorganization has already been announced. Usually, the market has recognized the first 95 cents on the dollar in such a case, but even the last 5% 2 or 3 times a year, on an annualized basis, builds up to a respectable compound. The major category of the partnership's investments, however, were in the undervalued category. Here the market was ignored, unless it was presenting something at an unusual price. Benjamin Graham had instructed his students to think of themselves in partnership with a Mr. Market. Every day Mr. Market tells you what he thinks the business is worth. Some days Mr. Market is feeling very optimistic, and is willing to offer you much more than your share of the business is worth. Some days he is very depressed, and he is willing to sell you his share for less than it is worth. All you have to do is know what the business is worth. Ben was right, Warren said. The market is a manic depressive. That's why you can't buy and sell on its terms. You have to buy and sell when you want to. After a while, around Warren, you begin to get a feel for business, as opposed to stocks moving. We are driving down a street in Omaha, and we pass a large furniture store. I have to use letters in the story because I can't remember the numbers. See that store, Warren says? That's a really good business. It has A square feet of floor space, does an annual volume of B, has an inventory of only C, and turns over its capital at D. Why don't you buy it? I said. It's privately held, Warren said. Oh, I said. I might buy it anyway, Warren said, someday. That phrase, that's a good business, I heard several times, always applied to something solidly managed, with a secure niche, plenty of capital and a respectable return on invested capital. Sometimes it was the ethnic banks in Chicago, which have 40 or 50,000 passbook savers so loyal they will drive for miles even after they have moved away from the neighborhood. Sometimes it was a Tennessee or Illinois bank that simply earned a very respectable return. One example can serve very well in this idea of the undervalued stock. In the first part of the 1960s, American Express was involved in the financing of some salad oil that turned out not to exist. A number of institutions were badly hurt, and several Wall Street houses whose commodity departments had participated went broke. American Express was sold from a high of 62 3/8 in 1963 down to 35. American Express. The name only is a great franchise, Warren said. He went into Ross's Steakhouse in Omaha and sat behind a cashier to see how many American Express chits showed up after dinner. He made a tour of the Omaha banks to see whether the scandal had affected confidence enough to discourage the sale of American Express traveler's checks. American Express had over 80% of the traveler's check market nationally, and nothing could shake it. Warren bought American Express at its darkest hour, and in fact the partnership owned 5% of the company at one point. Amex went from 35 to 189 in the following 5 years. The same reasoning went into Disney in 1966. Disney was selling at about $50 a share. On that basis, the whole company was selling for $80 million. But Snow White, Bambi, and all those other cartoons had been written off of the books. They alone were worth that much. You had Disneyland to boot, and Walt Disney as a partner for nothing. While Warren bought Disney for its basic value, the market picked it up and carried it into the leisure boom. And while Warren's reasoning was from Graham, both Disney and American Express were soon to be growth stock favorites. If the stock doesn't work in one context, sometimes it works in another. Sometimes the conglomerates would come along and bid for one of our asset value plays. By 1967, Warren was beginning to think that maybe he would not run the partnership forever. He was, of course, less hungry, but also, as he wrote to his partners, I am out of step with present conditions. When the game is no longer being played your way, it is only human to say the new approach is all wrong, bound to lead to trouble, and so on. On one point, however, I am clear. I will not abandon a previous approach whose logic I understand, although I find it difficult to apply, even though it may mean foregoing large and apparently easy profits to embrace an approach which I don't fully understand, have not practiced successfully, and which, possibly, could lead to substantial permanent loss of capital. Warren cut the expectations of his partners by about half. Philosophically, I am in the geriatric ward, he wrote. We live in an investment world populated not by those who must be logically persuaded to believe, but by the hopeful, credulous, and greedy, grasping for an excuse to believe. Those were the times when fund managers expected to do 30% a year, and when 100% gain could be expected in a computer stock, a franchising chain, or a pastel of nursing homes. A leading investment manager of a billion-dollar fund had delivered himself of a statement that money management was a full-time job. not only week by week and day by day. Securities must be studied on a minute-by-minute program. Wow, Warren wrote. This sort of stuff makes me feel guilty when I go out for a Pepsi. Many investment funds far outperformed both the Dow and the Buffett partners in the heady atmosphere of 1967 through 68. Most of them gave much of it back the following years. The Buffett partners were up again in 1969 against a loss of 6% or so in the Dow. But Warren was through. The ideas were coming harder. In retrospect, Warren said, maybe a convulsive period like the 30s provided Ben with his environment. A period when securities are really unpopular leaves a lot of bargains to be discovered. But for almost 30 years now, people have been combing and recombing, and I'm not sure how many bargains remain. There will be some from time to time. But now there are so many security analysts, even though most of them are wedded to other theories, the ranks of security analysts have really multiplied in one generation. There was yet another difference brought by changing times. Graham had originally divided his investors into aggressive and defensive. The defensive or passive investor was concerned with maintaining his principal and securing a return on it. The aggressive investor was to be rewarded for his attitude toward risk. If the defensive investor could expect, say, 4.5% return, then the aggressive investor would expect 9%. Presumably the defensive investor would be in a combination of bonds and solid stocks, and the aggressive investor in undervalued situations. But over the years, bond yields rose and the possibility of stock gains declined, closing the gap. The Fortune 500, Warren said, yields about 11% as a return on its own invested capital. If you paid out half and reinvested half, the return to an investor in the 40% bracket would be 6 to 7%, and you can get that in a tax-free municipal. There's no question that the Ben Graham approach was evolved in another era and designed for that time. Corporate managers in the 30s and 40s did not fear inflation. They feared going broke. They wanted a cushion against adversity, and sometimes that impulse led them to piling up cash far beyond their needs. Rather than reporting not only all their earnings, but even earnings they did not have, as became the fashion in the 60s, they actually hid their earnings through a variety of devices and reserves, so that they would have something for the lean years. Now corporate managers, fearing inflation and also wanting to look good on quarterly earnings basis, leveraged their companies. Meanwhile, conglomerates already leveraged sought out the remaining cash-rich companies. So there is not as much Graham material around as there once was, and yet the market does provide it from time to time. Warren introduced me to another Graham disciple. He has no connections or access to useful information, Warren wrote. Practically no one in Wall Street knows him, and he is not fed any ideas. He looks up the numbers in the manuals and sends for the annual reports, and that's about it. He is a very family-oriented fellow. He probably spends more time thinking about children than about stocks. There followed a list of stocks, about half of which I had scarcely heard of. The Rutland Railroad, the New York Trap Rock Company, the Union Street Railway of New Bedford, Jeddo Highland Coal. Clearly the fellow had never been to lunch at Scarsdale Fats, and was probably not around after the close at Oscar's. The record was not spectacular. It plodded away, beating the Dow Jones average by a few percentage points. Not as wide a margin as the Buffett partners, but up 17% compounded over 15 years. I made a lunch date with Herbert. We stopped at the check room with his raincoat and briefcase. He waited until the briefcase was stashed away. You couldn't, he said, be too careful. I didn't get to go to college, Herbert said. I went to work in the Depression because my folks didn't have any money, and I worked as a runner on Wall Street and then in the cage, tallying stocks. Herbert took a Graham course at night at the Institute of Finance. Ben really loved to teach, he said. He could have made a lot more money if he hadn't been so interested in teaching. Herbert operated just as Warren said he had. He never looked at rising stocks. He looked at the list of new lows in the paper every day. Look at the steels, he said. No one wants them. Will they go bankrupt? How can an industrial country not have a steel industry? Look at American Can under 30. Can they keep that dividend? I'm not very bright, Herbert said. I can't compete with all the bright people, and especially the ones who have college educations, who have been to business school, who have lots of corporate contacts. I don't know anybody. I have to buy what I'm comfortable with. These fellows that buy, even Procter & Gamble and General Electric, Why? Those stocks go up and down all the time. I just wouldn't be able to sleep at night if I owned stocks like that. What was Herbert buying? Well, there's one issue of Penn Central bonds, Herbert said. That was a bit breathtaking. The Penn Central is very busted. The Pennsylvania Railroad is bankrupt, I said. The value of the stock is negligible. The value of the bonds is questionable. It will take 20 years to straighten out. What you should buy is Sherman and Sterling, the lawyers, who will get all the money for the next 20 years. I know, Herbert said, but there is one issue of Penn Central bonds that is collateralized by the Pittsburgh and Lake Erie Railroad. I wrote Irving Trust and asked them, did they have the collateral behind the bonds, and they said yes. They don't pay interest on the bonds, but when they settle the case, I think they will. And meanwhile the interest is in a special account at Girard Trust. 12, 13, 14%. It may take a long time, but I can sleep at night. I'm not in a hurry. Things always take longer than you want them to. Had he really owned the Union Street Railway of New Bedford? Oh yes, they had a lot of cash. It took quite a while to liquidate, but it worked out very, very well. Warren bought a weekly newspaper in Omaha, where he seems to be as popular as the Cornhuskers' winning coach. He also bought part of the Washington Monthly, a small circulation magazine on political affairs. He is interested enough in newspapers to have made a bid for the Cincinnati Enquirer. Considering the Cornhuskers' background and his father's service as a Republican congressman, it is a mild surprise to find him a Democrat. And in fact, a number of Democratic hopefuls have found their way to Omaha to talk about issues and the future. Warren says he has no political ambitions. Most of the millions amassed by the Buffett partnership will go to a foundation, because there is no point in ruining the lives of children at Central High, by leaving them an uncomfortable amount of money. We had a long discussion one night about the uses of money. What would you do with $25 million, he asked, for he said, everything he wanted. The house was enough house, and Central High was good for the kids. He didn't like travel. He might be uncomfortable where they didn't speak English. He wanted to do things in the public interest, but while the problems had been well articulated, there were no great original solutions. One thing he did in Omaha was to join the Jewish Country Club. I ate lunch in the Omaha Club, that's the downtown club, and I noticed there weren't any Jews, Warren said. I was told they have their own club. Now there are Jewish families that have been in Omaha 100 years. They have contributed to the community all the time. They have helped build Omaha as much as anybody, and yet they can't join a club that John Jones, the new middle-ranked Union Pacific man, joins as soon as he's transferred here. That is hardly fair. So I joined the Jewish club. It took me 4 months. They were a little put back and confused, and I had to do some convincing. Then I went back to the Omaha Club and told them that the Jewish Club wasn't totally Jewish anymore. I got 2 or 3 of the Jewish Club members to apply to the Omaha Club. Now we've got the thing cracked. In introducing me to Herbert, Warren had also, to my mind, described himself. He never forgets, he said, that he is handling other people's money, and this reinforces his normal strong aversion to loss. He has total integrity and a realistic picture of himself. Money is real to him and stocks are real, and from this flows an attraction to the margin of safety principle. After our Omaha session, I participated in a seminar with about 20 leading money managers. I brought up Graham. That old stuff, said one of the managers. Graham is all right, but it's really just a lot of platitudes interspersed with 40-year-old industrial gossip. Then, after this particular 4-day seminar, I reported the discussion on Graham to Warren. He took it for granted that Graham would be, as it were, selling at a discount, but his loyalty was undiminished. Graham's teachings, he wrote, have made a number of people rich, and it is difficult to find any cases where those teachings have made anyone poor. There are not many men you can say that about. Chapter 11. The Debased Language of Supercurrency. When Benjamin Graham was not communicating in Latin or Greek, he depended on 2 other languages, English and numbers. The numbers, income statements, balance sheets, told you how a business was doing, what its strengths and weaknesses were, and what its characteristics were. In short, they were a mirror of activity. A good analyst could look at a cash flow sheet like Toscanini looking at a score. Beautiful, beautiful. Tum-tum-de-tum. Wait, wait, where are the flutes? Tum-tum-de-tum. Flutes? But when Toscanini looked at the score, he could make certain assumptions. If the score said C sharp, that meant it was a C sharp, whether played by a flute or a tuba. Beethoven did not put into the score C sharp, except that the composer has elected to defer certain notes, and to leave some out because this year they do not sound so good. We should have 3 good flute players by this time next year. See footnote 13. And counsel believes the composer has a meritorious defense, and nothing will have a material effect on this melody except maybe. Investors now have a problem that is more severe than in the days when Benjamin Graham would take his students through a balance sheet. The numbers may or may not mean what they say, and there is a crisis in the language. The power of the supercurrency is so strong and its rewards are so great that numbers go into constructing the best supercurrency picture and not necessarily into mirroring activity. There are all sorts of students of the marketplace and numbers of differing portfolio strategies. Let us take one of the most deceptively simple, which is to look for growing earnings. The first thing to cheer your heart, if you are a growth fan, would be a neat stepladder earnings pattern. 1965.93, 1966 1.25, 1967 1.49, 1968 1.68, 1969 2.08, 1970 2.40, 1971 2.71. Beautiful, beautiful, what harmony. That happens to be Xerox, which made a lot of people a lot of money. In the old days, some investors did not want small companies which might or might not grow up to be Xerox. These small companies needed all the cash they could generate, so they did not pay dividends. Some investors wanted dividends. Pension funds did not even keep large percentages of stocks in their portfolios. They bought bonds. They knew the interest rate on the bonds, and that the bonds would pay the interest for many years, and that would take care of the pensioners when they retired. But gradually, as a small growing company kept growing, more conservative investors became interested. A bank trust department here and there would nibble. A mutual fund might buy some. Not only would the earnings keep growing, but the premium that people would pay would grow. The adventurous investor would take the early risks, and then sell to the more prudent investor who required more convincing. Then 2 things happened. One we have already seen in the history of the 60s. The prudent investors got just as aggressive as the old risk-takers. They did not wait for a stock to become a seasoned and proper and judicious fiduciary holding. All of a sudden there were 10,000 security analysts scouring the backwoods for those earnings patterns, and 50,000 salesmen were eager to call everybody and tell them to buy. The second thing that happened was quite amazing. Growth? Is that what they want? Growth? Is that the highest price supercurrency? Is that how it's done? Wow. The supply of growth companies grew to meet the demand. Now, common sense, that great Yankee virtue, will tell you that there is one Xerox, not 17. But everywhere you looked there was a company with a neat stepladder of growing earnings. Some of them kept the neat stepladder right up to the day they filed for bankruptcy. Skeptics can look at some of the popular institution holdings such as R. Ho, as well as the ones already noted on Babson's booby list. Magic. Growth companies everywhere. You want growing earnings? We got growing earnings. Make our stock go up, then all our stock options are worth a lot. Obviously, all the earnings were not growing like that, but did not the numbers imply precision? Did not the numbers then represent reality? They did not in many cases. The world is not the way they tell you it is. The numbers represented a lot of imagination at work in a popular arena. But you say this is business. You make a widget for X dollars and sell it for Y dollars. And in there somewhere is the profit, and then Price Waterhouse comes in and signs the statement. It says, we have examined the books of Universal Widget, and they conform to generally accepted accounting principles. Generally accepted accounting principles. It is safe to say that for a generation no one knew what those 4 words meant. Leonard Spacek is a senior partner and chairman emeritus of Arthur Andersen and Company, one of America's Big 8 accountants. Here is Leonard Spacek on generally accepted accounting principles. How my profession can tolerate such fiction and look the public in the eye is beyond my understanding. I suppose the answer lies in the fact that if your living depends on playing poker, you can easily develop a poker face. My profession appears to regard a set of financial statements as a roulette wheel to the public investor, and it is his tough luck if he doesn't understand the risks that we inject into the accounting reports. That is the senior partner and chairman emeritus of one of the most prestigious accounting firms in the world. Everybody knows the odds on a roulette wheel. Translated even further, it means that if you see Universal Widget reporting $1 of earnings, that $1 can be 50 cents or $1.50, depending on which way they are playing the guitar that week. Where does all this flexibility come from? Well, you could change your depreciation from accelerated to straight line. If your depreciation charges are higher, then your profits are lower. So to increase profits, decrease depreciation. A couple of years ago, Armco Steel did just that. Its president, William Verity, said, "The move was a defensive ploy designed to get the stock up and out of the reach of asset-hungry conglomerates and other acquisition-minded folk. Of course, some future year your furnaces may be falling apart, and you without a cash reserve for new furnaces, but in the long run we are all dead. Let's get the stock up now." You can change the valuation of your inventories. You can adjust the charges made for your pension fund. You can make a provision for taxes on the earnings of a subsidiary or wait until the subsidiary remits a dividend to the parent. You can capitalize research instead of expensing it. You need not go as far as the gentleman at the United California Bank in Basel to avoid showing losses. There are legal means at hand. You can defer the cost of a new project until that project brings in revenues. If the project never comes off, you will take a bath some future year. There are in addition other discretionary expenses. There is a phrase for this philosophy. It is called après-moi le déluge, or as Scarlett O'Hara said, "I'll worry about it tomorrow." If you do manage to get your stock up, you can go out and buy another company which has some assets and some earnings, but whose stock has not gone up. Then you can play with pooling and purchase, although not as much recently as in the good old days. With the newly purchased company tucked in, you can keep the game going. All of the devices described are generally done with an eye on the stock, not on what might be considered economic reality. The stock market cares about current earnings. They took our old, quiet system and ran it right into the ground. "No one objects to a ruling," said James Needham, when he was an SEC commissioner, "as long as it improves the earnings. If you touch the X-ray the other way, they scream." Conversely, if you have a bad year, if the write-offs begin to catch up with you, if your stock is down anyway, then you gather up all the sins you can find and lump them all into the bad year. This is called take-a-bath accounting, even by the accountants. The idea is that as long as your stock is down, you might as well get all the bad news for several years in each direction out of the way. Cancel the old option plan, vote new ones, and hope the stock will go up again next year. 2 notes before we take off on the accountants. The first is that it is business itself that wants to write the books this way. Accountants may sign the statements as independent professionals, but they want the accounts. That is how they make their living. So if you're an accountant and you choose not to go along with reporting all the income, but deferring all the cost, the businessman is likely to say, "Get lost. I'll get myself another accountant, a more cooperative one who understands me." This is called shopping for accounting principles. The second note is that once again, there are some honest men and some honest businesses. James Needham, who is an accountant as well as a former SEC commissioner, and who is now president of the New York Stock Exchange, said there were less than 50 serious errors in 9,000 statements filed with the SEC. Only 22 out of Fortune's top 100 companies, said he, showed discrepancies between what they reported to the public and what they reported to the SEC. Yes, there are differences. Companies report on 8K and 10K forms to the SEC, and on the grounds that the SEC needs more information than the public, the information may be not only more extensive, but different. The 8K form now requires that companies also report whether any change in the auditor has taken place, and whether that change involved a disagreement in accounting principles. The auditor who has been canned is supposed to say whether he agrees with the reason for seeking another auditor. That leaves the public with only 2 problems. 1, disputes are not likely to be carried as far as the SEC, and 2, the security analyst, much less the average investor, is hardly likely to spend his afternoons in the gloomy vaults of the SEC library. It is not easy to get 8K and 10K reports. The trouble with saying that most of the businesses report fairly is that it leaves the public with a question. Which are the ones that don't? All the numbers look alike, and it requires a full-time professional accountant to ferret out all the nuances. It was not always this way. That is, there was not always this attention to hyping up current income. A generation ago, it used to be the other way around. There were far fewer stockholders, and the stockholders were much more likely to know the business, perhaps even to control it, and hence to know the auditors. Management liked to pile up cash as a reserve against leaner years. They did not want to report income. The stock market was sleepy. Besides, the stock market valued assets and dividends, not reported income. If you reported big profits, your unions would ask for more money. The tax man would ask for more money. Your shareholders would expect a bigger dividend. Gradually this changed. The Internal Revenue Code of 1954 had some regressive features: tax shelters, investment credits, declining balance methods of depreciation. Labor unions stopped looking at the published data and based their demands on what they could get, not on what the figures showed might be a slice of the pie. For the most part, they got much of what they asked for, and the corporation simply raised its prices, and we were on the way to cost-push inflation. Shareholders began thinking that if you could get the stock to go up by plowing the dividend money back in, dividends were for old ladies. The corporation discovered that the more it borrowed, the higher the earnings and the higher the stock, so it began to leverage. The trend finally culminated in the late 1960s when conservative managements were punished for their conservatism. If you carried your patents at zero, if you had written off everything and piled up the cash, if, in short, you had built up your assets, you were vulnerable to a company with no assets and a fast-moving, high-priced stock. Your own stock would have a one-shot jump when the offer would be made, but then you would be swallowed up into the company with the sexy paper, and history was to prove that those companies were ranking members of the booby list in the decline. Asset-rich insurance companies were a favorite target. Thus Liasco took over Reliance Insurance. National General took over Great American, and so on. LTV, the vehicle of Jimmy Ling, took over the famous old packing firm of Armour, and the famous old steel company of Jones and Laughlin, in the famous redeployment of assets on the way to its troubles. Not all managements liked the trend, but once it got going, few were strong enough to buck it. I wish to hell the stock market didn't want to see the earnings go up all the time, the chairman of a hotel chain told me. Business just isn't like that. Every year is not always bigger than the last year, and we have to bend things around a lot to get them to come out right. Why not report it the way it is? Then the stock would go down, and we'd be at a disadvantage vis-a-vis our competitors in hiring executives, making new hotel deals, and so on. If you could get everybody to go along at the same time, we'd do it. Some people began to suggest that maybe reported profits weren't the way to measure a company. Perhaps it should be cash flow or return on investment. The worst sandbagging for an investor came not necessarily when the numbers danced around before he bought. That was nothing compared to the bath handed to innocent investors when the numbers were changed retroactively. Universal Widget says it earned 50 cents in 1969, $1 in 1970, and $1.50 in 1971. You buy in, and then they tell you, sorry, we've changed our accounting. We didn't earn that at all. Put a little D in front of those numbers for deficit. Let not the investor take off an hour for lunch. By that time, the stock may have gone into one of those screeching dives that pulls out only at treetop level, a la certain Teed and F&M Schaefer. Shouldn't the investor get the same information as the SEC? Some of the accountants think that too much information would confuse the poor fellow. Philip de Fleiss, the managing partner of Lebrand, Ross Brothers in Montgomery, one of the Big 8 accounting firms, said thus: would you want things like maintenance and repairs in every annual report, or rents and royalties? A layman has access. He can go to a library. Most business libraries have these things. Or his broker can get them for him. If a man is going to invest and do a research job, then he should be doing the same kind of job the analyst is doing. As sophisticated investors got bagged, some of them began to take shots at the accountants. Did not Pete Marwick certify the Penn Central? Was not the distinguished name of Price Waterhouse on Minnie Pearl's fried chicken, later Performance Systems, later busted? Was not that Arthur Young's name on Commonwealth United? Did not the New York Stock Exchange itself sue Haskins and Sells, another Big 8 accountant, for certifying the busted New York Stock Exchange firm of Orvis Brothers? What did it mean to have a distinguished accounting name on reports? Nothing, said Thornton Oglove, an accountant who writes a newsletter on accounting for a Wall Street firm. The signature is worthless. That is pretty strong stuff. So one does have to remember that the majority of companies play it quite straight. For those interested, there are articles galore. I have used some of them here, in the Financial Analyst Journal, in the accounting magazines, and in Barron's and Forbes. John Childs of Irving Trust has written a very expensive, technical, and complete little book called Earnings per Share and Management Decisions. The ultimate responsibility in all of this was given by Congress to the SEC. Here is part of Section 19 of the original Securities Act of 1933, worth recalling just for the majesty of the Old Testament prose. It's also worth recalling that the title states, "An act to provide full and fair disclosure." The italics are mine. The Commission shall have authority from time to time to make, amend, and rescind such rules and regulations as may be necessary to carry out the provisions of this title, including defining accounting, technical, and trade terms used in this title. Among other things, the Commission shall have authority, for the purposes of this title, to prescribe the form or forms in which required information shall be set forth, the items or details to be shown in the balance sheet and earnings statement, and the methods to be followed in the preparation of accounts, in the appraisal or valuation of assets and liabilities, in the determination of depreciation and depletion, in the differentiation of investment and operating income, and in the preparation of consolidated balance sheets or income accounts. The Commission or any officer or officers designated by it are empowered to administer oaths and affirmations, subpoena witnesses, take evidence, and require the production of any books, papers, or other documents which the Commission deems relevant or material to the inquiry. So that is where the ultimate authority lies. But the SEC, whose payroll is an infinitesimal percentage of that of the CIA, could not possibly police all of American business. It bounced the reporting responsibility to business itself and to the accounting profession. But is accounting a profession? Could one be disbarred or tossed out for malpractice? For whom does the accountant work, the investor or the management? Most important, is there any consistency in reporting? In 1938, the American Institute of Certified Public Accountants set up a committee on accounting procedure to narrow the areas of difference in corporate reporting. In 1959, it set up the Accounting Principles Board to succeed that committee. The proponents of uniformity question whether any investor can make a decision when all the numbers are so different. How can the same Boeing 727 be depreciated over 10 years by one airline and over 16 by another? The defense says that it's management's prerogative to decide, that accounting is an art, not a science. And too much rigidity wouldn't be good either. The Accounting Principles Board put a committee to work on the metaphysical questions of accounting. What is economic reality? What is current value? What is fair value on a balance sheet? What should the objectives of financial reporting be? Can accounting provide what is needed? Should there be industry standards with the discrepancies reported? Do differing circumstances justify the discrepancies? The sway of the Accounting Principles Board is far from firm even within its own profession, and it remains to be seen whether the clients will go along. Each reforming rule is greeted with squawks from the owners of various gored oxen, and in fact, early in 1972, the Accounting Principles Board was sandbagged by its own clients when Congress passed an investment tax credit. Industry went in and lobbied for that credit to be allowed as a one-shot, one-year boost to profits. The accountants wanted the credit spread over the life of the equipment, and they were easily beaten. That dispute was followed by one over full-cost accounting in the oil industry. We need not go into the harrowing details. Full-cost accounting, said Stanley Porter, a partner of Arthur Young and Company, and author of a book on petroleum accounting, would produce instant earnings for those companies that adopted it, and leave the more conservative companies facing the erosion of their investment standing by comparison. Yet full-cost accounting spread like the Dutch elm disease. Within months, the Accounting Principles Board was just about out of business. The American Institute of Certified Public Accountants was devising another body, a Financial Accounting Standards Board, to replace it, which would include some non-accountants and which might be full-time and professional. So the whole business is still enveloped in clouds of dust. What is the investor to do? Short, of course, of getting the attention of his congressman, itself hardly likely, since accounting is rarely one of the gut issues in an election. I asked the question of many of the concerned people. Professor Abraham Brilloff of the City University of New York thought accountants should subscribe to a Nuremberg Code and should refuse to carry out orders that were improper or morally wrong. One member of the Accounting Principles Board said to me, "We are the establishment, and if we do not work quickly to change things, the whole thing is going to come down." David Knorr, a Wall Street member of that board, wrote, "Accounting today permits a shaping of results to attain a desired end. Accounting as a mirror of activity is dead. Even the legal profession is wary, lest generally accepted accounting principles not represent full enough disclosure." The Review of Securities Legislation, citing SEC v. Banger Punta Corp., U.S. v. Simon, and Gersel v. Gamble Skogmo, warned, "Counsel must beware of blind reliance on the adequacy of financial statements, both as a whole and in particulars. There are many situations in which such statements, even though competently and carefully prepared, and in accordance with generally accepted accounting principles, must be supplemented extensively lest the statements themselves become instruments of deception." Still another board member worried that Ralph Nader and the forces of consumerism might seize the issue, although, he said, the public itself doesn't give a damn. The public is a greedy lot. Give them 2 years of good market and they'll be back. Another professor of accounting wanted the professional consumers of the financial information, institutions and their analysts, to refuse to buy the production until standards were satisfied. The charges of the critics still echo, and they include such phrases as fiscal masturbation, massaging the numbers, and corporate fandangles. The head of one of our major drug companies put it quite succinctly. "One good accountant is worth 1,000 salesmen, and yet, all of these exceptions take for granted that there is truth and it can be made to work. Even the accountant's critics can sometimes see progress, though they then say it's not fast enough. If you look to Europe or Japan, the accounting is nowhere near as full nor as precise. In Britain, whence much of contemporary accounting grew, some of the work done is even better, but it is done on British companies with their own sets of problems. Accounting should chart the ebb and flow of activity so that non-accountants can take it for granted. It is scarcely fair to ask everybody to be an accountant, yet the way things are, few investors will be able to unravel the nuances themselves. The accounting profession should earn the investor's confidence, but in the meantime, an individual investor has to get help from the brokers who get commissions from him. Somewhere in the brokerage firm there have to be sophisticated buyers of information. You can, of course, get the annual report and throw the thing away if there are 15 footnotes, or if the notes are incomprehensible. Ultimately, there is only one defensive quality that can serve as protection, and that is common sense. Does it really make sense to believe that this cigarette company is increasing its earnings 30% a year? Does it make sense to believe that in an industry as easy to enter as Shell Homes, this producer is going to continue earning 50% more every year? If the company is in a number of different businesses, did it really generate the earnings, or did it buy them, or did it borrow them? There are enough things to worry about in life already, but there is no choice but to say, be skeptical and on your guard. Chapter 12. Co-opting some of the supercurrency. All right, the numbers dance around sometimes, but it is the only wheel in town. You still need some of the M3 because it is so much higher octane than M1 and M2. What we all should have done was to find a grandfather who sold his ratchet company to that great fount of supercurrency, IBM. Then all this would be academic. Granddad's ineptness we can lament, and it is hard to create supercurrency because you have to go through the whole diaper stage with a new company. And we are not going to get in on the first batch of freshly baked supercurrency in each company, because that is when the insiders sell to the outsiders, and we are outsiders. But at some stage we must successfully co-opt some of the stuff just to get out of the prole ranks of the M1s. Maybe we can just buy something that will go up a lot. After all, a $5,000 investment in Avon products in 1950 would have grown to $2.3 million, roughly, today. And $5,000 in the Haloid company that year would today be Xerox, and about $3 million. You only have to find one such plum. Is that still possible for an individual? If you ask this question inside the securities business, you get two answers. The first is from the New York Stock Exchange and the retail firms who have many branch offices and deal directly with the public. They say that the public has equal access to information, and that individuals have invested successfully for years and will continue to do so. The second answer comes from the investment professionals, who think the day of the individual investor is over. There used to be individual investors in mortgages, one said. Your grandmother might have held a mortgage on somebody's house. A mortgage on a house maybe in another town, brought to her by a mortgage broker who knew she was looking for an income. That doesn't go on anymore. Earlier, we looked at a convulsive period for the whole structure. The banking system that absorbed a run-on commercial paper, and the investment community which absorbed barely the collapse of undercapitalized brokerage firms. It survived. The structure shuddered a lot but stayed intact, and has now been bolstered. Within the structure, however, changes continue to take place. Institutions continue to increase their share of the trading markets. Much of the public stock, remember, comes from the conversion of the family company to supercurrency, and that tends to stay locked up in trusts. Here is what has happened. The institutional share of trading, in average shares per day. 1952. 800,000. 1955, 1,300,000. 1960, 1,600,000. 1965, 3,500,000. 1971, 15,900,000. Plainly, the days of Mr. Smith in Portland, Oregon, selling to Mr. Jones in Portland, Maine, are mostly gone, and so is everything that went along with owning a share in America. In order to increase their share of the market, many small investors had to institutionalize their investing. When I think of the individual investor taking to the field these days, a quarterback called Harry Theophilides comes to mind. He comes to mind because a sports writer called William Wallace did a column about him. Otherwise he would not come to mind. Harry Theophilides was 5'10". He played with the Redskins until Vince Lombardi came. But Lombardi was not about to have a quarterback who was only 5'10". Harry Theophilides was cut and went to the Jets, where he came off the bench in a game against the Giants, pumped the team to 3 touchdowns, including a couple of touchdown passes, and hit for something like 7 of 9 the following week against the Vikings. Nobody ever beat me out, said Theophilides. He was cut for Al Woodall, who is 6'5", and went off to the Edmonton Eskimos in Canada. Ever since I've been in football, Theophilides said, somewhat bitterly, I've been told I'm too short, that I can't see over the defensive linemen. Well, who can? Defensive linemen, when they come at you with their hands up, they're over 7 feet tall. Nobody can see over them. You do a quick slide into the gaps between them, and then you look. Sonny Jurgensen told me he could never see. He just threw the ball where he thought the receiver ought to be. The individual investor has to be considered about 5'10" on the investment field. And there are a lot of other people out there who, with their research and their computers and their staffs, are over 7 feet tall with their hands up. The odds against a superior performance by an individual investor have to be considered to have gone up markedly since the people who are 7 feet tall with their hands up have come onto the scene. It was easy enough for Mr. Jones in one of the Portlands to sell quietly to Mr. Smith in the other one. They were at least the same size. Plainly, for a great number of investors, safety and a passive return are one course. The gap between the passive return, which doesn't want to accept risk, and the aggressive return, which will accept it, has narrowed considerably. The return from a tax-free municipal approaches the average return on the bulk of industrial stocks. Utilities, unexciting as a part of the game and facing financial problems, still are assured of revenue growth. Some of them have partially tax-free returns and have a tradition of increasing their dividends every year. A second course is to buy the so-called great companies and not sell them. This is the course of the University of Rochester, which has had a remarkably successful investment portfolio. The university, being an institution, has a long time horizon. It is prepared to take the sudden downdrafts these stocks face in bad markets because it feels that over the course of a generation it will achieve a superior return. Rochester has large positions in Kodak and Xerox, both of which are in the university's backyard, and some which were given to it. The individual still faces the question, what is a great company? Because great companies become mature and not so great, early growth is an invitation to competition, and the growth companies of one era are not always those of the next. Nonetheless, it is possible, by concentrating on some of the characteristics below, to find companies which can be held for a long time. Both of these courses assume the ability to leave the game element behind, entertaining as that may be. Finally, a minority of individuals, those with some time and the proclivity to do their own work, can do very well. For the people who are 7 feet tall with their hands up are that way for everybody, even themselves, and nobody anywhere can see over them. You will have to take a quick step and look in the gaps between them. But a time may be coming in which it would be possible to be successful with just the old tenet that used to work. Anticipate the institutions. While institutions are big and muscular, their records are not all that awesome. Furthermore, their managers talk to each other and tend to run in packs, like beagles. All you have to do is find the scent before the beagles do. For institutions, too, have been burned. They love the security of a front-running company with growing earnings, and they are wary of small companies because they cannot move in and out of them well in size. If you can find the smaller, growing company and sell it to the institutions when it gets a bit bigger, you will have stepped into the gap between them. That sort of front-running means the stock can go onto the approved list of the banks, and a trust officer can put it into his accounts without being criticized. You will be by now paying some attention to the accounting, and you will be listening hardest to your own common sense. You will have husbanded your time and not wasted it on those industries, about 80% of them, that do not have favorable characteristics in the long term. Very likely the company you find will be financially strong, so that it will not have to sell more stock or borrow unfavorably. It will have a leading edge in its key products and the capability of improving that edge through research if that is the way it's done. It will have control over its own prices and a labor component low enough not to be a problem, or at least controlled labor costs. It will be in an area that common sense will tell you is growing. All of these things will have contributed to its nice profit margins and its profits. All of these factors can be the ones to look for in finding something adolescent that is bought to be sold. If in addition the company has something unique that makes competition difficult, you may have a great company that can be held. In the 1960s, it was fashionable to look to high technology for all of these characteristics, as well as for the something unique. Xerox and Polaroid were protected by rings of patents, but the lead time in patent protection is diminishing. If one polymer is patented, there may be a similar one which works equally well. Further, virtually everybody in the investment business underestimated how much the government flow of research and development money meant, even though the best of the pure companies, as the two above, were not dependent on that. In Avon products, it was the sales force that was so hard to duplicate. I have a bias about this particular philosophy, which you should correct for, because it is the one that served best when I was first learning. A bunch of us sat at the knee of one of the great apostles of the growth theory, a man who went out to the mutual funds and pension funds and preached the true gospel. Since then, we have learned that those growing earnings can be such a security blanket to the buyer that he pays too much for them. So even when the stepladder is true and the company is going to maintain the growth, it pays to buy them at the low end of the swings in their price-earnings ratios. Periodically, Mr. Market gets manic. A true growth company may swing from selling at 20 times earnings in a bad market to 45 times in a hypertensed market, and it does pay to wait for the troughs. Anyway, we sat at the great man's knee, and then we went out to apply the theory. We would wait tensely while the mentor graded our papers. I bring this up because I remember bringing in a stock that provides the perfect example of what an individual can do by himself. The mentor had bid us study Gillette, The mentor held up a pack of blue blades, very dramatic. This will double, and if you know a double, you can do better than that. People used up the blue blades, threw them away, and bought more. Gillette dominated its market with an army of salesmen. Its displays were on every drugstore counter, and it was going into other grooming items. What else was like Gillette? We were to go out scouting. I took a careful walk around a drugstore, and then I went to the manuals. And then I brought my stock to the mentor and waited for my very good grade. I had a stock called Tampax. It had no debt, no preferred, and plenty of cash. Its product was a leading product. It was like Gillette in that you used it, threw it away, and bought more. It had flexibility in the pricing. Its profits grew every year. I wanted an A for my idea. I got a B, and I protested. "It's a very good little company," said the mentor. "I suppose Kimberly-Clark or Scott could compete with it. But what is so unique?" "What is unique is that when people go to the drugstore, they don't know the name of any other product," I said. "Like Kleenex. Tell me the name of what else competes with Kleenex. A generic name is better than patents." The mentor wouldn't change my B to an A. "It's a solid B," he said, "but the earnings grew perhaps 15% a year. We were looking at technological companies whose earnings grew 50% a year, making oscilloscopes and particle accelerators and other patented, super sophisticated stuff, protected by patents and by technical staffs with hundreds of PhDs in physics." "Yours is a population growth stock," said the mentor. "I don't see why it's ever going to grow considerably faster, although that 15% could compound. Texas Utilities and Coca-Cola increase the earnings every year, too. And those stocks are already on the approved list of all the banks. So I didn't buy Tampax at 5, adjusted for splits. The mentor was right for that time. The technology stocks moved much faster. A couple of years later, the pace accelerated, so that their patents were no protection. And then there was price cutting in some of the products. Some of those technological companies are far bigger today, and some are treated as cyclical companies. But Tampax is around 120. I feel dumb every time I think about it. There are numbers of other examples of front-running, solidly managed companies in growing fields with some sort of edge about them. Some of the ones that worked in the recent past were as easy to understand as Johnson & Johnson, Band-Aids and baby powder, and McDonald's, the ubiquitous hamburger stands. MGIC, the Mortgage Guarantee Insurance Corporation, filled a conspicuous gap in mortgage insurance. Not only did these companies make it through the 60s and the Big Bear, but they are up better than 1,000% from their lows of a decade ago. That doesn't mean they are necessarily headed for that in the decade ahead. You have plenty of competition in looking for the outstanding steady growers. But you only need one for real success, and you can be sure that if you find one, somebody, a nice bank probably, will buy it from you at a premium some other time. Even if you are only 5'10" and the other fellows are 7 feet tall with their hands up. Chapter 13. Beta, or Speak to Me Softly in Algebra. There is no system in the market, and there are many approaches that work. The generation now in command has had just time enough to learn that at some point any of them can fail. It is a bright generation, so that discovery was damaging to its self-confidence. This generation entered the 60s full of beans. The generation ahead of them on Wall Street had clearly been paralyzed by the memory of the Great Depression. The new generation had moved in with the appropriate lack of inhibitions. The older generation had lacked real, serious security analysis. Now there were 10,000 security analysts. The older generation had relied on country club information and a few statisticians with green-sleeved garters. Now there were computers to screen and filter, to assemble a stunning variety of comparisons and ratios, to do charts and measure relative strength. The financial rewards for the new generation were great, but that was only right and proper for gentlemen and ladies of business school education, rational intelligence, daring, and perception. Then along came a severe test, and took away not only some of the profits, but some of the scientific and self-confident aura of the whole business. The security analysts turned out to be just as wrong as they were right. Writing in the January-February 1972 issue of the Financial Analyst Journal, The director of research of a large institution assessed statistically the research which went to institutions. That is research presumably painstaking and not horseback, aimed at a sophisticated audience. The results weren't much different from the Standard & Poor's averages, and were summarized as consistently mediocre. Some were good, some were bad, and taken all together they weren't so handsome. The article may have been a bit unfair in that it was based on published material. The best work of the best security analysts goes unpublished. Analysts are paid indirectly with the commissions of clients, and those clients are quite likely to make up a list, a short list at that, of the analysts and the firms they want to reward. If an analyst has a bright idea, it is going to go first to his biggest client, and then to his next biggest, and so on. By the time it gets to the nth client, or into print, it has lost much of its value. But it is only from print that surveys and evaluations in the analyst's journal can be made. Not only did the work of the security analyst follow the price of the stock, more than the course of reality, but much of the technical apparatus also blew its tubes. The performance of the funds has already been discussed, and in aggregate, the performance of the managers left something to be desired. The more sensitive and alert money managers were the ones to engage in some self-questioning. Notes from portfolio manager seminars reveal a change in the tenor of the meetings over a course of 4 or 5 years. As the jackets came off and the drinks were poured in the earlier meetings, the questions ran too. All right, what's hot? What do we buy now? How long have we got? By recent times, the questions had taken on a Kierkegaardian tone, at least so far as this field is concerned, full of doubt and musings. What is a portfolio as opposed to a list of stocks? Can portfolios be managed as portfolios? Does anyone do it? What is a buy? What is a sell? Which one do you concentrate on? Can anyone outperform anyone else? What is risk? The last question got asked a lot after some of the portfolios went down 40%. After all, why pay a professional to lose 40% of your money? Maybe something was wrong with the whole process. Assessing where the economy was going, making some sort of market judgment, letting the security analysts scout their stocks, and building the portfolio, with the portfolio manager using his experience, judgment, rational intelligence, intuition, and fingerspitzengefühl. Maybe that was the wrong way. Maybe there was something missing from the process. Maybe that something was risk, the opportunity for loss. A headlong race to include the risk factor in all the calculations began, even though the professionals for years were accustomed to speak of the downside risk. But maybe you could quantify the risk, so that you wouldn't have to depend on the portfolio manager's judgment. Thus was born what came to be called the beta cult, after the Greek letter beta. Beta stood for the measurement of market risk through the variability of the rate of return, and thus could be considered a component in capital asset pricing theory. The beta cult gave Wall Street a new jargon to toss around. A dozen Wall Street houses offered beta measurement services, some taking full-page ads in the Wall Street Journal and the New York Times to announce their discoveries. The math and computer people had a quick resurgence, and some senior people growled, as did Lamont Richardson of Booz Allen. These people with math and computer backgrounds who think they can assign precise degrees of risk to 5 or 6 decimal places are nothing but charlatans. You have to start somewhere with beta theory, and the usual starting place is with the Theory of Games and Economic Behavior by John von Neumann and Oscar Morgenstern of Princeton, published in 1944, which said, among other precepts, that in a game situation you had to calculate the risk accompanying the course to a particular reward, and to determine the utility of that course. In 1952, Harry Markowitz published a seminal article in the Journal of Finance, a version of his doctoral thesis at the University of Chicago. Markowitz showed that diversification could reduce risk, that you could measure the risk by measuring the variability in the rate of return, and that an efficient portfolio was one which provided the highest return for the amount of risk which the portfolio owner was willing to assume. For this, Markowitz was called the father of the beta. He now runs a small arbitrage fund that uses computer techniques but not much beta. At one beta seminar, Markowitz said that he was not the father of the beta, but the grandfather. That William Sharpe of Stanford was the father. The beta enthusiasm had one mildly amusing sidelight. All this statistical work and the implication that some formula, however sophisticated, can in some way replace the manager, is naturally threatening to the manager. At a seminar 5 years ago, the Markowitz model, as it is called, was discussed for a whole morning. It was roundly denounced. Markowitz had missed the whole point of diversification. One participant even suggested, and this remains in the mimeographed abstract, that Markowitz's books be assembled and burned, but within 5 years, brokers, one of them represented at the seminar above, were offering beta studies to their clients as a merchandising come-on. Beta theory is based on two simple ideas. One, that most stocks and groups of stocks bear a fairly close relationship to the market as a whole, and two, that to get higher rewards, you have to take greater risks. The portfolio's riskiness is determined by plotting its rate of return, capital gains plus dividends, against the rate of return on convenient market index, say Standard & Poor's 500. The beta coefficient is the measure of volatility, the sensitivity of that rate of return to the market. By definition, the market has a beta of 1.0, so a portfolio of 2.0 would be twice as volatile. On the average, it would go down or up as much as the market. If you are wondering what happened to alpha, that is the residual influence not related to the market, the vertical axis against which the beta slope is plotted. Beta theory has provided a happy hunting ground for the type who love punching computer keyboards and desktop calculators, especially in academia. When the Financial Analyst Journal did a bibliography on risk and return, it listed, and this in 1968, 253 articles and 89 books. Those totals have now gone much higher. The big push for beta came from the banks, and specifically from the Bank Administration Institute. In the late 60s, the money was flowing out of bank trust departments and bank-managed assets and into performance funds and other forms of go-go. The people taking the money away were saying that the swingers were already up 50 and 100%, and that the bank-managed money hadn't moved in 10 years. The banks wanted some form of statistic that would say, sure, the gains are big, but look at the risks. The Bank Administration Institute put out a report measuring the investment performance of pension funds, which had a considerable impact. Further reports came out of the University of Chicago's Business School, long a fortress of stock market statistical work, shortly to be renamed Beta U, and Beta got a nod in the SEC's Institutional Investor Study. All of this work was directed simply at refining comparisons, so that you didn't take Fund A and compare its record with Fund B, without also taking into consideration the volatility, and hence the risks, in each. If the so-called beta revolution is real, and not just another statistical fad, then all comparisons in the future will have to contain beta adjustments. Mutual funds will disclose their beta assumptions, and incentive fees will be determined by incentive results adjusted by beta. Just so you know what they look like, here are medium, high, and low beta funds. Nice and easy, right out of the geometry books. Y equals A plus BX. There are, as you might have thought, still a lot of disagreements about beta. Does the variability of the rate of return really equal risk? Maybe that is only part of risk. Even if you can describe past portfolios with beta, does that help you build future portfolios? Price behavior may be people behavior, but people do not behave according to thermodynamic laws, said a Penn beta researcher, whose paper reported that beta worked on the New York Stock Exchange in wide swings of the market, but seemed to be useless on the American Stock Exchange, back to the drawing board. Beta proponents say, sure, there are statistical biases, but they will be worked out imminently. There is no universal time series for beta. Beta might not work in portfolios with a short history, and could not some manager innocent of beta consider downswings as opportunity? One of the beta theoreticians, after a lot of calculator time, suggested that maybe risk and the opportunity for gain didn't come out quite as congruent as the first run-throughs suggested. Maybe the opportunities for greatest gain came in emphasizing the moderate risk course exclusively, and borrowing, if you could, to buy the moderate risk stocks. That, he suggested, was the most aggressive course possible. Thus did the statisticians arrive at what superachieving children do instinctively, for this is the statistical curve of the ring toss game charted by David McClellan. the Harvard psychology professor who was pioneered in measuring achievement. In The Achieving Society, McClellan noted that children with low achievement drives tossed the ring randomly, from any distance, but the high achievement children tossed from exactly that point that maximized not only their chances of success, but their satisfaction from it. It is a clean, dustless, fluorescently lit world, the beta world, full of the humming of computers. When the beta revolution arrives, you simply decide on the degree of risk you want and dial that. If you accept the idea, you dial a beta of 1.8 for high risk or 0.5 for low risk and go home. So do all the security analysts. The first step, said Professor James Lorry of the University of Chicago, is to give up conventional security analysis. Its occasional triumphs are offset by its occasional disasters, and on the average, nothing valuable is produced. The beta proponents are, by and large, those who believe the stock market is a random walk, touched on in The Money Game, the freshman course, and earlier here. The random walkers believed that charts were a lot of nonsense because, in my own postulate, prices have no memory and yesterday has nothing to do with tomorrow. Yet so far, the triumph of beta has been to correlate all the yesterdays, and according to Chris Wells, author of a notable beta article, unlike chemical formulas, investment formulas, if they become widely accepted, tend to self-destruct by distorting the very environment from which they are derived. Underpinning the asserted need for and utility of such a system is the asserted futility of trying to outperform the market, which is itself based on the asserted efficiency of the securities market. The market is presumed to be efficient in the sense that, in general, the price of any security at any given time accurately reflects the best available information on that security. Such a degree of efficiency, however, would seem to presuppose a large number of very industrious security analysts. If all security analysts were sent off to school to become metal workers, the efficiency of the stock market would very swiftly decline. Then there would be a lot of information that wasn't being used, and the few remaining portfolio managers who signed up for beta could outclass the computers with their specific information. A couple of years ago there was a flurry in the computer world about relative strength as a technique. All you had to do by definition was to stay in the strongest stocks, on the grounds that a stock is going up as long as it's going up. One of these was George Chestnut, who sold the service based on momentum, and whose American Investors Fund had risen 398.77% from 1959 to 1968. The machine does all the work, George said, raising both hands. Look, no hands. American Investors Fund went down 40% from December 1967 to June 1970. It had momentum, but it had too much beta, not enough alpha, and no soul. Conscientious fellow that I am, I have been to a number of beta seminars. Here are my notes from one of them. Any one security can have a substantial positive or negative alpha, and can have a fairly low rho. Rho is the correlation coefficient between the return on the stock and the return on the market. At this point I drew a ducky flying through the air. As we diversify, the portfolio's rho tends toward 100%, and alpha tends toward 0. I went up afterward to talk to our chief instructor. A colleague of mine passed me a note. Simulation does not prove that out, said the note. I drew a little ship on the water. With rho near 100% and alpha near 0, the portfolio's risk factors depend on its beta and on the overall market's average return, and standard deviation of returns. I drew 2 more duckies and wondered idly if I could get Teddy Kennedy to take the exam for me. A questioner in the audience had a question. Questioner: what happens if in the estimating equation for the beta you have misspecified so that you have serial correlation in the residuals? Moderator: what? Questioner: what happens if in the estimating equation for the beta you have misspecified so that you have serial correlation in the residuals? Panelist: I think I can handle that. It is not a serious problem. Questioner: but what if you do? Panelist: I have written a very complex paper which I am not sure I understand myself, and I can tell you it is not a serious problem. Moderator: does that answer your question? Questioner: no. What do you think of the market? I said. He looked at me like I was crazy. I had been reading a lot of the literature, so I may have looked a little addled. But I was longing for the good old simple days at Scarsdale Fat's luncheons, with Scarsdale saying, "What 3 stocks do you like best?" and the money managers all hustling each other. So I repeated the question. He saw I meant it. "I have all my money in a savings account," he said. "Beta theory is going to be a useful tool. At least it is a handy way to describe some of the characteristics of a portfolio. Maybe it is going to be more than that. Some people take it very seriously. Maybe all the security analysts and portfolio managers will indeed go off to become metal workers. If not, Beta will be integrated into the existing system, and you will get phone calls like this. This stock is selling at 36, and we think it could earn $3 easy. Keystone is looking at it very hard. The other stocks in the group all sell at multiples of 20 plus. And oh yes, it's got a beta of 1.6. That's pretty high, but this is a high beta market. Everybody's looking to juice up their betas. And before we know it, the accountants will get into the act and decide that according to generally accepted accounting principles, the stock has either a beta of 0.3 or 1.9, depending on which way you want to look at it, and we will all be back on safe, familiar ground. Even an elaborate quantification such as beta assumes that Monday will be pretty much like Friday, that the power will still be there for the computers, and the stock exchange will be humming along, its thoughts of moving to Dubrovnik merely a passing nightmare. But as that great social philosopher Satchel Paige once said, never look behind you, something might be gaining on you. What could that be? Well, watchman, what of the night? Arthur Burns's Angst. 13 Ways of Looking at a Blackbird. Prince Valiant and the Protestant Ethic. Work and its Discontents. Will General Motors believe in harmony? Will General Electric believe in beauty and truth? Of the greening and bluing, and Cotton Mather, and Vince Lombardi, and the growth of magic, and what is to be done on Monday morning? I think it was about 5 o'clock in the afternoon, and the snow was getting worse, and I began to ask myself what I was doing in the Pink Elephant Bar in Lordstown, Ohio. The Pink Elephant is on the highway, Route 45, and so is the 7 Mile Inn. And Rod's Tavern is just off the highway, and the highway is the one that goes by the new $250 million General Motors plant that makes Vegas on the world's most automated assembly line. My friend Bill and I go up, cold, to these various characters, some of them indeed with mustaches and long hair and sideburns, and there we are, boy social scientists, amateur pollsters. Can we talk to you? Can we buy you a beer? Rolling Rock or Genesee? Do you work in the Vega plant? Is that a good place to work? I mean, would you tell your brother or your son to get a job there? What do you do there? Does your wife work? Do you want another beer? When you get your paycheck, what do you spend it on? Do you spend it in stores, for things, or do you pay it to people, doctors, barbers, plumbers? What do you think of the kids in the plant, the old guys, the blacks, the foremen, the management? Do you want another beer? What do you want to do with your life? At one point, this character in a leather jacket comes up behind us, who looks like an old pro football player gone a bit soft, not a tackle, a guard or a linebacker, maybe 6'3", 245, and he says, "I heard you talking." We wait, some tension in the air momentarily. "Are you from West Virginia?" We are not from West Virginia. Bill is from Detroit, and I am flown from the canyons of Gotham. "I knew you wasn't from here. You talk like you're from another country." "Well, yes, sir, I say it is another country." "Good, let me buy you beer. I like talk to people from other countries." "What do you make per hour?" "Would you rather have overtime or the time off?" "Is there a generation gap?" "Would you buy one of the cars you make?" "What does the union do for you?" "Why do you work there?" "What would you rather do?" "Do you think things are working properly in the country?" You can see all the contemporary social science bits going on. Attitude, authority, agree, disagree, sick society, attitude, work. Our ambitions are very modest. Bill is doing a story. Maybe he can get another Pulitzer. Why not have 2? And as for me, why, I am just looking for clues, see, the future of American capitalism. I am going through the money management macro bit in an untraditional way. The man running the money comes into his office, puts on his green eyeshade and his sleeve garters, and says, "How goes the world today? And how will it go in 6 months? A year. But what does he know then? He reads reports and numbers. But what do they tell? I have just told you about some events in our recent history in which the system survived and some bright people failed. Are we really then back to normal? A big sigh of relief and business as usual? Or is there something else going on? Maybe the system is changing. Maybe our view of reality was distorted all the time. The very bright people were in charge of the government and making the world safe for democracy. And not only is the world not safe for democracy, it is not even safe in Central Park and downtown Detroit, and nobody wants to go out after dark. We put the money into public housing, and it turns into disasters such as Pruitt-Igoe in St. Louis, and 22 downtowns look like Berlin in 1945. We did put men on the moon, but do we really know how to manage and how to perform? The estimable white-haired and pipe-smoking chairman of the Fed, Arthur Burns, comes to report to the Joint Economic Committee of Congress. Clutched in his hand is the Fed's report for the year and its promises for the future. The report is all about the Fed's business, which is money and credit, and the estimable white-haired and pipe-smoking chairman says that the Fed is going to do everything just right. It is not going to let the recovery falter for lack of credit, nor is it going to put out so much credit that we will have another inflationary spiral. But before Burns delivers the report, he has to make some remarks that are not in the report. Maybe old-fashioned remedies. That is, those available to Arthur Burns. The levers of credit can't do the job. Businessmen aren't responding in the usual ways. Consumers aren't responding in the usual ways. Something has happened to our system of responses. Troubled times have left a psychological mark on people. Americans are living in a troubled world, and they themselves are disturbed. What can the matter be? Well, a long and most unhappy war, and busing, and the youth vote, and campus disorders, and urban race riots, and the fact that women also are marching in the streets. Oh my God, women are marching in the streets. If only life would quiet down for a while, said the chairman of the Fed, the classic economic policies would have a better chance of working. If only life would quiet down for a while. So said the chairman of the Fed, hardly one of your bomb-throwing radicals. Something has happened to our system of responses. If only life would quiet down for a while. Poor Arthur Burns. You press the levers and the right things don't happen, and the problem is life itself. But maybe that is life. Maybe that is the way things are going to be from now on. Good God, women marching in the streets, nobody responding in the usual ways. Mind-boggling. So that is one of the reasons I am getting a bit bloated on Rolling Rock beer in the Pink Elephant Bar on Route 45 in Lordstown, Ohio. The economists have made their usual cheery predictions. For the days when Keynes hoped that someday economists would be accorded the status of good dentists, and the analysts are off chasing the new nubile lovelies in a new game of après nuit le déluge. But I do not have to show performance weekly or even quarterly, so I can take the time to worry these metaphysical questions that all the money folk will worry about some other time, that have Arthur Burns fingering his galusil. If you simply read the financial pages, you would find no hint of anything different. The typeface is the same, the language is the same, and the reports are all of prices. Bonds are up, the dollar is down, retail sales are up, sheer minutia. So everything is back to normal. We had a bad turn there at the end of the 60s. We had to hold our breath a little, but now we can go back to the old stand. Eisenhower is on the throne, the pound is worth a pound, and the bells ring out over the land on the 4th of July. From Time magazine on the 4th of July, 1955. From Franconia Notch, New Hampshire, to San Francisco, California, this week, there was clear and convincing evidence of patience, determination, optimism, and faith among the people of the U.S. In the 29 months since Dwight D. Eisenhower moved into the White House, a remarkable change had come over the nation. The national blood pressure and temperature had gone down. The nerve endings had healed. In and around the cities, bulldozers and pneumatic drills and rivet guns played an unending symphony of progress. At the office coffee breaks, talk was easy and calm, not about the coming war or the coming depression. Has the symphony of progress come back, or does Arthur Burns really have something to worry about? They say, for example, that the good old Protestant ethic has died away. Whatever happened to work? Doesn't anybody want to? And growth. The whole system is geared to growth. That is its justification. It works better. What is all this about no growth, zero population growth, zero economic growth? There is only so much stuff in and on the planet, and at the rate we are using it up in X years, there will be no planet. Apocalyptic literature arrives not only on the ecological side, but on the cultural side. The revolution of the 20th century will take place in the United States, writes a French critic, Jean-François Revel, and it has already begun. There is a revolution coming, writes Charles Reich. It will not be like revolutions of the past. It will originate with the individual and with culture, and it will change the political structure only as its final act. This is the revolution of the new generation. If any of this is true, we cannot simply go back to where we were. Radical change is very hard for most people to contemplate, and money managers are no different. Their attitude is, sure, changes. We sell something and we buy something else to fit the changes. You say work is going out of style? We'll buy play. Here are my 6 leisure time stocks, and let me tell you how long I've owned Disney. Money managers operate on the theory of displacement. The framework will be the same. But inside you moves things around. My favorite is a gentleman I ran into after I got back from the Vega plant. I told him that one problem among others in certain localities was dope addiction, and at one plant, though the number sounded very high to me, the rate was reported to be 14%. Well, he said, I haven't owned an auto stock for years, but 14%? Geesh, who makes the needles? The chairman was pleased to report sharply higher profits for the year, due to increased sales of the entire line of hospital supply equipment. The reasons for the record profitability, said the chairman, were Medicare, Medicaid, and the sharply increased use of the company's new handy throwaway needle by the burgeoning heroin addiction market. Now it may be that displacement is all we have to consider. Ah, things are out. Quality of life is in. Back to the countryside. There is a waiting list for 10-speed bicycles. Who makes the 10-speed bicycles? Ah, the ecologists are gaining strength. Where is our list of water pollution companies? That is probably good thinking on the tactical level. But there is also a strategic level, and the strategic level has to consider what the more profound changes are, and in fact it ought to, even without the rather parochial justification of buying and selling. So this is why I'm in Lordstown, just as one stop, looking for the sources of Arthur Burns' angst. Will life quiet down? In the automobile industry, to consider the parochial side for a moment, rewards and punishments are very tangible, and since the automobile industry is such a fantastic part of America, that would affect us all. General Motors, my God, nobody can comprehend the size of General Motors. It makes 1 out of every 7 manufacturing dollars in the country. Its sales are bigger than the budget of any of the 50 states, and of any country in the world except the United States and the Soviet Union. But even General Motors has problems. As Henry Ford II said, the Japanese are waiting in the wings. Some day, he said, they might build all the cars in America. The problem, or one of them, is that imports keep rising in spite of the theology of Detroit, which always maintained little cars, fa. Americans won't buy them. Americans want power, a sex symbol, racing stripes, air scoops for non-existent air, portholes for non-existent water. They want to leave 2 big black tire marks going away from the stoplight, rubber on the road. And the names went with the technology. Firebirds and Thunderbirds, Cougars and Barracudas and Impalas. Grrr, nothing about driving a handy little car there. So the handy little cars sold were foreign. Eventually enough handy little cars were sold that the balance of payments continued in its sickening ways, and even Washington began to lean on Detroit. And Detroit figured, okay, we'll build a handy little car. General Motors was not about to have any more of the problems of urban Detroit. It put its $250 million Vega plant in the middle of an Ohio cornfield. And then this workforce showed up, the youngest workforce around, and look at them, hair down to the shoulder blades, mustaches, bell-bottoms, the whole bit. It looks like Berkeley or Harvard Square. It was a Ford official who wrote the following paragraph. But the same thing applies not only everywhere in the automobile industry, but probably in much of factory work. The memo is from an industrial relations man to his superiors, and he is talking about the present and the future. This gentleman is nobody's fool, and his memo should be in the sociology texts, not in the filing cabinets. The memo was Xeroxed, and a friend of mine got a Xerox and Xeroxed it again, so I have one, and I guess the UAW has one, because its Vice President Ken Bannon used some of the same phrases word for word in an interview. Communication by samizdat. Think what Xerox will do in Russia when it gets going. The rate of disciplinary cases was going up. Turnover was up 2.5 times. Absenteeism was alarming on Mondays and Fridays. Hence, the useless advice never to buy a car built on a Monday or a Friday. But your dealer will tell you his cars are built only on Tuesdays and Thursdays. Furthermore, the workers weren't listening to the foremen and the supervisors. And why? For many, the traditional motivations of job security, money rewards, and opportunity for personal advancement are proving insufficient. Large numbers of those we hire find factory life so distasteful they quit after only brief exposure to it. The general increase in real wage levels in our economy has afforded more alternatives for satisfying economic needs. Because they are unfamiliar with the harsh economic facts of earlier years, new workers have little regard for the consequences if they take a day or two off. The traditional work ethic, the concept that hard work is a virtue and a duty, will undergo additional erosion. General Motors was going to outflank that stuff with the newest, most automated plant. Machines would take over a lot of the repetitive jobs. The plant would be in that cornfield in Ohio, near Youngstown, away from all those problems of the, core city. Everything at Lordstown would be made in America, no imported parts, the apogee of American industrialism. The head of Chevrolet buzzed in for a Newt Rockne pep talk. America was going to make the small car, by golly, and that was the end of the elves in the Black Forest and the industrious yellow peril in Toyota City, who thought they had been in the small car business. Plane loads of newsmen were flown in. The line is going to do 100 cars an hour, lots of it without any people. Ka-chunk goes the machine that pops the wheel rim into the tire. Piffs goes the machine that blows up the tire. So what is all this about trouble in Lordstown? The line is not going at 100 cars an hour, at least not much of the time. And there are all these characters, all good UAW Local 1112. Average age 25. The youngest workforce practically anywhere. Peace medals, bell-bottoms, and hair like Prince Valiant. And the union president is 29 and has a Fu Manchu mustache like the one Joe Namath shaved off. And GM is going up the wall. Where is the productivity? Curtis Cox, the supervisor of standards and methods, is getting apoplectic. I see foreign cars in the parking lot, he says. The owners say they are cheaper. How is this country going to compete? The GM people practically weep when they think about Japan. All those nice, industrious workers, singing the alma mater in the morning. Hail to thee, O Mitsubishi. Whistling on their way to work like the seven dwarfs. For God's sake, never a strike, never a crossword. Playing on the company teams, asking the foreman if it's okay to get engaged to this very nice girl as soon as the foreman meets her. So I asked General Motors, quite routinely, if I can go see this apogee of American industrialism. Say, Tuesday, and General Motors says no, never. I admit to being a bit stunned. Do they not fly plane loads of people there all the time? Did they not fly alleged same plane loads at the end of the GM strike, together with appropriate refreshment, to watch the first Vega come off the line, with a handout about how the Vega was going to Mrs. Sadie Apple Pie, library assistant of Huckleberry Finn, Illinois, with a quote already from Mrs. Apple Pie? Oh, I have been waiting so long for my Vega. I can't believe it's finally here. I'm so excited. Did they not? What do they mean? No? Not that guy? Who the hell do they think I am, Ralph Nader? I begin thumbing my other notebook that has the number of the payphone in the hallway of Nader's boarding house. And it's off to Lordstown. Because even with plant guards, General Motors is not Russia. And anybody who has graduated from the good old U.S. Army knows how to deal with the lower levels of great bureaucracies. Where are you going with that rake? What rake, sir? That rake. Oh, this rake, the captain? Sir? He said take it over there. What captain? The other captain. What other captain? Beats me, Lieutenant. They just told me take the rake. So we are walking around the plant at Lordstown, all $250 million of it very visible, like an iron and steel tropical rainforest, with the electric drills screaming like parakeets, and the Unimate robot welders bending over the Vegas like big mother birds, and the Prince Valiants of Local 1112, zanking away with their new expensive electrical equipment. Vegas grow before your eyes. Beautiful. I recommend it, next time you are taking the Howard Johnson tour across the land of the free. But what are these cars waiting for repair? Marked, no high beam signal, dome light inoperative, no brakes. No brakes? No brakes. But what is this on the bulletin board? Management has experienced serious losses of production due to poor quality workmanship, deliberate restriction of output, failure or refusal to perform job assignments, and sabotage. Efforts to discourage such actions through the normal application of corrective discipline have not been successful. Accordingly, any further misconduct of this type will be considered cause for severe disciplinary measures, including dismissal. Corrective discipline? My God, you can get court-martialed in this place? They should have an industrial psychologist read the language on the bulletin board. I can hear the glee club louder. Hail to thee, O fair Toyota. Hi there. Hi. What is that? That's the window trim. Is this a good place to work? Well, it will be, as soon as we get it shaped up. Would you buy one of these cars? Sure, if it wasn't so expensive. It's a well-engineered little car. Wouldn't you rather be out on your own, say, a garage? Nah, a garage don't have no benefits. Say, I don't want to bother you. 2 of those Vegas just went by without window trim. Well, they all go by without something. This line is moving too fast. That's productivity, man. Oh, is that what they call it? I can give you a few notes of our brilliantly unscientific survey of Lordstown, but they are just that. Our people would rather have had the time off than the overtime, but their wives worked because they needed the extra income. They would tell their brothers to get a job there, and in fact some of them did. Supervisors bugged everybody. Sabotage? Beer cans welded to the inside of a fender? Well, there might be a few hotheads, but that's silly. Man, the Vega is our bread and butter. The more Vegas they sell, the better for us. If the foreman bugged our people too much, they would get another job somewhere else. They took for granted there would be such a job. We asked the older types if the young bucks were any different. They said, yes. They're smarter. They don't put up with what we did. Our favorite Prince Valiant haircut said, I am not going to bust my ass for anybody. I don't even bust my ass for myself, you know, working around the house. But beware, one has to be an epistemological agnostic considering any such report, whether done by journalists or social scientists. How do we know people who talk to us are representative of a workforce of 10,000? Further, journalists and social scientists are verbal, conceptual people. They would probably score very low in electrical repairs around the house. Unconsciously, they feel. How do they stand it? I wouldn't like to work here. They did not sleep through senior year in high school with Sister Maria Teresa droning on about Wordsworth, and look at the plant as a relief from that. My companion Bill once did a piece about labor for the New York Times Magazine, and some paragraphs were picked up by a social scientist writing a paper. When he subsequently went to do research for a book, properly in awe of all the academic sources, he found the sources quoting him. A second social scientist quoted the first, with appropriate footnotes, and a third quoted the second, with footnotes and notes, and so on the old beagle pack and cry. This doesn't mean the job can't be done, but it takes a large, thorough, well-funded effort, with the appropriate discipline of statistics and all the modes and variants in place. So all right, it makes sense to have a demurrer for the statistical discipline. But the feeling is there, something else is going on. The world is not necessarily going to settle back to the 4th of July, Eisenhower Regency, with life all quieted down. The key phrases are from the Xerox of the Xerox of the Xerox of the confidential memo at Ford. The next key phrases are from the banks of the Charles River. Lordstown is the biggest and bestest example from industrial America, and the Harvard Business School is the West Point of capitalism. Or at least so its denizens tell each other. And certainly the place has provided one of the great old boy networks of modern times. Let a business school type follow up out there in the world, and he need not fear. Another business school type will come to his rescue, and they will call it merger, or recapitalization, or synergy, or something. I have 2 straws in the wind to submit from the West Point of capitalism. Admittedly, these come from an unusual time. 2 years before, the greedy little bastards in investment management could hardly wait to get going on their first 5 million, as I said before. Now there is a new crop of greedy little bastards. Naturally, the course is still wildly popular, but outside, the Cambodian invasion has been timed neatly with my spring visit. The feeling that all is not well in the world has even penetrated the clouds of greed in my 3 sections. Around Harvard Square, the graffiti was getting political. Nobody had written Heloise loves Abelard in quite a while. Instead, this flowed in large letters for a third of a block. John Hancock was a revolutionary, not an obscene life insurance salesman. But that, of course, was on the college side of the Charles River, where the lifestyle is different. Beards and mustaches and poor boy clothes, almost as much a uniform as the gray flannel jackets and khaki pants of a generation before. But across the river at the business school, the budding apparatchiks are coming to class in Brooks Brothers suits and button-down white shirts, looking like sub-assistant secretaries in the Nixon administration. There is no revolutionary chatter in the course catalog at the B School. You find one of the major preoccupations of the catalog is control. The field of control deals with the collection, processing, analysis, and use of quantitative information in a business. In a previous year, when an SDS faction took over University Hall in the college and there was a big bust, the college as an institution seemed very confused, but the business school had a contingency plan in a fat binder with colored index tabs. I had the classes at that time too, and one B School faculty member, fearing some Dickensian Carmagnole in the streets, Paris, 1789, said of the dissenters, "They'll never make it to this side of the river. We'll blow the bridges first." So, this is not the last bastion. It is not Bob Jones University or even Utah State. It is where they grow the apparatchiks, the technicians who sop up the top spots a generation hence, and if something else is going on, these types will either lead it or fight it, or try to take it over after it gets going. First straw, notes from A class. The guest lecturer has posed a case. You are running a portfolio of $100 million. Baby stuff. You are in a competition, not unlike the one the Chase Manhattan runs among competing money managers. The worst performing portfolio managers at the end of a certain time get fired. The best get more money to run, and presumably appropriate rewards. Company A is a notorious polluter, but its profits are unimpaired. Company B is buying anti-pollution equipment that will depress its profits for years. Other things being equal, which do you buy, A or B? The case was not too far from reality. Ralph Nader's project on corporate responsibility was trying to put some people on the General Motors board, and Harvard owns 305,000 shares of General Motors. Harvard's treasurer reportedly said he was going to vote for management, because they are our kind of people, after which both faculty and students generated a furious debate. The case is not only limited to pollution. The same principles of the social purpose of investment can be applied to defense contractors, the makers of napalm, companies with investments, or branches in South Africa, and so on. All right, you want to achieve performance in your portfolio, and this performance is being measured competitively. It may affect your career. Do you buy Company A, the profitable polluter, or Company B, the unprofitable anti-polluter? Student 1. I would try to evaluate the long-term effect because in the long run Company B is going to have a better image. Student 2. But in the long run you would have lost the account. I think you have to know the wishes of the constituency. If it's a fund, how do the fund holders feel? What do they want? Scattered boos. The class begins to chant. A or B, A or B. Several other students offer comments, all trying to hedge, to keep both the profit and the social purpose. Student 3. I buy the polluter. Cheers, then scattered boos. It isn't the business of a fund manager to make a social decision, or to discriminate between companies on his own ideas of some social purpose. That could be dangerous. If we want to combat pollution, Let society vote for it, and have a consensus. I doubt that consumers really want to pay the price. You can't ask profit-making organizations to subsidize society. The radical student. The radical student is only radical by standards of this side of the river, which is to say that he is neatly shaven but is wearing a colored shirt and a tie that is a bit wider than the 1955 width. Maybe that's the problem. Everything in this school is geared to the purpose of the corporation, and that purpose is maximized profit. We ask the radical student, what are the goals of a corporation if not to maximize profit? Silence in the classroom, a rustling of papers. The idea is very confusing. What are the goals of a corporation if not to maximize profit? Not a hand goes up. It is just too hairy a question. We ask it once more. More shuffling. An occasional left wrist shoots out from the cuff with the wristwatch exposed. The radical student. You know the trouble? It's the way we look at it. We're concerned with property rights. At the law school, say, they talk about civil rights. We're objective, but maybe objectivity has been overdone. Is our one purpose to measure things? My second straw is the resolution. This was, as I said, an emotional time. The business school voted and passed this, then bought an ad in the Wall Street Journal to publicize it. The resolution called for American withdrawal from Southeast Asia, not startling for a student resolution at that time. But this was the business school, normally heavily Republican in 1968, and it was the language juxtaposed to the source that was startling. We condemn the administration of President Nixon for its view of mankind, and the American community which, 1. Perceives the anxiety and turmoil in our midst as the work of bums and effete snobs. 2. Fails to acknowledge that legitimate doubt exists about the ability of black Americans and other depressed groups to obtain justice. 3. Is unwilling to move for a transformation of American society in accordance with the goals of maximum fulfillment for each human being and harmony between mankind and nature. Harmony between mankind and nature? I asked the former dean of admissions, what was this about harmony between mankind and nature? When had that crept into the business school? I don't know, he said. I guess it means they're not going to work for Procter & Gamble and make those dishwasher soaps that don't dissolve and smother the lakes. They don't want to work for big companies anyway, or so they say. I'd like to see what they say a couple of years out. The big companies treat them as objects, they say. In the 50s, the guys here all wanted to get to the top of Procter & Gamble. In the 60s, it was finance. Last year, I said, my classes all wanted to go right to work for a hedge fund. You couldn't even offer them $20,000 a year because they were going to run $5 million into 10 in a year and take 20% of the gain. I used to say, good morning, greedy little bastards. The guys in the 50s said the ex-dean wanted to run the big company, and the guys in the 60s wanted to be Danny Lufkin. Make a big bundle by the time you're 40 and run for something. And now? And now they're just confused. I've never seen such malaise. I don't think the big companies have gotten the message yet, and maybe the Fortune 500 can run without the Harvard Business School. But I have the feeling something will give on one side or the other. More recently, I talked to the same ex-dean, who now teaches a popular course, and asked him what changes there had been. Popular journalism had said that things were back to normal, whatever that was. Naders Raiders had been swamped with applicants in the emotional summers, and now the young law students were scuffling in the line when the man from Sullivan and Cromwell came to interview. It was said pro bono was over. The law students didn't even want the social courses anymore. They wanted taxation and trusts and corporations. Were the current B school classes still holding out on the big corporations? Were the big corporations bending at all? They're bending to the extent that they don't come and interview the wives and tell them they have to fit to corporate life and move 14 times in 15 years, he said. But other than that, all you can say is that they're conscious of some change. As for my students, I think they have an acceptance of corporate life, and they're looking for something inner. I hear a lot about lifestyles, how they want a non-anxious working life. They don't want to have one of them called a dumbbell life, which is to say a blob of work at one end, a blob of home life at the other, and a conduit between, a railroad or a freeway. There's a lot of stuff about walking on the beach, that the worthy causes themselves, and that work should fit life, not the other way around. And they talk a lot about intimate relationships, wives, children, and so on. So if I had to divide the decades again, I would still say that the 50s produced the corporate man who would rise to the top and die 17 months after retirement, leaving a beautiful estate. The 60s students wanted a piece of the action, and currently the fantasy is a balanced life, just enough success to include it all. They want to run things, but not at any cost. They still want power, but now they want love too. Maximum fulfillment for each human being? Harmony between man and nature? That's not the old business school. How do you put those things into a balance sheet? Can we operate a corporate society without objectivity? Or at least what is passed for objectivity? I wrote in my notes, will General Motors believe in the harmony between man and nature? Will General Electric believe in beauty and truth? It is not, of course, a revolutionary idea in the limited history of capitalism in this country to make something for less than a maximum profit. First of all, profit was not necessarily something that could be controlled. It came like the rain on the crops, between the costs and the market. Moreover, when the bulk of business was family-owned, its purpose was to take care of the family, sons, nephews, and so on, and of the product's reputation, if it had a reputation of value. So a wagon maker could simply make a good wagon, and a book publisher could publish an author simply because he wanted to. What we have come to call social purpose was a matter of individual integrity, randomly and haphazardly applied. But these businesses sold out to bigger ones, and those in turn to bigger ones. Supercurrency, that New York Stock Exchange listing, that broad market with the stock selling at a fancy multiple, the sons of the founders with Caribbean estates, and the grandsons in their pads all secure to blow their minds with 3K electronic guitar apparatus, and not worry about work because the supercurrency has been salted and peppered into hundreds of trusts, so the taxman cannot get it. Only the supercurrency has to stay super. The profits have to keep growing. The multiple has to go up, and the accountants can't do it all. Multi-million-dollar businesses can't be run by intuition or seat-of-the-pants engineering. There has to be objectivity, whatever that is, and the continuous quantification of results. We have to have what the course catalog at the school calls a rigorous and systematic approach. That is, the collection, processing, analysis, reporting, and use of quantitative information. But there is competition, maybe, and the judgment of those crazy crapshooters up in New York. If the earnings go down, they will bomb the stock. And then what will our report card as a manager look like? For our man in the green eye shade asking how goes the world, how will it go? The harmony between man and nature becomes an important question, and not just a spiritual one. Nobody is against such harmony. When ecology first crept into the scene, industry seized it as an advertising opportunity. Not a filter was bought that the buyer didn't take an ad about cleaning up the rivers and waters. In fact, at one point, someone figured out that more was spent drum-beating about cleanup than on the equipment. Industry began to sense that the public belief that more was better was beginning to fall away. Union Carbide dropped its slogan, "There's a little bit of Union Carbide in everybody's home." They wanted you to think of the plastics and the sandwich bags, and instead a little bit of Union Carbide meant, the wind's shifted, here it comes again. Shut the doors, close the windows. You know what it cost to have the curtains cleaned last time? President Nixon gave an ecology speech, and somebody slipped him a real good quote from T.S. Eliot. "Clean the air, clean the sky, wash the wind. That's what we were going to do," said the president, not realizing that the very same quote went on. "Take stone from stone and wash them. Wash the stone, wash the bone, wash the brain, wash the soul. Wash them, wash them." Not ecology at all, but the blood of murder in the cathedral. But while everybody agrees that mankind and nature should live in harmony, few agree on what that means, or how the cost shall be borne. They have not changed the consciousness of the way they think. To paraphrase University of Colorado economist Kenneth Boulding, man has lived through history in a cowboy economy, with illimitable plains and reckless, exploitative, romantic, and violent behavior. Consumption was linear, that is, materials were extracted from supposed infinite resources, and waste was tossed into infinite dumps. But we are shifting to a spaceman economy. The Earth is becoming finite. Like a closed spaceship, Consumption must become circular, that is, to conserve what we have. Resources must be continuously recycled through the system. Air and water have always been free, and few realize that we are approaching the point in our cowboy ways where we will wrench the Earth's ecology out of shape. In the closing circle, biologist-ecologist Barry Commoner writes that we have to reconsider the true value of the conventional capital accumulated by the operation of the economic system. We have not considered the true cost. The effect of the operation of the system on the value of its biological capital needs to be taken into account in order to obtain a true estimate of the overall wealth-producing capability of the system. The course of environmental deterioration shows that as conventional capital has accumulated, for example in the United States since 1946, the value of the biological capital has declined. Indeed, if the process continues, the biological capital may eventually be driven to the point of total destruction. Since the usefulness of conventional capital in turn depends on the existence of the biological capital, the ecosystem, when the latter is destroyed, the usefulness of the former is also destroyed. Thus, despite its apparent prosperity, in reality the system is being driven into bankruptcy. Environmental degradation represents a crucial, potentially fatal, hidden factor in the operation of the economic system. So we do not even have a true picture of how well we have done. This parallels the arguments of the British economist Ezra Michon. If a wage earner dies sooner because of exposure to mercury, radiation, and DDT, but doesn't have extra medical bills, is there not still the cost of the lost earnings from the extra years? They have to be assigned a value, even if the human anguish of the missing years is ignored. According to Commoner, intense environmental pollution in the United States has come with the technological transformation of the productive system since World War II. Production based on the new technologies has been more profitable than the older technologies they replaced. That is, the newer, more polluting techniques yield higher profits. We could, of course, survive with new technologies, new systems to return sewage and garbage to the soil, retire land from cultivation, replace synthetic pesticides with biological ones, recycle usable materials, and cut down the uses of power. That would cost about $600 billion, or a quarter of our current capital plant. Placed in the kind of terms used in the analyst societies, this debt to nature means there is suddenly a liability on the balance sheet we didn't know was there. It must have been in the footnotes in fine print. We have been very profitable, but the plant is falling down. We can build a new plant, but we are going to have to amortize the charges against earnings for a long time. Ah, but then we have a spanking new plant. Isn't that good? Not in the terms necessarily that we have been used to considering as good. Of course, if we survive, that's good, and perhaps even prevent life from getting more noxious, that's good. But we have been measuring good as profitable. New capital expenditures are, at some point, supposed to increase the profits. That is why the class is so confused when asked what the purpose of the corporation is. Good is profitable. Profitable is new technology. New technology has been pollutive and profitable. Killing whales is very profitable until the day when there are no more whales, because we have only been amortizing the ships and the radar and the depth charges and harpoons. We haven't amortized the whales, and anyway, how do you replace whales? But the debt to nature, paid, does not increase either productivity or profitability. Thus, probably the corporation is not going to pay up unless the society compels it, induces it, inveigles it, or brings it about in some other way. The vision of good is simply too far removed from the vision of what has been perfectly good in the hundreds of years of cowboy economics. This is going to be true not just for the United States and not just for capitalism. The cellulose, paper and carton administration of the Ministry of Timber, Paper, and Woodworking in the USSR is going to have its problems, too. It has its quotas, and the boys at the ministry get their satisfactions from churning out the stuff, and ecology freaks are everywhere. This is from Professor Marshall Goldman's account of the pollution of Lake Baikal, the world's oldest lake and largest body of fresh water by volume. The manager of the plant at Bratsk is asked why a new waste filter has not been installed. Says he, "It's expensive. The Ministry of Timber, Paper and Woodworking is trying to invest as few funds as possible in the construction of paper and timber enterprises in order to make possible the attainment of good indices per ruble of capital investment. These indices are being achieved by the refusal to build purification installations. The finite earth argument leads almost inexorably to a call for an end to growth, both in population and industrial output. Growth in industrial output is one of the justifications for both capitalism and socialism, each to each. When Khrushchev talked about burying us, he was bragging about increases in industrial production. Increases in our gross national product have been hailed as the triumph of our system. Leave aside for a moment what GNP measures. It does measure only quantity, so if everybody goes and buys triple locks for their doors because crime has increased so much, the GNP goes up, though the quality of life may have gone down. There are those who believe we should attempt to measure such quality. The most dramatic assault on growth came from a group at MIT headed by Dennis Meadows, which built a mathematical model of the world system with the interrelationships of population, food supply, natural resources, pollution, and industrial production. The Meadows group produced a doomsday equation. The world is out of business in less than a century, unless the will is generated to begin a controlled, orderly transition from growth to global equilibrium. Even new technologies such as nuclear power sources, said the group, wouldn't help much. The team doubled the resources and assumed that recycling cut the demand to 1/4. Even optimistic estimates didn't put the day of doom off longer than 2100. We are going to stop growing one way or the other, said the group, the other being the collapse of the industrial base through depleted resources, and then lack of food and medical services. This report did not lack for critics. One economist said it was Malthus, with lights and a computer. Others said the base was too skimpy for the assumptions, and that future science and future technology were unknown. If you had assumed our population growth in 1880 without the automobile, you could have assumed asphyxiation by horse manure. If materials were going to become visibly scarce, would not the prices begin to anticipate scarcity? And would not new materials and new power sources be developed? The representatives of less developed countries who considered the report at a Smithsonian symposium were particularly alarmed, because freezing growth without some sort of worldly distribution of income would keep them at their current levels. The poorer nations, said the Indian ambassador, would slide down to starvation. At another international conference, the Malaysians said, some of us would rather see smoke coming out of a factory and men employed than no factory. And we are not concerned with pollution but with existence. At the laissez-faire end of the spectrum, economists like the University of Chicago's Milton Friedman think that in arguments over social issues, there is a strong tendency for people to substitute their own values for the values of others. The current pollution concern is an upper-income demand. The high-income people want to get the low-income people to pay for something that the high-income people value. People move from the clear, clean countryside to the polluted cities, not the other way around, because the advantages of the city outweigh the disadvantages. Left alone, people are more likely to act in their own interests, to evaluate the costs and benefits of their own activities. It is, of course, hard to legislate changes in consciousness. But most economists are unwilling to give up growth as a goal. World population is certain to grow for many years to come, an extra billion between 1960 and 1975, 3 more billion in the next quarter century. Even if that rate of increase is slowed, you need growth just to keep pace. In a world of no growth but more people, you only accomplish one person's well-being, or one nation's, at the expense of another. That is the kind of redistribution of wealth we had before there was any surplus wealth to compound, when people in skins hit each other over the head with mastodon thigh bones to accomplish the redistribution. Presumably, we have only recently outgrown such activity, and the record of social maturity is not a record anybody would trust to the application of economic problems. So the doomsday equations have at least the virtue of getting people to think about the problems of a finite earth. It will take long enough to do something about it anyway. It is from the increments that poverty is alleviated and the goals of the society met. If there are social problems, such as pollution, that can't be met by the market mechanism. They can be met by a pricing system, penalizing the polluter, let us say, or giving a tax incentive to achieve the desired end. This is not a net gain to growth in the traditional ways we have measured growth, because the stimulus from investments in pollution control is outweighed by the price rise in the end product, hence a damper on total demand. A study prepared for the Council on Environmental Quality, a government office, indicated this could be done for a small percentage of annual GNP, less than 1% for air and water. What is the impact of all this on the man in the green eyeshade, considering how goes the world? In the short run, and the short run is all that is considered by many of the men in green eyeshades, he can continue to play the game of displacement who makes the needles. If the Meadows model were to be true, and we were to be closer to doomsday, and the pricing mechanism were left alone, the man in the green eyeshade could make incredible killings by buying up commodities on the eve of their disappearance. But in the longer run, the demand for social purposes, whether in pollution control or health, education and welfare, is going to come out of the savings flow. Institutional Investor magazine polled 41 of the nation's leading academic, governmental, and business economists, and 2/3 of them believe that A. Growth should continue, with a change in priorities, and B. That additional income wealth redistribution is required. If the government borrows in the capital markets to deliver, it tips the balance we discussed in an earlier chapter. If it raises taxes to deliver, that comes at least partially out of profits. And if it, in effect, prints the money to deliver, then inflation also will cut into profits. As is often said in this sort of discussion, there ain't no such thing as a free lunch. There are some items to be balanced against this. One is the value of the compound in a trillion-dollar economy. One is the growing role of services in the economy. By 1980, the Department of Labor says more will be employed in services than in manufacturing. Services are non-pollutive, but the productivity curve also begins to flatten because there are no economies of scale from doctors, teachers, barbers, and string quartets. The man in the green eyeshade is a capitalist and a manager. The capitalist and managerial classes may see, writes Robert Heilbroner in Between Capitalism and Socialism, the nature and nearness of the ecological crisis, and may come to accept a smaller share of the national surplus simply because they recognize that there is no alternative. Some conclusions are inescapable. Even if the ecological crisis is overstated and far away, even if social problems can be solved with the existing mechanism, both of those points arguable. The consensus is moving away from the market as decision maker and from the business society. As soon as you get all the articulation of goals and priorities, you are moving from decision-making by market to decision-making by political philosophy. This is an idea developed by Daniel Bell, both in the end of ideology and in the post-industrial state, and by others. What's good for General Motors is good for the country, said Charlie Wilson, one of Eisenhower's businessman cabinet members. It would be interesting to see year by year what percentage of the people agree with that, and to watch the change. So the money manager in the metaphorical green eyeshade will no longer be operating in a world where the market determines totally what is produced and induced, nor in a society run by business decisions. Capital is scarcer and profits are thinner. He is still looking for 3 stocks that will double, but the range of his options is less. He has always looked not just at profits, epsilon, but at the rate of change in estimated profits, epsilon, plus delta epsilon, and in the long run, the broad run, the macro scene, whatever, his expectations are diminished. Open-ended expectations are an integral part of the markets we have grown up to know. Without them, the calculators can calculate the rates of return, and everybody can be on their way home at 10:05 a.m. to work on their leisure time, or more likely, to attend some committee meeting that will be devised to take up the remaining hours. The expectations are what Keynes called animal spirits. A large proportion of our positive activities depend on spontaneous optimism rather than on a mathematical expectation, whether moral or hedonistic or economic. Most, probably, of our decisions to do something positive, the full consequences of which will be drawn out over many days to come, can only be taken as a result of animal spirits, of a spontaneous urge to action rather than inaction. and not as the outcome of a weighted average of quantitative benefits multiplied by quantitative probabilities. Thus, if the animal spirits are dimmed and the spontaneous optimism falters, leaving us to depend on nothing but a mathematical expectation, enterprise will fade and die, though fears of loss may have a basis no more reasonable than hopes of profit had before. Individual initiative will only be adequate when reasonable calculation is supplemented and supported by animal spirits, so that the thought of ultimate loss which often overtakes pioneers, as experience undoubtedly tells us in them, is put aside as a healthy man put aside the expectation of death. None of this will happen tomorrow, and it was also Keynes who said that, in the long run, we are all dead, and that the conventions by which we operated were a succession of short terms. Those looking at the long run did so at their own peril. We have a marketplace in which it is possible to float all the services as well as the manufactures, and so probably many happy hours of playing with the displacements await our men. But if we are to give up the illimitable plains of the cowboy economy, the new and smaller horizon is going to affect our ability to believe that we can compound and extrapolate with impunity, that the 3 hot ones we heard about at lunch today can go from 5 to 100. We have already lost our gunslingers, a phrase I once applied to some of our citizens, and if our big sky goes, we will have to give up some of our fantasies. But they always were fantasies anyway, and maybe there are other energies to make our wheels spin. Having thus dispatched the spirit of capitalism, let us see what we can do with the Protestant ethic. That phrase describes a devotion to thrift and industry, postponed pleasure and hard work, the hustle as approved by the Lord. It accompanied the Puritan temper, a rather forbidding and pleasure-shy view of life, and is aptly described in the confidential Ford memo together with the complaint that it is disappearing, the traditional work ethic, the concept that hard work is a virtue and a duty, will undergo additional erosion. You have already seen the seeds of conflict, because if Prince Valiant at the Pink Elephant says, "I'm not going to bust my ass for anybody, I don't even bust my ass for myself," it is safe to say he does not believe that hard work is a virtue and a duty. We may keep using the phrase Protestant ethic, everybody does, but for the record we should now split Protestant from ethic. We call it that because Max Weber called it that in one of the classic works of political economics, and the sociologists and political economists are still sending students to the paperback stores for Max Weber, and not just for the Protestant ethic and the spirit of capitalism. The textile families of northern France, Catholics all, sent letters to their sons, and to each other, that could have gone right into Die Protestantische Ethik. Weber did not say, of course, that Protestantism was the sole cause of capitalism. In his commentary on Weber, Julian Freund says that the Protestant ethic was at least in part a reaction against Marx's solely economic motive. Embryo capitalism had existed in other societies, Babylonian, Indian, Chinese, and Roman, but the spirit of capitalism only developed with the mystery-less, magic-free character of Protestantism, with its rationality and rationalization. This will come up again in a moment in the counterculture's objections. The accompanying asceticism of Protestantism said that you worked hard in your calling to succeed, a sign of election by God, but did not spend the wealth created, because only sobriety pleased God. Thus the Puritan came to accumulate capital without cease. Even Keynes's assumptions in Essays in Persuasion seem to be based on a kind of Protestant society, where wealth increases because the margin between production and consumption increases. Talk about industry, thrift, and the way to salvation. The Protestant ethic has found its happiest current home in a very non-Protestant country, at least in name, Japan. A while back on a visit, I would ask people in Japan, "How much vacation do you take a year?" And the answers would come back, 2 days, 1 day, 3 days. Why so little? Well, if you work on your vacation, you get paid more, and the beaches are too crowded anyway. And I remember sitting with the translator of my own book, himself a distinguished director of the Bank of Japan, everybody cross-legged, a sliver of raw fish poised between his chopsticks, a garden scene framed perfectly by the door. "In the 1960s, said the honorable director, our total output passed Italy, France, Germany, and England. At this rate we will pass the USSR in 1979. How? Our people saved 20% of their wages, No other country saves so much. In the U.S. it is closer to 6%. It is indeed, and when sour years come and the people clutch a little and the savings rate goes up to 8%, the president gathers his economic advisors to Camp David and wants to know what the hell is wrong with the consumer. How do we get him to loosen up? Of course, said the director's research assistant, we will not pass the United States until... And everybody stopped talking because that was not courteous. Sometime in the 1990s, said the director, and many things could happen by then. We have social overhead building up. But we have done this without resources, without oil, without surplus food, said the assistant. With industry and thrift, industry and thrift. The voices in Osaka rise to haunt the finite earth model builders. In the morning, alma mater. For the building of a new Japan, let's put our strength and minds together, doing our best to promote production, sending our goods to the people of the world, endlessly and continuously, like water gushing from a fountain. Grow, industry, grow, grow, grow. Harmony and sincerity. Matsushita Electric, Matsushita Electric. Industry and thrift, dedication and devotion. You could imagine the United States without them, but not without the mythology and ethic behind them. What is at stake is the happiness of Arthur Burns, whether we will always have a cost-push inflation, whether we stay nation number one like President Nixon wanted, and what happened to our dreams of becoming rich. Nothing unambitious about that either. Once again, the Ford memo. For many, the traditional motivations of job security, money reward, and opportunity for personal advancement are proving insufficient. Insufficient. Security, money, and personal advancement? Do you know what we have to throw off to get to this point? I give you the Honorable Cotton Mather. There are two callings to be minded by all Christians. Every Christian hath a general calling, which is to serve the Lord Jesus Christ, and save his own soul. And every Christian hath also a personal calling, or a certain particular employment by which his usefulness in his neighborhood is distinguished. A Christian at his two callings is a man in a boat, rowing for heaven. If he mind but one of his callings, be it which it will, he pulls the oar but on one side of the boat, and will make but a poor dispatch to the shore of eternal blessedness. Every Christian should have some special business, so he may glorify God by doing good for others and getting of good for himself. To be without a calling, as 'tis against the fourth commandment, so 'tis against the eighth, which bids men seek for themselves a comfortable subsistence. If he follow no calling, a man is impious toward God, unrighteous toward his family, toward his neighborhood, toward the commonwealth. It is not enough that a Christian have an occupation, but he must mind it, and give a good account, with diligence, and so on to Poor Richard's Almanac. A sleeping fox catches no poultry. One day is worth 2 tomorrows. Diligence is the mother of good luck. Early to bed and early to rise provides a man with job security, money reward, and opportunity for personal advancement. The extension of this ethic into industrial America was a real triumph. The Ford vice president has a distinct problem. It is very hard to think of working on the line as a calling. Cotton Mather's listeners did not take this lightly, nor did he. Man and his posterity will gain but little by a calling whereto God hath not called him. A calling was to be agreeable, as well as allowable. It does make work seem softer and more important to have been prayed for. It is a wonderful inconvenience for a man to have a calling that won't agree with him. See to it, O parents, that when you choose callings for your children, you wisely consult their capacities and their inclinations, lest you ruin them. And cry mightily to God by prayer, yea, with fasting and prayer, for his direction when you are to resolve upon a matter of such considerable consequence. But, O children, you should also be thoughtful and prayerful, when you are going to fix upon your callings, and above all propose deliberately right ends unto yourselves in what you do. It is a bit hard to imagine then, Ma, I fasted and prayed and sought the wisdom of God. I know my calling, and I am going to work on the line at Ford, $4.57 an hour as an assembler. It seems almost simplistic to suggest, but you are more likely to bust your ass when everybody has been fasting and praying for you and what you are doing in your oar of the boat on the way to the shore of eternal blessedness than if none of these things are true. And if you are Ford, you have an extra problem if that spirit has departed. Not that it has departed everywhere. It is still in the literature. Ralph Waldo Emerson's self-reliance and wealth are in a direct line from Cotton Mather and Poor Richard. Be not only industrious, be clever, absorb and invest. Bishop Lawrence, doyen of the Episcopal Church at the turn of the century, really did say, in the long run, it is only to the man of morality that wealth comes. Godliness is in league with riches. Some of our major corporations have institutional advertising even today that could have been written by the social Darwinists. And Dale Carnegie courses run on principles that were devised by Benjamin Franklin. The man who gets ahead in business reads the Wall Street Journal every business day. Did you ever see the television commercial about the man who gets ahead in business? Business is a field event, pole vaulting, and the bar is set at about 100 feet. And the poor bastard is there in his business suit and his Knox hat and his briefcase. And he looks up nervously at this bar 100 feet high and fingers the pole uncertainly. After knocking the bar off the first time, he makes it the second, presumably because he has read the Wall Street Journal. The Wall Street Journal may be one of the best papers in the country, but I suggest that anyone who sees his job as a 100-foot pole vault with no track shoes is in the wrong calling and should pray for guidance. While the literature of the Protestant ethic has been exhorting everybody for 300 years in this country to be industrious and thrifty, sober and wise, to postpone gratification, in the words of the scholars, another literature has sprung up. It is literature really only in the McLuhanesque sense, but it is with us every day, and that is advertising. The purpose of the advertising is not to get you to produce and save, but to spend, to buy the goods, and this has been the case since at least 50 years ago, when mass marketing and mass advertising really got going. Now we have commercials in living color, and the populace spends far more time with them than the old populace did with Cotton Mather. What do we see? First of all, we never see anybody working except when they are candidates for medication, aspirin, pain relievers, tranquilizers, cold remedies. At least not office or factory work. The white tornado and the man from Glad will come and help with the housework. The rest of the time, people are at play. Is it possible to sell soft drinks without running into the surf? You only go around once in life, says the beer commercial, so you have to grab everything you can. That character is hanging precariously onto the rigging of his boat because one hand is clutching a beer can. And the airlines, well, there is the bell tolling the end of the Protestant ethic. Fly now, pay later. Pan Am will take you to an island in the sun where you can be a beachcomber. Not a calling approved by Cotton Mather. And Eastern wants to fly you and Bob and Carol and Ted and Alice all to your own little love nest in Jamaica. The message of capitalism has been schizophrenic. At work, be hard-nosed, industrious, single-minded, frugal and thrifty, and once you leave work, whoopee! Have you seen Carol and Alice in their bikinis? It may be that some doers can step into a telephone booth and emerge as Clark Kent, but I doubt if it works for a whole society. The second literature of exhortation, advertising, sometimes recognizes this, and tries to say that the deferred gratification of the Protestant ethic is a matter of hours, not lifetimes and generations. You've worked hard, you deserve this, says the clever ad, whether it is a beer, the reward for a day, or a vacation, the reward for a season, or whatever. Buy, try, fly. The less intensive attitude toward work also applies to play. In the winter of 1972, Columbia barely managed to field a basketball team for its Ivy League opener. It could send only 6 men to Providence to play Brown. 4 members, the New York Times reported, January 6, had resigned, making it a particularly dramatic example of student unhappiness with organized extracurricular pursuits. Several other college teams have suffered similar player shortages in the last month, said the team's second highest scorer as he departed. My father thinks I'm just a degenerate hippie now, because when I left high school I had all these fantastic ambitions for wealth and fame, and I wanted to be the greatest lawyer in North Carolina. Now I just don't have that. Oppose this to that paragon of the extreme ethic, Vince Lombardi. You could say, of course, that this is not quite fair. Soldiers and professional football players are supposed to win, but the example is not frivolous. When Lombardi died, his death was a major front-page story in all, including the most serious, of newspapers, and personally grieved the President of the United States. Lombardi's hold on the country and the President was that for 10 years the teams he had coached had either won championships or come in second. The ethic, according to Lombardi, all from Lombardi, and run to daylight. Winning is not everything. It is the only thing. The will to excel and the will to win, they endure. They are more important than any event that occasions them. To play this game, you must have that fire in you, and there is nothing that stokes fire like hate. And from Lombardi's Players. He had us all feeling that we weren't going to win for the Green Bay Packers, but to preserve our manhood, and we went out and whipped them good and preserved our manhood. Vinny believes in the Spartan life, the total self-sacrifice, and to succeed and reach the pinnacle he has, you've got to be that way. The hours you put in on a job can't even be considered. He treated us all equally, like dogs. I don't think I'd want to be like Lombardi. It takes too much out of you. You drive like that, you've got to give up a lot of time with your family, and you lose a lot physically. Still, now that I'm in business, I'm applying Lombardi's principles. I sent my secretary home crying my first 3 days on the job. One gal retired on me. I was putting them through training camp. I walked in and the first thing I said was, "Your job is on the line. If you don't make it, you're through." I said to the secretary, "What the heck you been doing all day? I don't see anything you've done." And if she gave me a letter and there was one mistake in it, I'd make a big X all the way across it and say, "Type it again." It worked out pretty well. They're organized now. I'm strict. A lot of him has rubbed off on me. And the Players on the changes. If you were told to beat your head against the wall, you did it. I think we're entering a different period now. I think we now have to give youngsters a good reason to get them to beat their heads against the wall. Kids today don't fight like we did. They can play football and basketball like hell, but they're very gentle, very kind. They're out playing for fun, and it's not going to interfere with their demonstration for the week, or with the things they consider important. Those kids don't look at it like the whole world is going to fall apart if you don't beat the Bears. The examples are so eloquent they need no comment. Someday we may have such technology and science and compound interest that whether people work hard or not would be marginal. But meanwhile there has been a lot of talk about alienation and unhappiness, and the blue-collar blues and, for that matter, the white-collar blues. Industry notices this because of absenteeism, turnover, and the lack of candidates for foremen. But at bottom nobody really knows. 5 years ago, from 1970, the National Commission on Technology, Automation, and Economic Progress tried to survey existing knowledge on job satisfaction and dissatisfaction under modern industrial conditions. There was pitifully little. With all the talk about alienation, dehumanization, and the loss of satisfaction from work, you would think that many researchers would be trying to find out the facts, by asking questions and by devising more direct measurements, by trying to figure out what aspects of particular routines are most destructive of satisfaction, and what loss of production would result from changing the routines, but apparently not so. I suspect, pending the reconvening of the National Commission to fill in the gaps, that two things are true in this country. One is that there are certainly a lot of jobs in this country that are boring, not built to the human spirit or the human body, or not fulfilling in some other way, and that most of American industry is only beginning to pay attention to this. The second is that people like to work, as opposed to not working or hanging around the house. They like to work, or at least they like to go to the place where work is, because they see their friends, they have a beer afterward, or a coffee break during, and it gets them into motion. And anyway, we have not developed the tradition of playing the lute and counting that as a good afternoon. Given any degree of pleasantness, encouragement, and satisfaction, they would go to work even without the exhortations of the ethic and the prospect of the shore of eternal blessedness. It is almost axiomatic in the literature of work that part of the problem comes of bending the men to the machines. But computers are machines too. The pay may be less than around the non-electric machinery, yet the blues are not so much heard from this sector, and among the differences may be style, atmosphere, and air conditioning. How hard, or with what care, people work is something else. William H. White, Jr., and the other observers of the 50s told us of the crossover. The executives were working the 70-hour week and taking work home while the blue-collar hours were going down. The difference is that both the executive and the blue-collar worker are now conscious of options that heretofore they did not think they had. Conscious only, for relatively few have acted on the alternative. Behavior and attitude do not necessarily go immediately together. Most of the attention has been paid to the younger generation. At least the future executives were thinking about a balanced life, and the corporations were getting a bit shyer about telling them how demanding corporate life was going to be. Whatever the terrors that haunted the man in the gray flannel suit, not making it, not having the house in the suburb, the terrors do not have quite the same intensity that they used to. The terrors are also less for the industrial workers. For one thing, if you have a house and a car, another house and another car become much less urgent, however pleasant or convenient. There is a lake within cruising range of the Vega plant in industrial Ohio, which is, to put it baldly, a blue-collar lake, which is to say most of the boats belong to union workers from the plants. If they put 5 more boats on that lake, you will not be able to see the water for the boats. Thus, if you are an industrial worker and don't have a boat to take the kids in, the chances are you have a friend who does, or maybe your old man will lend you his. A lack of things, unless those things are food, clothing, and shelter, does not provide terror except for a man in a gray flannel suit who has bought a distortion of the old ethic, its tangible evidences without its spirituality. Back to the Ford memo. Because they are unfamiliar with the harsh economic facts of earlier years, new workers have little regard for the consequences if they take a day or two off. That's about as succinct as one can be. The harsh economic facts of earlier years were an unpleasant but effective motivator. You do not even have to have gone through a Great Depression yourself. If you heard enough talk about it while you were growing up. Now it has been more than 30 years since the end of the Great Depression, and not only did the Prince Valiants in the plant not know about it, they have not even heard that much about it because Granddad does not live with them. I had a series of chats with Daniel Yankovic, social scientist and the head of the leading marketing research and social science research firm that bears his name, a firm that polls continuously in this area for corporate clients. Only in the last 5 years has this change in attitude taken place so strikingly. The changing of work goals, from salary to interpersonal relationships, to content of work, has also been documented by Professor Ray Katzel, chairman of the Psychology Department of New York University, and others. It took that long, almost 2 generations, for the motivation by economic fear to fade. Granted, all the moonlighting to make ends meet at the current levels, granted all the places and pockets that have been missed, and some of the unemployment which persists, mass employment is not a political possibility. Almost everyone would agree to that. And the economic width of grapeshot, what this country needs to shape up these deadheads is a good depression, has gone out of the lexicon of bargaining. What Yankovic calls the sacrifice consensus is breaking down. The sacrifice part of that phrase means that deferrals for something else are not as popular or necessary. I am doing this for my family. I am working so that my son has a better life than I do. And the consensus, obviously, is that there was agreement that this was a right and proper way of life. The breakdown of this sacrifice consensus does not mean that it is replaced right away with something else. Only that now there are many elements present, some sacrificers, some not, but no agreed upon consensus. If women's lib breaks the equation between masculinity and being a good provider, what does that do to motivation? And say, to insurance? Yankovic asked at one point, which started something that made us both late for dinner. So our productivity curve begins to flatten, not only because we are becoming a service economy, but because some of the motivations, the spirit and the fear, have gone out of the producers. And maybe our inflation is persistent. If you want the dank side of the extrapolation, some of the workers retire right there on the job and wait for their pension. Some take Fridays off. The servicing of all our things, and indeed even the services themselves, become so erratic and sloppy that the manufacturers have to work to make them service-free, no checkup for 10,000 miles, and the consumers get so irritated they transfer that irritation into political channels and gladly accept more government regulation of business. So, it is affluence itself that has taken the edge off our edge. But the President need not exhort us to get out and return to the honesty of a day's work for a day's pay, which he has done on several occasions. Nation number 1 will not be unique, because these elements don't stop at the water's edge. At different times, but for the same reasons, they will take place in all the Western industrial countries. The exhortations of Chairman Mao may be to a different end than the shore of blessedness, but the tone is the same. In the capitalist industrial countries, it is the first generation off the farm that provides the longest hours and the most uncomplaining workers. Somebody who has spent 16 hours a day looking at the wrong end of an ox for subsistence on a patch in Poland may not complain at all when he emigrates with a paper suitcase to a steel mill on the south side of Chicago. But his grandson may not think it is that good a deal. We are the furthest off the farm. Japan had a generation that made its industrial reputation. Those glee club singers in the Matsushita plant think Matsushita is about the most dazzling thing that ever happened. But meanwhile the Germans are using Turks and Spaniards, again, fresher from the farm, to fill out the ranks in the Volkswagen plants. All of which does not solve our problem, but gives us company. Perhaps that just gives us a challenge. Adolf Berle, among his other activities, was co-author with Gardner Means of the granddaddy classic in all this line of thinking, The Modern Corporation and Private Property. In one of his later books, The American Economic Republic, Berle suggested that we had a flexibility of response which he called the transcendental margin. Those qualities that accounted for the prosperity of Israel but not Iraq, of the Netherlands but not Bulgaria, a certain creative energy. It propelled our system not toward profits but toward, are you ready? Beauty and truth. In a younger and more optimistic America that did not seem so strange. If we still have it, or something like it, it should be possible to make of work something fulfilling that does not need either the spiritual exhortation or economic fear to motivate it. That is a tall order and a big challenge. But the luckier of our citizens who have experienced something like it know that under those propitious circumstances it can be fun to bust your ass. We ignore revolutions at our peril. Current evidences may or may not lead to profound changes, but we know that even when changes seem to happen quickly, the ideas behind them have been hanging in the air for a long time. Our man at the desk considering how goes the world, had he been in the city of London in 1913, would have been one of the merchant princes of the world. To him for capital came the Moscow Power and Light Company, the breweries of Bohemia, the trolley lines of Shanghai, the apples of Tasmania, the oil of Mexico, the ranches of Texas and Arizona, the tin mines of Malaya, the hemp of Tanganyika, and the railroads of absolutely everywhere. Half a century later our man was still at his desk and still at work. A bit shabbier, but his role in the world had changed. At this point the metaphor is going to break down, because revolutions do not come neatly across a desk. If the change is profound enough, the frame through which we have looked at this scene will go away, and the desk and the chair will still be there, but nobody will be sitting at them. But once again, a degree of skepticism is in order. In going through an inordinate amount of the literature, for example, I found one phrase a number of times. Our youth is in revolt. The writer is a verbal, conceptual person, usually an academic, and what he means is, my graduate students are in revolt, or my students have just worked their way through some Marcuse and they have had it with the system. The faculty of engineering is not so prompt to report that the students are in revolt. This is not at all to write off small numbers of people. They may have a symbolic value to everybody else articulating what larger numbers feel. But I think it is important to distinguish the flavor of what has been done. Greenhouse people have reported on greenhouse people, which is to say that academics and book writers have talked about students, who may not end up being greenhouse people, protected from the storms and freezes of life, but who are in a stage of life, being at school, where they are protected from what shapes everybody else. Just the simple numbers have gotten so much bigger. 25 students here and there do not make the impact that a counterculture of 1 million makes. But that million counterculture is possible because of a $1 trillion economy and, among other things, a student population of 8 million. When everybody has to spend 16 hours a day behind an ox, there is no counterculture. Obviously, I would not have taken this time and space if I thought we were still at July 4, 1955, in the Eisenhower Regency. Obviously, in spite of the looseness of the ways in which we have learned, something else is going on. I belong to a club housed in a magnificent old building in New York, which is supposed to be made up of distinguished intellectuals, because I suppose somebody had written The Wealth of Nations as an achievement by my name. The club has been infiltrated by foundation executives and downtown lawyers, and the average age of the members is 94.3, because foundation executives and downtown lawyers are very long-lived. Anyway, following the precepts of intellectual inquiry, we had a debate one night on Charles Reich's The Greening of America. This is the most talked about of the revolutionary tracts. Corporate America, an idea, incidentally, from the old Burrell and Means classic, has taken over the country, to the mindless end of its own perpetuity. This apparatus of power has become a mindless juggernaut, destroying the environment, obliterating human values, and assuming domination over the mind and lives of its subjects. We are not only an incredibly rich country, but a desperately poor one, because we have disorder, corruption, hypocrisy, war, distorted priorities, an artificiality of work and culture, powerlessness, absence of community, and a loss of self. Apologies for the abruptness of the summary. But out of biological necessity, a new consciousness has emerged out of the wasteland of the corporate state, like flowers pushing up through the concrete pavement. The revolution is individual and cultural, and only changes the political structure as its final act. I did my homework quite properly and intensively, because there was much that was not only naive, but diffusely derivative, some of it funny. 7 times Mr. Reich stated that there was no more chunky peanut butter. The corporate state had the power to deliver only homogenized peanut butter. The corporate state gave us snowmobiles instead of snowshoes, so that the winter forests screech with mechanical noise. Yet 4 times the author celebrated light motorcycles, to restore a sense of free motion, and he obviously never tried to read or think near a quiet road patrolled by a kid with a new Honda. Moby Grape was celebrated for the positive feelings of "It's a beautiful day today," which did seem to me to ignore "Oh, what a beautiful morning." Consciousness 1. And Peggy Lee's "Now it's a good day." Consciousness 2. That was fun and games. My real barbs came for the greenhouse thinking. Yet 5 minutes after the discussion started, I threw my notes away, because there wasn't any debate. My distinguished seniors had read the book, and they were so furious they weren't even listening. Their faces were becoming purple over their white-winged collars. What in the world could be so threatening? On the spot I had to switch sides and become the public defender, because the argument from the other side was, "It does not exist." And the point I have been making is that however imperfectly assessed, something else is going on. Jean-François Revel's tract, largely a pamphlet to needle his fellow Frenchmen, says that only in America can the true revolution take place. It is the revolution of our time. It is the only revolution that joins culture, economic and technological power, and a total affirmation of liberty for all in place of archaic prohibitions. It is nice of somebody to say we are still trying. And he mentions some of the political activities that have taken place: sit-ins, civil rights marches, student strikes, and so on. But it is important to separate out, for this discussion, the political aspects. Martha Mitchell may have looked out the window and seen the milling students as the 1970 St. Petersburg mobs, but few others did, and it becomes important to separate out what is style. Long hair may or may not represent something profound, but if you compare yearbook pictures of the class of 1872 and 1972, the beards and the sideburns look much the same. The only difference is that in 1872, Daddy had a beard or mutton chops too. If we leave out politics and style, that brings us back to behavior. Within that, loosely, there is a revolutionary idea, and that is, where did all those bright people get us, anyway? Weren't McGeorge Bundy and Robert McNamara 2 of the smartest people walking around? Consciousness 2, wrote Reich, rests on the fiction of logic and machinery. What it considers unreal is nature and subjective man. Consciousness 3 is deeply suspicious of logic, rationality, analysis, and of principles. We don't have to look very far for a prime example of the causes of a suspicion of logic, rationality, and objectivity. If we do not stop the communists in Vietnam, they will think we are chicken. They will take over Asia, and so on. We analyze the problem. We will send X numbers of men. We will drop Y numbers of millions of tons of bombs. Every day our television screens will carry the body count report. Them, 5,357. Us, 422. Villages pacified today, 324. The next day the score is the same, and the next. They see the score and we see the score. Therefore we win the war and achieve our principles, and the communists will learn the lesson. It is all there, measured, in what Yanklevich called the McNamara fallacy. The first step is to measure whatever can be easily measured. This is okay as far as it goes. The second step is to disregard that which can't be measured, or give it an arbitrary quantitative value. This is artificial and misleading. The third step is to presume that what can't be measured easily really isn't very important. This is blindness. The fourth step is to say that what can't be easily measured really doesn't exist. This is suicide. Thus, the use of feeling, emotions, ritual, and magic by the unconscious revolutionaries as a rebellion. The marked tendency, says Theodore Roszak, in The Making of a Counterculture, a literary essay which isn't really about that at all, has been to consign whatever is not fully and articulately available in the waking consciousness for empirical or mathematical manipulation to a purely negative catch-all category. In effect, the cultural garbage can, called the unconscious, or the irrational, or the mystical, or the purely subjective. Reich. Accepted patterns of thought must be broken. What is considered rational thought must be opposed by non-rational thought. Drug, thought, mysticism, impulses. Of course, the latter kinds of thought are not really non-rational at all. They merely introduce new elements into the sterile, rigid, outworn rationality that prevails today. That is the real end of the Protestant ethic. Not only everybody stoned, man, but the end of the rationality that led to the burgeoning of capitalism. It is as if Yanklevich wrote, the great victories in succeeding centuries won by Protestantism, individualism, rationalism, science and industrialization, all were gained at a terrible cost, the sacrifice of community. And to define community, he quoted from still another sociologist, Robert Nisbet. Community encompasses all forms of relationships which are characterized by a high degree of personal intimacy, emotional depth, moral commitment, social cohesion, and continuity in time. Community is founded on man conceived in his wholeness rather than in one or another of the roles, taken separately, that he may hold in a social order. Max Weber, one of the founders of sociology, whose phrase gave us the melody for this sonata, and who was the masterful historian of rationalism, wondered whether all the secularization and rationalism would not strip life of its mystery, charm, and meaning. But obviously, and obviously is admittedly a rational adverb, the complex technological society is not going to go away. Some small numbers of people may try to go away from it, to manage on communes with the last whole Earth catalog as a textbook. I wouldn't knock that, and I found myself inordinately tickled to have a book of mine included in the catalog among the kerosene lamps and potter's wheels. The rest of us are left to cope, to try to reintegrate what is missing into what we have. We can use a seeming rational approach to try to assess, for our own rational and managerial ends, what the changes in ethic and spirit mean, but totally to accept a non-rational world is to say goodbye to our role. Anyway, irrationality and mystery and magic are no strangers to us in the money markets. That was one of the points of the money game, to show that while the language of the game was built on rationality and precision, the game itself was played by behavior, and with all sorts of totems and taboos that would do credit to any tribe in New Guinea with an anthropologist in residence. Changes do not occur overnight. The moral code which accompanied the accumulation of capital for the past several hundred years has encouraged us to applaud and honor purposiveness. In his remarkable and extraordinary essay, The Economic Possibilities for Our Grandchildren, Keynes wrote, "Purposiveness means that we are more concerned with the remote future results of our actions than with their own quality or their immediate effects on our own environment. The purposive man is always trying to secure a spurious and delusive immortality for his acts by pushing his interest in them forward into time. He does not love his cat, but his cat's kittens, nor in truth the kittens, but only the kitten's kittens, and so on forward forever to the end of catdom. For him jam is not jam unless it is a case of jam tomorrow and never jam today. Thus, by pushing his jam always forward into the future, he strives to secure for his act of boiling it an immortality. It may be that the era of purposiveness, with its inherent dictum of sacrifice, is winding down, however slowly. That does not mean another era of something else is immediately at hand. The counterculture may not be a proper guide to the future because it is defined by its opposition. It is easier to describe what it is against than what it is for, but it may serve to stimulate some sort of synthesis, to make us broaden the idea of what is rational, to help crack the consensus. Long before the term counterculture came to be bandied, Keynes had delineated the lopsidedness of the accumulative society. We have been trained too long to strive, he said, and not to enjoy. Perhaps in 100 years, he wrote, 100 years from 1931, that is, the chief problem of mankind would be to live agreeably and wisely and well. What would bring us to that point? Science and compound interest, incremental technology and accruing wealth. Some of the members of our affluent and post-affluent society are already into that spirit, as we have seen. But alas, our views of both science and compound interest are changing. Science is no longer the unmitigated good the late Victorians saw. The radio added to Pasteur, added to the electric light, added to the steam engine. There is even some doubt about how incremental scientific growth is. In The Structure of Scientific Revolutions, Thomas Kuhn argues that each generation of scientists rewrites its textbooks to make everything a continuous flow. And as for compound interest, well, Keynes did say, in a phrase usually overlooked, assuming no important wars and no important increase in population, compound interest does not solve our economic problems if population compounds faster, because per capita is our divisor. Unexpected turns in the road do have a way of materializing. It was only a generation ago that some of our industrial societies were worried about how to get the birth rate up. If we could indeed count on the cushion of science and compound interest, then indeed we could look forward to the day when, Keynes again, there will be great changes in the code of morals, all kinds of social customs and economic practices, affecting the distribution of wealth and of economic reward and penalties, which we now maintain at all costs, however distasteful and unjust they may be in themselves, because they are tremendously useful in promoting the accumulation of capital. We shall then be free, at last, to discard. But what do we do on Monday morning? All of these exercises come under the perilous heading of long-term expectations, and we know that the long-term investor must seem, Keynes again, eccentric, unconventional, and rash in the eyes of average opinion. If the long-term investor succeeds, that confirms the belief in his rashness, and if he does not, he will not receive very much mercy. Worldly wisdom teaches that it is better for reputation to fail conventionally than to succeed unconventionally. Meanwhile, avarice and usury and precaution must be our gods for a little longer still, for only they can lead us out of the tunnel of economic necessity into daylight. If we are left with capital and not community, we still have to do our best to make our garden grow. Even the enlightened ones said that some hours must be spent in chopping wood and carrying water. But it would be folly not to be aware, even for parochial purposes, of the changes going on around us, and that awareness is not a traditional sensitivity in the rational preciseness of a game played with numbers. Meanwhile, the mechanism and the structure of the markets in which our game is played have survived. The currency and the supercurrency are still there. Maybe some of the players have gotten a little heavier. All of us have to make choices on the uses of our energies. Some things are as they are, and not as they ought to be. But this is the way the world is. If you are still for the game, why may you prosper. I wish you the joys of it. This has been an Audible Inc. production of Supermoney, written by Adam Smith, narrated by Adam Zink, executive producer Jennifer Bassick, producer Mike Charzik, and Studio Now Inc. Music by Michael Whalen. Copyright 1972 by Adam Smith. All rights reserved. Forward copyright 2006 by John Wiley & Sons Inc. All rights reserved. Preface copyright 2006 by Adam Smith. All rights reserved. Production copyright 2009 by Audible Inc.
Chapter 14. Telephone and Email Negotiation Tips. The telephone is probably the most treacherous device ever created, at least for negotiations. It's not treacherous if you know how to use it, but most people do not. With cell phones, it's even worse. Disruptions to negotiations are deadly. Even without the telephone, it is all too easy to derail a discussion, unless, of course, you don't like the way a negotiation is going and want to change the subject for a while. Many years ago, I had a secretary, an Italian woman who was a stunning olive-skinned beauty. Without even trying, she was the most sensual creature I'd ever seen. It wasn't her dress or makeup, nothing like that. It was the way she walked and talked. She radiated beauty and seduction. I was in an intense negotiation with 4 other lawyers. We were really going at it. I would have welcomed a change to the pace in the negotiation, but I didn't know how to do it without creating an incident. I needed a copy of a letter I had received, so I phoned my secretary and asked her to bring that particular document to me. She brought it in, and when she walked into the room, 5 lawyers looked at her and they all stopped talking. That was quite a feat. All she said was, "Here is the document you asked for, Mr. Ross." Then she simply walked out of the room. All 5 lawyers were stunned, and we all looked at each other, and one of them asked, "What were we talking about?" The hostility in the room was instantly diffused, and from there on, the negotiations went smoothly. That unplanned happening was so effective, I made it a permanent part of my negotiating plans and used it many more times when the environment and the personalities warranted it. It never failed to achieve the desired result. It's easy for someone to diffuse a train of thought, to change the atmosphere of a negotiation with a little effort. So you must make a conscious effort to stay focused, especially when distractions occur. It's hard enough to maintain focus in a face-to-face negotiation, but it's even worse when it is a telephone negotiation. It was many years before people were ready to accept telephones into their homes. They couldn't understand why anyone would want to put a device in his living room so that someone could summon him with a bell anytime he wanted and start a conversation. Yet, this is what we have today, and existing technology has created an even more complex negotiating environment. Good and bad aspects of the telephone. The telephone acts as a speed-up device. It's very different from doing business in person. The time frame of a typical phone call versus a typical meeting effectively proves my point. Ask yourself, what would you consider a very long business call? 1 hour would be a very, very long business call. However, if you are negotiating in person, 1 hour is considered a short time to negotiate any meaningful transaction. For example, if you are buying a house, negotiations would take many hours of many days. The very nature of the telephone forces everything to occur in a much shorter time frame than a face-to-face meeting. People are only capable of talking for a limited period and have a tendency to think, "Enough already. Let's get it finished." This is a significant disadvantage because both sides end up with less information. Of course, once you know the pitfalls of a telephone negotiation, you can, with practice, use the telephone to your advantage. Convenience. The convenience of the telephone is also its biggest drawback. If you're receiving a call, the timing could be hazardous to your negotiation strategy. If you are unprepared, distracted, or not in a negotiating mood, you can't control the timing of the incoming call. The person making the call immediately interferes with whatever you're doing at that time, the people you're with, and your schedule, and that puts you at an immediate disadvantage. If you believe in the golden rule, doing unto others what they do to you, the opposite works to your advantage. If you are the one making the call, then you are in control, and it's up to the other side to realize the timing is not good and take some defensive action. It's ironic that, as a rule, people don't like to defer a phone call, even when it's inconvenient. It would be so easy to say, "We have a time zone difference, and I'm not awake yet. Can you call me back in an hour?" But many people will say the timing is fine, even when it isn't. They willingly accept the disadvantage because they believe most calls are important. In our culture, we like to get things done quickly. We don't like putting off callers. So once a caller gets someone who's unprepared on the phone, the caller has a distinct advantage. The necessity to answer the telephone has been offset to a degree by caller identification and answering machines, but most people answer the phone when it rings. Some telephone traps. Telephone calls often occur in chaotic situations. When you go into a face-to-face meeting, you will have prepared a thorough outline of goals, a comprehensive list of agenda items, a stack of research kits ready to pass out, and you will have assembled all of the support staff you need to make a compelling argument. Using the telephone, you cannot be as well prepared. The agenda is about the only item that can be adapted to a telephone negotiation. If you're making the call, it's almost a certainty that the other side isn't well prepared. The big question for every telephone negotiation is, how important is the item that one side or both is going to forget? Here are a few suggestions that will give you a huge advantage in any telephone negotiation. Before you make a call, prepare a written agenda for yourself. List in priority the points you want to cover and make sure you cover them all. Whenever someone initiates the call to you, ask him exactly what he wants to talk about, and just listen and make notes of what he is saying. This should be a one-way conversation. He talks, and you listen. It's okay to ask for some clarification and to add, "I got it," from time to time, but any meaningful discussion is not started. At the end of the call, you simply say, "You caught me at a bad time right now. I'm in the middle of something, so I'll call you back." You can take 10 minutes, an hour, a day, whatever you need to be able to respond in a well-conceived, intelligent fashion to the items that were raised in the earlier call. Then, when you call back, you're in the driver's seat. Now you know exactly what you plan to say, but the other side is not adequately prepared to respond to your thoughts. Remember, people have a tendency to forget things during telephone meetings. So let the other side ramble on in the normal, informal manner of most telephone discussions and, as I said before, just listen. Someone will, indeed, forget something, and it is most often the person who receives the call and elects to respond without giving careful consideration to the consequences. That receiver is far less likely to be prepared. The person making the call is better prepared, even if it's only an informal mental list of things he wants to discuss. As with all negotiations, the telephone negotiation is going to be dominated by the more organized side. You have to train yourself to always be prepared in any telephone negotiation, and train yourself to be ready for every negotiation, especially the ones you have by telephone. You should have at your fingertips all documents you may need, an agenda of items to be discussed, a calculator, an estimate of the duration of the call, and anything or anyone pertinent to the discussion. Don't forget the words of Louis Pasteur, "Chance favors the trained mind." There's no face-to-face. One of the biggest flaws in a telephone negotiation is that you can't react to anything but the other person's voice. You don't see any facial expressions, any body language, or interplay with others on the call, or any of the many forms of input we might ordinarily use to judge the effect of our message on others, or to gauge the conviction the other side has for the arguments they make. If you want to get a no, use the telephone. It's the worst forum for making a convincing argument and for changing someone's mind. The reactions of other people are invisible to you, so it's much easier for anyone to play power games with you without you even being aware of it. For example, if you're in a conference call and you make a statement, One person on the other side can convey thoughts to the other person with a facial expression or gesture that you will never see. That won't work in a live face-to-face negotiation. The lack of input in a live and in-person discussion is a huge handicap, especially if you are alone and there are two or more people on the other end of the line. You never know who is listening. The telephone negotiation presents a special type of challenge. You never really know who is on the other end and what their roles are. The other side might not tell you the truth even if you ask. They might say, "It's just me on the line today." And you might answer, "Good, I'm glad John Smith isn't listening, because I can't talk to that SOB since he only creates problems but never comes up with a solution." And, of course, John Smith is on the phone, and now he's a worse enemy than he was before. If you were in a room face-to-face, you can see who is there. Or the other side might tell you, "Just between you and me, my accounting people don't like your numbers." You can defend your numbers easily enough, and you might even be inclined to say something derogatory about accountants in general. But the CFO or some other accountant may also be on the phone. They may be scribbling notes to the person you're talking to, telling him what to say, what to ask, and how to answer. This puts you at a tremendous disadvantage, because you don't realize who's there and who is controlling the negotiation. You have to play defense on the telephone. Assume someone else is listening in to your conversation and that you have to be careful about what you say. If you believe that you suffer any disadvantage in a telephone discussion, insist on a face-to-face meeting. This disadvantage can be applied in reverse, of course. If you're going to have a telephone negotiation with someone, you might be wise to have your accountant or lawyer, president, or other advisor there scribbling notes to you, telling you what to say. If there is going to be an advantage and a disadvantage, you are better off having the former than suffering from the latter. Interruptions are deadly. Negotiations always have a certain momentum at a particular time. Every interruption to the normal flow is a setback. No person can maintain his focus or posture while interruptions are occurring. If you are interrupted, your mind goes elsewhere, and your train of thought is destroyed. And the more interruptions there are, the worse this becomes. So if you're on the telephone with someone and he keeps excusing himself to talk to someone else who came into the room or called on another line, you have to nip it in the bud. You need to say, "Call me at a time when you can talk without interruptions. How's 3 p.m. today? Block out 45 minutes and call me then." Ironically, when you're on the telephone, you might have the habit of accepting the kinds of interruptions that would be entirely unacceptable if you were in a live meeting. Someone else in your office would never think of disrupting a meeting by walking into the room and asking you a question. But he can telephone you, and if you take the call, they have achieved the same result. Sometimes interruptions occur that must take precedence over any telephone negotiation. For example, if Donald Trump walks into my office while I'm in the middle of a telephone call, there's no way I can concentrate on that call while Donald's waiting. I immediately tell the listener, "Something came up that requires my immediate attention, so I'll have to call you back." Notice, I didn't say when I would call. So the timing is all mine if Donald's visit requires some immediate action. You can't examine documents. If you're in a face-to-face negotiation, you can make the argument, "I've got figures right here that justify my position." You can present the proof to the other person as you're talking. You can't do that on the telephone. Have you ever been on the phone and heard the other person rustling papers? He's looking for the document that justifies his position, but what good is it? All you hear is the rustling of paper. You can't see it. Just as you can't read the other person, you also can't read the other side's documents, and they can't read yours. Both sides are at a disadvantage in this situation. One side can't refute the other side's points because they don't see the other side's documents. You really don't even know if they have any compelling evidence. It could be a negotiating ploy when, on the telephone, to claim to have compelling evidence, knowing the other side can't demand to see it right then and there. So, the other person tells you during a real estate negotiation, "I have a survey by a reputable brokerage firm showing that the average rent for a building such as yours is only $28 per square foot. You're asking for $35. How do you refute the other side's survey when you're negotiating on the phone? The survey might not exist. It might be 5 years old. It might have been the result of poor sampling. You have no way of knowing that if you can't examine the document. There is a tendency to expect resolution. This is a trap that is indigenous to a telephone negotiation. Somehow, on a telephone call, people expect some type of agreement to result. That doesn't always happen in a face-to-face meeting. In a face-to-face negotiation, you may come to the point where you want to say, "Let me think about this for a couple of days, and then we can get back together." That's not unusual when you're there with the other person. But on the telephone, both parties are prone to settle something one way or the other. If we talk about some issue for 15 or 20 minutes, we both think we have the right to get a definitive answer then and there. Learning to master the telephone. Now that we've given some thought to the intricacies of telephone negotiations, I'm going to show you how to become a master at turning telephone negotiations in your favor. Learn to listen. People don't listen intently on the phone. That's the main thing for you to remember. The basic reason for slipshod listening is that you don't know when something important is coming, only after it has been said. At the same time, you don't really know if the other party is really listening to you, so the problem is twofold. Without any visual cues, you're only responding to what you hear. So you need to put extra effort into really listening intently to what the other side is saying and making notes to remember some key items. If you want to drive somebody crazy in a telephone negotiation, don't say anything for a few minutes. Before long, the other side will get frantic and say, "Are you still there? Did we get disconnected? Can you hear me all right?" Or something akin to that. In a face-to-face meeting, there are numerous situations where either one or both sides are silent, maybe just contemplating an answer. On the telephone, the lack of talking indicates a complete breakdown of communication, so the last speaker feels compelled to fill the void. When you let this happen, the other side is compelled to do the talking, and you will learn a lot more about them than they can learn from your silence. In some situations, this will result in the other side giving you much more than they ever would if you were in a room with them. Ask the purpose of the call. Anytime someone calls you, always ask what his agenda is, why he is calling. Then just listen carefully to his response and talk only when there is more information you can obtain by your response. If he says, "I think the price you're asking is too high," you may respond by asking, "What do you think is the right price?" You're getting more information, but you haven't agreed that the price is too high, and you haven't even indicated that you're willing to negotiate. But if he gives you an alternative price, at least you know what his thinking is. You have gained information while giving none in response. After getting all of the information you can, you still want to be in control of the agenda. So you should say, "Let me consider what you've said, and I'll get back to you." If it's to your advantage, you can set a time for you to continue the discussion. Otherwise, just leave the time open. Meanwhile, you can take whatever action you think is appropriate to tailor a response. Then, when you call him back, you are prepared and have supporting information to bolster your position. You already know how much he said he is willing to pay. You also know at what price you would be willing to sell. If the range of uncertainty is narrow, it should be relatively easy to bridge the gap. Maybe "let's split the difference" might be the way to go, or some other appeal to human nature that we discussed earlier. If the gap is wide, you will need to present some compelling reasons for the other side to revise their numbers, or Prepare to abort with a take-it-or-leave-it stance. Always use a checklist or agenda. You should get in the habit of creating and updating a telephone checklist or phone call agenda that lists items in priority order to ensure that you won't leave anything out. You want to be sure to gather as much information as possible if the other side initiates the call, so that when you call them back, you are prepared for everything. So, when you're done discussing price and you know what number they have in mind, you can ask, "What else do you want to talk about?" Maybe delivery dates, representations, or other issues will be raised. When you call back, you have your checklist and agenda and the arguments you will use with whatever backup you need. Then you will be as organized and prepared as you can possibly be. Don't hold telephone negotiations where interruptions may occur. You want to be sure you won't be interrupted during an important telephone negotiation. You should close your door and alert a receptionist or secretary not to put through any calls until you say so. You can control this on your side, but you won't be able to control the same thing for the other side unless you insist on it as a condition for your call. You can say, "We have a lot to discuss, and we should do it without interruptions. I can clear an hour at 9 a.m. tomorrow. Is that okay with you?" Pick a time that works for both parties, and you'll be surprised how much will be accomplished. One excellent way to avoid interruptions is to create what I call a quiet hour. Set aside an hour in which you will make all the calls you need to make, but will not permit any outside interruptions, i.e., personal visits, deliveries, or incoming calls. I have found that my quiet hour is the equivalent of at least 80 minutes. Try it for yourself, and you'll be amazed at how much you can do in that hour. Have all materials available when on the phone. If there is a lot of documentation involved with your negotiation, the telephone is the worst venue to use. But if you have to talk on the phone, be well organized and have everything ready. Have all of your documents easily accessible and well organized to make your arguments. You would never talk into a face-to-face meeting without organizing your materials. Many people are so casual about telephone negotiations that they are ill-prepared to negotiate intelligently. Knowing this puts you in control. If you organize well and prepare everything, you will have a clear advantage. It's not just your materials that should be well prepared. You should be sure you have anticipated all that you may need. For example, be prepared to crunch numbers if necessary. Most negotiations involve money and a discussion of it, so you have to be ready to do some on-the-spot number crunching. If numbers may be involved, be sure you have a calculator handy and you or someone on your side knows how to operate it. Take good notes. You might be a great note-taker in face-to-face meetings, but in a telephone negotiation, I cannot stress enough the importance of good note-taking. You must take good notes about all phases of the discussion, what was decided, areas of continuing disagreement, definition of the issues, and itemization of new issues. To be of any value to you, your notes must be immediately filed when the call is over. If you wait and the notes get lost or misplaced, you would be better off if the telephone call never took place. Most negotiations consist of a series of discussions and meetings, so your notes should be dated, list the name of person or persons on the other side, and they should be detailed. You should assume you will need to refer to them again later, and if you are sloppy, you will pay the price for it. Most people don't take the kind of notes I'm referring to. If you have ever watched someone while they're on the phone, they might be having an intense negotiation, talking about important issues, but not taking a single note, and maybe even doodling. That telephone negotiation counts as much as a face-to-face meeting, but without notes, it is much more difficult to pin down the other side. If the other side doesn't recall the details of a discussion, it is powerful to be able to tell them the time and date of the conversation and read back what they said. If they don't have good notes, you'll win that argument hands down. Confirm the conversation with a follow-up letter. I've talked previously about documenting your meetings with a periodic follow-up letter summarizing the issues, what was decided, what remains, deadlines, and so on. But this is even more important after a telephone negotiation, because people are so casual about telephone conversations, they have a tendency to forget what was said. They are prone to forget the details of their agreements, and they have a tendency to take the telephone negotiation less seriously. Documenting the details of a telephone negotiation is more critical than it is with a face-to-face meeting. People will very rarely respond to the letter by saying, "That's not what we agreed on," or "That's not what we discussed." They either don't read your letter or email, or they don't think the issues you stated are important enough to take issue with immediately. Here again, people underestimate the importance of a telephone negotiation, so they are not likely to challenge anything you say in a follow-up letter. The follow-up letter or email becomes a very important document later if the other side contradicts or conveniently forgets something they agreed to in a previous telephone negotiation. Email rules of thumb. Unlike the telephone, email communication leaves a paper trail, so the odds are better that everyone will at least take seriously what they write down. Some important things to remember about email. Grammar and punctuation make impressions. There is a tendency for people to not check spelling in email, but they should. Spelling and punctuation are not just old-fashioned ideas. They create an impression about your education and intelligence and your attention to detail. They also convey the idea that you care about the impression you make on other people. Nonverbal expressions can be misinterpreted, so be careful. When you have only the words to read, you can't hear the tone of voice. So if I write to you, it's important that we discuss this immediately. You can't tell whether I'm in a friendly mood or angry with you. You don't know if I'm being casual or demanding. So I have to be careful how I construct my message. For example, I might write to you, "As you and I have already discussed, the document has to be recorded by tomorrow to meet our contractual deadline. It's important that we discuss this immediately." Now, with an explanation preceding my previous statement, it makes more sense. I'm providing an explanation so you will respond more readily. I received an email from a woman not long ago. We'd been exchanging emails and working out some details to a deal. All that the message said was, "No thank you." The lack of tone can be easily misunderstood, or even be thought to mean something completely unintended. This concerned me because things had been going along quite well, so I was puzzled and, frankly, I couldn't remember exactly what I'd said in my last email. So I looked it up. She had sent me several things I had requested, and I'd sent a reply that simply said, "I received your information. Thank you." Now her email made sense. She had meant to answer my thank you message by saying, "No, thank you," i.e., she was thanking me for something I had done for her earlier. But her tone of gratitude didn't come through. That, combined with a lack of grammar and emphasis, could have led to a misunderstanding. Follow-up is important and courteous. Following up after a complicated discussion is an effective negotiating tool and a courtesy. Whether your meeting took place in person, by telephone, or by email, a summary is always a smart idea. You can start out by saying, "Thank you for all of your hard work in resolving the details. I'm sure we will be able to arrive at a solution to the remaining issues." You then summarize what you've agreed on, what else needs to be done, and what deadlines, if any, have been set. This maintains clarity and perspective during the negotiation. It also keeps communication open and avoids misunderstandings. Email is an easy method because it doesn't take up any office space. The other side can move your email to an online folder without needing physical file space and retrieve it easily later on. As long as you are keenly aware of the problems in telephone and email communication, you should be able to manage problems as they arise, and manage them so that they do not handicap you during your negotiations. Being aware of the pitfalls makes you a better negotiator. Notice that I never used the words telephone conversation in this entire chapter, but rather telephone negotiation. Every telephone call or telephone conversation, no matter how casual, is in fact a negotiation, and you should give it as much importance as any other type of negotiation. Don't forget it. Chapter 15. When to use non-binding letters of intent, or memoranda of understanding. A binding commitment you might obtain from other people is not limited to a signature on a contract. Every negotiation, especially a Trump-style negotiation, is based on developing a personal relationship with other people and deriving the benefits that grow from it. These include something beyond the legalities of a contract. A moral commitment from a person who is trustworthy is often better and stronger than a legal one. I can personally attest that this trait runs in the Trump family. When Donald Trump was working on Trump Tower, he needed access to Walter Hoving, the CEO of Tiffany & Company. He wanted to negotiate for the purchase of Tiffany's excess air rights at their Fifth Avenue location and a purchase of their option on the Candell property next to Trump Tower. Donald's father and Walter Hoving had done some business together, and Donald's father suggested to Donald that he could work out a fair deal with Hoving in a short period of time. A meeting was set up in Hoving's office with Hoving, a young attorney from Coauthor Brothers who was counsel to Tiffany, Fred Trump, and me. There had been prior discussions between Fred Trump and Walter Hoving that were to be finalized at that meeting. Fred and Walter shook hands on the deal, and we were about to leave when the attorney from Coauthor said he had prepared a document for Fred Trump to sign. Hoving asked to see the document, looked it over, and proceeded to tear it up. Looking at his attorney, Hoving said, "Young man, you may be a good lawyer, but you have a lot to learn about dealing with people. When Fred Trump makes a deal, his word is good enough, and there's no need for a written document." This doesn't mean you can do away with documents. In a complex negotiation, the working documents you prepare can serve to define the issues and bring the entire transaction into focus and create that all-important moral commitment for which Trump-style negotiating is known. Good working documents add to the time investment by both parties, which helps build commitment to the deal, and they help to save time and disagreements later by serving as an outline for those final legal documents. Trump's World Tower at the United Nations is a perfect example of the way good documents in a negotiation can support key verbal agreements. Building this project was not a simple matter of buying the land and getting permits. Trump wanted to build the tallest residential structure in New York, and to do this he needed to acquire air rights, which allow a developer to build a taller building than he otherwise could. Under New York laws, you are allowed to transfer air rights from one property to another on the same block. So, to develop a very tall building, Trump needed to buy air rights from adjoining landowners. This was complicated because he had to negotiate with many people at the same time and keep it all confidential as well. If word of what he was trying to do became public, the price of the air rights would have immediately skyrocketed. He proceeded to make verbal deals with all the owners in which he promised them the highest price he offered to any of them. Their reliance on his word enabled him to make deals with everyone before word spread about his intentions. As you might imagine, all of these arrangements, promises, contracts, and purchases of rights involved a lot of written documents, even before the deal got to its stage of execution of legal and binding documentation. But the verbal agreement was never violated. The value of a non-binding letter of intent, or memorandum of understanding. To bring a transaction into focus, especially a complex one, you must begin with a thorough and clear definition phase to crystallize the thinking of the parties. This is where a letter of intent, LOI, or a memorandum of understanding, MOU, can be very helpful. The deal can initially be discussed in general terms, but to clarify the understanding of all parties, you may need to prepare and distribute a piece of paper with the whole deal summarized. There is little practical difference between an LOI and an MOU, both of which should be non-binding to achieve the desired result. A review without involving lawyers. The LOI is usually used to outline a transaction before too much discussion has occurred. The MOU is typically utilized after the parties have met and agreed on several items. The purpose of an LOI or MOU are identical, so don't sweat the label. Each LOI or MOU should be very brief, a page or two at most, with very concise language. It summarizes the intentions of both sides. The LOI or MOU should specifically state that it is not a legal document, that when signed is binding on either party. In light of this, it shouldn't read like it was prepared by a lawyer. It should be more informal in tone and much shorter and less detailed than the actual contract that is prepared later by your legal counsel. It should hit the highlights of the deal in general terms with a minimal amount of specificity. It's like an artist's sketch on canvas outlining the picture before he begins applying paint. He sketches in the outline of what he's going to paint and what it will look like, but the actual details are to be added later. The LOI or MOU engenders better thinking. In the course of preparing an LOI or MOU, you not only focus on what you have agreed on, but also on what has not yet been agreed on. Since it can double as a type of interim negotiation status report, the LOI or MOU can do much to bring both parties to the same level of understanding, even though there has not been a complete meeting of the minds. For example, let's say you write in the LOI or MOU that the purchase price for the property is $500,000, but many aspects of the deal have yet to be clarified. When is it to be paid? How much of a down payment is required? Are there any contingencies? The purchase price is just a starting point. The LOI or MOU stimulates thought on both sides as to what has been negotiated and what remains to be negotiated. Highlights terms that were not negotiated. It is often just as important to clarify terms that might not have been raised or fully discussed. These might not be obvious to both sides, or one side might have an entirely different take on the agreement than the other side. As you go through your preparation of an LOI or MOU, details arise that you realize weren't discussed. Once you recognize that fact, you prepare a list of the issues not yet discussed and create a new agenda for their negotiation. Fills the gaps in continuity. In most negotiations, differences arise between the two sides because there is a break in the continuity of the negotiation. As long as both sides continue talking, they can resolve the areas where different positions have surfaced. The longer the time gap between negotiating sessions, the greater the likelihood that memories will get hazy. So when a negotiation stops, the LOI or MOU serves as a bridge to indicate what has been agreed on or not agreed on as of its date. Negotiation often consists of hundreds of smaller negotiations. I call this the theory of transactional fractionalization. The negotiation is actually a series of individual negotiations that take place at different times, under different circumstances, and with different parties involved. Ultimately, all of these individual negotiations are blended into the final completion of the deal. Because there is usually some kind of time lapse involved between start and finish, this multitude of smaller negotiations can cause problems because both sides are likely to forget exactly what was discussed, when it was discussed, and if a final resolution has been reached. An LOI or MOU summarizes the multitude of smaller agreements that both sides have reached and shows the amount of progress the parties have made toward a final settlement. If you have excellent notes or a playbook, it will be an easy task for you to summarize the state of negotiations at any time. Who controls the document? Whenever you draw up an LOI or an MOU, recognize the power you gain by putting your thoughts down on paper. It defines the agreement. It provides a chance for the other side to agree or to disagree. And in the absence of a response, your tacit agreement on its contents will make it easier to finish the deal. Two aspects of an LOI or MOU are worth noting. 1. Document control is important. Whenever you have the chance to draw up documents, you should take it. This refers to contracts, amendments, leases, and of course any LOIs or MOUs. The person preparing the document decides what goes in, what gets emphasized, and what gets left out. You know what you want to draw attention to, and you also know what you choose to leave out because of its controversial nature. The other side will read what you put in the LOI or MOU, but they will have to figure out for themselves what you left out. Not only is it true that most people are poor note keepers and fail to follow up communications in a timely manner, they are often blinded by your written words and conclude that you have accurately summarized the whole deal. 2. The LOI or MOU may reveal the hidden negotiators. You sometimes get the sense in a negotiation that the person you're talking to is operating under a set of restrictive guidelines and doesn't actually make the final decisions. When you send out a non-binding LOI or MOU and request a signature indicating approval, pay attention to who signs or initials it when it comes back. The person signing the LOI or MOU may be the actual decision maker. If it is initialed by the other side's attorney or legal department, then you know it went through a legal review. If the CFO signs off, then it was scrutinized from a financial point of view. If someone else, who you never met, signs the LOI or MOU, like the CEO of the company, you know that he or she is the real power behind the negotiation on the other side. Getting approval of your LOI or MOU is a powerful, important step. You need to know who has to agree on the LOI or MOU. Understanding the scope and knowing the people participating in the approval process makes it hard for anyone on the other side who has signed off on the document to raise new issues at a later date. A guide for the legal documents. The structure of an LOI or MOU should be viewed as a preliminary draft of what will ultimately become a legal agreement. That way, an attorney can't simply go off and make up a contract without making it conform to the agreements as defined and described in the LOI or MOU. It prevents someone from making last-minute changes to items that have been agreed on. While a legal contract can certainly embellish on the terms set forth in the LOI or MOU, it cannot change the contents or what the other side agreed to, either explicitly or implicitly. Creates a moral commitment and adds to time invested. Some aspects of every negotiation are intangible. The LOI or MOU helps clarify and define these important but intangible issues for both sides. As you draft the LOI or MOU, you may discover that these issues are clarified in your mind simply as a part of the process of articulating your point of view. Just because something is intangible doesn't mean it is not important. Moral commitment is sometimes more important than legal commitment. Very often, an LOI or MOU, even though both expressly state that they are non-binding, may actually create a moral commitment that both sides feel obligated to honor. It may be an agreement to negotiate in good faith, for example. The agreement may even be unspoken. The LOI or MOU may transform an intangible into a tangible. If the other side agrees with what you write in your LOI or MOU and feels morally committed, he will be reluctant to come back later and contradict that agreement. The act of seeing the LOI or MOU and acknowledging its acceptance is powerful. For someone to disagree, he has to take specific steps to discuss the disagreement by communicating with you. If he doesn't communicate with you, then you have a moral commitment from him that is only good to the extent of his morality. I tell people that this is often more valuable than a legal commitment. This is even more binding if approval is obtained from a key executive or board of directors. The LOI or MOU is also valuable because it gets you beyond the phase where one side is asking, should we make a deal or not? Once you define the essence of the deal in the LOI or MOU, it articulates the deal in a way you believe the agreement exists. That makes it easier for the other side to agree, since the LOI or MOU serves as a map of the deal. Time investment is important to negotiators. The time investment, the importance of time put into the negotiation, is important to both sides, and the negotiation itself gains value. The LOI or MOU are yet another step adding to the time investment. If you prepare the LOI or MOU, that takes up your time. When the other side receives it, they spend time reading it and discussing the deal. There may be more time spent if they want to modify the LOI or MOU and send it back to you. And then you also spend more time reviewing it. So both sides increase their invested time, and that motivates them to make the deal succeed. Chapter 16. The Most Intricate Deal I Ever Negotiated. Occasionally, you may come across a transaction where a participant refuses to negotiate because he feels that his position is so strong he can control the outcome just by playing hardball. Or a key player may be absent, making a transaction very difficult to complete. But it can be done. It just takes a little extra tenacity and creativity. I remember a deal just like that with the Katz Agency. Although it was not a Trump deal, it had all the earmarks of a Trump-style negotiation. As I go through the scenario, I will identify factors, terms, and techniques, in parentheses, that have been discussed in this book, so you can see how these things played out in a complex, high-stakes negotiation. Since the transaction was so dramatic, I have written it like a play, in 3 acts. Act 1. Background. All of the action takes place in New York City in 1990. A major recession has been in progress, and companies have shelved any expansion plans they had. Many prominent builders recently built buildings on speculation, without any commitments from tenants, believing that the rental market would recover by the time their buildings were completed. That didn't happen, and as a result, there was an overabundance of vacant space with no takers. At that time, the Katz Agency, now the Katz Media Corporation, which was a titan in the sale of radio and TV time to advertisers, was contemplating a merger that would substantially increase its space needs by at least 50,000 square feet. Katz was headquartered in 150,000 square feet of space at 1 Dag Hammarskjöld Plaza on 2nd Avenue, in a 750,000 square foot building between 47th and 48th Streets. This sounds like a lot of technical detail, but you'll see why it's important to the story in a minute. About half of the Katz Agency space was covered by one lease. I'll call it the good lease. The rest of the space had been leased at various times as the need arose and was subject to several separate leases, the bad leases. The good lease covered about 75,000 square feet of space and had a remaining term of approximately 3 years. The rent for the good lease space was $25 per square foot, which was cheap by the standard of the time. My task was to renegotiate the good lease and the bad leases and get Katz the additional space it needed for the merger, while also taking advantage of the depressed real estate market. Cast of characters. George H. Ross, a consultant for the Edward S. Gordon Company, ESG, a reputable real estate brokerage firm in New York. Ross is an experienced negotiator and real estate attorney who was hired as the chief negotiator for Katz. Larry Rubin, Katz's current landlord, a respected and smart real estate developer who owned 1 Dog Plaza. Ross and Rubin had done many deals in the past and had mutual respect for one another. a relationship. Ross knew that Reuben was a tough negotiator who would exercise as much power as he had. This was actual knowledge proven by experience, not apparent knowledge. Reuben believed that Ross knew the business of real estate and had a reputation as a deal maker, not a deal breaker. Actual knowledge. Jim Greenwald, the head honcho of the Katz agency and a close friend of Ross, relationship, as well as an investor in Beck Ross Communications Corporation, a Ross-owned entity that owned and operated several radio stations. Harry Macklowe, a respected, smart developer who in 1988 had built a major office building at 125 West 55th Street in New York City. The building was completed more than a year before this negotiation, but was still completely vacant, so Macklowe was in trouble. Ross and Macklowe had done deals in the past, had an amicable working relationship, building trust, and they knew they were both deal makers. Actual knowledge. Scene 1. Place. After reviewing and analyzing the good lease and the bad leases, obtaining critical information necessary to formulate a strategy, Ross meets Greenwald for lunch, creating a friendly environment. Ross. Jim, tell me exactly what you would like me to accomplish for you. Finding the story. Jim. George, I'm in serious negotiations to complete a merger for $20 million that will strengthen Katz's position in the market. I have some lousy leases at One Dog that are all over the place regarding expiration dates and rents. I would like to consolidate my entire operation and make a new deal with Reuben that will handle my expanded space needs and get me a rent I can afford. Can you help me? Ross. Sure, Jim. I know Reuben well, so I'll arrange a meeting with him to test the waters, and I'll tell you what happens. Ross goes back to his office and prepares for his meeting with Reuben using the post technique described in Chapter 9 for the initial negotiation. P equals persons. Reuben and Ross will meet at Reuben's office. Reuben will probably have his son there to hear what Ross has to say. O equals objective. To see if Reuben is amenable to recasting the good lease and the bad leases and leasing more space to Katz. S equals strategy. To try to convince Reuben that this approach eliminates the uncertainty of the rental market in 3 years when the good lease expires and affords him the benefit of Katz occupying more space. T equals tactics. Tell Reuben about the distinct possibility of Katz vacating Reuben's building entirely and making a deal for space in a new vacant building on Manhattan's West Side, creating a bogey. Ross prepares a checklist of items to be discussed at the meeting. 1. Does Reuben have an additional 50,000 square feet available to lease to Katz? 2. Is Reuben happy with Katz as a tenant? 3. How amenable is Reuben to recasting the Katz leases? Scene 2. Place. Reuben's office sometime later. Ross, Larry Reuben, and Reuben's son are present. Ross. Larry, I've been engaged by Katz to solve their space problems in your building. They would like to take more space. Right now, only one of their leases is at a rent consistent with today's weak market. Reuben. George, Katz is a good tenant. They pay their rent on time, and I would be interested in making a new lease for more space and renegotiating the good lease, but I won't touch the bad leases. I like the high rents and the staggered expirations. That's my position. Take it or leave it. You know that if I want to, I can beat any deal you make elsewhere, so it's best to deal with me. Ross. Then I'll have to make a deal on a new vacant building on the West Side where the owners are dying for a tenant like Katz, and see if you can beat that, creating a bogey. Reuben. Come on, George. We both know that the rents on those new buildings have to be high to satisfy the mortgagees. You also know that Katz's remaining obligation on the leases in my building is several $1 million. No builder in his right mind will take over that obligation. Katz's only hope is to make a deal with me. No one can make a better deal than I can. Plus, cats will save the cost of moving, creating a new installation, and an untold amount of aggravation. I hold all the cards. Intimidation. Come back to me with a reasonable proposal, and I'll consider it. Scene 3. Place: Jim Greenwald's office. Ross and Greenwald are present. Ross: Jim, I met with Reuben, and any deal with him will be tough to swallow, because he knows that if he wants to, he can beat any deal you make elsewhere. I've examined your leases, and you've got real troubles with the high rents and long terms on a lot of your space. Greenwald: What can we do? Ross: I've got an idea. Harry Maclaw has a new vacant building on 55th Street and might be willing to make a deal with cats. I'm very friendly with Maclaw. I'd like to come up with an alternate deal to induce Reuben to back down. Always have a plan B. Greenwald: Okay, see what you can do. Scene 4. Place: Ross's office, where he prepares a checklist for his upcoming meeting with Maclaw. It looks like this. Questions needing answers. 1. Does Maclaw's building have at least 200,000 square feet of vacant space in 125 West 55th Street? Assume yes, but ask Maclaw. 2. What rent is Maclaw asking for his vacant space? What concessions are available, such as free rent and money for tenant improvements? What lease term is available? Options available? Ask Maclaw, but check ESG's database. Assume accuracy of information the other side gives you, but always verify it. Who holds the mortgage on Maclaw's building? Is there a hidden negotiator? What is Maclaw's financial condition? Assume it's good, but verify. Post plans for Maclaw meeting. P equals persons: Ross, Maclaw, and members of Maclaw's staff. Get name and function. O equals objective. See if Maclaw has space to meet Katz's needs, and if so, on what terms is he willing to make a deal. Creating the zone of uncertainty. Staking out the starting negotiating positions of the two sides. S equals strategy. Tell Maclaw that Katz is very strong financially and would be a great tenant to have in his building. Tell him that Katz has given me the authority to make a quick deal. T equals tactics. Bring a history of Katz. Started in 1886 as the first advertising representative. Now #1 in New York. Have the financials of Katz available if necessary to verify net worth. Ross calls Maclaw and arranges a meeting. Act 2, Scene 1. Place: Maclaw's office. Present are Maclaw, Ross, and Maclaw's CFO. Ross: Hi, Harry. It's good to see you again. Creating a friendly atmosphere. I'm here to bring you a first-rate tenant for 125 West 55th Street. Have you got 175,000 square feet of vacant space? Maclaw: Have I got 175,000 square feet? Hell, I've got a whole 550,000 square foot building vacant. What do you have in mind? Ross: I represent the Katz Agency, which has 150,000 square feet at One Dog. They have a bunch of leases, but I could convince them to move to 125 West 55th Street if I can get them a good deal. What are you asking in rent? How much free rent do you give? What's the value of the initial improvements you make for tenants? Maclaw: My asking rent starts at $34 per square foot for lower floors and goes up for higher floors. I want $5 increases every 5 years. I'm looking for a minimum 10-year lease. I'll give a 4-month free rent concession, and I have a $30 per square foot work letter for tenant improvements. Ross has now established one parameter of the zone of uncertainty. But if you bring me the right tenant, we'll work things out. Voluntary useful admission. Ross: Okay, Harry, I hear you. Let me crunch some numbers, and I'll get back to you. Ross goes back to his office to have his accounting department, using professionals, compute the estimated cost to Katz of the proposed Macklow deal. Since Ross now has the parameters of Plan B, he sets up a new meeting with Reuben. Scene 2. Place, Reuben's office. Present are Reuben, Reuben's son, and Ross. Ross: Larry, I've been thinking over what you said, and I agree that no one can make a better deal for the Katz agency than you, if you are willing to do so. They need a 10-year lease for 175,000 feet. What deal are you willing to make? Reuben: Here's what I'll do. I want them to increase the rent on the 75,000 square feet of cheap space to $36 per square foot, starting immediately. On the rest of the space, I want $42 per square foot, starting immediately. I want a bump of $4 per square foot every 5 years. I won't pay for any improvements to the space, and there's no rent concession. Ross has now established the other parameter of the zone of uncertainty. Go back and tell Katz that's my offer. Ross: I'll discuss it with Katz and get back to you. Ross goes back to his office to compare the Reuben proposal versus the Macklow proposal. Scene 3. Place, Ross's office. Ross and John Williams, a number cruncher at ESG, are present. Ross: John, I ask you to run the numbers on Plan A, the Reuben deal, and Plan B, the Macklow deal. Did you do that? John: Yes. Here is the comparison. Ross: So the total cost of the Macklow deal is $4,855,000 less than Reuben's offer, if we eliminate the loss on the subletting of the existing space. Is that right? John: Yes. Also, I've assumed that Katz's share of any increases in taxes and operating expenses would be the same for both buildings. Ross: Thanks, John. I'll relay this information to the Katz agency. Ross sets up meeting with Greenwald. Scene 4. Place, Greenwald's office at the Katz agency. Present are Ross, Greenwald, and Katz's CFO, Jones. Ross: We've run the preliminary numbers on both deals, and while they look almost equal, a few things worry me. If we go the Macklow route, the cost of your exposure on the Reuben space could be as much as $4 million. Your leases require you to pay that much in rents, whether you are in the building or not. Also, I'm not sure of how much money Katz will have to pay for improvements in the Macklow building, beyond what Macklow has provided. It could be a sizable expense. Since you shouldn't pay rent for both spaces at the same time, I'll have to get assurances that Macklow can cover the remaining rent you owe at One Dog Plaza. Finally, I'm sure any deal will require his mortgage holder's approval, and I haven't started the hard bargaining yet, so I'm not sure they'll okay the final deal I intend to make. I'd like your professionals to satisfy themselves on my estimates of all the cost involved. Greenwald: Jones, please take care of that. Ross to Greenwald: There are some intangibles for you to consider if you go the Macklow route. You can't put a dollar value on them, but they should play a role in your final decision. Each floor in Macklow's building is 30,000 square feet, while the floors in Reuben's building are only 17,000 square feet. The larger floor plate means less traffic between floors and a more efficient operation. You'll need fewer copiers, fax machines, food pantries, and receptionists. These will substantially reduce operating cost. The location of the Macklow building is better than Reuben's. It is more centrally located, close to transportation systems, and more prestigious. You can design a new space to suit your needs instead of trying to update space that is 15 years old. In making a long-term deal, price should not be your only consideration. There's no right price for the wrong item. Think it over and let me know how you'd like to proceed. For the next few months, Ross has meetings with Reuben, Macklow, and the Katz people, the invested time principle. Cost estimates are obtained. Financial projections are created. Space designers and architects are consulted. Use of professionals. Ross is unable to convince Reuben to be more reasonable in his demands. Macklow is anxious to make a deal, but balks when discussing the need for him to make cash expenditures. The executive board of the cat's agency, find the decision makers, convenes to decide what to do. Greenwald invites Ross to participate in the meeting. Final act, scene 1. Place, Greenwald's office after the heated board meeting. Present are Ross and Greenwald. Greenwald: George, you heard the board. They're against spending money to solve a space problem that may occur in 3 years. They're gung-ho for the merger that will cost us about $12 million, and we'll have to borrow it from a bank. They're concerned that if we take on major expenditures, the bank won't make the loan. I think they're right. Unless you can pull a rabbit out of a hat, we'll sit tight and make a deal with Reuben for the additional space we need because of the merger. If we can't make a deal with him, we'll operate out of 2 locations. I hate not to take advantage of a market opportunity, but unless you can come up with a viable alternative, we'll pay you for your time and effort and call you in a few years. Ross: I hear you loud and clear, but I still think I can rattle Reuben's cage so that he'll come up with a much fairer deal. I'd like to use Macklow as leverage. There's no doubt that a deal with Reuben is the way to go if he's reasonable, but there's a slim possibility that I can structure a deal with Macklow that the board will approve. Or even if they don't, I can use it as a wedge to get Reuben to lower his sights. Do I have your permission to try? Greenwald: Go to it, and good luck. You'll need it. Scene 2. Place, Ross goes back to his office to devise a plan to try to convince Macklow to make a deal within the restrictions laid down by the cat's board. Necessary pre-planning. Before setting a meeting with Macklow, Ross prepares a list of important questions, making an agenda before a meeting. 1. How can I make a deal with Macklow where he advances all the money Katz needs for the move to Macklow's building? Answer: increase the rent to repay him. 2. How can I get Macklow to take over the remaining obligations under the lease with Reuben? Answer: quantify the exposure and blend it into the rent. 3. What assurance do I have that Macklow will meet his monetary obligations? Answer: insist on money up front as a condition of signing the lease. 4. I've been told that a major law firm has been negotiating to take a big block of space in Macklow's building, but the deal has stalled. Why? Answer: ask Macklow, or the head of the law firm, or both. 5. I'm going to ask for a low rent and huge monetary concessions from Macklow, and I know the approval of Macklow's mortgage holder will be required. How can I convince them to approve the deal? Answer: convince them a building with a less than ideal lease is better than sitting with an empty building at a time when tenants are scarce. 6. Does Macklow know I'm trying to make a deal with Reuben? Answer: assume he does, but try to juggle both deals. 7. How can I script this negotiation? Answer: you can't. There are too many variables. Just wing it. 8. What do I do if Reuben learns I'm dealing with Macklow? Answer: tell him that is because his deal is outrageous. And if he's reasonable, I'll make a deal with him. After carefully devising the answers to the questions Macklow will probably raise, Ross sets a meeting with Macklow. Ross tells him the cat's agency is ready to make a deal, and Ross thinks, although it's a highly unusual deal, perhaps he can convince Macklow it's a good one, even though he knows initially he won't like it. Aim high, and you'll come out better. Scene 3. Place, Macklow's office. Present are Ross, Macklow, Macklow's CFO, and Macklow's lawyer. Ross to Macklow: Harry, I've gotten the cat's agency to carefully consider taking a lease in your building, but it will require several millions of dollars of upfront money from you. Macklow: George, to tell you the truth, since the building's been vacant so long, I haven't made any payments on my mortgage. If the lender wanted to, it could foreclose and own the building outright. The lender has agreed to give me an opportunity to salvage my investment by finding a deal they will approve. Ross just uncovered a hidden decision-maker. Any money you need to make the cat's deal must come from the lender. I can negotiate a deal and recommend it, but that's as far as I can go. Ross, let me outline the deal I think cats will accept. Hear me out, and let's put our heads together to figure a way to induce your mortgagee to accept it. Here are the basic terms that Katz wants. I'll give you the bad news first. 1. Once Katz makes a deal with you, they want to be free of all financial obligations from the space covered by any Reuben lease. You'll have to assume all their monetary obligations under their leases. That means you'll have to quantify in your own mind the dollar value of Katz's exposure, taking into account the amount you think you can save by subletting or getting a release from Reuben. Then you'd have to agree to pay it when due and recoup it by increasing your rent. 2. Katz's architects figure that the installation Katz will make in your building will cost $8,750,000 more than your building standard. That excess will have to be funded by you, but can also be recouped by increasing the rent. 3. To be consistent with what is presently available in the marketplace, the basic rent must be $10 per square foot below your asking rent. 4. Katz needs $12 million to complete its merger and wants to borrow the money from you and repay it with interest over the term of the lease. Now for the good news. 1. Katz is a financially solid entity that has been in business since 1886. They are an excellent credit risk. 2. Katz is willing to sign a 15-year lease on space on the lower floors, which are the hardest for you to rent. This will enable you to make the deal you've been trying to make with the law firm for the upper floors. Between the two leases, the building will be almost 100% rented in a depressed market. 3. If I get the green light, I can finish the deal with you within 1 week, which means less lost time for you. 4. Using my relationships with your mortgage holder, the importance of building relationships, I think together we can convince them that increasing the amount of the mortgage by the money you need and having a 100% rented building is a much better position for the mortgagee than having a smaller mortgage on an empty building during a real estate recession of unknown duration. Maclow's attorney. There's no way that Reuben will consent to an assignment or cancellation of the leases in the Reuben building. How can Maclow get the benefits of any subletting of that space? Ross. The Katz agency and Maclow could sign a takeover agreement, whereby Maclow is responsible for the rent Katz is obligated to pay under the Reuben lease. Katz would agree to make any sublease of the Reuben space that Maclow requests. The takeover agreement will be structured in such a way to protect Maclow and Katz from a default by either of them. Maclow to Ross. That's the wackiest deal I ever heard of. Ross to Maclow. I agree it's unusual, but I don't think it's wacky. What's your alternative? Is it better to sit with a vacant building and lose it to your mortgage lender? Maclow to his attorney. George has a point there. Draw up the papers, and let's see if we can make the deal work. Maclow to Ross. One thing I need from you. If I go through all these gymnastics and agree to make a deal, I want your promise that you won't go back to Reuben and make a deal with him. Ross. Once the paperwork has reached the level that I feel comfortable that we have a deal, I'll stop negotiating with Reuben. However, until that point, I still consider myself free to negotiate with Reuben. Create an incentive to move quickly. Ross, together with the Katz representatives, spend about 3 intensive weeks negotiating the documents containing the terms set out by Ross and verbally approved by Maclow. When the deal has reached the stage that Ross believes it will happen, Ross sets another meeting with Reuben. Scene 4. Place: Reuben's office. Present are Ross, Reuben, and Reuben's son. Ross. Larry, up to now, you've refused to budge from your prior negotiating position. As a courtesy, maintaining a relationship, I'm here to give you one more chance to change your mind, or you'll lose Katz as a tenant. Ross then tells Rubens the terms of the deal that Macklow is willing to make with Katz. Reuben to Ross: I don't believe that Macklow will honor any deal he makes. He hasn't got the money to do so. Ross: Larry, you've known me for a long time. If I say it can be done, then it can be done. If you doubt it, just stick to your position and watch what happens. Take it or leave it. Reuben to Ross: I don't care what you say. You'll never make that deal with Macklow. Ross leaves Reuben's office and calls Macklow and says, Harry, if you put our deal to bed, I promise you I'm through negotiating with Reuben. Macklow's deal with Katz is finalized and approved by Macklow's mortgage holder. Ross tells Greenwald to call a meeting of the board of directors of the Katz agency to approve the Macklow deal. Greenwald calls the meeting, and Ross explains the advantages of the Macklow deal. 1. Katz gets the $12 million it needs to complete the merger and pays it back as part of the rent under the lease with Macklow. 2. Katz gets brand new space in a new prestigious midtown office building. 3. Katz is protected from its exposure under the leases with Reuben. 4. The larger floor size of the Macklow building creates greater efficiency and a savings in the cost of operations of more than $1 million per year. The Katz board approves the Macklow deal. However, Reuben has a mole on the Katz board and learns of the approval of the Macklow deal. Reuben calls Ross. Reuben to Ross: George, I'm willing to meet the Macklow deal. Let's meet and work it out. Ross to Reuben: Larry, you had your chance, and you said I couldn't do what I said I could do. Now the ship has sailed, and you're not on board. Sorry, I gave my word to Macklow that if he honored his deal with me, I was through negotiating with you. Keep your commitments. Maybe next time you won't doubt my word. The end. Chapter 17. 6 Tactics for Increasing Your Power in a Negotiation. The recurring theme in Trump-style negotiation is looking for ways to satisfy both sides, to structure a deal so that everyone feels that he or she comes out a winner. I experienced an unusual example of this type of negotiation approach when I worked for Saul Goldman and Alex DiLorenzo Jr. in the 1960s. One day, an elderly, disheveled broker came into our offices and handed me a listing for an apartment building in Brooklyn Heights. It was for sale by a family who had built it 40 years before and owned it ever since. The asking price was $860,000. Not knowing whether it might be of interest to Saul Goldman, I showed him the listing. Saul knew all about the property and had tried to buy it years ago but was unsuccessful. He told me he would love to buy the property, and when I told him the asking price, he was shocked because it was so low. He told me to find out how many people the broker had already shown the listing to. So I spoke to the broker again, who told me we were the only real estate investors he'd come to, because we were well known as the #1 buyer of Brooklyn properties. When I told Goldman that, he said, George, if this deal gets out in the market, there will be a bidding war for it. We have to avoid one and move quickly. Tell the broker I'll buy the property for $1 million. I said, Saul, they're only asking $860,000. How can I justify $1 million? He told me, hey, you're the lawyer. You figure it out. I went back to the broker, who was still sitting in my office, and said, my client likes the property, but there's a major problem. The price is too low. The broker didn't understand what I said, and he replied, well, I know they're asking $860,000, but I think they might sell it for $800,000. You weren't listening to me, I told him. The price is too low. If you raise the price to $1 million, you've got a deal. Just bring me a contract for that price, and I'll give you a check for $100,000 as a down payment, and we'll close in 30 days. The broker was thoroughly confused and asked me, why would anyone pay $1 million for something they could buy for $860,000? Reaching for a plausible explanation, I said, my client is an eccentric millionaire, and he won't buy anything costing less than $1 million. That's his style. As I told you, if you come back to me with a contract for $1 million, I'm authorized to sign it and give you the down payment. The broker left my office like a shot and came back the next day with a contract, which I signed and gave him the $100,000 deposit. Now the kicker was that before title passed, Goldman had lined up a non-recourse first mortgage on the property for $1.4 million from a bank. The bank thought it was worth at least that amount. Goldman took title with his own money, and a few months later I closed the loan with the bank without disclosing the original purchase price. By overpaying, Goldman had ensured that he would get the property quickly. With his instinct, he believed he knew the property's true value, and he was right. He made a great deal. If you approach negotiation with the idea that one side must win and the other side must lose, you're not using Trump-style negotiation. Your goal is not to squeeze everything you can out of the other side, but to create a deal they can live with. Both sides in this transaction got more than they were willing to accept, and both walked away feeling like winners. Whenever you can create that feeling, you are executing a Trump-style negotiation. With skill, creativity, and showmanship, you can turn adversaries into allies by showing them how it is possible to make a deal acceptable to both sides. The desired outcome is mutual satisfaction. The last step in explaining how Trump-style negotiation works is to summarize 6 of the most important deal-making techniques you can use. Mastering these basic fundamentals will guarantee you a higher success rate in closing mutually satisfying negotiations. 1. Keep exceptional records. Remember what I said earlier. The side that is more prepared in any negotiation has a better chance of winning. The notes you take during a negotiation serve as a defense against the other side raising new issues or contradicting themselves later. If you are able to refer to a specific discussion, including the date and what was said, you have a compelling argument. 2. Wherever possible, develop your own forms and create the aura of legitimacy. It is a truism that the side that prepares documents decides what goes in and what stays out. The aura of legitimacy is set by you presenting something for signature and authenticating it by saying something like, "This is what I used in a similar deal with GM. If they approved it, it should be fine with you." The existence of a contract, application, agreement, or other document carries the aura of legitimacy merely because it exists, and people have a tendency to believe the written word. 3. If you can, use company policy as a negotiating tool. If you represent a company in your negotiations, simply presenting the argument that is our company's policy will put an end to many arguments. Somehow company policy is like a mandate from God. The other side is likely to realize there's no point in trying to change something as inflexible as company policy. They rarely probe to find out whether or not the policy in fact exists or is that inflexible. 4. Be willing to take calculated risks. You have to play to win. Taking risk may be reckless if you have not evaluated the risk and reward beforehand. But a calculated risk is worth taking if you are willing and able to live with the consequences. For example, if someone wants to delay the final stages of a negotiation, you can calculate that the other side has more to lose than you do by walking away. So it might be worth the risk of saying, "This is my best offer, take it or leave it." Successful negotiators are willing to take calculated risks. Suppose, for example, I make you the following offer. I've tossed this quarter 49 times, and it always came up heads. I'm willing to give you 100 to 1 odds that it will come up heads the 50th time as well. Now, you know the odds are 50-50, so you would jump at the opportunity, right? Let's change the scenario a bit. Assume that your total life savings is $200,000, and I say, I'll bet $20 million against your $200,000 that it will be heads again. The odds haven't changed, but the stakes have, and suddenly the possibility of losing everything becomes a reality. You begin to think, with my luck, it'll come up heads again and I'll be wiped out. You refused the bet, even though it was a well-calculated risk. Any negotiator who has the courage to take risks has an advantage over those who lack the courage to do so. 5. Use time as the ultimate negotiating weapon. Every negotiation has a time element involved in various phases of its development. As long as you are not forced to operate under a deadline governing your side, you can use time as a weapon to control the negotiation. When you are aware that the other side must end the discussion within a specific time and place, don't begin negotiating in earnest until the latest possible moment, because that's when the other side is most vulnerable to accepting your suggestions. You can also make effective use of delay as long as it furthers your agenda or makes the other side eventually come around to an agreement because they get tired of waiting. Deadlines, delays, and deadlocks are all time-related methods of negotiation. Figure out how to use each of these at appropriate times to enhance your negotiating power, and by all means avoid allowing the other side to use time against you. 6. Make and use general commitments to gain concessions. You can make promises to the other side of a general nature to gain the advantage. For example, you can say, I promise that I'm going to see this through until we reach an agreement. This is a moral commitment to not walk away. But if you are going to make such a commitment, you should expect reciprocity. Keep in mind that you can choose to refute your moral commitment if circumstances so require. But if the other side does so, you can remind them of their agreement and get them to continue negotiating. The entire field of negotiation is merely the continual use of diverse methods to communicate ideas that will achieve a favorable result. Some people are effective motivators, and others are not. Some hold their cards close to their vest and carefully control what they do, say, or employ to impress others. Inept negotiators signal when they have a good hand or a poor hand by what they say, write, or the actions they take. Skilled negotiators are easy to deal with, but they get what they want. Your awareness of negotiation skills and tactics is essential to making the process work. You certainly don't want to find yourself in a situation where you're at a disadvantage. And if you do, find a way to delay the proceedings until you've had a chance to create a plan that can reverse that situation. In this book, I have provided you with a series of strategies, tactics, and skills worth mastering. Anyone who studies the philosophy of Trump-style negotiation will eventually be able to apply these skills in his or her own negotiations with other people. I never said it would be easy, but over time, you will create your own databank of what worked and what didn't. The ability to negotiate effectively is a worthwhile talent in any situation, industry, or organization. You will discover that it transcends your professional life and carries over into your personal life as well. You will be better equipped to deal with salespeople, friends, spouses, and children once you gain the insights into what people are really thinking when they say something. You will be much better equipped to be an effective salesperson because that's what a skilled negotiator is. Once you are able to recognize common errors or human nature, you will be a much better negotiator on every level. You're always negotiating. It never stops. Just remember this most important element of Trump-style negotiation. You can only achieve mutual satisfaction and complete the biggest and best deals when you build a relationship of trust and rapport with those with whom you become involved.